high is within striking distance. We're about 150 points away from that level. Just for the near term, on the downside will be yesterday's intraday low of 26,047. That becomes a key support level. On the macro front, we did get one data point for the Indian markets. The November core industrial growth came in at 1.8%. This is for the month of November. There was improvement in coal, cement, fertilizer. And this number, 1.8 core sector data, was an improvement compared to the October, which was just a minus 0.1%. Now, looking ahead for the day, there are no major domestic economic triggers at least. So some global cues will dominate. You will get the delayed US Q3 GDP numbers, where economists are penciling in a growth of 3.5%. The core PCE advanced estimate, again, critical for rate cut expectations. And finally, not to forget, it's the Nifty weekly expiry. Nigel, the monthly expiry will be next Tuesday, but today will be the Nifty weekly expiry.
Well, that's right. And today's expiry will be as big as any because, a lot of people will close out their positions today and not wait for the monthly expiry as well. But let's tell you first in terms of the cash market action, institutions were net buyers because the DI buying outweighed the FI net selling out. So, that was good news. Institutions have continued to buy in this market. And there were signs yesterday that there's a bit of a short covering bounce that's playing out. The Nifty ended higher, the Nifty Bank ended higher, and the open interest on both of them was down anything between 5 to around 6% or thereabouts. And that perfectly tallied in with what the FIs did, both on the index. There are signs of short covering out there. And even on stock futures, there was some kind of short covering on both those two parameters. So clearly there was a short covering bounce that played out and some long addition as well. And if we look at it, the last few days, at the start of the series, the net short positions were around that 85,000 contracts, 87,000 contracts short. Then it ballooned up to around 1.65 lakh contracts. And now that's back down to around 1.44 lakh contracts just in the last few days, telling you the power of short covering. And 21,000 contracts have got closed out, which has helped in terms of this bounce. Mind you, there is still very much net short. 89% of their positions are on the short side. Moving to the option side of things, well, yesterday there were clear signs that the FIs were writing puts, which gives you some kind of hope that maybe the lower levels will be supported. Just one word of caution, the PCR has moved to around 1.4. Normally, when it moves to the upper end of the range, 1.55, 1.6, you see some consolidation or a mild pullback. We're moving closer to the upper end of the range at around 1.42. And last week, I had pointed out that we were at the lower end of the range. And at the lower end of the range, you do see some kind of a bounce. But at the upper end of the range, sometimes, tells you the put writing is getting too easy. So keep an eye at 1.6 is the upper end of the range. And that's because yesterday you saw writing 26,100 put, 26,200 put. On both those two strikes, the premium did come down drastically. So if you look at the technical levels and you look at the options data, the 20 DMA becomes very important, which is at around the 26,000 odd mark. That's where the options data is indicating support. That's where the 20 DMA is as well at. And the all-time high is 26,326. I think we get to that before the end of this year itself, just a couple of 100 points away. Probably even in today's trading session, the bulls will want to drive home the advantages. But they'll require, the support of the Nifty Bank because yesterday's trade, it was actually a bit of an underperformer, though we continue to see support at around that 58,500 mark, which incidentally is the 50 DMA. A stock that I'll be looking at today is Chola. The stock yesterday ended closer to the low point of the day. The stock was down close to around 3.5%. And there are massive shorts in the system. There were some unconfirmed reports, speculative reports actually. But a lot of sell-side analysts are rubbishing that. So, the shorts in the system, they may have to run for cover today. Chola is the stock, in fact, that I'll be keeping on my radar for today's trading session.
Okay, all right, Nigel. Thanks very much for that. So a lot of cues to watch out for. I'd be looking at Coforge, which is the meeting for fundraising on Friday, as well as Granules, which has a fundraise board meet today as well. So those are a couple of stocks I'd keep on my radar. But let's get in some global perspectives. Stephen Englander, who's the Managing Director, Global Head at G10 FX Research and North American Macro Strategy at Stancy Bank, now joins in this morning. Steve, thanks very much for taking the time out. I'm sure you're going into your Christmas break, but just wanted your thoughts in terms of where we might end up the year, considering that we're just about kissing distance away from record highs on the S&P, as well as for the Indian markets.
Thank you very much. It's always a pleasure to be on with you. Look, there's nothing that prevents the market from continuing the trends that we've seen. I think the issue is whether once we start serious trading at the beginning of next year, whether these trends are going to be maintained. Equity market trends, I think there's reason to be optimistic that investors are kind of looking at the potential for stronger activity than was expected earlier, stronger productivity growth, decent profits. So I think that that part of the market may be better supported. The question of whether inflation is as low as the CPI suggested, whether the Fed cuts as much as the market is beginning to think, I think that could come back and haunt parts of the market at the beginning of next year, because I think the market's going a little bit too far in its buy-in of those data trends.
Hi, Steve. Good morning. Good to see you in. Getting into 2026, though, what kind of performance you're expecting from equity markets first? Because this year, clearly, you have the mother market that's done very, very well. And select emerging markets as well have done well. What would your pecking order be in terms of performance on equity markets in 2026? Does India feature top of the list?
Well, I wouldn't say it features top of the list, but it has surprised in terms of growth, and that could be supportive of Indian equity markets. But we're not that optimistic on how the rupee is going to trade in the coming year. This episode of dollar weakness, we think is likely to be temporary. It could continue to year end, but probably won't continue into next year. What India has going for it is that growth keeps surprising on the upside, and that's hard to ignore in a world where growth is mediocre. But the competition does come from the U.S., and I think the question will be which market the investors choose to buy in.
Stephen, your thoughts on gold? Historically, gold was always seen as a hedge against recession, a hedge against geopolitical tensions, basically for diversification. So when there was instability, gold prices went up, and then when things calmed down, you saw gold prices retreat. But just the environment we've been, now it appears that geopolitical flashpoints are not episodic. It almost seems to be structural. We're constantly dealing with it. So with that backdrop in mind, do you think there is a possibility that, gold going ahead, I know it's had a fantastic run up for the last 2 years in a row, but maybe gold needs to be a part of your portfolio in a bigger way now compared to what we thought about it maybe 5 years earlier?
Well, I don't know if it needs to be, but it certainly seems to be something that everybody's making a bigger part of their portfolio. And we expect gold prices to hit new highs. We don't think we're done yet with the gold rally, or the commodity price rally in general. I think what it's telling you, when you look at the two, asset markets that are really doing well, equities and precious metals, I think what it tells you is that there's some confidence in economic activity. And there's some confidence that money is going to be relatively easy. But there's not so much confidence in fiscal management anywhere. And so, gold is serving as a hedge, both against uncertainty, against geopolitical issues, and against risk. So, I think it's telling you that there's some fear of economic mismanagement, even though there's optimism about economies doing relatively well on their own, sort of independent of what policymakers are doing.
Steve, wanted to get your thoughts on the rupee as well, because it's been a rough year for the rupee. We've recovered from those record lows of around 91. We're holding above those levels at this point in time. But what's your sense? Where are we headed when it comes to the currency?
Well, we think we'll see the rupee above 90 again. We don't think that this is necessarily the end of rupee weakness. We don't think it's going to be a terrible currency, but I think it's surprised a lot of people on the weakness. I think we'd have to see economic growth really surprise us, and the RBI kind of really surprising us and in terms of the stance that it takes. But I think that if we're right that the dollar gains because of the strength of U.S. equity markets, U.S. productivity growth, the rupee won't be the worst currency, but it's not going to be the best.
Any levels that you have in mind where it could stabilize?
No, we don't think it's going to be terrible, but we see room for it to go back over somewhat over 90. Not, nothing exciting in terms of where it goes, but not really seeing this as the beginning of a extended rally.
All right, we will slip into a short break on... Sorry, Stephen, we'll thank you for joining us. Let's also tell our viewers the interactions that we've lined up on the show today. So first up, 8:35, we've got Jyoti Gupta of Nirmal Bang joining in to discuss the cement sector and Ambuja Cement's board note for the amalgamation of ACC Orient Cement, what the swap ratio tells us and who does it favor. At 9 a.m., we will be joined by Harshit Kapadia of Elara Securities to discuss the railway sector amid the revision of ticket fares. IRCTC was in focus yesterday on the back of that. 9:20, Trideep Bhattacharya of Edelweiss AMC will be our market master for the day. 9:35, we begin Corporate Radar and the management of Masgao Docks will join in to talk about their outlook for the second half of the year. And following that, the management of Chalet Hotels will join in at 9:45 to outline their outlook for calendar year 2026. And towards the end of the show, former RBI Governor D. Subbarao speaks to Lata Venkatesh on the current rupee decline, foreign funds selling and the India growth story.
Time to slip into a short break. We've got a lot of stock-specific action to track for you in our special Top 10 segment. We're looking at ACC Ambuja, Orient Cement, HCL Tech, Ramco Cement, Prestige Estates, Anthony Waste Handling, Sangvi Movers and Paytm. They'll be reacting to positive news flow, while Bell Rise will be the only stock that will be reacting to negative news flow.
Runway. And you can catch that interview with Umesh Revankar at 9:30 p.m. right here on CNBC TV18. Now, the Supreme Court's decision to strike down electoral bonds, failing to make a dent to political funding. The Election Commission has released all political donations made by individuals and corporations in the last financial year before the Lok Sabha elections were held. The BJP has mopped up more than 6,000 crore rupees with a 50% surge in funding before the Lok Sabha elections. Congress a distant second with over 500 crores. The Tata Group has emerged as the largest funder of political parties. Santya joins us now with all the details. Santya, take us through the data on who's funding whom and by how much.
So, Shireen, the Election Commission of India has released its latest contribution report. So why is this report important? Because it clearly shows who donated how much money to which political party. It is significant because this is the first time since 2018 that detailed information on donors, donation amounts and party-wise contributions has been made public following the scrapping of the electoral bond scheme by the Supreme Court in February 2024. So who took the biggest chunk of the pie? Once again, the BJP emerged as the single largest beneficiary of political donations and got the lion's share of corporate donations. It received 6,088 crore rupees. The party's share of total funding jumped from 56% in 2023-24 to 85% in 2024-25. The Congress received 522 crore rupees, sharply lower than last year's 1,130 crore rupees. Taken together, opposition parties, including the Congress, received a...
Welcome back. Still tuned into Bazaar Morning Call. Let's get our research team now. They're standing by with the CNBC TV18 list of the top stocks that you need to track for today. Well, Nigel, we're going to kick it off with the entire cement space. We're going to see the big amalgamation of ACC and Ambuja. Tell us more.
Well, that's right. Finally, it's happened, right? The long-awaited and anticipated merger of Ambuja Cement's units have been announced, and it'll create one cement platform, for the group itself. The board has approved the amalgamation of ACC as well as Orient Cement, which will bring ACC, Orient, Penna and Sanghi, all of them under one entity. The ratio should come up for you on the screen. Ambuja will issue around 328 shares for every 100 shares held in ACC, which is pretty much in line with what the stock prices ended yesterday. And Ambuja will issue around 33 shares for every 100 shares that one held in Orient, which tilts the scales a little in favor of Orient shareholders because that premium is close to around 8 to around 9% or thereabouts. So you need to keep in mind Orient Cement, well, the stock price is less than half of what the initial transaction was done in at. For the time being, Orient Cement shareholders will be happy because it's not as bad as what they thought. Everyone was worried that the ratio is going to be very, very heavily stacked in favor of Ambuja Cements. The transaction should be completed in the next 12 months or so, subject to regulatory approvals. You'll be asking, what are the benefits? Well, it simplifies the group structure. If someone was giving a company discount, that goes away. Most brokerages were not giving that, but that's one positive. The second factor is it improves transparency, governance standards, because now that master supply agreement or that MSA or related party transactions, they are done away with. It also aligns with Ambuja Cement's plan to increase the cement capacity from around 107 million tons to around 155 million tons by 2028. And the management is also talking about 100 rupees per ton that they will gain from supply chain efficiencies. While Nirmal Bang analysts, well, they say that there could be an additional 40 to 50 rupees benefits over the next 2 to 3 years, which is expected from improved tax efficiency and working capital optimization. So those are all the benefits. Since there'll be some dilution, the promoter holding will come down to around 61% from around 68%. Net-net, amalgamation will have a neutral to a positive bias on the entity. The big gainer in all of this will be Ambuja Cements, because they are getting all the entities consolidated under one. They're getting scale as well as size. And Orient Cement, because that ratio is favoring those shareholders. So those stocks should react positively in today's trade.
All right, I'm going to watch for HCL Tech because HCL Software, which is a business segment under the listed entity, has made two announcements, made two acquisitions. The first one is they will be acquiring Jasper Soft for $240 million, which will accelerate the company's agentic business intelligence. So payout is $240 million. The company has not stated what the revenue of the acquired company is. The second acquisition is a smaller one. It's a Belgian startup, early stage, Wobby, which specializes, again, in AI data, etc. And $5.2 million is the payout. As I said, this is a smaller one, $5.2 million. And even the acquired company had negligible revenues, like 0.1 million euros. This is for HCL Software. So basically, HCL Tech has three key business segments. The big one is the services business. Second one is ER&D. And the third one is HCL Software. So all these three, so it's operated independently, but it's a part of the listed entity. So these acquisitions will feed into HCL Tech. But we know the payout, like close to about $250 million for the two of them, a little less than that. But we don't know what the acquired revenue will be. But the capabilities are clearly AI.
Okay, all right. The capabilities are clearly AI. HCL Tech, along with a lot of the IT stocks, did well in yesterday's trading session, so ended up the high point. But Vivek is here to tell us about Bellrise Industries and why he's looking at that. Vivek, over to you.
Well, that's right. So Bellrise Industries will be in focus. As per term sheet we managed to access today morning, we understand that one of the promoter entities called as Sumit Tools Private Limited, is looking to offload close to 6.56% stake of the total equity. Total size of the particular block deal that they're looking to pair the stake at works out close to 897 crore rupees. The offer floor price is at a close to 3% discount to yesterday's close, so 153.7 is where the floor price is at. After this particular block deal, this particular entity, Sumit Tools, will not have any stake. Now, the other thing to watch out for is whether this particular block deal happens in the block window itself, post which will be interesting to see how the stock reacts.
Okay, all right. Thanks a lot for that, Vivek. Ria is here to track Ramco Cements. Yesterday, towards the end of the trading session, they had made an announcement, I think 3:15 odd, and Prestige Estates as well. Ria?
Well, yes, Nigel, first up on Ramco Cements, the company has sold non-core assets worth roughly 515 crore rupees to Prestige Estates to pair its debt. And with this, so far, the company has disposed roughly non-core assets worth roughly around 1,017 crores versus their initial target of 1,000 crores. And apart from this, the company has also taken effective steps to dispose of further non-core assets worth approximately 200 crores. And this is to be done before February 28 of 2026. Moving on to Prestige Estates, they have announced the acquisition of a 25-acre land parcel in Chennai. The site is proposed to be developed into a large format project, and it has a development potential of roughly 5 million square feet. And the estimated top line potential from this is 5,000 crores. Now, the company has said that the location is well suited to meet the city's sustained mid-segment housing demand. And remember, in H1 of FY26, Chennai contributed roughly 4% to the company's sales. And overall for FY26, the company has guided for roughly 25 to 27,000 crores of pre-sales. And in H1 so far, they have already crossed around 18,000 crores.
Thank you. Moving on now to more stocks which are in the news. Vinny joins in. Vinny?
Hi, good morning. So firstly, we have Anthony Waste, which we're expecting to open up on the green as one of its subsidiary has received a contract for development of 600 to 800 TPD mixed solid waste processing plant. This is in the state of Maharashtra. The contract size is around 330 crores. The time period for this contract, the tenure is around 10 years as well. So positive here. Sangvi Movers, we're expecting positive here as well. The renewable subsidiary of the company has secured a large work order for around 430 crore rupees. This is from multiple independent power producers. It's an EPC project that's come in with a combined capacity of around 270 megawatt. Lastly, we have Paytm also, where we could expect to see some bit of a green here. They've expanded into the overseas they're expanding their overseas footprint with new subsidiaries in Indonesia as well as Luxembourg. Other than that, the company's also said that its Paytm, Arab Paytm Payments LLC, which is the subsidiary of the company in UAE, is diluting some stake as a strategic investment. This is to Abar Global Opportunities Holding. That's a special purpose vehicle that will be created over here, and they'll be issuing them around 76,800 equity shares, which will represent around 49% stake post the issue as well. So total investment that would come in would be around 20 crores because of this. That's something that we'll watch out for as well.
Okay, bunch of stocks there. Thank you, Vinny, for bringing us all of those stocks in focus. Let's, in fact, quickly recap all of our top stocks. Stocks with positive news flow today are ACC, Ambuja Cements, Orient Cement, HCL Tech, Ramco Cements, Prestige Estates, Anthony Waste Handling, Sangvi Movers and Paytm, while Bellrise Industries is the only stock on our radar that is likely to see some red. All right, let's go across to Manisha Gupta, commodities editor. She joins in with a roundup with all the action from the commodity space in the market overnight. Manisha, over to you.
Thank you so much for that, Ekta. Well, I'll start with the precious metals because yet another day and yet another all-time high is what we are dealing with when it comes to gold and silver. So gold has gained 2% overnight and it's hit a new record highs around $44.85 an ounce. So we are inches away from that $4,500 an ounce when it comes to gold. Well, there's a lot of buying that has continued, fund allocations as well before they head for those holidays. And it's not just gold. Take a look at silver prices. We've seen 4.5% of gains here, and we are inching close to $70 an ounce. Gains also seen when it comes to base metals as a space. Copper prices gained up by 1.5%. We are trading at all-time highs on LME, 5-month highs on COMEX. Aluminum prices are trading at 3.5-year highs. You have nickel, which is trading at a 2-month highs. Zinc prices trading at a 5-month highs. So everywhere that you look at in metals, it is a strong gain. It is about supply concerns, dollar index trading on a weaker side as well. What is also gained in the Asian markets right now is the crude oil prices, with U.S. pursuing oil tankers off the coast for Venezuela and Ukraine continuing to strike on Russian energy factors. The crude oil prices in this week also are headed on a positive note. So $62 a barrel is back when it comes to Brent right now.
Everything is up. Gold, silver, crude, base metals. Manisha, thank you very much for that. We will slip into a very short break. On the other side, we'll put the spotlight on the cement sector. Jyoti Gupta of Nirmal Bang will join in, and special focus on the Ambuja Cement Board's nod for amalgamation of ACC and Orient Cement.
Crore rupees. So who were the top donors? The Tata Group was the largest individual donor, contributing 757 crore rupees to the BJP. L&T linked Elevated Avenue Realty donated 500 crore rupees, and Megha Engineering and its promoter donated 320 crore rupees to the Prudent Electoral Trust, the biggest BJP donor trust. Hinduja Group, Mahindra Group, Naveen Jindal faction of the OP Jindal Group, RP Sanjeev Goenka Group and DLF donated over 100 crore rupees, Shireen. The Serum Institute of India donated 100 crore rupees to the BJP. Torrent Group, Bajaj Group and ITC were other key donors. Shireen.
All right, Satya, many thanks for joining us. That's the latest as far as political donations in FY25. public data now being released. The union government has rejected concerns that the new definition of the Aravalli Hills based on a 100-meter elevation weakens environmental protection. Union Minister Bhupendra Yadav says the Supreme Court's order, in his words, has been misinterpreted after it sparked protests across North India. Activists and farmers allege that the new definition would proliferate mining and construction activities. They also fear that this could accelerate desertification of the region. Addressing a press conference again today, the minister said that currently only 277 square kilometers, which account for less than 1% of the Aravalli range, are open for mining. He said all current protections applicable to the Aravalli ranges will stand. Here's more on the Aravalli flashpoint and why activists have raised concerns over the ecological ramifications of the new definition. Remember, all of this is being said outside by the government. It will be interesting to see whether this is taken to court.
Aravalli bachao, desh bachao! Desh bachao, desh bachao!
Welcome back. Well, let's get some fundamental analysis going. We have Parag Thakkar, Senior Fund Manager at Fort Capital, who joins us on the show. Hi, Parag. Good morning. Good to see you in Parag. Let's talk about the sector of the last few days, the NBFC space. Shriram Finance, they've come out with that big deal that the street was sniffing. The good news is, even after the deal that was much anticipated, you've seen the stock gain 6 to around 7% post-announcement. Your view on the stock, and also what does it mean for a company like Chola? It always enjoyed these premium multiples. Now there appears a bit of a shift that's taking place out there. But there were fears with regard to some kind of a Cobra post, and most sell-side notes that are coming out today, they believe that it's not anywhere close to as severe as what the street was fearing. So your view on both these names?
Yeah, so first of all, I would like to say that I have kept a huge conviction on financials all throughout because I have faith in Indian economy, and then financials are leverage proxy to play the economy, which is growing at 7.5%. Plus the credit cost across the financials are under control, and that will attract definitely a lot of foreign capital, and that has been, we have seen in so many cases, right? Yes Bank, Samman Capital, IDFC First Bank got money from Bogo Pincus. This one, various financials attracting a lot of capital, FDIs, I would say, because here is a sector which can grow at 12 to 15% very conservatively, and credit costs are under control. So I would like to say, and Shriram Finance, to be specific, it is a book value accretive transaction. Book value will go up by 20%. And ROAs will go to say 3.6, 3.7%. So even at today's price, it is right now trading at 1.9 times. So I would say that any fall in such kind of name will be a good buying opportunity once the trade fizzles out, and the people who have short-term trading profits, they book out. After that, one can clearly look at it. Coming to Chola Finance, I would like to say that I also read the Cobra Post thing. I also don't find anything material in that. Let's see if the market reacts very negatively, which I don't feel it will react. But if it reacts negatively, that will be a good buying opportunity in that name also. Because in vehicle finance, we have seen auto sales going up, right? For example, October, November, MHCV volumes were good. Even December Vahan data is showing 24% growth in MHCV. So I would say that vehicle finance, in fact, we have bought Tata Motors CV in last week only, which is current price around 410. We bought closer to 400. So I'm saying that I have a positive view on this NBFC space, as well as especially vehicle financer names, whichever comes. So I think the Chola can provide opportunity, but let's see. As you rightly pointed out, all sell side guys, and including buy side guys like me, we don't believe in this note of Cobra Post. Let's see. And Murugappa is a trusted management since last so many years. So although the valuation of Chola is slightly elevated, I would say. Even today, after such a big run in Shriram Transport is cheaper than Chola.
Okay. Well, basically, the Cobra Post, for those of you who missed it, Cobra Post is alleging that, with Cholamandalam, there are transactions upwards of 10,000 crore rupees, which are related party transactions, involved in a network of the Murugappa Group entities, to which analysts saying that this payments made by Chola to other companies within the entire, Murugappa Group is industry practice. They also went on to say, analysts have said that they don't find the remuneration paid to auditors' fee excessive. The payment of fees which are made to credit rating agencies are also a global practice. For at least for now, the allegation by Cobra Post seems to be related to related party transactions of 10,000 crore rupees, which analysts, at least as of now, don't find to, very concerning. But we'll wait by to see if there is any official confirmation from any official word from the management. Parag, yesterday the big stock was GE Vernova TND. Do you look at that? I mean, what is your view on HVDC? I mean, stock has had a fantastic run up, but from here on?
No, so I will not comment on the stock's specific name in this sector because we don't own this sector's names. But I would like to say that, one of the biggest bottleneck in the power sector today is transmission. So any company which caters to transmission space and where it has a good competitive position will do well. Now, valuations is a different ballgame. Most of the companies in this space are very richly valued. So that is why we have ignored this space. But definitely, from need of the ecosystem perspective, definitely transmission grids needs to be strengthened significantly, and all the players in the ecosystem will benefit.
Got it. Parag, request you to stay with us. Let's focus on the big cement amalgamation that was announced late last night. Ambuja Cements, well, they approved the amalgamation of subsidiaries ACC as well as Orient Cement with the company to create a pan-India cement powerhouse. Jyoti Gupta, Senior Research Analyst at Nirmal Bang Institutional Equities, joins us on the show. Hi, Jyoti. Good morning. Good to see you win. Luckily, you're not traveling. A lot of analysts got stumped out. Suddenly, out of nowhere, at around 9 p.m., this announcement did come in at. But tell us, what are you making of it? CLSA, they put out a note. They're saying that the amalgamation of ACC Orient with Ambuja will lead to 10% value accretion for Ambuja shareholders as per their scenario analysis. Do you have a number with regard to how much of value accretion could be there for Ambuja shareholders?
Good morning and thank you for having me on the show. So, this proposed merger is definitely will have a significant impact on Ambuja Cements. It'll actually address long-standing structural inefficiencies that persisted since the wholesale era. And for shareholders, I think the value accretion should be higher, more than 12%, as per my numbers. So 10-12 possibly currently at this point of time, but maybe going forward it should be higher for the shareholders.
Okay, all right. And, I guess there is a bit of an arbitrage that's there for Orient Cement holders. But, some minority shareholders, whether it's on my LinkedIn or various other platforms, they've been writing to me. They're like, Ambuja bought this asset at around 395 rupees or thereabouts. And now they're doing this merger at 170, 175 rupees. Any comment on that? I mean, there's a 9%, premium in comparison to yesterday's close price. But you want to comment on that?
I think you won't see much for minority shareholders. It would be anywhere between 7 to 8%. I think 9% also for me, I think it's a little high. I think somewhere around 7 to 8% is what you should expect.
All right. So net, Ambuja is the way to play it. Could you tell us what is your current target price that you have? And also, I was going through your note, besides the 100 rupees that the management is talking about in terms of savings, you are factoring in another 50 to around 60, 40, 50 rupees or thereabouts. Explain that to us.
So basically, I see, there will be working capital and tax benefits which are likely to come over a period of 2 to 3 years. Mainly from optimization, which are going to support the cash flow generation. Also, what you need to see is the impact of process, which I think is excluded from this entire, cost saving metrics. So that should also have an impact of 160 to 200 rupee per ton. So basically, synergies plus process plus your, overall, the tax benefits of 40, 50 is what I'm saying. I think broadly it'll be the same range. So that's the kind of improvement that I see from this merger.
And Ambuja Cements moves to around 1,500 rupees of EBITDA per ton in the next few years. Is that something you're factoring in?
I think 1,500 plus by FY28, it should happen.
By FY28. And in your pecking order, could you tell us where does Ambuja come in? And what is the target price currently you have on Ambuja Cements? Will you tinker with it?
I think Ambuja has been my top pick in large caps, followed by Ramco and Nuvoco in the small caps. So that has never changed in the last 2 years, ever since I joined as a research analyst. So and my target price is anywhere close to 690. I think it should surpass my estimate as well.
Okay, just a quick word, getting into 2026, that consolidation has taken place. The top 5 players from having 50% of the market, in the next couple of years, will go to around 65% of the market. And now some of these acquired assets are going to ramp up, plus we have additional supply that's coming in there. In this sort of a scenario, will you play the large caps rather than the mid cap, small cap companies?
I will play Ambuja in the large cap, but having said that, you see the additions which are coming is basically grinding capacity. So when you have grinding or blending capacities coming in, we don't take that as an increase in capacity supply. It's always a clinker units. If you are adding more of clinker units is where I say it's an addition to supply, but not for grinding and blending units.
Got it. Okay. All right, Jyoti. And since you're with us for the cement industry, everyone talks about those green shoots, but then those green shoots, they just move away. The kicking the can down the road has been taking place for the last few quarters. How are you reading the demand scenario as of today? If you could help us out, because there was some slowdown in October, November, then there's a pickup in December. Birla Corp's management as well indicated the same. On demand as well as on pricing, how are things looking for the Q3?
So as far as I understand, Q2 has been very good on a low base. Third quarter, we are sitting somewhere at an 87.5 million ton industry number, slightly higher for Q3 FY25. Now Q4 October month was slightly weak. Still, if I say it was flat, November was a double-digit growth, and assuming that December is again flat, which is not the case at all, we should still see a high single-digit for the industry, or maybe for some large players, a double-digit growth as well. So I don't see the demand looking. In fact, I met somebody yesterday who said that Eastern UP is very strong around double-digit growth. South is doing very well. West is stable. North is doing very well. East is around 3 to 4%. So I'm not really looking at a low single or a 5 to 6% growth. It would be higher for the industry. Fourth quarter, definitely it's going to be very well. We may expect price increases maybe in the month of Jan, while the volume will dominate the quarter from mid of January. So overall, Q3, Q4 and Q1 of FY26 definitely look very well to me.
Okay, all right, Jyoti, we're going to leave it on that note. Thanks very much for joining in. So the management has said that around 100 rupees per ton would be a saving or synergies that we would eventually see from this amalgamation. But Parag Thakkar is still with us. Parag, let's shift focus away from the entire cement space. Just wanted your thoughts on Prestige, because they seem to be going quite aggressive in terms of land parcel acquisition. They've acquired a 25-acre land parcel in Chennai with a revenue potential of around 5,000 odd crores. Any thoughts in terms of how you'd approach that stock?
So we don't have Prestige Estates in our portfolio. We have DLF, and we always like DLF and Aurora Realty in the real estate space. And real estate space is right now going through a little bit of sluggish phase, as reflected by stock prices also. But in my view, in medium to long run, lower interest rates should benefit this sector. And hence, we remain positive on DLF. DLF is a huge rental income, the business which I love the most.
Okay, all right. Well, Parag, we need to take a break on that note. But up next, we're going to get talking on the technicals. We have Sudarshan Sukhani joining in and Nitish Thakkar to tell us what they're tracking today in terms of the techs.
माननीय न्यायालय का जो फैसला आया अरावली के खिलाफ, उसका हम विरोध करते हैं। अरावली न कोई राजस्थान की, बाकी पूरे देश की दिलों की धड़कन है। मैं समझता हूँ हमारी आत्मा हमारी माँ के समान है। अरावली के साथ छेड़खानी हम नहीं होने देंगे।
जो भी आदेश दिया उसको वापस लिया जाए और जो अरावली पहाड़ है, ये हमारी रीढ़ की हड्डी है, इसी से हमारा पालन पोषण भी होता है, पशुओं का भी चारा होता है, जो भी कुछ होता है जो हमारा यहीं से होता है।
कुछ नहीं बचने वाला है, सारी बायोडाइवर्सिटी जाएगी, सारे जानवर मरेंगे, सारे बर्ड्स मरेंगे। तो प्लीज मैं एक साइंस के स्टूडेंट होने के नाते कहना चाहती हूँ कि ये गलत है।
बीजेपी की सरकार की कमेटी की रिपोर्ट के आधार पर सुप्रीम कोर्ट ने फैसला दिया है, और जो सुप्रीम कोर्ट ने फैसला दिया है वो फैसला गलत है, उस फैसले को हम स्वीकार नहीं करते। अरावली के मुद्दे पर पूरा राजस्थान एक है।
भारी विरोध करते हुए इस विरोध को जारी रखेंगे, और जब तक इसके रिवीजन पिटीशन दायर होती है जब तक हम विरोध जारी रहेगा।
राज्य उदयपुर की सौंदर्यता है, जिस कारण यहाँ पे पर्यटन आ रहे हैं, जो सौंदर्य है वह इस अरावली के कारण है। अरावली के कारण मेवाड़ है, और इसका संरक्षण बहुत जरूरी है। इस संबंध में हम ज्ञापन दे रहे हैं कि सरकार रिव्यू पिटीशन फाइल करे।
Environmental activists and opposition parties across 4 states are protesting after the Supreme Court delivered an order on the 20th of November accepting the recommendations of a central government committee on a new definition for Aravali Hills. According to this new definition, any landform with an elevation of 100 meters or more above local relief is an Aravali Hill. Aravali Range, on the other hand, is a collection of 2 or more hills within 500 meters of each other. This definition was recommended by an Environment Ministry-led committee comprising of representatives of Gujarat, Haryana, Rajasthan, Delhi, Geological Survey of India and the Forest Survey of India. Here is why experts are worried. They say the new definition will encourage mining, construction and commercial activities. According to some activists, only 8.7% of the Aravali landform
Welcome back. Well, let's get in some more statistics now. We have Hormuz joining in. He has all of the big movers in terms of data and which saw heavy volumes of trade yesterday. Hormuz, over to you.
Good morning, Ekta. And lots of broader market names that were moving, and railways was one such theme that was doing well yesterday, and particularly on strong volumes. And one such name was Jupiter Wagons, that was up almost 20% in yesterday's trading session. It was the biggest single day gain that the stock saw since June of 2020. And volumes on Monday, of course, they were the highest on record, and they were the sum total of the last almost 70 sessions put together. And 7.5 crore shares were traded on Jupiter Wagons yesterday. The 20-day average is less than 8 lakh shares. Now, but however, despite the very high trading volumes, the delivery volumes are very low. Only 6% of the total traded volumes are marked for delivery of 44.5 lakh shares compared to a 20-day average of 3 lakh shares. And the stock has been a bit of an underperformer, down around 43% from its 52-week high levels of close to 550. Now, Infosys was the other one. The stock was in the news over the weekend with all the news that it garnered with regards to its ADR. The stock did well in yesterday's session. The volumes were the highest since July of 2024. 2.5 crore shares were traded yesterday. The 20-day average is only 80 lakh shares. And here you saw significant delivery-based buying because 75% of that was marked for delivery. Almost 1.75 crore shares were marked for delivery yesterday. 20-day average of less than 50 lakh shares, and the stock is now just 6% away from its buyback price of 1,800 rupees. You have to keep an eye out today because the ADRs yesterday were down around 5.5% overnight. And lastly, Cross Limited, we've mentioned about this in our Under the Lens segment as well, and the biggest single day gain since November of 24. Volumes were the highest in 4 months. 28.5 lakh shares traded, 20-day average of less than 3 lakh shares. 7.5 lakh shares marked for delivery, the 20-day average of less than 1 lakh shares. The stock is now nearing its IPO price of 240. Now, why that is significant? Because it has never traded above its IPO price, which is 240 rupees a share.
Got it. All right, Harmas, thanks a lot for that. Let's hop across to Sudarshan. He's gone through a lot of brokerage notes. Sudarshan, what are you picking up?
Good morning, Nigel. So I'll start with Pine Labs. Morgan Stanley has initiated coverage. Pine Labs got listed in the month of November of 2025. And now Morgan Stanley has initiated coverage with an equal weight call. And target here is 260. And that implies an upside of almost 12% from current levels. It believes that company is a leader in its focus segments. And also it benefits from first mover advantage and a strong partner ecosystem. It projects 19% revenue CAGR over FY25-28. And the shift towards an asset-light mode model to drive EBIT margin to 20% by FY28 versus 3% EBIT margin that company reported in FY25. But it has an equal weight call because valuations as per Morgan Stanley is fair at the current levels. Second one is Nuvama has returned on Century Ply. It has a buy call and target here is 1,028 per share. It believes that company is confident of achieving rupees 12,000 crore revenue target by FY31, and that is basically targeting 18% CAGR. Some of the catalysts that it has mentioned: plywood execution is strong, MDF margin shall turn around from S2 of FY27, and laminates turnaround is in progress, and particle board to record EBITDA break-even by Q3 of FY26. So basically this quarter.
Thanks a lot for that, Sudarshan. Parag Thakkar is still with us. Parag, any of those stocks you like? Century Plyboard, Pine Labs, the few brokerages that...
Sorry.
Please go ahead.
We have Greenply in our portfolio. We have recently bought Greenply in our portfolio, where we feel that, again, as this report also highlighted, MDF can revive, and they are putting up a new plant also. Plus, plywood will grow at 10%. I think, and in last quarter, there was a shutdown, so I think margins will also revive. So we hold Greenply in our portfolio as a disclaimer. Of course, your investors are please advised to take advice of their financial advisors and then take a call. So this is a stock we like.
And Greenply trades at a sharp discount in comparison to Century, if I remember correctly.
The market cap is too small compared to the brand value which it has. It might do a revenue of 2,800 to 3,000 crore next year, and the entire market cap is 3,300 crore only with 500 crore net debt. So enterprise value is below 4,000 crore. It's a branded business which trades at 1.2, 1.3 times EV to sales.
Okay. Parag, have you looked at Bellrise? That large block or large trade which was supposed to take place has now been executed. It's worth around 897 odd crores. It's a recent listing. Any thoughts on that counter?
No, so we have not studied this stock very precisely. But I would be constructive on many auto component names. We have many other names in our portfolio which are auto component, like NRB Bearings, Mindacorp, and the various other auto component names we like, and especially now CV suppliers also. So, but not any specific view on Bellrise.
Okay, all right, Parag, I believe there's a fundraise meet for Granules as well. We'll be trying to get the management post that. What's your view on the stock?
So Granules is a stock which is one of our largest small cap holdings since long, after the stock corrected from 725 to 450 levels due to that Hyderabad unit inspection. We believe that, see, if even after that unit not operating optimally, this company is, for example, Q2, their earnings were up by 30% YOY. Net debt to EBITDA is below 1x. So it's a huge cash flow generation and 15% and above ROC. So I would like to say that a company growing at 30%, that to in a finished dosage form, which they supply to US, and the US business is doing extremely well. So in my view, it's a company with 14,500 crore market cap, net debt of below 1,000 crores, and it is going to generate 1,000 crores cash profit next year. So 6 to 7% cash flow yield, above 15% ROC. So still very constructive on this name, although we have bought it from very lower levels.
Okay, absolutely. Well, anyone who bought it at its 52-week low of around 421 odd rupees is sitting on good gains of over 40%. It had hit those levels earlier this year and very close to its 52-week high of around 621 rupees. So going in strong into that fundraise board meet, which is scheduled for today. We'll take a short break on that note, but we'll come back with the pre-opening, and also with us will be Harshit Kapadia of Elara Securities to discuss the railway sector amid the revision of ticket fares. And we will be connecting with Sudarshan Sakani and Mitesh Thakkar for some tech calls as well.
Experts say 90% of the Aravalli range in Rajasthan will be vulnerable after this new definition. Overall, a substantial portion of the Aravalli Hills across 4 states will become unregulated. According to experts, this definition could lead to massive ecological damage and desertification. Aravallis play a crucial role in preventing desertification and maintaining groundwater levels. There's a worry that the new definition will increase the risk of destroying the natural beauty of the Aravalli Range, and the judgment would remove ecologically sensitive land from legal protection. After widespread protests, the Union Minister for Environment and Forests has tried to clarify that the judgment does not imply that there are relaxations for mining in Aravalli Hills. The government said that it's wrong to conclude that mining is permitted in all landforms below 100 meters. The government said that the Supreme Court, after a lot of deliberation, has accepted the government committee recommendations and imposed an interim moratorium on new leases. Minister Bhupendra Yadav said that mining remains completely banned in Aravalli Hills area in Delhi, and there is no change in reserved and protected areas of Aravalli Hills. He added that mining is allowed only in less than 2% of the 1.47 lakh square kilometers of Aravalli Hills. But despite this clarification, experts and lawyers have a lot of questions and say that the government must make this clarification before the Supreme Court.
Permissible area of mining, तो पहले तो अलाउ नहीं होगी जब तक कोई एरिया आइडेंटिफाई नहीं किया जाएगा. इकोलॉजिकल सेंसिटिव, उसकी सेंसिटिविटी देखनी होगी. कंजर्वेशन क्रिटिकल एंड रेस्टोरेशन प्रायोरिटी एरियाज विद इन अरावली लैंडस्केप वेयर माइनिंग शैल बी स्ट्रिक्टली प्रोहिबिटेड और परमिटेड ओनली अंडर एक्सेप्शनल एंड साइंटिफिकली जस्टिफाइड सर्कमस्टांसेस. तो ये तो अरावली के प्रोटेक्शन के लिए है.
I respect Mr. Yadav, he is a good friend, but I must disagree with him. Supreme Court's order of 20th November 2025 is a sugar-coated pill.
Welcome back. You're watching Open Exchange live from the CNBC TV18 Motilal Oswal studio. Now, Chola Mandalam investment has been under pressure. For starters, the street was comparing the valuation difference between Shriram Finance versus Chola, and after the MUFG deal, the street got bullish on Shriram Finance and Chola came under pressure. But yesterday, as you can see in the last 1 hour, the stock saw accelerated selling pressure and ended down about 4%. Now, there was a Cobra post which alleged corporate governance issues in Chola. And that's what perhaps got the street worried. Gaurav is now joining in to tell us first what the Cobra post alleged, what are their key concerns, and if he's heard from anyone from the analyst community with respect to a response or how one should look at these allegations.
Well, as local journalist group Cobra Post, they reported some allegations against Chola Mandalam investment, and this is because of some governance gap that they found in the reporting. So first, let's understand what are the key allegations that they have made. They say that around 10,000 crores worth of related party transactions were concluded in Chola, which includes the Murugappa Group entities and which merits close regulatory scrutiny. In fact, to note that, they also say that Chola Mandalam diverted amount worth more than 6,000 crores since 2015. Apart from that, they say that Murugappa Group, they reported cash value worth more than 25,000 crores in the last 5 years, which is actually high, unusual, and indicates asset quality risk for Chola Mandalam investment. They say that they are reporting some kind of raised red flags on the share of increased auditor fees as well, which was in the range of 1.2 to 1.4 crores in the last 2 years. Related party transactions, there also they see some kind of discrepancies which suggest non-disclosure and non-compliance. If you take an example, they say that company reported around 940 crores worth of income earned via commissions by selling insurance, which could be in non-compliance with the IRDAI regulations in FY25. Apart from that, they say that company has also reported some payments which can be questioned, and this is regarding the Murugappa family members. Lastly, there are some concerns regarding payment of fees, regarding the credit rating, and some concerns regarding underwriting practices as well. If you look at the analyst community, we know that Chola is a very reputed name, and if you look at some of the analyst view, they believe that these concerns are not something which are new, and second is that these are not actually accurate. In fact, in terms of cash deposits, analysts believe that it is actually a positive because it constitutes around just roughly 12% of Chola Mandalam's cash collection. In terms of insurance, they say that many companies have changed their reporting standard in FY25 in terms of insurance income, and that is the reason they are seeing some spike specifically in the standalone numbers. In fact, on the consolidated number, it is not a sharp spike to say. When it comes to payments to Chola Mandalam MS, which is the insurance arm, it is actually industry practice as per analyst. They also believe that the auditor fee is not something which is a concern. It is not something that can be higher at this point of time. And payment regarding the fees to credit rating agencies, it is actually a global practice. And lastly, analysts also said that they will be waiting for any comments from the company. So definitely we will be also waiting on that. Remember, at 3 p.m. today, Cobra Post is going to hold press release. So let's see what they have to say on that. But all in all, because of this, we saw some accelerated spike, a decline in the stock yesterday. Let's see if it holds or if it slides even further in a day today.
Okay, all right. Thanks very much, Gaurav, for that. So Chola, that stock ended at the low point of the day yesterday. It's lost around almost 8% just in the past 5 days. But nonetheless, let's get back to the technicals. We have Sudarshan Sakani as well as Mitesh Thakkar with us. Sudarshan, you go first. What would your tech calls be at this point? Say for the indices first.
Yeah, good morning. Well, yesterday the suggestion was to look to buy the indices either on a dip or on a minor consolidation. So if you've taken that trade, hold on to it, keep 150 point stop loss from your entry points or somewhere around 26,100 and stay long. Now, in case you haven't had a position or you have exited it, there's a buying opportunity coming today also. Primarily, the index is now suggesting that slowly and steadily it should cross the previous highs and go higher. We'll see what happens, but that is the sense that I'm getting. So buy the Nifty on a minor dip, on a minor consolidation, keep a tight 150 point stop loss and stay long.
Okay, so looks like the uptrend is intact and maybe we should prepare ourselves for fresh milestones. So buy is the call coming in from Sudarshan. Mitesh, what about you? What's the approach to trade?
Good morning. Actually, yesterday we had some ideas that the index could possibly go higher than the previous highs, and I suggested a target of around 26,380, possibly 26,400. The only condition was that we need to clear this 26,200 10-20 mark. So I think we are most likely heading towards those levels. So we'd already taken some long ideas, long positions on the Nifty, and now I think once we open around this 26,220, 230 zones, maybe take part profits and revise your stop to about 26, 145, 150 zones, which is where we started taking longs. So the idea is that, yes, we are positively biased, at least in the short term, and a fresh hike we've been offering. Because, we have been making higher highs, the next supply line, that pivot of the supply line is at about 26,380, 400, and that's why this target comes into picture. Beyond that, I think it could be a very fast momentum break on the upside.
Okay. Mitesh, what about your stock calls?
Yeah. So on the stock side, I have more buys compared to sell. A buy on Uno Minda with a stop at 1274. Look for targets of around 1335 here. Bajaj Auto is a buy. Keep a stop below 91.30. Look for targets of 92.40. Persistent made a fresh swing high, so buy here as well with a stop at 65.20 for targets of 66.50. And one sell call, that's Hero Motors. It's been, seeing some kind of a profit booking led correction. So if it breaks 56.80, it's about 20 points higher from there. So if it breaks 56.80, take a shot with a stop at 57.21 for targets of 5,600.
Sudarshan, your stock calls?
Well, it's also an all buy list. HAL is a buying opportunity with a stop under 42.90. I have some small shares in HAL. BSE is a buy with a stop under 27.20. IRFC is a buying opportunity with a stop under 115. And Indian Bank comes again in my list as a buy with a stop under 770. This is a good time. We're probably getting the Santa Claus rally finally. So stay only on the long side.
Okay. Thank you very much for that. Now moving on, the Indian Railways announced a revised fare structure starting from the 26th of December. The hike is expected to add about 600 crore rupees in terms of an additional revenue for FY26. To discuss this, the railway capex outlook not too far away from the budget as well. So street expectations have started coming in. Harshit Kapadia of Elara Securities is now joining in. Harshit, morning, and thank you very much for joining in. So first, let's talk about this railway fare hike. Give us the quantum, the impact, and who would the beneficiaries be?
Morning. So basically, this fare hike has been mainly on the
on the coaches, which is going mainly on the longer distance side. The major beneficiaries would be definitely IRCTC on the Indian Railway side as far as the revenue is concerned, and is expected close to around 600 odd crores kind of revenue is expected to be additionally backed by the Indian Railway on the initial estimates which they have done for the 26 year. Going forward, this has been going to be a trend is what we see, because this is what the Indian Railway plan was, to increase the passenger fares as well as to reduce the freight cost. And that's where they wanted to get more volumes out of it, as well as the subsidization which they are giving on the passenger fares is something which they are looking to reduce. That's the overall goal. Given that the cost, which is railways right now facing, cost to income ratio is close to around 97% or more than 97% in an average year. So that's where the logic is.
But the stock didn't react too much. You're saying the only beneficiary is IRCTC, but the stock yesterday was only up 1%. Year to date, it's down 13-14%. What is the view on IRCTC per se? If this is a material 600 crore increase in revenues for the company, shouldn't it have reflected in the in terms of the stock price?
So this is an estimation done based on how the passengers, a number of passengers travel on the Indian Railway, especially for the moving from one station, not within the cities, but on a longer distance trains. So this is just an estimate. Probably this will be, looked over a year and how things improve, plus how passengers also take these kind of fares. Earlier, these kind of intervention by the Indian Railway was negatively put, and they had to then resort to the older price levels. So that's where so people would be, basically looking whether this is going to swiftly go through or pass through, or there could be some hindrances. So probably that could be one reason why the stock reaction has not been that great.
Okay. All right. Well, Harshit, there was a cabinet approval of projects worth almost around 25,000 crores as well. What is your sense in terms of who the beneficiaries would be for that? It is mainly aimed to enhance connectivity to approximately over 3,600 villages.
Right. So largely when we talk about connectivity, the largest beneficiary has always been RVNL. Followed by ERCON and then RITES in terms of distribution of projects, where more than 60% of the project goes to RVNL, 30% goes to ERCON, and 10% goes to RITES. This has been the trend for multiple years within the PSU bracket. Now even private sectors are also participating, but there are some hiccups where private sectors are not directly participating, but they're taking orders from the PSU. So PSUs are getting the orders, and then the private sector is taking those orders on terms of execution. So the major beneficiary will be RVNL.
Do you think that they can reverse this underperformance that they've seen? RVNL is down around 20% on a year-to-date basis. We have ERCON, which is underperformed as well. We're going into the budget as well. Would you, one, expect this kind of underperformance to reverse? And two, would you take positions ahead of the budget?
So the major question that one has to see how the budget movement happens, because the entire railway capex is only spent via budget. The railway additionally doesn't have much income left because the expenditure or subsidization is high at the Indian Railway level. So if the budget increases from 2.65 lakh crore to 3 lakh crore, and that was the vision which the Indian Railway was giving, given its Indian Railway 2047 plan. So based on that, if you look at, then probably we will be moving towards the 3 lakh crore number. Whether it will happen in next year or next 5 years is something that people will be watching out. So that has to swiftly move, the budget number. That is where you will see the interest coming back on the railway stock, whether it is, companies like IRCTC or the EPC companies or the equipment manufacturing companies.
So which stock are you most bullish on, Harshit? Because across the board, as Ekta was pointing out, this year we've seen a correction, a retracement in the stocks. So from here on, any buys?
I would see one stock as a buy where Rail and Metro both are going to see a very strong pickup because they already have got orders. We are awaiting execution to happen. BML would be my top pick within the space, followed by RITES Limited. Those are the two names that I would prefer on the railway side.
And for BEML, I think your target price is 2,700. Is that correct? So that's a sharp 50% upside from current level.
Absolutely. So if you look at the company has almost 17,000 crore order book, and the major part of railway as well as metro orders, which is mainly more than 11,000 crores, is likely to be executed over next 3 years time frame, starting this as in FY27. Bangalore Metro, Chennai Metro, LHB coaches, plus delivery of Vande Bharat, all is coming together for this company in FY27. So that is a company to watch out for.
Okay. All right, Harshit, we're going to let you go on that note. Thanks very much for joining in and giving us all of those details with regards to the entire railway space. Let's, in fact, now go across to Sudarshan. He has one stock in focus, Samvardhan Motherson, as the company's acquired Nexon's auto wiring harness business. Sudarshan's here with more details on that. And this is also our bull versus bear segment. So he's getting us both the perspectives on this. Sudarshan, go ahead.
Good morning, Ekta. So this stock has been in the focus since the Q2 earnings, and the stock is near the record high, up more than 70%, one of the biggest outperforms if you talk about the auto segment as well as the auto ancillary segment. Now today there are two reports. One is bull, another is bear. So first I'll talk about the bull, and that is the Nomura. It maintains buy call, but it does not see the big up move from the current level. It has a target price of around 125 per share, and the current price is around 123. And it says that company is going to acquire Nexon's autos wiring harness business and to foray into global PV wiring harness segment. And this acquisition is done at attractive valuation, and potential transaction to be EPS accretive, and is attractively valued at 4.3 times CY24, that is EV per EBITDA, and could potentially lead to EPS accretion of 2% in the first year itself of the acquisition. But Kotak Institutional Equities has a sell call, and here the target price is 95 rupees per share. So Kotak believes that share is going to fall from the current levels of around 123. It believes that acquisition to be marginally EPS dilutive in the near term, and muted global PV trends and expensive valuation underpin the sell rating by Kotak Institutional Equities. But as far as the company is concerned, the demand has improved. Auto demand, if you talk about, has improved over the last few segments, both on the domestic front as well as the export front. So that's one of the reasons that why you are seeing a big up move in not only Samvardhan Motherson, but in most of the auto companies and auto ancillary names.
Okay, all right, sir. Thanks a lot for that. Well, let's go from Sudarshan, who's from our team, to Sudarshan, who is our technical expert for today. Sudarshan, what's your 910 call?
It's HAL, buy HAL with a stop under 42.90.
Got it. Okay, all right. What about you, Mitesh?
I'll go with the buy on Bajaj Auto for targets of roughly around, I think, just a minute, sorry. I'll go with the buy on Bajaj Auto, and we'll look at upside targets of around 90 to 40.
Got it. Okay, all right. Thanks a lot for that, gentlemen. Let's focus then on the long-awaited and the much-anticipated merger of the cement companies. That's Ambuja Cements. The units, well, the merger has been announced, which will now create one cement platform. The board has approved the amalgamation of ACC as well as Orient Cement with Ambuja. What are the ratios? Ambuja will issue close to 328 shares for around 100 shares held in ACC, which is pretty much in line with what the close price was yesterday. While Ambuja, well, they'll issue close to around 33 shares for every 100 shares held in Orient Cement. That tilts the scales in favor of Orient Cement shareholders, which is reflected in the, in the initial opening that we're likely to see. The transaction is expected to be completed in the next 12 months. That's subject to regulatory approvals. Let's highlight the benefits, though. 1, it simplifies the group structure and reduces the holding company discount. 2, it improves transparency and governance standards via elimination of the master supply agreement and the related party transactions. It also aligns Ambuja Cement's plan to increase the cement production from ballpark around 107 million tons to around 155 million tons by 2028. The management targets cost savings of around 100 rupees per ton from the supply chain efficiencies, while Nirval Bang also says that there could be an additional 40 to 50 rupees per ton benefits over the next 2 to around 3 years. That's expected from improved tax efficiency and working capital optimization. The promoter holding, because of the dilution that we're likely to see, will come down to around 60.9% from around 67% odd. Morgan Stanley, they're bullish on the stock. They say that it's a positive development. It removes the overhang of managing multiple listed companies under Ambuja Cements. And they say that this will be viewed favorably by shareholders as well. CLSA, they've quantified it. They say the amalgamation could lead to 10% value accretion for Ambuja shareholders as per their scenario analysis. Net-net, amalgamation will be viewed with a positive bias for the entity on the whole. So, good news coming in, but it was on expected lines.
Okay, all right. So that's on the entire cement space. Just want to point out that Biocon is going to be in focus as well because they have announced that they will be securing full and exclusive global rights for the biosimilar adalimumab. This is basically from Fujifilm Kyowa. So under this new agreement, Biocon Biologics will assume end-to-end responsibility for this biosimilar when it comes to manufacturing, commercialization, along with rights for any additional development activities. So that's the piece of news which is coming in for Biocon. Puravankara was also in focus because there was an announcement of a 50-acre land that they will be acquiring. So that stock would be in focus as well. But let's also recap, or let's recap all of the top stocks that we covered earlier this morning and which will be in focus. HCL Tech will be in focus on account of acquisitions, Ramco Cement, Prestige Estates, Anthony Waste Handling, Sangvi Movers, Paytm, Bellrise Industries, ACC, Ambuja Cements and Orient Cement. All of these stocks will be in focus.
Okay, let's get the rupee rate as well up for you on your screen. Yesterday, the Indian rupee depreciated a tad bit after closing higher for 3 consecutive sessions. Yesterday's closing was 89.65. Today's opening is 89.61. So pretty much at those levels. So that's the dollar rupee rate as we kick off trade. For the Indian markets, the GIFT Nifty is suggesting, actually we've got the pre-open now, and that's up close to about 32 odd points. So it's suggesting a mildly positive start, building on the rally that we had over the last 2 days, where the Nifty gained 350 points and the Sensex added close to about 1,000 points. We are supported by positive global cues. Wall Street ended with a gain of nearly 0.5%, and Asia this morning too is tracking mildly in the green. The question is, will the seasonal rally push the indices higher into year-end? Can we make a dash towards our all-time high levels of 26,325? The pre-open is at 26,200, which means we're about 125 points away from that. That's the Asian market picture in the green now. So globally, global markets are being supportive for the rally for the Indian markets to continue into the third day.
Well, that's right, Ruma. And the stocks that we had highlighted, Orient Cement is reacting positively because the ratio that they've given with regard to the number of shares that you'll get for the shares that you have in Orient Cement, that's favoring actually, Orient Cement shareholders. The stock is less than half of what it was at its peak. So explains why Orient Cement has opened gap up. And the ultimate beneficiary of this entire merger will be Ambuja Cements. So that one as well is up close to around 4.5% or thereabouts. ACC trades at a discount. That entity is going to be merged into Ambuja Cements. So good times in terms of synergy benefits as well. So all those 3 stocks have opened up in the green. But I think we've got just 10 seconds before the market opens. And it's going to be a positive one, heading towards those fresh all-time highs on the headline index.
Okay, 2, 1 seconds. The bell has gone and the first tick on the Nifty is in the green. The Nifty opens shy of 26,200, but it's actually a flat opening. It's green just for saying. It's an absolutely flat opening for the Nifty and the Sensex. So after a 2-day heady rally, markets are pausing, consolidating. Mid-cap index also absolutely unchanged. The big gainers today on the way up, Shriram Finance, that continues to rally, 940 on that. Of course, the day gain today is far more modest, just up close to about 0.5%, but it's added on a significant bit over the last 2 trading sessions. You've got a Coal India, SBI Life, Cipla, where you're seeing some modest gains, up close to about 0.3, 0.5%. Coal India has now moved to the top Nifty gainer. On the way down, I think the only notable profit booking is visible in IT names. The Nifty IT index had gained for 4 consecutive trading sessions on expectations of Fed rate cuts going into 2026 as well. So IT was rebounding after oversold levels. But today you are seeing correction, profit booking. The top 3 Nifty losers, Infi, Tech Mahindra, TCS, all belong to the large cap IT pack. BEL, where Elara Securities was just telling us very bullish. Their target, sorry, that was BEML. BEL is seeing a bit of a correction. That's down also close to about 0.5%. The rise in crude prices is putting a bit of a pressure coming on Asian Paints. Sun Pharma, HDFC Life also opening in the red. On the way up, you've also got now Coal India. We spoke about that. That's up 1%. L&T, Interglobe Aviation seeing buying. And metals, clearly the sector of the year. The metal index is up 23% year to date. And today, buying is visible in Hindalco. Hindalco this month only has added nearly about 8%. But quiet, it's flat for now. It's a red tick. But let's see as the day progresses whether we can pick up some momentum on the way up. Volumes too are on the thinner side, and today is the Nifty weekly expiry.
Well, that's right. The point on metals at the start of this month, we had highlighted that aluminium could be, one of those metals to track, which was actually underperforming. Hindalco, as Rima mentioned, is up 8%. Nalco, I think, is up more than 10%. And Vedanta, obviously, that demerger got the green signal. That as well is up close to around 10%. So that aluminium trade clearly is working out. I'll tell you the stock of the morning. It's Chola Investment. And the reason is because that much feared report with regard to pointing out various, shortcomings, that's not as bad as expected. In fact, the street has made those shorts scamper for cover. The stock is up 4.5% as we speak. Massive up move is what we're seeing out there. Yesterday, the short addition was close to 10%. Today, all of that is, there is some unbinding out there, and there is some unbinding of those short positions. Explains why the stock has moved up. Ambuja Cements holding in the green with a gain of close to around 3%. But ACC, well, the street always expected the ratio to be in favor of Ambuja Cements. It trades at a discount, but no interest at all in that stock, despite having very, very favorable valuations. Dalmia Bharat up 1.4%. You have Coforge is down close to around 5%. Infosys is coming for a bit of a breather. So that stock is well under some pressure. Canada HSBC Life Insurance, the stock is up close to around 9%, and the volumes are very, very high. So that one should come up for you on the screen. And Bellrise, promoter entity had to sell some shares. That large trade got cleared out of the way. Stock up close to around 7.5%.
Yes, in fact, I think after Bellrise, the other big stock that you need to watch out for from the broader markets is Anthony Waste. So that stock is up around 9% and volumes are picking up on that one as well. And it's rallied quite significantly in the past couple of days, though year to date the performance hasn't been great. We have Orient Cement, which is up around 7%. We have Sangvi Movers, where there was news on that one as well. So that stock is up around 5.5%. Ircon is seeing follow-on buying, so that stock is up around 2% from the railway space. But remember, it's an underperformer year to date. It's lost around 25%. RVNL is also seeing some amount of traction on the upside. Biocon, there was news with regards to their biosimilar. So that stock is holding with a gain of around 0.8% at this point. On the downside, just watch out for a couple of these stocks such as Newlin Labs, Cohance Life, Pratap Snacks. Nothing really stands out considering that it's more of a quiet day. But on the upside, a couple of these stocks are definitely moving on the back of news at this point in time. Chola Investment now at the high point, up around 5% for that particular counter. We have a couple of others such as Chola Finance also, which is holding up with a gain of around 1%, unperturbed by the Cobra Post report, you'd have to say. Misho, that one continues to decline. In fact, that stock has lost around 14% this week itself. So just watch out for Misho. We have Grow as well, which is just about a little weak. So down around 3%. Physics Wala, which is down around 1.5%. So a couple of these new listings are taking it on the chin this morning. All of them down and out a little bit at this point.
Okay, let's get in. Tradeep Bhattacharya, CIO, Edelweiss AMC, joining us on the show. Tradeep, can we say season's greetings to you? I'm not sure whether we'll have one more interaction before we close out the year, but great to see you this Tuesday morning.
Good morning.
Hi, good morning. So what's the call going into 2026? And then if you could tell us about the underpinning of optimism, because 2025 has been a bit of a challenging year. So the underpinning of optimism going into next year is a pickup in earnings. What are your channel checks suggesting about how Q3 is going to shape up in terms of an EPS growth, the sectors which will lead, the sectors which will lag? And is there any risk of an earnings disappointment? I mean, tell us, based on your interactions with the managements, in Q3, what should we expect?
Sure. So, good morning. Thanks for having me on your show. And yes, one of the critical parameters that we monitor is how earnings are incrementally moving. And one of the reasons behind the consolidation that happened in the market last year was lackluster earnings. We actually cut our earnings by almost about 10 to 12% over the last year or so. And for the first time in September quarter, we saw early signs of an earnings upgrade cycle starting up. And from what I'm hearing as channel checks into the Q3, I think certain sectors more than others are certainly looking better, but net earnings are looking better than what people initially thought about. One is on the consumer discretionary side. Certainly, the checks seem to suggest that whether you look at autos or some of the big ticket consumption, the uptick seems to be sustaining. That's one. Secondly, while overall from a financial standpoint, some of the segments within financials are actually bottoming out. So we're going to see a little bit of a bounce back with regards to growth rates in the sector. These two sectors are, from the channel checks so far, seem to suggest that demand is holding good and in fact turning towards the better. IT, the furloughs have not been impacted as much. So broadly in line is what I would say. And that's what the channel check seems to suggest. So, which is good news, given what we have seen in the last few quarters. So far, the earnings season expectations for the immediate quarter seems to suggest that earnings will likely hold up, which is good news heading into New Year.
So for auto in particular, just to go a little deeper, what's the expectation of an earnings improvement? I mean, do you have more granular details? Because the sector has also done very well ever since the announcements of GST cuts. So even if earnings deliver, can there be upside in stocks from here on?
I think overall, the September quarter numbers, when they came through, while the numbers are better than expected, I think most of the estimates on the sell side didn't change all that much because everybody wanted to see that follow through onto the December quarter numbers before they change the full year numbers. That, I think, will finally come through with this quarter numbers, particularly for the consumer discretionary sector overall. And that's what I'm talking about. So I would say that, yes, versus the current estimates which are baked in, so far, I would say that we could see an earnings upgrade of about 2 to 3% come through with regards to even the expectations that we are on two sectors that I talked about, consumer discretionary and financials.
Okay, all right. Well, Trideep, just wanted to narrow down on maybe a couple of sectors. We were just discussing the entire railway space just some time ago, and it's going to be in focus going into the budget. Is that a sector which would pique your interest at all?
Not as much as in the past, is the right way to put it. I would say that overall, if you look at Modi 2.0, it was all about capital goods and different elements of infrastructure coming into third gear and fourth gear. In Modi 3.0, the party is split between consumption and infrastructure. And hence, because the overall spend is split between these two areas and little more emphasis on consumption, and we have seen plethora of measures like GST reforms, tax cuts and whatnot. And next year, we have 8 pay commission coming through. On the other side, the infrastructure investments would likely be more selective going forwards. So rather than having a broad-based spend in railways, maybe Kavach or certain components of railways will see investments and broadly at flattish level. Within infrastructure, though, the areas that we see continued strength in spend from a government standpoint will be defense. That's an area we clearly see that even Y on Y as we head towards budget, I wouldn't be surprised if the allocation toward this space increases meaningfully versus what we have been used to in the past.
All right. Hi, Trideep. Good morning and good to see you, Ben. What are you making of these newly listed companies? Lenskart, so much of debate. The stock actually has done pretty well post-listing. It could be a limited float factor as well. Grow has done pretty well. While on the flip side, something like an urban company listed, went to 200 rupees and then pulled back big time. Any of these stocks you like, which are worth looking at post the recent correction? Meesho, case in point. Stock went up big time. Yesterday it was at lower circuit with no buyers.
So, of course, we can't talk specifics, but 2 or 3 things that I would like to highlight here. One is, given how this new age IPO companies are popular at the time of the IPO, the anchor allocation and the main book allocation is hardly little, and liquidity in some of these stocks is really challenging. So I think one should evaluate the performance of the stocks, not from the listing price standpoint, but after 1 month and 3 month lock-in opens. That's when one has decent enough liquidity and true price discovery happens over a period of time. So hence, the right price discovery we will figure out over the next 3 to 4 months with regards to these IPOs. So we don't get excited. Bottom line is we don't get excited by the listing day price move. Some of these names are certainly in our portfolios. While I can't tell you the names, what I could say is that stocks which have unique business models, who have a path to profitability and unit economics are kind of in their favor, we certainly kind of look to hold them. Though I have to say that of late some of these IPOs are priced pretty finely. So we would use price declines to build our position rather than be very aggressive on a day-on-day basis is the way I would put it.
Deep, as a house, what is the call on gold and silver? Are we in for a correction after what's been an extraordinary year for precious metals? Or do you think the rally continues? And what could be the extent of any correction? Because correction is natural in the normal course of any asset.
The way I think about equities and gold, these are the 2 ways where over the medium term are good instruments to beat inflation overall. And ultimately, given that broadly, we are entering into a tariff-led world is likely to be more inflationary than what we have been used to before. Now, of the 2 asset classes, when earnings estimates are coming through, equities would tend to do quite better, would turn out to be better inflation hedge. But when earnings estimates are not coming through, precious metals do the hedge component and kind of, do well. Over the last 12 to 15 months, earnings estimates have been lackluster. And that partly explains the strength in precious metals, along with the worries about various global currencies. My sense is if we do get a sustained earnings upgrade cycle come through, equities would do better than precious metals. Of course, for that, the tariff and some of these areas which we have not resolved so far needs to resolve. But if they were to come through, then 2026 equities might do actually well, and gold and precious metals might actually see a bit of a healthy correction in the context of asset allocation.
Okay, Trideep, I don't know how much you've possibly looked at this entire GLP-1 opportunity, but it is expected to probably add 1 to 2% to the pharma growth. And all of this conversation is coming at the back of Novo Nordisk also getting approval from the FDA for a weight loss pill as compared to the injection, which is tougher to take. So just give us a sense, are you looking at pharmaceuticals in India from that lens as an opportunity?
Indeed, and we have positioned our portfolios to benefit from this. And for the benefit of viewers, while GLP-1 turned out to be the primary reason of popularity initially was diabetes and the result for that, it is obviously touched upon a far bigger market, which is the weight loss market or the obesity market, which is one of the issues to deal with. And hence, we do think that it will be globally, not just in India, a fairly popular area with a large TAM, if you may call it that way. The idea is to find those companies which can capture this opportunity profitably in their P&L and balance sheet. Indian companies particularly are looking to launch of the generic version sometime mid of next year. As and when that happens, a few companies will benefit more than others. And I can tell you in the context of pharma, we are certainly already positioned in there and would look to kind of continue in that direction.
Okay. All right, Tradeep, we're going to let you go on that note. Thanks very much for joining in and speaking with us and giving us all of your perspective in terms of the markets. Well, for the Nifty, it's just about consolidating with a little bit of a negative bias at this point in time. Seems as though people are starting to take those holiday vacations, and you can see the volumes and the texture of the market definitely much quieter at this point. But let's get talking to a couple of companies. Mazagon Dock Shipbuilders is the next management on the show. The stock is up more than 13% in 2025 so far, and the defense major expects its order book in excess of 1 lakh crores by FY27 and margins at 15%. To discuss this, we have with us Ruchir Agrawal, who's the Director of Finance, Mazagon Dock Shipbuilders, and we will be focusing on 3 main points. First is profitability outlook and provisioning overhang. 2, order book targets, update on major tenders and execution concerns. And finally, strategic diversification plan, de-risking revenue concentration. So these are 3 of the points that we will be focusing on in today's conversation. Mr. Agrawal, thank you very much for taking the time out. First, just wanted to start by discussing about this large order award of the P-75 Scorpene submarines. What is the status of that? Because there is concern that it is yet to materialize at this point in time, and it has been delayed versus what the company had guided.
Good morning, viewers. And as far as P-75 Scorpene contract is concerned, it is still live, and Navy is finalizing the deal for that. But we have not been called for any negotiations so far. It is still on. We can only say that the deal is still on, and we expect that by, say, end of FY26, we should hear some good news for that.
What's the size of this particular order, sir, if it comes through by the end of FY26?
We expect, but the negotiations have still not started, and it will take time. So it may be.
Okay, I think we've lost the audio for Mr. Agrawal.
By 27, yes.
Sorry, yeah, go ahead. If you could just repeat what you were saying.
I'm saying that we have still not been called for any negotiation by for CNC negotiation for Scorpene class submarine P-75 additional, which we have to make 3 submarines. And we hope that they will be coming, and it may be by end of FY26 or maybe by early FY27.
Okay, so you're hopeful of possibly hearing about it by the end of FY26, early FY27. What is the quantum of the order, if you could just repeat that?
It will not be right on my part to figure any figure for this. And we will be knowing it closer to the deal when we back then.
Okay.
All right. Hi, Mr. Agrawal. Good morning and good to see you. When the street is waiting by actually to hear about some of these large orders. But I want to quiz you on a couple of numbers that you had given us earlier. I want to know how far away from the target you are. Now, you had guided, I think, for an order book to cross 1 lakh crore by FY27. Current order book, if I look at it, it's ballpark 28,000 crores. You could correct me on that number. So which are the large orders you're expecting, say, in the next 18 months? And what will the order book look like by the end of FY26?
Order book was around 27,400 on 30th of September, which is still depleted this quarter because we have executed many of those contracts. Now we expect that as the negotiation for 75I is already on, and before close of this financial year, we should sign the deal. And in that case, if everything goes well, our order book should be more than 1 lakh crore.
More than 1 lakh crore by FY27, correct?
No, by 26.
Oh.
1 lakh. So that's in the next 3 months, you're expecting so much of order inflow?
Yeah.
So from 27,000 crores, you'll end the year at 1 lakh crore of an order book. Correct, Mr. Agrawal?
We are around 25,000 now. 27 was the figure of 30th September. So we will be around, we will be exceeding something 1 lakh crore by FY26 end.
Sir, and other than, sorry, just to go back to this to understand, other than the Scorpene submarine order, Are you expecting any other large order wins which will help you plug the gap from where you are today to get to 1 lakh crore by FY26 end?
I would like to clarify that this Scorpion order we are not expecting so early because that is still not finalized. And I already mentioned this in my today that we expect that the deal is still not closed and it may come up. We have not been called for negotiation. But for 75I, the negotiation is already on. And we expect that before the close of this financial year, we will be signing the contract with Navy.
So the P75I are 6 submarines where you are negotiating for?
Yes, yes.
Okay, and you could hear on that by when you said?
The negotiation is already on and it may come anytime. But we expect that before the end of this financial year, some good news should come.
And the quantum of the order, again, if you could apprise us of that?
And the price I would not be able to tell because it is under negotiation.
You had given, sir, a guidance of 12,500 crore of a top line in FY26 and about 15% margins. Does that hold?
Yeah, we are holding with that.
You're holding with that.
And we expect that we should meet that, although challenges are there. This year, the monsoon was a little bit extended, but we expect that we will be meeting these targets.
Okay. Other than monsoons, are there any other challenges? Could you elaborate a little bit more? If you miss the target, what could be the reasons for doing that?
Maybe I don't expect as of now what we are reviewing that we will be missing the targets. We expect that we will be achieving the targets. And let's see how these 3 months go ahead.
Correct. Mr. Agarwal, what about exports? It's a smaller proportion, I think, of your business, but you're quite optimistic on larger orders coming in. So you could tell us what's in the funnel with regard to exports and as a percentage of revenue, what is it? Where is it headed?
As of now, we are only we have only one order in hand. That is around 715 crores. And in my earlier communication, I already mentioned that we are not earning on those contracts. In fact, we are losing on those contracts. And now when India is coming up with the big shipping infrastructure and facilities, we expect that if we are also there, then probably we will be going for more export orders from here, from this position.
Okay. Just wanted to ask about the provisioning as well, because that the reversal actually helped your profitability. Is there any kind of provisioning reversal which is expected in Q3, Q4?
I don't expect too much of reversals of provision what we made for our MPV and Coast Guard vessels and current price at which the orders are being made. I don't think a major reversal. And I also don't expect that there could be any increase for, on those products. Almost what we provided in the...
Okay, so you're not expecting...
Last quarter of this year.
Okay, all right. So we're going to leave it on that note. There's a little bit of a scratchy line there. So that's Mazgon Dock Shipbuilders expecting lesser amount of provisions in the next 2 quarters. They're not too hopeful about certain projects, but they're sticking to their 1 lakh crore order book guidance, possibly by the end of FY26. Nigel, that's what the management said. So maybe there'll be quite a gap to fill in terms of getting there from here to then.
Absolutely. All right. I'll tell you what. Let's slip into a short break. On the other side, we'll get into more festive mode. We have the management of Chalet who will be joining in to tell us how's the festive season panning out and what's the outlook for the second half of the year. Stay with us.
It is a bitter pill. The old definition which was given by Forest Survey of India way back in 2010 to the Supreme Court and accepted by the Supreme Court was not required to be changed. So it is the government of India together with these states which are, are run by the same political party. They requested the Supreme Court for constitution of a new committee. And the committee has come out with this definition, which makes complete mockery of a mountain range.
Well, reactions continue to come in on the Aravali issue. Now, up next, the holiday season turns out to be a nightmare for several H-1B visa holders. Hundreds are left stranded in India as the US delays visa renewal interviews. That and more when we return. You can catch all of CNBC TV18's news and updates on YouTube, Facebook, Instagram, X, and Geo Hotstar. Subscribe to CNBC TV18 Access for exclusive stories. While India and New Zealand have concluded FTA talks and aim to double bilateral trade in 5 years, the pact is expected to be signed in about 3 months. It will give zero-duty access to all of India's exports to New Zealand. In return, India will offer New Zealand duty-free or reduced duty access on about 70% of its tariff lines, covering roughly 95% of current bilateral trade. Furniture, wood products, kiwis, apples, coking coal, metal scrap are likely to become cheaper in India. However, sensitive items like dairy, coffee, onions, sugar, spices, edible oils and rubber have been kept out of the deal to protect domestic producers.
It's also our third FTA with a Five Eyes nation, Australia,
Welcome back. In our corporate conversation now, let's invite the management of Chalet Hotels. It's the perfect time given the winter vacations and the festive season. Shwetang Singh, Executive Director of Chalet Hotels, will now be joining in. He's currently the Executive Director, but Mr. Singh will take on the role of the CEO and MD effective 1st of February 2026 for a 3-year term. We always speak with Mr. Sanjay Sethi, but he will transition as a part of the leadership transition, move on to being a non-independent, non-executive director from 1st of February 2026. And with Chalet, we will discuss 3 main points: holiday season demand trends, the hospitality sector outlook for next year, and financial synergies with Athiva, their wellness plan. Thank you very much, Mr. Singh, for joining in. So before we get to the big picture, what your plans are as a CEO and MD, first just give us a channel check how Q3 has been, because historically, the second half of the year is always stronger for you. You get about 55% of the annual revenues in H2. And this time, Q2 had very few wedding dates, which negatively impacted you all. So many weddings happening, seasonally strong. So Q3 in terms of revenue growth, ARR and occupancy. On these 3 metrics, what is your expectation?
Thank you. Good morning. Thank you for having me on the show. You seem very well informed with respect to how hospitality behaves. So there's not much I can add there, but I can tell you that we have had a historic November. Usually when you look at this festive season, especially Q3, it's best to look at October and November details together, because what happens is that basically the Diwali moves along with the Dussehra season, and that's typically slightly low in terms of business. So when you look at October and November together, October was steady, November was absolutely historic. It's been, from what I hear from my colleagues, it's been the same for the larger industry as well. And December is steady. So we should be coming out smelling like roses from this quarter overall. You're absolutely right. The reasons are clearly seasonality. The fact that the Saya dates, we had a strong quarter of Saya dates. It's also the time when, a lot of corporates set up their MICE, etc. So it's also good from that perspective. So overall, just the weather, the fact that there are Saya dates and there is MICE movement all put together, along with the fact that there is leisure movement at this time, as a lot of people take holidays as well, turns out makes this quarter a very strong quarter. We expect a similar sort of a quarter for Q4 as well. Again, February coming out very strong. Unfortunately, January doesn't seem to have Saya dates. It typically opens up around the 14th of January. This time we have 1 or 2, but not the big ones towards the end of January. February then again is very, very strong, and March is steady. So Q3 and Q4 together should come out very, very strong. In terms of ADR and occupancy, whilst it's we don't give out specific numbers, but I can tell you that it will be comfortably in double digits and probably mid-teens overall.
So ARR mid-teens in Q3 and Q4. What about occupancy? So when you say that November has been historic, what kind of occupancies have you enjoyed?
Again, it's price sensitive data, but I can tell you that both occupancies and ADR went through the roof, and both for our leisure and business locations. So it all happened at the same time. South has been very strong for us, both Hyderabad and Bangalore. And in Bangalore, we had also added some extra number of keys at some 130 keys. And that has been very well received by the market, stabilizing pretty quickly. So actually, overall, we have had, very comfortable double-digit growths, and the overall revenue for the business, etc., and EBITDA growth will also be very comfortable double digits, and higher to senior teens actually.
Okay, Mr. Singh, thanks for joining in. Well, the two of the segments which actually caught my eye is your residential projects, where the revenue was up 94% on a year-on-year basis in Q2. Your commercial real estate segment was up 76% year-on-year. Yes, nascent, but your residential project is already doing around 280 crores in terms of revenue at this point. Just give us an outlook in terms of what the plan is on these two segments. What are the kind of projects that you're currently executing? And what is the run rate that we're expecting on these two segments?
Let me talk about the residential project first, because it's a one-off. It's not our main business. Right? Actually, at the time when we got listed, it was seen as a risk. But thanks to the hard work that the team put in, we have actually managed to make it a big positive for us. What you see in terms of revenue and EBITDA booking for the residential is not a steady income that you can expect going through to the subsequent quarters. It's basically, at certain points in time, once you have received the OC, once you have completed more than 95% and issued the letter for possession, it's only at that time that you can book revenues. So these revenues and EBITDA tend to be clustered, and therefore please see it as a one-off. There are still 2 residential towers in that project that have still to be booked. The first set of 9 towers are already booked, and therefore there was a spurt in EBITDA and revenue. In terms of residential, again, we will not necessarily go down that business, at least as a major plan or central to what our business is. Moving on to the commercial real estate, right now we have 2.4 million square foot of commercial real estate that is in play. And we have about 900,000 that's under development. Of the 2.4 right now, we have about 76% that is occupied, and our last exit was about 26 crores per month. So if you multiply that by 12, you get basically what is the annual expectation coming from there. But as we speak, we are leasing out more. Particularly in Powai, we have some space to lease out. We are only at 77-78% occupancy in Powai. So that's going out, and that should then bring up the revenues and EBITDA in that segment as we go forward. Again, whilst it's quite central to our business, commercial real estate, but it's always been seen as sweating the asset strategy. Our central business remains hospitality, with commercial real estate only adding an ancillary revenue, but a very significant one to cover us both from an annuity income and cover us against the cyclicity of hospitality.
All right. Hi, Mr. Singh, and welcome to the show, and looking forward to interacting with you. Nigel on this side. Well, Mr. Singh, I must confess that I had a bit of a busy year personally. Couldn't take my family too far away from Mumbai, but I visited your Powai property a few times during the course of this year, and we felt we were far away from city life. Really, really good property out there. But I want to focus on a couple of other brands that you've launched. The Athiva brand, I think you've launched close to 900 keys. So tell us the positioning of Athiva, and what are the targets you've set out for this brand?
So Athiva, our first Athiva opened in Khandala. I think you were referring to Khandala, not Powai. If you've been out there, and it used to be the earlier Dukes. We have...
No, Mr. Singh, I had visited your Powai property.
What is the FPS today?
Yeah.
Okay. So that's
precisely, but
currently under renovation, and we hope to open that in the first quarter 4 of this year.
Right.
So that's in the works. Coming back to Athiva, we are positioning it in the upper upscale segment, just below leisure. The equivalent would be a Marriott or a Hilton brand from those portfolios. Right now, we have made an announcement of 900 plus rooms, but essentially they are all our hotels. So if you see Navi Mumbai, or the Aksa Beach, which belongs to the group, the two Goas or Thiruvananthapuram. They all belong already to us, and this is not a third-party play at this point in time. It's not an asset-light play. It's also I just want to make clear for our investors and for our viewers that the 900 that we talk about is part of our announced pipeline itself, barring the one at the Aksa Beach. So actually, of the 1,200 keys that we've announced in our pipeline, this 900 less 150 of Aksa Beach, less 250 of Aksa Beach is already in the pipeline. So these are not new hotels. These are only going to be branded Athira going forward.
One number answer, sir. I think 5,000 keys is what you had guided by the end of FY26. So after your first term of 3 years, what would the number stand at? One number.
It should be comfortably more than 5,000, although our announced pipeline is 4,600. But we have enough within the group going on within the group that should take us north of 5,000 is all I can give you at this point in time.
Okay. Well, a pleasure speaking to you, Mr. Singh. Wishing you, the entire team, a very, very good end to the year. And you're sounding very, very optimistic about prospects for the second half of the year. So wish you well. We'll catch up in 2026.
Yes, we must do that. Thank you so much.
All right, let's focus on the next corporate, Belrise Industries. That's the management on the show. The stock is buzzing in trade. There was a very large trade that took place earlier today. They have also signed a strategic agreement with the Israel-based Plasan Sasa for defense opportunities. The stock, in fact, has seen a big gain post its listing. To understand who was party to these morning trades, as well as what's the way ahead, we're joined by Mr. Swasthit as well as Sumit, the promoters of the company. Hi, gentlemen. Good morning and good to have you all in. Give us a few details, gentlemen. We understand that there was a large trade today and the promoter entity was the seller. Could you clarify on that? What was the proportion of sale? Who was the buyers? And is there an intent to further reduce stake in the time to come? I think it was 73% is what the promoters held. Post today's trade, it would come down a little bit. At what level are you all comfortable?
So I can answer the question. Firstly, I'd like to talk about why we went ahead and did this trade. So right from our first earnings call, we have guided on merging or acquire two of our related party entities. One is Badwe Autocoms and second is Exumates. So if you were to merge both of these entities in, that would have pushed our promoter shareholding above 75%. And in that case, we would have violated the MPS norms set by SEBI. Hence, we have done this transaction in advance of the merger that we filed. And that is the reason why we have gone ahead and done this transaction as of today.
Okay.
Got it. So post this transaction, the promoter holding would have come down to around 66, 67%?
Yeah. Correct. Today, it's around 66 to 67%.
And who was the buyer today? If you could give us some color on that.
We are unable to mention that.
I thought I'll try my luck on that. But anyways, we'll wait by, once the disclosure comes in on the exchanges. Post getting the unlisted entity into the listed entity, as you had promised at the time of the IPO and various other analyst meets as well. What will the promoter holding look like?
So that will, of course, depend on the valuation that we do it on. What we have committed to our shareholders and what we think is extremely critical is that we'll be doing these transactions at or around the book value. So, which is why we feel that these transactions will be value accretive to our shareholders right on day one. And in that sense, we'll be able to reward our shareholders for the fact that they've been with us on this journey so far.
Okay. All right. Well, let's move away from that. You've now signed an agreement with an Israeli company for a defense opportunity, which could possibly fructify over the next 2 to 3 years. Just give us more details on this.
Absolutely. So we signed a strategic partnership agreement with a company called Plasan Sasa. They're based out of Israel. They're a very, very innovative company. They're a global leader in armored solutions and anti-ballistic protection mechanisms and the likes of it. And we've signed specifically for this one product called the Atom, which is a UGV, unmanned ground vehicle, which will be focusing on the Indian market in terms of the product, in terms of a strategic intent to work with the MOD, but also working with Plasan to manufacture these items and products in India, as well as manufacture and supply to them for their global supplies.
Okay, but when could we possibly see revenues show up in the P&L from this particular strategic partnership? And is this going to be one of many? Just give us a sense in terms of the longer term plan, as well as when the monies will show for this particular partnership.
So, as you know, the defense space is a space which is like an elephant. So once it takes a little bit of time to move, but once it moves very surely. So in a sense that the intent is to work on this with all hands on deck. Plaza and Sasa team as well as our team will be working on building or on fructifying something very soon. However, with working with the MOD, sometimes things can take time, but we're very confident of something fructifying in the near future. At the same time, this partnership allows us to manufacturing supply to our strategic partner. That can happen sooner.
What's the total addressable market opportunity on account of this partnership?
So Plasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Plasan on supplying some components for their global exports. So that's already in progress. And we should see revenues of that in the next fiscal year.
Okay. You said Plasan is a $2 billion company, right? But now with this partnership, what is the total addressable market opportunity that you all are gunning for? Do we have a number for that?
We would not like to. So if you think about it, it really depends on what the quantum that the MOD would like to procure. In a sense, it's a large market, but we would not like to comment on a specific there.
All right.
Will the margins be higher? I mean, are you moving into a higher value segment? Can you at least tell us that?
Most certainly.
So higher margins.
Higher values.
I mean, give us some number, right? I mean, how much higher would it be? A couple of 100 basis points, more than that? Just some color on that front. As a percentage of the mix, how much is defense likely to contribute since you're looking at de-risking the business?
So I can answer that. So defense and aerospace in general as a segment would be a higher margin business than our automotive business.
Okay.
And of course, there can be larger work capital cycles, but in the end, we expect this business to be ROCE accretive for our business. Right now, we don't have a number in mind as to what we want the share of defense and aerospace to be for us in the future. That being said, we're very confident that we want to make this segment a meaningful part of our business going forward, and all the efforts as of now are going towards that.
Got it.
Well, we're just going to try and get some more numbers from you. Just wanted a sense, because you've maintained your mid-teen revenue growth guidance for the medium term. So just tell us what the exit rate would be for FY26 and eventually for FY27, when we do see maybe defense coming through in terms of your P&L. What can we expect in terms of your guidance?
So we are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'd appreciate is just this year we've announced 4 new manufacturing facilities with discussions ongoing for a few more in the future. So in that sense, every time we launch a new facility, there is a bit of drag on margins because no facility is going to make optimal margins right from day one, which means that the potential gains that we make through higher value segments like aerospace and defense, or maybe working more in the 4-wheeler and commercial vehicle sector, that of course will be an offset with all of the new growth that is coming in. So that's why we're maintaining a target of a mid-teens revenue growth in the medium term and stable EBITDA margins.
Okay. No more promoter stake required? Just one final word?
Sorry, can you repeat that?
Will the promoters need to sell further stake for all the integration amalgamation that you've planned, or this is it?
The 2 entities that we're planning to merge, this should be it.
Okay. And there is nothing else which is on the horizon in terms of further stake sale by the promoter?
Nothing else on the horizon.
Okay. All right, gentlemen. Thanks a lot for joining in. It seems the street was waiting for this block deal to get out of the way. And now you have the stock that's moved to the high point of the day. Wishing you all the best. end of 2025. It's been a good listing for y'all. Your shareholders would be happy as well. And those that got the shares earlier today as well, they're already sitting on some hefty gains. We'll wait by for the names.
And even the discount was not too much. I think the floor price was about 3% lower compared to where the stock closed the prior day. So even the block deal didn't take place. And this is a stock which has done well since the IPO price.
That's right. And if what I hear correct is when they were listing, the bankers had an opinion, and there were various interested investors as well that believe pricing should have been at the lower end. And, they went with that. And the returns are there for the taking. Thanks a lot, gentlemen, for joining in. Stock now at the high point of the day, 11% higher. No, in all probability, no more selling from the promoter entity. And they had to do it because, as promised, that unlisted entity was going to be coming in there. But Chandan Taparia, Motilal Oswal Financial Services, is joining in to help us out with his take. Chandan, how are you feeling today? Going to be working for Christmas? And what's the view on the market? That initial dip has got bought into. As you were prior on the screen, the Nifty is actually flattish. What's the fresh trade?
Good morning, Nigel. Thanks for having me. So yes, it seems that market is in mood to celebrate Christmas, and best wishes in advance for a fantastic festival. The good part is that we are in a range. Nifty got stuck in a range of 600 points in between 25,700 to 26,325 from last almost 30 trading session. The VIX is below 10, which indicates that the market is not in hurry to see the next leg of momentum. But yes, the trend is intact. Supports are shifting higher. Index gradually shifting its support to higher zone and recently took support near its 50-day exponential moving average. So I believe slow and steady market is gearing up towards the new all-time high territory to welcome the festivity as well as welcome the new year. So I believe till Nifty holds above 25,800. Buy on decline could continue to take the indices towards 26,350 to 26,500 marks. When we talk about Bank Nifty, it is also consolidating in a broader range from last almost 7-8 weeks. Supports are intact. Until it holds above 58,800, Bank Nifty has potential to continue the momentum or swing towards 60,000 marks. So slow and steady, the levels are shifting higher. Range is narrow because of the lower weeks, but trend is intact, and we will continue to be with buy on decline stance. Now talking about trading ideas, positive on the entire metal basket. Metal and mining stocks are likely to do well. In fact, at the beginning of this series, we came out with the report about the seasonality theory that in the month of December, out of 10, 8 times the metal index remained positive. And this really worked well, and we still believe the momentum could continue. So positive view on the entire metal and mining name, whether we talk about Hindustan Zinc, NMDC, National Aluminium, Hindustan Copper and all. But here I'm recommending to buy on NMDC. It has given a consolidation breakout on the daily chart with surge in open interest volume. We have seen put writing activities, put call ratio of the counter is shifting higher. So looking for a fresh leg of rally in the counter, one can buy with support of 77 for an upside target towards 86. Second trading idea, that is buy on Glenmark. We have seen consolidation breakout and selective pharma counters are doing well. Supports are gradually shifting higher. We are expecting better rollover, and roll cost is also turning upwards. So recommending to buy with support of 2020 for an upside target towards 2150. One more trading idea, that is bottom out approach on defense counter. It seems that HL has bottomed out after the lower top, lower bottom of last few weeks. And now one can buy with support of 4320 for an upside target towards 4650 marks.
Okay, all right, Chandan, we'll leave it on that note. Thanks very much for joining in and giving us all of those tech calls. Well, Glenmark, he mentioned, is in focus also because they have launched a particular drug in the US markets. The market size is around $67 million, and the drug is used as an emergency when somebody has an allergy attack. So that stock is in focus on account of that as well. We'll take a short break, but on the other side, Manisha Gupta will join in and she'll be taking us through the commodity space. Stay tuned.
Fly Emirates, fly better.
And now New Zealand. We are soon going to launch discussions for the terms of reference with Canada also. And we are already at an advanced stage in our discussions with the USA. see tremendous potential for doubling this trade in the next 5 years.
India and New Zealand have announced the conclusion of FTA negotiations. Both the sides aim to sign a trade pact in the next 2 to 3 months and double bilateral trade from the current $2.4 billion, which was recorded in 2024. Meanwhile, India's FTA negotiations with the European Union are at an advanced stage, and both the sides are looking to conclude talks at the earliest. India had signed FTAs with Mauritius, Australia, the UAE and the EFTA bloc, which have already been operationalized. Meanwhile, the FTA with Oman is likely to be operationalized in the next 3 months, whereas the FTA with the UK is expected to be ratified next year. 7 FTAs have been concluded by India in the recent past to mitigate the adverse impact of US tariffs and geopolitical uncertainty. India's bilateral trade with FTA partners Australia, the UAE, Mauritius and the EFTA bloc is collectively around $150 billion. The combined import potential of the EFTA bloc, the UK, Oman and New Zealand is around $1,370 billion. It remains to be seen what kind of export opportunities are going to open up for India in the coming days, and more importantly, which are the opportunities which are going to be encashed by India's exporters moving ahead to mitigate the adverse impact of geopolitical uncertainty.
Abhimanyu, many thanks. India-based H-1B visa holders who returned home to renew their U.S. work permits are now stranded. This after the U.S. consular offices abruptly rescheduled visa appointments. The U.S. State Department has told applicants that interviews are being delayed due to the Trump administration's new social media vetting policy aimed at ensuring that no applicant poses a threat to the U.S. national security or public.
Welcome back. Let's shift focus to the commodity space now. Manisha is here with us to tell us what she's tracking this morning. Manisha, over to you.
Well, thank you for that. It's not just the precious metals which have been buzzing in trade. By the way, they have made yet another all-time high. But it also is about the base metal prices, which have been surging as well, and most of them heading on a positive note to end 2025. The best of the gains, of course, clearly coming in for the Dr. Copper. We've seen 39% of gains come in for that. Aluminum is trading at a 16% on the higher side. And we've seen zinc prices gain up by 3.5% as well. The first half for zinc wasn't so great, but it's commendable that we've been able to come into positive for this one. What also has done quite well has been tin prices. That, of course, is an outperformer with 48% of gains. But we haven't seen such a great comeback come in from nickel, and lead prices just about in the positive on your screens. So it really is copper, which is the hero within the metal pack. There's a reason it's called Dr. Copper. If you look at the LME prices, well, we have seen a record highs very close to that $12,000 a ton mark. When you look at the US copper prices, we saw an all-time high in the mid-year. And having said that, it's been a great time for copper this year because almost everything that you're looking at in sense of fundamentals seems to be very, very supportive. It is also headed for the strongest annual gain since 2009 on the back of outages at major mines. There are limited new project developments that we've seen in sense of reports or on-ground break-in that has been supportive. When it comes to mining, well, whether it was about Chile, Peru, Indonesia, you've seen concerns come in from all of those major producing countries there. And there's no major investment seen. Deficit is expected at 19 million tons by 2050 on the back of a lack of major investments in any project. So when you look at the demand in the meanwhile, that is expected to be on a stronger side. Long-term infrastructure demand is what the markets are working with. It also has to do with the fact that there are historically low treatment and refining charges. We do understand that when it comes to China and Japan, they've agreed on zero duty, 0% TNC charges. So that tells you that there is a lack of refining metal available in the global markets there. But it also is about on the back of demand growth coming in on EVs, grid upgrades and data centers. But markets do say that it is majorly on paper because when you look at the Chinese market, there is weak demand coming in from there. It also has to do with the fact that not so much demand is coming in from Europe as well. It also is about high premium that is pushing manufacturers to cheaper alternatives. It also is about US, which has been buying a lot of copper because of expectations of a 15% duty coming in. So there is copper, just that it is not getting consumed, but it is getting stockpiled is what the markets fear could lead to some correction going forward there. The other one really is aluminum. 3.5-year highs onto this one, 29.70. It's not too far away from its all-time highs either. And for aluminum as well, it is the Mozambique smelter, which has gone down in sense of maintenance, which is pushing the prices higher. It is about disruption at Iceland, inventories at Japanese port down by 5.5% on a month-on-month basis. And then it is about China, which also is putting out a cap at around 45 million tons. No more production than that in this year tells you that if China stays on course with this 45 million tons, you are looking at higher highs coming in for aluminum as well in the next year.
Okay, all right, Manisha. Thanks very much for taking us through the entire commodity setup. Well, for the markets, absolutely flat at this point in time. Stocks such as Chola Investment up around 6.5%. Time for a break now. On the other side, former RBI Governor D. Subbarao speaks to Lata Venkatesh on the current rupee decline, foreign fund selling and the India growth story. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Standing by with more. Shilpa, people being left stranded, what exactly is the way forward here?
Well, what was meant to be a routine trip home for visa renewal has turned into months of uncertainty for thousands of Indian professionals working in the United States. Now, many had traveled to India for their H-1B and H-4 visa renewal stamping, with their interviews scheduled between December and February. But those appointments have now been pushed back, some to 2026, others as far as mid-2027. For H-1B holders, the consequences here are serious. If their visa stamps expire while they are still in India, they cannot return to the US until the interview happens. That has triggered fears of job losses and immigration status risks. Now, many are scrambling for solutions from employers or are trying to apply for emergency appointments. Now, the disruption came after the US Department of State extended the mandatory social media vetting to employment-based visas as well from the 15th of December. Now, to manage the expanded checks, consulates have cut interview capacity, triggering mass rescheduling and long delays. Now, the US Embassy told CNBC TV18 that in every visa case, consular offices will take the time needed to ensure applicants pose no risk to US safety or security and have credibly established their eligibility. Now, the fallout has been such that it forced
Welcome back. Former RBI Governor D. Subbarao was one of the few governors who saw through a rupee decline twice in his term. In the 2008 Lehman crisis, when he had just taken over, and in 2013 during the taper tantrum at the end of his term. In this exclusive chat for Money Control, Lata began by asking him if the current rupee decline is more deadly because it comes not from a current account deficit but a capital account outflow. Listen in to a slice.
Historically, the rupee came under pressure because of widening current account deficit. But this time round, the pressure is coming from capital outflows. And why is that happening? There are several components in the capital account. There's ECB, there's NRI deposits, but the flows that are causing worry are the foreign investment, the FPI, foreign portfolio investment, and FDI, foreign direct investment. So why is there outflow of FPI? For several reasons. First, that domestic investors have come in a big way. As Anant Narayan, a former whole-time member of SEBI, wrote in a recent op-ed, the number of retail investors has multiplied 3 times in the last 10 years, from about 4.5 crore to 14 crore. So they're coming in a big way and displacing foreign investors. And foreign investors are also finding it attractive to
sell out at this time.
Sell out because valuations are high. On the other hand, on the other side, there is the attraction of AI. So people are exiting here, taking advantage of fear of missing out on the AI boom. So all these forces are causing FPI to flow out. On FDI, I heard the chief economic advisor say in some interview recently that the gross inflows are not too bad, but it's the net inflows which are causing worry, because a lot of foreign investment is going out because foreigners are, taking away retained earnings.
They're getting a very good price because...
Very good price. So I would worry not so much about the rupee going down because the rupee is tracking fundamentals. The question we should ask is why are fundamentals somewhat disturbing?
Yeah.
And I worry about foreign direct investment going away. Why is, if India is really the growth story, 7+%, etc., we are the growth story of tomorrow, why are foreign investors not continuing here? Why is domestic investment not taking place? Even domestic investors are going away. So that, I believe, is a bigger worry.
Yeah, Anant Narayan's argument, I read that edit too, and he wonders whether, Indian shares are too highly priced because of this tidal wave of domestic investors. And maybe we should change taxes and make it less attractive. I don't know. But let me come to the complaint which foreign investors often tell us on the channel, that we are the only country which taxes them. So do you think now that we are actually worried they are stomping out, should we reconsider the tax on foreign investors?
See, we tax foreign outflows not for fiscal revenue reasons. We tax foreign outflows, capital outflows, because we want to prevent hot money from coming in, because in the past we had flippant capital come in and cause huge instability. So we don't want to open up ourselves to that vulnerability. So I believe there's a case for looking at taxation. First, capital gains tax. Foreign investors want to be able to estimate their post-tax returns with some degree of confidence. But our tax regime does not make that possible. It's not the tax rate so much, which I believe is not outrageously high compared to other emerging countries. It is the burden, tax compliance burden. There is, for example, we don't have a stable tax regime. There is different interpretations. There is discretion, a lot of discretion in interpreting the tax laws. So what I think we should do is to have a tax regime, say that this is what it's going to be for the next 5 years, have a very exhaustive list of FAQs, have somebody in the ministry who will be able to respond to queries and questions by foreign investors with some authority so that they feel more confident about coming in.
Okay. Now, they have a complaint with our capital gains tax as well. Many countries don't have a tax on capital gains
but on the withholding tax, I believe there is a case for reducing the rate because we don't get stabilizing long-term foreign capital because our withholding tax is too high. So there I would think that there is a case for reducing the tax rate, whereas in capital gains tax, it is more a case of improving tax administration and the tax regime.
Got it. Do you think that this inflation targeting framework is giving Reserve Bank more freedom? In your time, remember, Mr. Chidambaram was forcing you to cut rates.
Right.
But now there are 6 people. So do you think Reserve Bank has more freedom now?
Just to put the record straight, not just Chidambaram, but even Pranab Mukherjee. So both finance ministers were putting pressure because the situation at that time was such. There was policy paralysis. The government could not do anything to push growth up. So they wanted the Reserve Bank to do something, be the cheerleader, inspire some confidence in the market. From a political perspective, quite understandable. From the technocratic perspective of the RBI, not to be done. Okay, but the question is...
if it is it better for the governor now?
I would think so. The inflation targeting framework and the MPC came into being after I left the RBI. From what I see outside, I believe it makes the RBI more independent because it's easier for the government to put pressure on one individual, the governor, rather than a committee. And there is the framework, So if the inflation breaches goes beyond the
6% mark
band, there is concern both on the government side and the RBI side, a more shared concern. And when the MPC idea was first mooted, all of us were concerned, including you, about whether the government will put their own people on the committee, to
back the committee. We worried that
to do their bidding in the committee. But over the last 10 years, members of the MPC have been very credible, outstanding economists and analysts who've been there, and MPC has established a record. So there is a plausible case that the MPC and inflation targeting framework has worked and has made the RBI more independent. But there is always the question of inflation in India, which is oftentimes from the supply side pressures. So if that happens, as is often the case, can RBI's monetary policy do the job of reining in inflation? And what does it do to the credibility of the inflation targeting framework? That question remains open. The other question, since we are on the subject, I also worry about exchange rate. Because whether we like it or not, the pass-through from exchange rate to inflation is high and getting higher. So if the MPC is tasked with the responsibility of just inflation and not exchange rate, can there be a conflict? Okay. So I think we've got to be mindful of it. Thankfully, so far, it's not been an issue, but we've got to be aware that this could sometime be an issue.
But broadly, inflation has remained under 6%. So would you say, for all its frailties, the inflation targeting framework is a success?
I would think so. You know, as I said, there's a plausible case to argue that inflation targeting has been a success. You know, because the circumstances which some of us had reservations, like the administered interest rate regime, a high fiscal deficit, which could undermine the inflation targeting framework, but the less of worries today. So I think the circumstances for making inflation targeting framework a success have also changed for the better.
Well, we finished exchange rate and inflation. Let me come to fiscal consolidation. One has to give credit to the current regime and to Mrs. Sitharaman. They have kept their word on bringing down fiscal deficit. But, you know, now we see most other Western countries actually running up deficits, especially the United States. Why is fiscal deficit so important in our context? Why are we not taking liberties?
Well, first of all, for good or bad, fiscal deficit is the single most important indicator foreigners look at when they want to evaluate the credibility of government's economic management. So that's the reason why it's important. Second, I want to say that as much as Finance Minister Sitharaman has been very credible on fiscal consolidation, and she's on track to deliver 4.4% of fiscal deficit in FY26, I think it's too early to declare victory. Because our debt to GDP ratio is still quite high.
Yes,
for the central
85.
government, it is 60%. For the general government, it's as much as 80%. So interest payments are the single largest item of expenditure, both for the central government and for state governments. Interest payments are the fastest growing item of expenditure, both for the central government and for the state governments. And one thing people say, you know, that like you said, look at America, look at Japan, 250% of debt to GDP, look at America, 150%, UK, 150%, EU, so on. So we can't compare because our revenue to GDP ratio is also low. So if you look at the primary deficit, etc., you realize that we can get into a debt trap at a much lower debt to GDP ratio. So we need to be worried about that.
Let me come to the growth bit, and I want to ask banking before I run out of time. You think growth has, you know, we've got over 7% for the last 4 years now, especially if you average out. You think that we are on a structural better growth, higher growth?
That's a tantalizing question. Actually, the story is much more rosy than that. Not only do we have a 7+% growth prospects, but current account deficit is low.
Yeah, 1%.
Inflation is low. So have we hit the Goldilocks situation? This is in contrast to past situations where we had rapid growth, but collided into inflation or balance of payments pressures, or we had stability, but at the cost of modest growth. And part of this growth with stability argument is, the story of better macroeconomic management. We have the FRBM, greater compliance with FRBM. There's the inflation targeting framework, and we're less reliant on foreign capital than we were before. Yes. So that's the positive side of the story. But I would think that we can't declare victory. We can't say that we shifted to a structurally higher growth path because look at private investment. Capital investment is yet to take off. It's quite tepid. The job situation is quite disturbing.
That is disturbing.
Household incomes are rising more slowly than the GDP. There's productivity is not improving.
Inequality, yes.
Inequality, jobs, productivity. So there are lots of concerns. So I would think that there's cause for cheer, but not for celebration.
Okay, not 3 cheers, maybe
Yeah,
one
not
or 2 cheers.
Yeah.
Let me ask you a final question, sir, on the way IAS has come into everything. I mean, I don't mean any affront to you. You also were an IAS officer who came into RBI. But now they are in RBI. They are an IAS North Block, ex-North Blocker is in SEBI, ex-North Blocker is heading IRDA. Is this good? IAS spreading its tentacles everywhere.
Give me a couple of minutes to respond to that, which is that, my response, as you said, may not be seen to be objective because I'm guilty of having been in the IAS. But the organizing principle of the IAS is that the IAS officer brings the breadth of experience because they're exposed to the world, exposed to the country, they work at the frontiers, they know the situation in the hinterland of the country. They bring that experience. When they get into a leadership position, domain knowledge is less important than the breadth of experience. They should be intelligent enough to take advice from domain experts, appreciate that, and take a decision. That's the organizing principle. Has it worked? Largely. But there have been very, very evident failures as well. So the question is, in the financial sector, like the RBI, SEBI, IRDA, is domain knowledge more important than the breadth of experience? If you take the RBI, for example, we've had IAS officers who've been outstanding governors, like Mr. Venkataraman, Dr. Y.V. Reddy, Shaktikanta Das, and now Governor Malhotra. We've had non-IAS officers who've been outstanding governors.
Rangarajan.
Dr. Rangarajan, Dr. Jalan, Dr. Raghuram Rajan. So I don't think it's the IAS, non-IAS. But I believe, to differ partly to you, domain knowledge perhaps is more important in the financial sector. And the IAS officers who come in should be prepared to dirty their hands because they don't know the plumbing. Like I went to the RBI right at the top. So I didn't know the plumbing of the RBI. How is regulation done? How is supervision done? How do RBI traders trade the rupee? I don't know that, right?
That's true. But you don't, when you're making decisions at that level, you don't necessarily have to know every nitty-gritty. My only worry is that we had a fairer share of non-IAS people, before. It looks like this moment, in the last 2 years, the IAS domain has increased.
If the government is, disinclined to consider non-IAS because they know the IAS officers, I think that will be net negative. So whenever opposition opens up, they should look at all possible candidates and take the best decision. Don't disqualify an IAS officer just because an IAS officer, but don't take an IAS officer just because he's an IAS officer.
Yeah, that would be ideal. And I would assume that Prime Ministers think that way anyways.
Big tech firms, including Google, Microsoft, Apple, Amazon, they've all advised employees to avoid international travel if a visa stamp is required. And they've asked those who are already abroad to return immediately before that current visa stamp expires. Microsoft, for instance, has warned employees that emergency appointments for those already abroad are highly unlikely, while Amazon has cautioned that last-minute cancellations could leave employees stuck outside without the ability to work. Now, these companies, remember, are among the largest H-1B employers with a significant share of their workforce on this visa. Now, immigration lawyers are also urging caution. They're warning that many employers cannot allow remote work from India because of tax, payroll, and export control rules. They also add that job loss while stuck abroad could mean applying afresh for H-1B visa, and that will trigger the new $100,000 fee that most companies are unlikely to bear. Emergency appointments do exist, but approvals are very rare. And lawyers say there is no indication yet that fresh interview slots will be released. For now, relief may be months away, turning what was meant to be a routine visa process into an open-ended wait with careers and families hanging in the balance. Back to you.
Yes, uncertainty for a whole host of people on H-1B and H-4 visas. Shilpa, many thanks for joining us. Oracle co-founder and billionaire Larry Ellison has provided an irrevocable personal guarantee of roughly $40 billion to bolster Paramount's hostile attempt to acquire Warner Brothers Discovery. Along with the $30 per share offer, the amended bid includes stronger execution assurances and even a higher reverse termination fee that matches Netflix's offer. However, the amended offer is conditional on Warner Brothers Discovery retaining 100% ownership of its global networks business and not proceeding with any sale. The board of Warner Brothers has already cleared the deal with Netflix and has advised shareholders to reject the Paramount offer. Mumbai's iconic Mahalakshmi racecourse is now at the heart of one of the city's biggest urban transformation plans. The Maharashtra government has unveiled plans for a nearly 300-acre Central Park, promising vast green spaces on the surface with sport and convention infrastructure built entirely underground. Shilpa dives into the ambitious plan and what it has to offer.
Mumbai's iconic Mahalakshmi racecourse, a 140-year-old landmark known for the Indian Derby, is now home to Mumbai's ambitious Central Park project if things go to plan. The Maharashtra government...
The big-ticket cement merger approved. The board of Ambuja Cement approved the merger of ACC Orient Cement with itself. Stock of Ambuja and Orient Cement rally. ACC trades under pressure.
Coforge under pressure. The stock slumps close to 5%. The board says that it will mull a fundraise on the 26th of December.
A Cobra Post report flags worrying patterns of a large value cash transaction at Cholamandalam Investments. The stock surges 6% as the company says that the allegations are malicious and baseless with ulterior motives.
Belrice Industries signs a strategic agreement with Israeli firm Plasan to explore opportunities in the defense sector. The promoter also sold close to a 6.5% stake to meet the minimum public shareholding norms ahead of the planned merger of two related entities. Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, and with me is little Vinny. Vinny, market's more or less flattish. A bit of a rarity when you have this combination. But par for the course, I would say, right? Today's the weekly expiry as well. Still, there are individual stocks doing a thing of their own. Festivities are here. Santa's almost coming to town.
Yes.
We have the Nifty that's flickering between green as well as red as we speak.
Absolutely, Nigel, but green strongly still holding on for the mid-cap, more of the small cap side, right? Mid-cap is also flip-flopping between the red and the green, but Nifty small cap, that's comfortably in the green right now, 0.3% of gain there. So yes, some cheer at least there. And like Nigel mentioned, right, it's the weekly expiry for Nifty. So that is something that is leading to a bit of a volatility. Advance decline ratio, though, is largely in the favor of advances versus declines. Like you can see 1,700, 800 stocks on the advance side versus declines at around 900. Today, where the pressure is coming in is the Nifty IT. That's down almost more than 1%. We have autos that's seeing some bit of a pressure as well. Other than that, metals, energy, FMCG, still managing to hold on to some bit of a green in today's trading session over there. So yes, that's what we'll be keeping an eye out on. A lot of movers in terms of the individual names as well that we're seeing coming in. So that is what we should watch out for as well in the trading session.
That's right. A couple of stocks actually deserve special mention. Vinny, Ola Electric, the one has seen a sharp spike up in the last few minutes. Remember, the stock's seen a sharp correction from the top. Now it's pulling back a little bit. Promoter entity went ahead and sold last week, so that's come off. And the stock of this is Misho. The stock is down, I think, 20% from the recent peak. It went up on very limited float. And the stock, I think it hit a high of 240 just 3 sessions ago. Now it's at around 188 rupees. It's just breached the 200 EMA as well. So sharp downtick is what I'm saying. Actually, it's just recently listed, so it doesn't make sense looking at that particular. The 20 DMA. 20 DMA is around 192 or thereabouts. So sharp downtick out there. And Jupiter Wagons is now up close to around 8.5%.
I think Jupiter Wagons has been buzzing in trade for the last couple of trading sessions. Yesterday also it was up in trade. So we'll watch out if there's anything that comes up on that front. But today also 8% gain there for Jupiter Wagons. Other than that, you know, in just the last 30 odd minutes, NMDC Steel, that's the one that's picked up a bit of pace as well. So let's watch out for that one. Managing to hold on to gains of 3% as of now. NMDC Steel actually is what I'm talking about. Other than that, Ola Electric is also something that we're watching out for. But let's put the spotlight on Samvardhana Motherson. They will be acquiring Nexans auto electric wiring harness business, and this is going to be at an enterprise value of £207 million, enhancing its exposure to high and low voltage harnesses and increasing the access to premium OEMs. Pankaj Mittal, who is the CEO at Samvardhana Motherson International, is joining us now to discuss this acquisition. Thank you so much, sir, for joining us on the show. It's a pleasure having you here. Firstly, you know, if you could highlight a bit more in terms of the acquisition, what are the synergies that one could expect, and when will we start seeing those synergies?
Well, it's a very exciting opportunity for us, which is fully supported by the top customers. This will nearly double the revenues of the wiring harness business in Europe. It brings to us a company with 60 years of experience and a team which is very highly capable in design and development of wire harnesses with a very clear focus on automation. With this capability will also support our existing global business and also enhances our premium OEM relationships. This company supplies for ICE powertrain, the high voltage harnesses, and it has focused now on developing body wiring harnesses, which is a clear growth path for it for the German car makers. The company has no overlap in our existing business and also very little overlap in the manufacturing side. So it opens up new manufacturing sites for the company and has a high growth potential due to Motherson's strengths in other geographies. Also, the company doesn't have currently a vertical integration, which has been our strength, which will definitely help us in improving the performance.
But how much, sir, will be the revenue from this, sir? If you could give us that number as well. What is the revenue expected? From when will we start seeing the revenue coming in for the company?
We expect the closure in the first quarter of 26-27. And the revenues currently are shaped above 700 million euros.
All right. Hi, sir. Good to see you, Ben. Give us a few more details. What's the return profile ratios? You know, if you could help us out with that, and the margin profile of this acquired business. I think last count it was doing around $750 million, as you mentioned. So scaling up plans of revenues, margin, and return ratios of the acquired entity.
See, we will be able to give a lot more color once the closure of the deal happens. And as I mentioned, it will be in the first quarter of 26-27. We have already given the EBITDA profile of the past years, but once the closing happens and the company comes to us, we expect the company to perform well over the next few years. As you have seen in the past, also we did the PKC acquisition, whose revenues are much higher with a very good profile, with a clear focus on return on capital employed. And we expect that they should go in the same direction in which we have been working in the wiring harnesses sphere, which happens to be our oldest automotive business.
So, you know, are there any cross-selling opportunities that come in? Since obviously you do not have any overlapping business, but, you know, gives you some expansion furthermore in the geography. So any cross-selling opportunities or something in terms of a platform sharing opportunity, anything there?
Definitely, as we make deeper inroads with the premium car makers, it will open up more and more cross-selling opportunities, as well as it will help us in our integrated modules business, where we will be able to add more content as the customers have been looking for someone who can give modules. So that's also a kind of direction in which we will all work.
Okay. So, you know, overall, I just want a number in terms of revenue. I know I'm saying it again, but for the company in terms of overall sales, you said Q1 FY27 is when there will be a completion of this acquisition as well. So for FY27, anything you all have envisaged that where do you see this number of 700 million pounds, which is their revenue for calendar year 24, move up in FY27, and how does it add to your overall revenues as well?
See, as I mentioned, currently what we see is a revenue a shade above 700 million euros, considering the current volumes of the car makers. And as we move forward in 26, 27 and onwards, there will be a good growth trajectory because the body wiring harness business will start its inflows, which has been in the development phase and has just started revenues. Also, the company has been the most advanced powertrain harness manufacturer in the ICE segment, which with the current trend is supposed to continue the expansion rather than depletion with the changes which are happening in the market.
All right, sir. Final question before we let you go. What's the outlook for the year in terms of growth? What kind of revenue band are you looking at, 26 as well as 27, and margin trajectory as well?
Well, we for this company, we do expect that once we take over the company, we go in depth. That's the time when we make...
For your current entity, sir, not for the acquisition, because you're not giving us too many details out there. So I said, let's focus on what you can give us some details on. Tell us.
Well, as the quarter is around the corner for closure, so we can't talk much about this quarter. But definitely year on year, you would see improved revenue performance. The company has had many acquisitions which have been merged in, plus all the entities which have gone in for restructuring in Europe, especially, have started to give better results. So that's what we told you at the end of the last quarter. And we will be able to give you more color as we close the quarter and move forward.
Okay, we'll wait out for those numbers over there. Also, 750 million euros, my correction, it's not pounds. Euros is what the company has been reporting, the numbers in the acquired company. So you said good growth. Can I ask you, good growth means what? 20%, 30%? What should we expect at least for the acquiring company?
See, in such companies which are manufacturing the same product, there is a limited sharing of information which is there till the acquisition is completed. But we do envisage double-digit growth as we move forward in the years. So it's not something which happens in a year, but we see a very good growth over the next 3, 4, 5 years after the acquisition is done. And even in the very first or second year, you will see a good growth because the new products which the company has launched for the car makers, they will come in full flow.
Okay, double-digit growth at least is what you've highlighted for us. We'll watch out for the numbers there, and after the completion, maybe in Q1 FY27 as well, we'll speak with you for more details. Well, thank you so much, sir, for joining us this morning, giving us highlights in terms of the synergies that come in from the new acquisition as well. But on that note, we're going to slip into a very short break. We have Dharmesh Shah of ICICI Securities who will join us after the break to talk to us about the technicals on the market.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
But nearly 295 acres of this land into a public green space and build a convention and sports complex completely underground, all without shutting down the racecourse.
Deputy Chief Minister Eknath Shinde says that of the 295 acres, 125 acres will come from the Mahalakshmi Racecourse, while 170 acres will come from coastal road land being developed by Reliance. These two parcels will be connected through an underground subway, creating one contiguous park stretching from the racecourse to the coastline. The master plan, prepared by renowned architect Hafiz Contractor, has one principle at its core. What you see above the ground remains green. Anything that gets built goes below the ground. The plan also envisages that the existing racetrack stays operational and visually unobstructed, while the surrounding land is reorganized into public green zones.
ये पूरी तरह ऊपर जो है पूरी तरह ग्रीन बेल्ट रहेगा, ग्रीन कवर रहेगा. आपने उसका देखा भी है कि ये बहुत ही वर्ल्ड क्लास का बहुत बड़ा सेंट्रल पार्क होगा, तो इसमें मुंबई को ऑक्सीजन पार्क के रूप में इसका फायदा होगा, इसमें पोल्यूशन कम हो जाएगा।
The plan is to divide the surface level park into 3 zones. 1, a botanical garden with orchards, palm gardens, medicinal plants, bamboo groves and water bodies. 2, a topiary garden with landscaped lawns, jogging tracks, flower gardens, event lawns, mazes and a 900-seater open-air amphitheatre. And third, a city forest designed as a dense green zone with rainforest patches, deciduous forests, spice gardens, koi ponds and broad walks. Gravel pathways will be used to reduce the carbon footprint. Beneath the central garden, the plan proposes a multi-level sports arena.
Welcome back. Well, keep an eye out on a few stocks actually from a broader markets. I think Greenply has suddenly spiked up. I recall that Parag Shah this morning, in fact, was talking about the stock, about it having valuation discount in comparison to CenturyPly. And Greenply suddenly moved up. So intraday chart actually should come up for you. Good uptick is what we're seeing on that one. MSTC as well as seeing a bit of an uptick in the last few minutes. And I think Anand Rathi, let's pull Anand Rathi share, that as well has moved up. Intraday charts is what we're calling for. We'll get that in just a bit. Let's welcome Dharmesh Shah, Assistant VP of ICICI Securities, who joins us for a technical check. Hi Dharmesh, we've had a good last few couple of days. Where are we headed from here? What would you do? Take the money off, enjoy the 400-point run, enjoy Christmas, or is there a happier Santa's coming with a bag full?
Yeah, so good morning, Nigel. Yes, definitely. The Shanta Rally has started, I think so. The week started on a very positive note, and it looks like, I think so, the breakaway gap and the falling trend line channel breakout, indicating, I think so, the end of the corrective phase. And we should be looking for a target of around 26,700 in the month of January. So we believe, I think so, 25,700 should act as a very strong support, which has held multiple times. So 50-day exponential moving average has been holding out well even in this volatility. So 25,700 as a strong support with higher target of around 26,700 is likely in the coming month. But few points to highlight, I think so, as you mentioned, the Santa Rally, we have done some analysis historically. If you look since 1995 till date, the last 10 days of the December, 90% of the time, the Nifty average return has been around 2%. So we believe, I think so, one way to look at the market from the short-term perspective remains to be positive. But again, I think so USD INR, I think so that is the most important to be look out for, which has witnessed a selling pressure from the upper band of the rising channel. And historically, there has been the 5 instances wherever it has retested those upper band of the channel. The average fall in next 2 months has been around 4%. At the same time, Nifty has an inverse correlation with an average gain of around 10% in next 2 months. So we believe, I think so, good days are yet to come. I think so, too early to enjoy the party. But yes, definitely, I think so, we believe. And a dip towards 25,700 should be looked as a buying opportunity for target of 26,700.
Okay, surely good days are yet to come. Hold on, Nigel, before you start partying. So just wait out for that. But Dharmesh, which are the individual stocks that you're looking at as well?
Yes, as far as stock specific is concerned, we remain to be positive for Adani Port. I think so. I think so. The stock seems to be witnessing a cup and handle breakout, and I think so it's holding those breakout level. Going forward, I think so we believe Adani Port should surprise us from the positive side going forward. But we look for a target of around 1675 for Adani Port, keeping a stop loss of 1375. Apart from Adani Port, I think so auto as a space which has been consolidating for a long time, as we witness a breakout, and what we witness currently is, I think so, more for consolidation. But auto ancillary space is something I think so looks more interesting from the current levels, where again tire stocks particular looks more positive, where again the raw material prices also came down and the beneficiaries of the fall in the crude oil pricing. That is one way to look out. But technically, again, C8 Limited looks more promising from the current levels. Again, the stock has witnessed an 8-month of falling trend line and seems to be resuming the upward momentum with strong sets of volume. So C8 is something one which we like at the current market price, where we look for a target for around 4,300, keeping a stop loss of 3,550. So C8 Limited and Adani Port remains to be a top pick at the current market price.
Okay, Dharmesh. And a quick take, if you could give us also in terms for today's movers that we have, Bellrise, obviously it's on the back of a news flow and it's much recent in terms of listings. So anything that you're keeping an eye out on here, if you could read the charts for us?
For which stock? Sorry.
Bellrise
The
Industries.
name of the stock.
Bellrise Industries.
Yes. So yes, Bellrise again, I think so the stock has been a new listed, but yes, definitely the way that things to be panning out for the Bellrise, it looks like I think so can be look for target from 185 to 186, typical stop is around 165.
Okay, thank you so much, Dharmesh, for joining us on the show this morning, giving us this individual stock views as well as the view on the market. On that note, we're going to step into a very short break. After the break, we'll have more stock-specific action.
Fly Emirates, fly better.
The sports complex includes facilities for badminton, basketball, volleyball, table tennis, gymnastics, wrestling, boxing, skating, and an aquatic arena. The adjoining convention center will be spread across nearly 9 acres. The project includes 3 levels of basement parking to accommodate about 5,000 cars.
A key piece of connectivity is also moving ahead, which is the 1,200-meter underground tunnel that will connect the park to the Nehru Science Metro Station and the Coastal Road. And where I am standing right now in Worli on the Lala Lajpat Rai Marg near the NSCI Dome is where the underground subway will connect the racecourse to the Coastal Road garden that is being built here. A 550 crore rupee tender has already been floated for the underground tunnel project, and the civic body says it is in the process of identifying the next step. But experts say whether the city will get a true public green lung or just another ambitious blueprint will depend on execution. In Mumbai, Shilpa Ranipeta.
Well, Mumbai's Central Park in the making. And with that, it is time for us to wrap up this edition of India Business Hour. Thanks very much for watching. Do stay tuned. The news will continue right here on CNBC TV18. We're back in a moment, right after this break. Well, 2025 will go down as the year that India's financial sector saw a significant amount of FDI coming in, both strategic as well as financial capital. We've seen deals in RBL, IDFC Bank, Federal Bank, and the largest to close out the year perhaps is the one with Shriram Finance and MUFG. Joining us now on the record to talk to us about this deal, what they intend to do with the capital that they get, and whether or not a bank license is on the anvil at all, is Umesh Revankar. Mr. Revankar, many thanks for joining us here on CNBC TV18. Appreciate your time. Let me start by asking you, you're well capitalized. You didn't really require the capital, 20% tier 1 capital already. The rationale and the timing of this deal?
See, capital is always welcome. And when the capital is coming from a reputed international organization, that makes a huge difference for the cost of funds. And as we were discussing, we were looking for some kind of a large international partner for our growth. And when the right opportunity was there to take this, we thought we should take it. So one thing we are very clear that 20 is what it looks little higher above the regulatory requirement. But since we have...
Welcome back. The big merger was announced, amalgamation of ACC as well as Orient Cement into Ambuja Cement. And that was long awaited, right? So the units now will come together and form one cement platform. The board has approved the amalgamation of these companies with Ambuja Cement. The ratio comes up for you on the screen, 325 shares for 100 shares in ACC, which is pretty much close to yesterday's price. And if you're an Orient Cement shareholder, for every 100 shares you have, you'll get 33 shares of Ambuja Cements, which was favorable as of yesterday's close. Transaction gets closed out in the next 12 months or so, but what are the benefits? It simplifies group structure. In case there was a holding company discount that was being assigned, that goes away. It improves transparency governance standards as well, elimination of the master supply agreement and related party transactions. It also aligns with Ambuja Cement's plan to increase capacity from 107 million tons to 155 million tons. And the management says that they are targeting savings of around 100 rupees per ton from supply chain efficiencies. Nirmal Bang, the analyst Jyoti, joined us earlier today. And she said that there could be an additional 40 to 50 tons, 40 to 50 rupees per ton benefits over the next 2 to 3 years, which is expected from improved tax efficiency and working capital optimization. Promoter entity, well, because of the dilution, holding comes down to 61% from around 67%. Brokerages like Morgan Stanley as well as CLSA, they are positive on the stock. They believe that it should be viewed favorably. Morgan Stanley believes it should be viewed favorably by shareholders, while CLSA, they say the amalgamation could lead to 10% value accretion for Ambuja shareholders as per the scenario analysis. Net-net, amalgamation will have a neutral to a positive bias on the stocks. Ambuja Cements is the biggest beneficiary of this, and Orient because of the arbitrage opportunity with regard to yesterday's close price. So those stocks are doing pretty okay. Coforge is under pressure. They're going to be raising some money. Rima joins us to break it down for us. Rima?
Thanks so much for that. So Coforge has announced that the board will meet on the 26th of this month, where they will consider a fundraise. And after that, at 5:30 p.m., the company will be holding an investor meet. The last fundraise by Coforge was in May of 2024, when the company raised 2,240 crore via a QIP, and this was to fund the Cigniti acquisition. Now, you can't compare the stock price, the QIP price, to where the stock is currently today on account of stock split, which took place, after that. Now, the question everyone's asking is, why is Coforge looking to raise the money? We don't have the answers. We'll know on the 26th. But is it to raise, money for an acquisition? Because one of the pillars of growth for the company has been acquisition. They've done the Cigniti acquisition. After that, there was the Rhythmos, there was, I think TM Labs. So the company has grown partly on account of building capabilities via acquisitions. At a recent analyst meet, the Coforge had outlined some areas, according to analysts, where they could consider an acquisition. This would be to improve their capabilities in geographies like ANZ, APAC, and even in industries like healthcare and UK public sector verticals. Now, the cash on the books is not very significant, which is why analysts say if they have to do an acquisition, maybe they could be looking for some equity fundraise. Now, why could the stock be under pressure? Because one, every time you raise money, there is some dilution risk. And secondly, in the past, Coforge has had concerns with analysts on account of the cash flow generation, which was the weakest compared to other mid-cap or, large-cap IT peers. After that, the company has course corrected, and they did guide that, the cash flow payout will be, free cash flow to PAT will be 70%. Is there a risk to that? Or will the company be looking to further increase their investments in data center? Because last time they said they will not be doing that. So I think there are some concerns, and plus Coforge, as we know, has been a rank outperformer. Not this year, but just over the last 3 or 5 years, stock has done very well. So interesting board meet. Coforge looking to raise some money. 26th is the date.
Okay, we'll keep an eye out on 26th. But Rima, thank you so much for joining us this morning and explaining us why Coforge is in focus. But with that, we're absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. We are leaving the Nifty with a mild bit of a positive side right now, 26,180 levels. We'll keep an eye out on that. But thank you so much for tuning in. Up next, your Trading Hour.
The 20 something, which is borderline.
Okay.
So you need to be above 20 all the times. So we were already in the borderline. So we were looking. Indian regulatory requirement, a statutory requirement is 15.
Correct.
But since we have an international rating, so it was 20, and the international rating agencies prefer to be about 20. So we were always looking at that. And when we had a great opportunity of highly reputed organization like MUFG, then we thought we should take it forward.
Okay, so how long were the talks on? I know that this is something that we've spoken about and asked you previously as well, but how long were the talks on? And were there other suitors that you were also talking to? And what made you want to zero in on MUFG specifically?
We were talking to multiple people. It is not that it's just one team or one organization we were talking to. But we were looking at the appropriateness because being a lender here in India for nearly 50 years, we wanted an organization which has an international reputation and who have experience of being a partner in various other countries. MUFG is one bank. If you look at their background, they have been a partner in Morgan Stanley US with 23% stake there. They also have the investment in Thailand, Indonesia, Philippines, and Vietnam. 4 countries. So Asian countries also, they have a very large exposure in the retail lending. So most of their lending in the Asia is in the retail.
Okay.
So I thought with their experience, knowledge, and the expertise what they built on digital platform, it will be a great suit for India so that we can play on their experience plus the digital platform which they have built, which looks very robust, and we can easily have an advantage of what they have gained out of their experience in the other Asian countries.
Okay, I'll get to the synergies in just a second, but let's talk about the 20% stake. And there is a lot of speculation that they could perhaps look at eventually going beyond 20%. Has that been a discussion, a conversation that you've had with them? Are they interested?
See, the conversation can go on from 5% to more. So there has been a repeated discussion on how much to invest and what should be the long-term plan. Right now, we are sticking to 20. And probably with experience what they gain of the investment, then we may take a call. But right now, there's no talk of anything about going about 20%.
You're saying right now there is no call on going above 20%.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Reema Tendulkar. Reema, hi. Well, weekly expiry for the index. So as of now, we are quiet as quiet can be, but the second half promises to be a lot of action.
Indeed. It's also just consolidation. We've had 2 good days on the trot. The Sensex has moved up 1,000 points in this period. The Nifty has gained about 350 points. So keeping that in mind, markets are just absolutely flatlining. Advanced decline ratio, though, is in favor of the gaining side. Crude prices, too, have also inched up a tad bit as US-Venezuela tensions remain high, and even Russia-Ukraine continue to sort of bubble under the surface. So crude has moved up, and so has gold. Gold continues to make new and new record highs. 50th record close as of yesterday for gold prices, and today very close to that $45,000 an ounce mark. But let's talk about individual stocks. On my screen, I can see Shriram Finance continues to do very well. It's another 1.5% gain on Shriram Finance, while IT is seeing some profit booking after 4 consecutive days of gains. But Hormuz, what are you looking at?
Well, the broader markets, the advanced decline as of now is painting a good picture as it has been over the last 2 to 3 sessions as well. The broader markets are doing well mostly on larger counts and some stock-specific movers as well. And they are seeing around double-digit gains, but news-driven names today in the list. Cholamandalam is one of them. The biggest single-day gain since Jan. The stock had been spoken about quite a bit all through the day over some allegations and the company's clarification as well. 8% higher now on the stock. The stock has now rebounded after a 9% decline in the last 6 sessions. So it has almost recovered everything that it had lost in the last 6 sessions. The volumes today are already nearing 70% of yesterday's volumes. So we have had close to 40 lakh shares that have been traded. The 20-day average is just under 4 lakh shares. So 10 times its 20-day average already. The stock is now crossed its 50-day moving average of 1699. Trading above that is now gained almost 45% this year and has delivered positive returns in 8 out of the last 10 years as this Murugappa Group company. Now, Deccan Gold Mines is another one. Is the second straight day of gains here as well. The stock is up 15% and the top gainer on the small cap index today. The biggest single day gain since April. Volumes are the highest in 3 months. Here too, the volumes in the first 2 hours are 10x of the 20-day average at this time of the day. 20 lakh shares traded compared to 2 lakh shares. The stock though, despite this this move is below its key moving averages. The rights issue that is currently open for subscription, the company is planning to raise around 315 crore. That will close for subscription on Friday. So keep this stock on your radar. And lastly, of course, Coforge. You'll talk about it in a lot more detail as to why the stock is down. The biggest single day fall in 4 months, falling on high volumes as well. Now, close to 20 lakh shares have been traded, 4x of its 20-day average already. The stock is now slumped below its 50-day moving average, and the 100 DMA is at 1759. So that's the important level next on the downside that you need to watch for Coforge. It's had a forgettable year so far, down around 8%, have recovered from the lows, of course, but turning out to be the first negative year for the stock after 2022, Rima.
Thank you very much for that. And now let's take the discussion to a veteran investor. He's watched many cycles in the markets now. Mark Mobius, Chairman, Emerging Opportunities Fund at the Mobius Emerging Opportunities Fund, is joining us on the show. Mark, great to have you. Now, 2026 has been the third consecutive year of gains for the S&P 500 and even gold. Gold, in fact, in the last 3 years has given a compounded return of 140%. It's been absolutely phenomenal. But as we look ahead to 2026, I think the big question on everyone's mind is AI a bubble right now, given what we've seen? And what happens to these AI-related stocks? And if that bubble bursts, then maybe the U.S. economy is in trouble. So let's start this discussion with your thoughts on what's happening with AI. Is it a bubble, and where does it go from here?
Well, there's no question that AI has been pushed and pushed and pushed by so many people that it's quite a bubble-like territory. But at the same time, you must remember that AI is here to stay and is expanding. More and more people are adopting AI systems. I myself, I'm using AI almost every day. So there's no question that the AI revolution is here to stay and will continue. But some companies have been emphasizing their AI expertise, and that really may be a little bit too much. Some of these companies are not really into AI directly. And so I think we have to watch it and pick and choose those companies that are really into AI systems and developing AI. And you must remember that in addition to the software, there is the hardware, the chips, which is very important to develop AI, and of course the power systems used to drive this whole system. So I think there's a lot more than what we can see now. And I think going forward, AI will continue to be a very important element in the market.
But you said it's in an AI bubble-like territory. Do you want to elaborate on that? Does that mean a correction is due? And do you want to mention some of the stocks in the AI theme which you like? Because you said there is sort of this AI washing which is taking place, where everything is brushed and called AI. And how similar is where we are right now to what happened in 2000 at the dot-com bubble?
Bubble insofar as the AI systems are penetrating into almost every industry that you can speak of. So that's a big difference than what we saw at the bubble, the dot-com bubble. The thing we have to do is differentiate between those companies that are very, very engaged and expanding into AI and those that are on the peripheral. Now, for example, if you take companies like the chips companies, let's say TSMC. TSMC, of course, as you know, is the most sophisticated company in the world for chips. And they are very much involved in AI because they are doing the actual foundry work for AI chips. So that's something to watch. In other words, it's a good idea to look at the peripheral companies that are serving the AI revolution.
Mark, thank you so much for joining us today. You know, you spoke of AI, but you've been a very avid watcher of emerging markets. You've seen seen them over the years now. But as of now, India, coming to specifics here, it's been a forgettable year, if you could call it that, when you would compare it to other EM peers. You've been speaking about the reforms that need to happen in the country to stimulate the economy and then the markets as well. You've spoken about this in your previous interactions, but now with these slate of reforms that have taken place, be it the income tax cuts, be it the rate cuts from the central bank, or be it the GST rationalization as well, Do you still believe that a lot more still needs to be done to stimulate the economy, or we have come a fair distance from where we were 12 months ago?
Oh, no, there's a lot more to be done. And one of the most important things is to allow more and more investments to come into India. As you know, the bureaucracy involved in entering India is very, very complex and difficult. Now, as that begins to fade away, as the Indian government begins to loosen these restrictions, you're going to see an incredible growth in the Indian hardware market in addition to software. So India has a long way to go. There's a much more development that we can see going forward, and I'm very optimistic.
What is your weightage on India right now in your portfolio, and would you be looking to increase it?
And now it's about 20% of the portfolio, and we expect to increase it as we go forward.
And if you look to increase it, what would be the level you're comfortable with, and what would you be looking to buy in India?
Probably 30% would be a good weighting. And where we would want to focus is on the software companies, as well as the hardware. In other words, computer hardware companies, which I think will be growing at a very fast rate going forward. Now, of course, many of these are not listed yet, but as we go forward, this will be a good development area.
Software and hardware is what you're pointing out to Mark, but do you believe that India is going to be that consensus anti-AI trade? Because we may not have as many direct AI plays, but when it comes to adoption of AI, India has been one of the fastest. Do you believe one of such proxy plays as well?
That's two things. One thing, you must remember, you've got 1.4 billion people, the largest population in the world. So there's no question that AI will be in India and will grow in India very rapidly. That's one side. The other side is the development and production side, the software, the hardware. All of this will be expanding in India, not only because the Indian market is absorbing all of this technology, but because the global market will be absorbing more and more of that. And as China begins to fade away or begins to reduce their impact on these markets, India will take over.
Can you share some names which interest you in India in software and hardware, Mark?
Well, I think a company like Infosys is a very good company. I'm looking at companies that are doing the hardware for Apple, companies that are not yet listed but are going to be listed going forward. That would be a very interesting area to develop.
On Infosys and generally broadly the Indian IT sector, the view is that India is sort of a net AI loser as of now, which explains why India has underperformed many of the emerging markets in 2025. So what explains your bullishness on Indian software companies and Infosys in particular, if you could share your thoughts?
You must remember there are listed software companies in India already, but there's a lot of software taking place in companies that are not yet listed. So this is where we want to look, because if you look at the chip development, for example, the software that goes in the chips, a lot of that is being developed in India, but in companies that are not yet listed. So this is an area which we think will be a very important one to focus on.
Mark, have you taken a look at all of these new age companies that have gone public very recently? There have been a lot of concerns with regards to their valuations, and so on. Have you looked at any of them, be it in the consumer servicing space or in the e-commerce space as well, the recent listings?
Of course, we are focusing on those companies that are using AI in their development, whether it be in consumer goods, whether it be in entertainment, whatever you want to look at. AI will be hitting these companies, and those that are behind will have problems. So there's no question that this AI revolution is hitting all companies, and we want to focus on those companies that are able to use AI effectively without spending too much money, by the way, but using it effectively. So this is a very important area that we can go for.
Mark, sorry to probe, but many of the areas which interest you in India appear to be a bit unlisted. You spoke about companies doing hardware for Apple, for instance, or involved in chips. So in the listed universe, which is where majority, most of our audience and the people watching, can you tell us some of the stocks which you have in your portfolio or any recent additions that you've done in India?
I can't give you what we're going to be adding going forward because obviously that would be somewhat a problem.
In the last 3 months, what have you added in India?
No, what we've done is we've added those companies that are going into the AI revolution, but in a very systematic way. I can't give you names, but generally speaking, that's where we want to focus.
What about financials? Because financials seems to be quite the consensus going into 2026. When we speak to experts, they're saying that it's a good scenario for financials. Do you like Indian banks, NBFCs?
Generally speaking, we shy away from financials, from banks, because they're somewhat opaque, very difficult to look behind the scenes and look at, for example, non-performing loans, et cetera, et cetera. Now, of course, there's some new financials that are coming in using AI to service customers. That could be interesting going forward, but we haven't really focused on any particular one at this stage.
Shying away from financials, Mark, despite the slew of large deals that have taken place in the Indian financial space in 2025, almost $11 billion, including one mega $4.5 billion deal concluded just a couple of days back. Other than the non-performing loans, is there anything, because the balance sheets now are very strong compared to what they were 5-6 years back, still do not wish to look at the Indian financial space?
Well, the fact that you see these mergers and these acquisitions is not necessarily a healthy development. It means some of these companies need help, need to be merged into other companies in order to survive. So I think you have to be very careful in thinking that this is an optimistic scenario. I would be very cautious on that.
Mark, you've also been bullish on traditional assets like gold. Gold is at $4,500 an ounce. What is your view on gold after this kind of an astounding run?
I still like gold. I think gold should be part of any portfolio. I hold 10% of my personal assets into gold. And I think going forward, gold will continue to be very, very good. Now, it doesn't mean that it's going to go up in a straight line. There'll be corrections along the way. But there's no question that in US dollar terms, at least, gold will be doing very well, simply because of the proliferation of dollars around the world. And now with AI, you're going to see a lot more development in terms of literal gold. In other words, gold that is not necessarily hard, but soft gold embedded in some of the currencies. So this is going to be a very interesting development going forward.
So $5,000, Mark, a realistic prospect over the next 12 months?
Why not? There's no reason why it can't get to that level.
Just before we ask you about the book, one final question on India. Where does it feature in your pecking order among other emerging markets? Because when it comes to Korea, Brazil, they have been outperformers this year. Do you believe that India will turn the tide in 2026 and outperform a lot of these EMs?
As far as we're concerned, India is number one. It's the most important market in emerging markets, not only because of its size, but because of the youth of the population and because of the developments that are taking place in India that will be revolutionary, very, very important.
Now onto your book, Mark, The Digital Currency Revolution. We spoke of traditional assets. Now this one speaks of the non-traditional assets like crypto. There has been so much talk about crypto all through the year, and even companies have started to put them on their balance sheets. Banks are beginning to open up. ETFs are beginning to open up. Is crypto as an asset class here to stay? Part one. And part two, would that be one of the de-dollarization triggers going into the years ahead, or are they two separate things?
There's no question that crypto is here to stay because there's so many different things happening in the crypto space. However, probably the most important element of this entire process is the fact that central banks around the world are looking at crypto to develop their own systems to back up and to combat the crypto space that is being taken up and is challenging the central bank's currencies. So this is a very, very important thing. Every country in the world now is looking at crypto and developing their own crypto coin for their own currency. This is very, very critical going forward.
And what does that do to currencies as a traditional asset class, Mark? You mentioned it is going to be a challenge for a lot of these currencies, but would that then become a key feature of shaping monetary policy going forward and so on and so forth?
Most definitely, because now with the issuance of digital currencies, central banks will have much more control of how this currency is being used, who is using it, how it's being used, etc. So in some ways, it's going to be a very, very good way for central banks to control the whole system. However, there are also on the other side, those people who say, no, we don't want central banks to be interfering with our money and how I use it and where I use it. And that's why you can see on the other side, things like Bitcoin and other independent crypto activities taking place. So it's going to be a very interesting development going forward.
Mark, great conversation as always, and wish you, your team, your family a very happy New Year and a Merry Christmas. We speak again in 2026.
Have a Merry Christmas and a Happy New Year. Thank you.
Thank you very much. And speaking to India, let's slip into a break. On the other side, we'll focus on the bond market when Isha Gupta joins in.
You want to talk business? Meet me in the On-Board Lounge.
Experience, perhaps there could be an eventuality where you could see that. Would that result in an open offer? Will that result in a management change?
See, as far as they are concerned, they're very clear that management will continue with Shriram because we have 50 years experience in India, plus the management depth they have seen. They have come and visited the branches, talked to the senior management team. They have seen the depth. So they're very happy with the depth. So there's absolutely no talk or discussion on management change. Management will continue to remain Shriram. And the way we run the business will be the Shriram way of doing business. I don't see there is any change on that.
But an open offer, do they have the appetite for that?
I don't really see that. We have not discussed on that right now. So probably as they experience India, if they are very happy with India, because right now India is growing at 8% plus GDP, and that really is the excitement they have, and they would like to see how India is growing. And with this kind of a capital coming in, and I think there will be a much stronger demand for credit in India.
So the door and the window in the future is open?
I can't say that now, because right now discussion is limited to 20% only.
Okay, limited to 20%. Let me ask you about the other piece that's being speculated on, and something that Uday Kotak tweeted about also, is this a precursor to an eventual bank license? Is that the plan? Is that the aspiration? Is that the ambition?
I can't comment on that because, see, the way Mr. Kotak's journey, if you see, he started as an NBFC.
Correct.
But immediately he moved to bank because his
team and India Bonds presents Bond Street.
Welcome to Bond Street, and as we head closer to the end of this year, if you look at the yields overall, well, we've seen them, especially in case of corporate bonds, gain up slightly by the point of 3 to 4 basis points in the secondary markets there. Interestingly, when you look at the overall market, the last 24 hours actually have seen the yield on 6.48%, 2035 gilt rise to around 6.6643% there. trading at highest level since March 18, and this is on the back of lack of announcements of any other opening market operations auction there. There also is a rise in the US yields, by the way, and that seems to be impacting the Indian markets as well. And we have seen a decline in rupee also in turn supporting that. Interestingly, when you look at the bond deals on the bourses, which is NSE and BSE, if you look at the last two trading sessions, Friday was 135 billion, and we've seen a decline on Monday to around 91.93 billion there. The bond street, when you look at the corporate bonds and the number of trades that we have seen happen, well, that clearly seems to be going on the higher side as bond seems to be becoming mainstream, especially in 2025. So when you look at FY 24-25, it was 11.9 lakh number of corporate bond trades that we saw happen. In this year, in this financial year until now, till the month of November, it has been to the tune of 16.2 lakhs. Now, the street does believe that the way we are going in sense of implied annualized growth there, by the time we are at the end of FY26 in the month of March, this would be much higher to the tune of 24.32 lakhs as well. So the implied annualized growth rate that we are looking at in sense of number of trades stands at a tall 104%. Also, take a look at the trading volumes, especially when it comes to corporate bonds in the secondary markets. So FY 24-25 saw 17.1 lakh crores there and there. And then till the month of November for the current fiscal, it stands at a tall 14.96 lakh crores. The implied annualized growth and the volatility, when you look at both of these, the FY26 perhaps is estimated to close at a tall 22.4 lakh crores as well. In this case as well, when you look at the implied annualized growth that the street is working with, is to the tune of 31%. So what we saw in FY24 was a growth, absolutely. FY25 really seems to be building onto that one. The numbers clearly show that. But with that, let's go for a short break. Come back and talk more markets and stock specifics.
CNBC TV18 and India Bonds presents Bond Street.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Where he wanted to address, where he wanted to focus was maybe a bank. My constituency is different. I want to be in retail lending. I want to service the customers who are underbanked and unbanked. So, and there is a huge opportunity and scope for me being an NBFC. Whether I need to change that, I don't really see that now.
But what about MUFG? Does that, does the ambition change with MUFG coming in?
So that is something which we need to discuss over the period. I don't think this is the time to discuss about it. And a banking vehicle is totally different. And your constituency is totally different. When you become a bank, you need to be prepared for multiple services. You can't be just lending services. Right now, being a focused lending company to the self-employed and small enterprises, SMEs, we are focused on that. And there is a huge opportunity potential for us to service this particular segment, which is underserved. And we would like to prefer to be in this segment because as per the own RBI's data, RBI and World Bank data, around 40 lakh crore is the credit gap in SME sector alone. Forget the other segment which we are in vehicle financing. So there is a huge scope and opportunity. Why should I change my constituency? And that's giving me a good margin and good customer connect, and I'm able to do a lot more things with my customer. I need not do that.
Okay, so you need not do that. At least that idea is parked for the moment. But let's talk about something that you brought up, and that is the cost of funds. How much do you see an improvement as far as your cost of funds are concerned? What kind of a decline are you envisaging now with this deal going through?
See, right now, if you look at my balance sheet, my debt to equity ratio, which is around 4.3, 4.4. With the infusion of this, as and when the money receives, maybe it will come down to around 2.6 level. And again, there is a scope for me to increase my debt to equity ratios so that profitability goes up. So the pressure on me to raise resources comes down to that extent, and therefore I'll be more choosy, and I can bring down the cost. My expectation is that I can bring down the cost by around 40-50 basis point incrementally over the period now.
That's a significant improvement over what you guided, which is about 15 basis points at this point in time, right?
That's normal course, yes. With this capital coming in, it is going to be that much. And long run, it is going to be much higher because with a strong balance sheet, our ability to raise resources at cheaper cost will further increase.
So can you lay out the trajectory on what you mean by in the long term, you can see an even more significant than a 40-50 basis point?
You know, the index is still yo-yoing in that very narrow range, still at around that 26,200 mark, around 15 odd points higher. The dip has gotten bought into, but it's just a very narrow 75-point range so far in the first couple of hours of the trading session. But the one stock, before we go to Sudarshan, is Tata Capital. Since we are on the subject of new listings, Tata Capital has traded in a 15 rupee range all through this while since its IPO, and today it has moved higher, 4.5% higher now on the stock. And if we check, this might just end up being the biggest single day gains it has had since its listing. The IPO price was 331. It continued to trade between that 336 to around 320 odd range all through this while. And now it has moved above those levels on strong volumes as well, has Tata Capital. So 4.5% higher on the stock. Speaking of new listings, Meesho has had a very, very topsy-turvy day. The stock at one point was down 7%. Then it saw a very sharp recovery, and then that recovery has been sold into, and it is back to the lowest point of the day. 7% lower on Meesho, now 187. The post-listing high is 254. So it's almost 25% lower compared to that post-listing high. Now, on this weekly expiry session, what is the FNO space indicating? Sudarshan is here to tell us just that. Sudarshan.
So it's a weekly expiry day, and as you mentioned, that Nifty is trading in a narrow range of around 70 to 100 points, and this is what the options data is indicating. Good parties, Nifty is holding to the levels above 26,100. Not so good parties, Nifty is unlikely to move beyond 26,200 if we go by the options data. Why I'm saying so? First, let's take a look at the put options. 26,100, 26,150 and 26,200. All these three put options have seen a fall in the premium. But at the same time, if you go on the call side, the maximum addition in the open interest is being seen in 26,100. At the same time, premium for the same is moving higher. But if you take a look at 26,200 call option, for that, premium has moved lower. So in very near term, it's very difficult for Nifty to move beyond 26,200. I've checked the next week data also. Even the expiry for 30th December is indicating that it's tough for Nifty to move beyond 26,250 or maximum say 26,300. So support, immediate support for Nifty would be 26,100. If we fail to hold that, next support comes around 20-day moving average of 26,000. Resistance remains around 26,325. For Nifty Bank, support would be today's intraday low of 59,200 and resistance would be 59,400. I have taken some of those stocks, two stocks that are seeing short covering. One is Chola Investment. I had mentioned in the morning that the stock might see an upside, and this is what reflecting. It has seen a sharp short covering after the company's clarification, and also there was a positive brokerage note, and the stock is sharply higher, currently up more than 7%. Another stock is seeing short covering is REC. Some of the stocks that are seeing fresh longs, first one is Coal India, because there is a report of one of its subsidiaries may file for an IPO, and on the back of that, the stock is higher. And another stock is seeing fresh longs is Godrej Consumer.
Thank you very much for that. Let's invite Sneha Sheth from Angel One on the show now for a quick technical check on the market. Though not much is moving at the index level. Sneha, what is your summary deduction from the way trade has panned out today? Very quiet and flat.
So very good morning. Overall, if you see Nifty, yes, we have seen a very strong move in last couple of sessions. And today, being an weekly expiry, and especially looking at the options activity, it seems that Nifty may conclude this weekly series around 26,150, 200. That is the range which we are looking for. I believe any up move towards 26,200 to 20 should be in the levels wherein intraday traders should be exiting their long positions. As far as positionally the trend is concerned, I believe we may soon head towards 26,000 and 26,300 and beyond even. On the lower side, I believe 26,000, 26,100 is the good support zone. So overall, private sector banks haven't moved much, and if they continue to participate, then I believe Nifty may, may see a fresh record high anytime soon. So overall, biasness remains positive.
Fresh record high anytime. So yes, Neha, please go ahead.
Yeah, so for as far as the individual counters are concerned, I have a 2 buy call. The first one is from the metal space. Now, if you look at the Steel Authority of India, this counter has corrected decently, and I believe it has taken support near the 200-day simple moving average on the daily chart. And looking at the last 2 sessions activity, along with the options activity, I believe we may see an up move at least towards 138, 139 is the level which I'm looking for. The stop loss can be maintained around 130 in this case. Apart from this, the another counter which I'm liking is UPL. Now here also, if you see the chart structure is very strong. It's the third session wherein we have seen a very strong move. Stock is, looks poised for an up move at least towards 810 zone. So go ahead and buy this counter. Keep a stop loss of around 769, and the target would be around 810.
Thank
Yeah.
you. Oh, sorry.
Thank you so much for sparing time and joining us today with your views on the index and specific stocks as well, Sneha. The other one, of course, is Samvardhana Motherson. The company announced an acquisition yesterday, acquiring Nexans Auto's wiring harness business. And Sudarshan is here. He's back with us to tell us more on the bull versus the bear for Samvardhana Motherson. Sudarshan.
So Motherson has had a very good 2025. It's been one of the biggest outperformers. If you talk about all the auto names, the stock is up more than 70% in 2025. And after Q2 earnings, in which company had reported a very strong set of earnings, since then stock has moved somewhere around 20 to 30%. Now today there are 2 notes. One is on the positive side, another on the negative side. But even the positive note does not indicate a much upside in the stock price. So Nomura maintains buy call target here is 125 per share. Current share price is around 120 rupees per share. Company is saying that the company has announced acquisition of Nexans Auto's wiring harness business to foray into global PV wiring harness segment with an attractive acquisition and potential transaction. As per Nomura, it's a cash EPS accretive and is attractively valued at 4.3 times CY24 EV to EBITDA, and it could potentially lead to EPS accretion of 2% in the first year itself. But Kotak Institutional Equities has a sell call, and here the target price is 95 rupees per share. It believes that acquisition to be marginally EPS dilutive in the near term, and muted global PV trends and expensive valuation underpin the sell rating of Kotak Institutional Activities. We also had a chat with the management. Let's listen in what exactly he has talked about the acquisition and also about the outlook on the business front for FY26 and the beyond.
It's a very exciting opportunity for us, which is fully supported by the top customers. This will nearly double the revenues of the wiring harness business in Europe. We expect the closure in the first quarter of 26-27, and the revenues currently are shaped above 700 million euros. As we make deeper inroads with the premium car makers, it will open up more and more cross-selling opportunities, as well as it will help us in our integrated modules business, where we will be able to add more content, as the customers have been looking for someone who can give modules. So that's also a kind of direction in which we will all work. Quarter is around the corner for closure, so we can't talk much about this quarter. But definitely year on year, you would see improved revenue performance. The company has had many acquisitions which have been merged in, plus all the entities which have gone in for restructuring in Europe, especially, have started to give better results. So that's what we told you at the end of the last quarter. And we will be able to give you more color as we close the quarter and move forward. We do envisage double-digit growth as we move forward in the years. So it's not something which happens in a year, but we see a very good growth over the next 3, 4, 5 years after the acquisition is done. And even in the very first or second year, you will see a good growth, because the new products which the company has launched for the car makers, they will come in full flow.
So we're coming in on Samvardhan Madison. One stock, Chalet Hotels. We chatted with the management earlier today, and the stock is up 3.5%. What he basically said that November has been historic for the company. October was steady. December is likely to be steady. But November, the ADR, average daily rates and occupancy went through the roof. Those were his words, historic and through the roof in the month of November. And the street, 9:45 is when we conducted that interview. And you can see that since then, the stock has been fairly buoyant. Get into a break. We'll come back and talk about more stocks themes as you look at 2026. Stay with us.
Fly Emirates, fly better.
As far as your cost of funds is concerned?
We are AA plus and credit rating. We have been discussing with the credit rating agency for an upgrade, and if that happens, then there will be additional advantage. We will have a broader selection of broader sources to go, and that will bring down the cost further down. So apart from the strong balance sheet and rating upgrade, that should give us nearly, I believe, around 100 basis point decrease over the next 1.5 to 2 years, not immediately.
Okay.
It may take a longer time, but that will bring down my balance sheet cost of fund today is around 8.8.
Correct.
And that, if it comes down to around 100 basis point in the next 2-3 years, that much I can pass it on to my customers. Ultimately, how much we are able to pass it on to the customer and make them more comfortable, that matters a lot to retain my customer and grow the customer.
Well, let's talk about growth then, because that's the big question. What do you do now with this capital, which is quite significant, that's coming in? Does that whet your appetite to grow more aggressively? And does it change your portfolio mix as well?
I don't really see a change of portfolio mix because there is enough opportunity in our segments like commercial vehicles, passenger vehicles, machineries, and two-wheelers. That are our major vehicle segment. Plus, you have a SME segment, which is around 15% of the portfolio. So, if you look at each of this portfolio, the demand is very high. Now, last 5 years, if you look at from 2019 onwards, commercial vehicle sales came down.
Yes.
And through the COVID, it came down further. And post-COVID, it has grown. If you look at the last 10-15 years commercial vehicle sales, you will see that whenever the sales come down, when economy slows down, come down, it jumps beyond what it was in the previous peak by 20%. This time it has never even crossed the previous peak. That is 2018 was the previous peak. That means there is enough potential. People have postponed buying a newer vehicle for nearly 4-5 years, mainly because India upgraded the emission norms to Bharat Stage 6. And at that same time, there was inflation pressures.
Welcome back and on to our special year-ender series. The year is drawing to a close and the focus is now shifting to what's in store for the next year. And Nigel is back with us to tell us how the coming year is going to shape up for aluminium companies and the industry as a whole. Nigel.
Well, that's right. Aluminium prices are ending 2025 close to the highs that we've seen this year. So the big question is, does aluminium have more steam left for the next few years? The answer could probably be yes, because there are two factors at play. One is demand is rising and supply is tight. Let's focus on demand first up. Aluminium demand is moving towards a structural story as electronic vehicles use a lot more aluminium than traditional petrol or diesel vehicles. Solar renewable energy projects, well, they are aluminium heavy, and global grid expansion as well as electrification are only accelerating. Put it all together, aluminium demand is estimated to grow at around 2.5% per annum for the next many years. The booster shot is supply growth isn't keeping up. The global aluminium inventories are sitting at multi-year lows. The LME aluminium stocks, well, they are down by roughly around 20% on a year-on-year basis for the past month. China, the world's biggest producer, is already running at around 97% capacity utilization. Production growth in 2025 has been just around 2.5%. And China's capacity is capped. So you'll ask, what about outside China? Well, things ain't easy out there as well. Aluminium smelters, well, they are competing with AI data centers for electricity. The US, Europe, and Africa, all of them are struggling to lock in longer-term power contracts, which means fresh supply of aluminium could probably be hard to come by. Just to highlight a few examples with regard to the power issues. Century Aluminium Smelter in Iceland, well, it faced a partial shutdown in late 2025. That's in late October 2025. While Mozal Aluminium Smelter in Mozambique, that's set to be placed on care and maintenance from March 2026 because the smelter was unable to secure an electricity supply agreement. NALCO joined us here on CNBC TV18 and they said that they expect aluminium to stay in deficit for the next 2 years. On the cost side, aluminium cost curve is hovering around $2,400 per ton for nearly 90% of the producers. Now, in a deficit market like this, prices usually stay well above this cost curve. Let's wind it down then with the valuations of the listed plays. Listed aluminium plays, that is. Hindalco, well, they benefit from higher LME prices through its Indian operations. Though the near term, well, they'll see cash flows which will get impacted because of Novelis's Oswego unit, which was impacted by a fire. NALCO, well, they have soft alumina prices for now, but they'll benefit from stronger aluminium prices. And Vedanta's aluminium business, well, it contributes most of their EBITDA and stands to gain because capacity additions are coming on stream and they are also working on lower coal as well as bauxite costs via sourcing most of their raw material from captive sources. Bottom line, with demand structurally rising, supply constrained, aluminium could remain firmer for longer. That's the hope at least.
That's the hope indeed. Nigel, thank you for breaking that down for us and telling us what's in store for these aluminum stocks in 2026. Coforge is now down to the lowest point of the day, 5.5% lower now on the stock and extending its losses from the initial recovery that was seen has been sold into. Take a short break. More on the markets on the other side. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Prices went up by around 30 to 40%. Therefore, many people have postponed buying or upgrading the vehicle. And I believe next 4 to 5 years, if India is growing at the current GDP growth rate, we should be upgrading most of our fleets.
Okay.
And also the new technologies are coming into the vehicles, whether it's a passenger vehicle or commercial vehicle, two-wheeler. As the new technology comes, the prices are going to be a little higher. So that will absorb most of the money what we have raised is what I strongly believe. So we should be able to grow more than 20% in these segments which you are in. Plus the SME segment is very vast. The opportunity there is multifold. So we should be able to really cater to the SME segment much efficiently rather than what we are doing now. We have been doing most out of the relationship now.
Yeah.
So we should be able to build more on SME portfolio.
You know, the kind of growth that you talked about, and a lot of it is because, as you pointed out, was pent-up demand on account of things like BS6, GST, and so on and so forth. But now with MUFG coming on board, with this deal getting done, do you accelerate the kind of growth momentum that you're already factoring in? And in terms of new opportunities, what kind of new opportunities, if any, do you look at? I understand that you will continue to double down on commercial vehicle financing, SME financing, and so on and so forth. But your AUM aspiration, does that now change on account of this deal?
Definitely, yes. There will be a higher AUM growth. We expect from 15% guidelines what we had given. we should be able to grow around 20% is what I feel, because we have enough branch network, depth in the management, we have a reach, we have everything to grow. We don't have to really build that to grow. Since I have that kind of a network and people, and also the constituency, my constituency is very comfortable with me, that the customers, I'll be able to really grow. So 20% growth is a comfortable growth for next 5 years. As long as India's economy is growing, the GDP growth rate is at what today, 8%, we should be definitely growing at 20%.
At 20%, at least for the next 5 years or the foreseeable future is what you're pointing out. But, you know, you also talk about...
Welcome back. Coforge is a stock which should be on your radar. The company has said that the board will meet on the 26th of this month, where they will consider a fundraise. After that, at 5:30 p.m., they will also hold an investor call. Now, the last fundraise done by Coforge was in May of 2024, when the company raised about 2,240 crore via a QIP to fund their Cigniti acquisition. The QIP price then and the current market price is not comparable because the stock underwent a stock split since then. Now, the question is, why is the company looking to raise money? We can only speculate, and analysts say maybe it could be for an acquisition, because the company has done acquisitions in the past. So Cigniti was a big one, Rhythmos, TM Labs. These were some of the more recent acquisitions done by the company. And at an investor call, which the company held very recently, one of the pillars of growth was acquisition. Acquisition could be for capability, it could be for geographies, like expand into the ANZ region, APAC, or even into industries which bolsters their presence in healthcare or UK public sector verticals. Now, the cash on the books is not much. So if they want to do an acquisition, they want to fund it, maybe, the equity fundraise could come in. Now, why is the street a bit concerned? Two reasons. One, any form of fundraise results in dilution. And two, the company in the past had faced some issues surrounding cash conversion. Analysts have pointed out that amongst all the mid-cap IT companies, Coforge's cash conversion was the weakest, the free cash flow generation. So therefore, the street was disappointed with that. And now, the company has turned the corner. They've said that free cash flow to PAT will be 70%. So the street doesn't want, any change to that guidance. So that could be some explanations for why Coforge is under pressure. But we'll come to know on 26th when the company raises that fundraise via, the fundraise on 26th. We'll get details.
Friday is the day. It's going to be an action-packed day. It's the final trading day of the full week of 2025. Coforge, as of now, 5% lower on the stock, among the top underperformers within the IT space. But the reversal has been seen in Cholamandalam. As the Cobra Post alleges corporate governance issues. Gaurav is here with more details, what brokerages are saying and what the company also clarified, which led to that reversal in the stock. Gaurav.
Well, yes, if you look at Chola, it is actually stock of the day, we could say, because it is not only up more than 6%, but it is also holding on to the gains. And the reason being that yesterday we saw a fall of more than 4%, and there was a post from Cobra Post, it is a journalist website, which suggested that there is a corporate governance gaps in the Cholamandalam investment, not only in Cholamandalam investment, but also in the Murugappa group and the promoter entities. Now, company said that the entire allegations are malicious and baseless, and at the same time, they have given some clarification. So first, let's understand what were the concerns raised by Cobra Post. There were concerns related to the related party transaction, high cash deposit that they have. Other than that, sharp increase in the auditor's fee. Then there were some concerns about the related party disclosures as well. And lastly, payment as a fees towards auditors and underwriting practices. Now, to all the concerns that were raised, Cholamandalam have given their comments on that, and in a very detailed format. First is that they say that the entire allegation were malicious and baseless. At the same time, they have also reassured investors that all the performance metrics are actually in line and robust for the company. For cash deposits, what they are saying is that the borrowers that they are catering to are predominantly the kind of borrowers who pay back in cash, and this is something which is in line with the regulators. In fact, on call, they also gave an example. Currently, the cash collection stands at around 15%. It was as high as 50% in the historical time frame for the company. And they say that the cash collection will remain as a part of a company because that is the business model that they follow. Second is that the related party transaction. On that, company said that related party transactions are fully disclosed, and at the same time, all payments are also in compliance with the regulatory requirements. On call, company also said that around 10,000 crores number, which is being revolving around through the post, It is actually a cumulative number for the last 8 years, and at the same time, payouts to Murugappa Management Services specifically are less than 1 crore. So definitely, company has given a very clear guidance, and at the same time has cleared the air, we could say. For third quarter also, they believe it is going to be a robust quarter. So all in all, company remained positive. Analysts also remained positive. As a result, we are seeing more than 5% gains, which are held by the company so far in a day.
6.5% higher for Cholamandalam. Gaurav, thank you for that. Just before we take that break, pull up these railway names and they are shooting through the roof as of now. Ircon is now up 12%. And the stock has seen a very, very sharp spike in the last few minutes. And there you can see there's RVNL, that's 4.5%. That's moved to the highs of the day as well. Look at IRCTC, that's moved to the highest point of the day. Look at Ircon. Ircon is up 12% as we speak, among the top gainers within the broader markets today. And that is the one that has led that spike among the railway stocks. There you can see the stock was at around 167, and within a few minutes, the stock has moved to 177 as of now. So sharp surge in a lot of these railway names. Take a short break. More on the markets on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
What is that restructuring going to entail? Is it a restructuring at the holdco level? Can you explain to us what the restructuring as part of this MU entails?
Basically, what we're talking about is the credit business and the protection business. We have a
insurance.
Partner. Yes, insurance.
Sanlam.
Yeah, life general we have. We also have the AMC business. We also started wealth business. So we would like to make this as a two broad segments. And the lending segment will be a totally focused one, where MUFG is going to be a partner. And the rest of the businesses are going to be with the Sanlam and other partners, if there are any. So like that, we are differentiating and making it. That's a plan. That's a structure which we are proposing. That is at a holding company level, is nothing to do with SFL level.
In terms of metrics now, and you gave us a very clear indication of what the cost of funds will look like, but in terms of other metrics, whether it's return on equity, etc., what could the next few years look like? What are you working towards? What are the targets?
There are multiple moving ratios here. Definitely the ROE will definitely come down because of the large capital infuse. But ROA will go up. So as the ROA goes up, then ROE will definitely go up. As we are able to leverage more, the ROE multiple will go up. That's how it looks like. But you have to see other moving parts, like net interest margins are going to go up because of cost of fund is coming down. Our credit cost is going to come down because we are going to onboard a customer with higher credit profile, better credit profile. That is going to bring down my credit cost to some extent. So this, and with these two in between, margin and the ROA, definitely the ROA will move towards from 2.8 now to around 3.6 level. And multiple of that, as I leverage nearly 4 times, and that's the kind of the ROE I'm going to get. So ultimately, we'll move towards 15.5 or 16 in the next 5 to 6 years, what is there today. So the growth trend is very clear, and all the ratios will be more positive year on year. And that should be the way we should be working for next.
As far as the margins are concerned, you did point out clearly that you expect a margin expansion.
It's been 60 minutes to 11 a.m. and the Nifty, what has it done? Precious little over that period. Still continues to remain at the flat line as we speak on this weekly options expiry session that now shifts into the second half of the day. Reema and I take your leave on trading our halftime report on the other side. Thank you so much for watching.
Of this deal going through as well. What will the margin expansion trajectory look like over the next few years, you think?
The net interest margin could reach to around 10% because of the capital being there. Capital getting deployed will bring down your cost of fund to some extent in the next 2 to 3 years. So then over the period, it will moderate. So that's how it will look like.
The regulator, of course, the regulatory process will now start with the agreement being inked. What are the timelines that you envisage? And I'm sure that there would have been an informal check with the regulator on whether this deal has their blessings or not.
See, we are going to put the application now. Definitely, we are in touch with the regulator for various other requirement purposes and also for a dialogue. So these are all things we have to be taking, the other interested organizations or parties or regulator in touch. So I believe there is they are welcoming this because it shows a lot of confidence in India's growing economy. That's one thing. And large capital coming in retail lending definitely help the credit growth and also the consumption, indirect consumption or direct consumption. It also add a lot of asset getting created. See, we are one organization which has always focused on lending against asset or for acquiring an asset. So asset creation gives a lot of opportunity for individual to progress in his life and building a sustainable income. So whether you are buying a taxi or buying a truck or bus or machinery, all this will add to your ability to improve your income. So that being the case, I feel the regulator will be definitely be very positive about it and hope everything will go on time.
What's the indicative timeline by when you expect all the clearances to come through?
We have given a 3 to 4 months window for everything, but hopefully would like to get
close
things
it earlier.
faster. Yeah.
So how does life change? Assuming that within the next 3 months, you will get all of your regulatory clearances in place, how does life then change when the clock starts ticking from then on?
See, we are already preparing ourselves for faster growth. So as and when it falls in and the money comes in, the next is the growth. How do we speed up?
Stocks trade ranged in a pre-Christmas trade as FPI flows flip. Utilities, metals and energy eke out some gains while IT, consumer durables and autos drag.
Adani Group announces the merger of Ambuja Cements, ACC and Orient Cement to create a 107 million ton mega cement company, while significant cost deleveraging that will be taking place and simplifying the group holding structure.
Cholamandalam Investment dismisses allegations by Cobra Post on irregular cash levels, suspect a related party transactions, ill-gotten gains by key management personnel and questionable transfers to rating agencies and for CSR. Analysts too see little merit in the allegations. The stock bounces.
Metals see buying across the board with precious gold and silver scaling new highs even as copper, aluminium, nickel surpassed recent peaks. Supply side factors are big drivers for non-precious metals. Hello, good afternoon. You all have tuned in to Halftime Report coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Ekta Batra as well. Ekta, good afternoon. But today, a bit of a muted day of trade, at least is what we are seeing coming in for the markets. You are surely ready for Christmas today, but the Santa rally seems to have taken a bit of a pause. Last couple of days, we did see the run-up. But today, 26,000 though. Nifty holding on to that, flip-flopping between the red and the green. Do not forget, obviously, Nifty weekly expiry as well. So some volatility on the back of that. But broader end of the market, especially the small cap side, that was managing to hold on to decent gains in today's trading session. As of now, also 0.1% of gain is what we're seeing there, Ekta.
Hi, Vinny. Yes, absolutely. Very quiet at this point in time. So just about preparing for Christmas. I'm sure a lot of people have packed their bags and they're on their way to their vacation spots. So for the Nifty, just about 11 points higher as we speak. We have the mid-cap index, which is just about 72 points lower. And remember that we did have an FII net sell figure which came through in yesterday's trading session after 3 to 4 consecutive sessions of buying. So maybe that's deterred sentiment a little bit in today's trading session. But nonetheless, let's get talking about the first company, or talking to the first company that we have on the show. OneSource Specialty Pharma is the first management on the show. Semaglutide goes off patent in Canada in January of 2026. So what are the opportunities for the company? And to talk more about that, we have Neeraj Sharma, who's the CEO and Managing Director of OneSource. We will also be discussing the Biosecure Act, which has now become law in the US. So what kind of opportunity CDMO companies do have from that? Mr. Sharma, thank you very much for taking the time out. Well, I'm going to start by asking you about the latest news with regards to the Delhi High Court order on companies such as Dr. Reddy's and OneSource, as well as Sun Pharma, and we just heard on Zydus as well, where the Delhi High Court has allowed semaglutide manufacturing and export to countries which do not have a patent, and you're not allowed to obviously supply to the Indian market till the patent is intact. Just give us a sense in terms of where things stand when it comes to these court cases. Are you a part of all of these court cases? And is everything intact in order to actually start manufacturing and supply?
Yeah, thank you, Ekta, for having me over. Yes, these court cases and the results are definitely positive, for the industry in India. Because as you know, while India itself is turning out to be a very significant market for GLP-1s, but also many Indian companies are looking at markets outside of India, to really expand and to grow the entire GLP franchise. So definitely, I can't tell you that whether we are on all these court cases or not, but the result and the decision from the High Court is certainly very positive. We at OneSource are already ready for manufacturing. In fact, we are manufacturing for our customers, and as and when our customers start getting approvals for markets like Canada and other markets where the patent is going to be expiring soon, that's when the actual launches will start. India definitely is an area where one of our customers already has an approval, and as soon as the patent expires in late March, our customers will be entering the market in India.
So just it's public knowledge that you are Dr. Reddy's is a customer of yours, considering that your name is mentioned in the Delhi High Court order. But that is the case for Sun Pharma and Zydus as well. Sun Pharma is one of your customers for GLP-1, along with Zydus?
Ekta, as I would say, whatever is in public domain, I'm happy to talk about. Whatever is not in public domain, no. But as I said, I would suffice to say we have a very significant customer base, Ekta, and our customers, our global customers, they would certainly be launching in markets where patent expires, and that includes India.
Okay.
Sure. Hi, Mr. Sharma. Good afternoon. This is Vinny joining in the conversation as well. So surely it's a big opportunity. But are there any more tie-ups that you're seeing from the global front as well? Because obviously we know the China plus one strategy, everyone moving and looking at India for that. But have you seen, we've spoken about inquiries? But anything materializing on the global front?
So most certainly, Vinny, this is an area I think I have mentioned earlier also on your channel that the whole concept of supply chain diversification is an absolute must. In fact, the trend, as you know, started with the pandemic and then really got accelerated, when both companies and countries realized that, too much dependence on a single geography is hugely detrimental to patients in countries, right? So the whole concept of expanding beyond one geography really happened, and then various ways, into whether it is the Essential Medicines Act in Europe or now the Biosecure in US. Getting passed. This is a huge development, for countries like India, with our such a significant manufacturing base, manufacturing expertise, our whole talent base, which we have, cost efficiency, and a strong, compliance track record with the global regulatory standards. So all these put India specifically, India, more generally, and OneSource very specifically, in a very good place to get benefit from this supply chain diversification, which is an absolute must right now.
Okay. All right. I got that. Well, this is public knowledge because you've mentioned it in your Q2 call. You have a tie-up with Natco Pharma for SEMA?
That's correct. That's also public domain. We have with Natco Pharma. In fact, in our partnership with Natco, we have Viatris as our customer in the US, and who have the first to file status and exclusivity in number of SKUs in the world's largest market, which is US.
Okay, all right. Well, what is your sense in terms of what the Canadian market will look like when semaglutide goes off patent in January? Because there are no companies which have still received approval from Health Canada. There are companies such as Dr. Reddy's which are now seeing delays. Are you recalibrating the opportunity from the Canadian markets?
So, Ekta, I can tell you that the opportunity is massive, and it continues to grow. Because as we have seen, as the supply has increased from the innovator itself, how the latent demand has been so much there. It was only artificially being constrained because of the supply. So as the supply grows, there will be a further boost to the market in Canada and elsewhere. You are right that as on date, there have been no generic approvals, but these are complex products, Ekta. So agencies do want to be absolutely sure, that they have seen everything before they approve. In fact, Health Canada hasn't approved any peptide product yet, but we, our customers and we are confident that the approvals will come. It's just a matter of a few months here or there. But the basic underlying demand and the market size remain absolutely intact. And we are really looking forward to, our customers. We have multiple customers who will be launching in Canada, and everyone is very confident and have given robust forecasts for this market. So we are really looking forward to getting into the market soon. It may not happen in January at the time of patent expiry, but it will happen, soon after. We are talking about a few months later.
Mr. Sharma, just leave us with an idea on how exactly the GLP market is now progressing, considering that we're having this conversation on a day where Novo Nordisk has received approval for the oral version of Wegovy by the US FDA as well. So it's a very fast-changing market where, people will probably transition from injectables to the oral version fast enough if the efficacy is the same. So in that context, where do companies such as OneSource stand? Do you have to transition faster as well?
So I can tell you, Ekta, that the market opportunity is absolutely tremendous, because it is the first time there has been a really products for such a scourge as obesity, right, which is the root cause of immense number of metabolic diseases. So how we look at it is that there is a potential patient population of anywhere between 1 to 1.5 billion people globally, who could be a potential. Now, whether the industry and is able to penetrate, 10% of this or 50% of this, nobody knows. But you can just imagine the colossal size of this opportunity. And I can tell you that's why with all the new clinical trials and the results, from purely a diabetic product, then for obesity, now these products are really products for metabolic diseases, whether it is chronic kidney disease, liver disease, and even beyond, with results in sleep apnea and Alzheimer's and so on. So it's a very, very large potential patient population, and all the new products. In fact, there are a number of new products in GLPs which are in pipeline. You will see all these finding a place because the patient population is so large, including orals. Orals also, orals have a place. Orals will be something which will be used by patients who've got needle phobia, and also, it's definitely a good opportunity, a good option for patients who cannot take injectables. But considering that a daily pill versus a weekly injectable, there are still, most people still go for injectables. We at OneSource are clear that, and so are our customers, that, while orals will find a place, the market will overwhelmingly stay as an injectable market. And we are very clear. In fact, we are doubling down in this area. I had mentioned previously on your channel that we are investing almost $100 million in expanding our drug device combination, both injectable and assembly capabilities and capacities. And we will be one of a very significant global players in this arena.
Okay, all right. Mr. Sharma, always a great pleasure talking to you. And obviously, the GLP market continues to be of great interest to everybody. And like you mentioned, the transition for it to possibly be used for many more conditions as compared to just diabetes, as well as, diabetes and weight loss at this point in time. Thank you very much for joining in and speaking with us. So that is OneSource talking about their business. We're going to do one thing. We'll take a short break, but we'll take you through all of the stocks that are moving in trade on the other side. Vivek will be joining in for that.
Fly Emirates, fly better.
Plan our growth. Already it has been planned, but then the acceleration starts, and
So that's what I'm trying to understand. What if you're assuming you're in third gear today and you're going to the fifth gear? What changes between now and then?
See, change is once you go into fourth gear, what happens when you drive the vehicle?
Yeah.
Then you are able to see the visibility much better. And you are able to maintain your speed and control in much better way. So you are in total control of what you are doing. So that's how I think moving from third gear to fourth gear will give us that kind of a comfort, smooth ride, and that will definitely be helpful to everyone.
They've got 2 board seats. What else changes on account of this deal from a governance perspective?
The best practices, what the MUFG Bank has, is definitely will come in. Apart from their expertise, their knowledge, that definitely get added. And probably our people also would be able to visit some of their investment, some of the companies where they invested, and try to see what they have done differently or unique. We would like to be a unique player. We don't definitely want to copy things, but that learning will help us to improve our management and efficiency. Ultimately, efficiency improvement is a productivity gain, and that will result in your better credit cost. That will result in better ROA and ROE.
So, you talked about how this is in a way a vote of confidence for the India growth story. It's a vote of confidence for the Indian financial sector. What do you make of the list of deals that have been inked this year? As I said, both strategic as well as financial, a whole bunch of deals getting inked in the banking sector, but also in the NBFC space. Yours, of course, the largest FDI into the sector, at least up until now. What do you make of this?
So
and does this change the competitive intensity of the business as well?
So what I understand is, India being now the engine of
Welcome back. Well, flat for the markets as of now, but there are specific stocks which are in focus. So Granules is in focus on account of that fundraising. So they've approved fundraising of up to around 1,762.5 crores. 1,462 crores will be raised via 2.4 crore in terms of convertible warrants, which will be issued on a preferential basis to promoter group as well as a non-promoter investor. And additional 300 crores will be raised via issuance of shares on a preferential basis to non-promoter investors. So both of these issuances are happening at 585 rupees per share. So that is a discount, or just about, it was a discount earlier to its opening price of around 600 odd rupees. Now it's corrected to around 598 rupees at this point. But let's go across to Vivek now. He joins in to tell us about all of let's go across to Sudarshan now, and this is our Insight Edge offering on halftime report. He's looking at Belrise Industries, which has surged in trade after it signed a strategic agreement with an Israeli firm, and the promoter has additionally sold 6.6% stake. We did speak to the company earlier as well. Sudarshan joins in with a 360 view on that. Sudarshan.
So it's been 6 months since Belrise Industries got listed on stock exchange, and what a move this stock has seen, almost double from the listing price of 100 rupees. Now the stock is hovering around rupees 180, and today also it has moved as high as almost 12% in today's trade. And the reason, two reasons. First, promoter has sold nearly 6.6% stake to raise almost 900 crore. Another company has also signed a 3-year defense agreement with an Israeli company. So now first talking about the block deals and why the company has sold, or promoter has sold nearly 6% stake. So basically it's to meet the minimum public shareholding norms. As of September 2025, total promoter stake was 73%. But in the DRHP, company had mentioned that there would be a merger of two related parties. Once that merger would have taken place, the promoter stake would have crossed 75%. So to meet the minimum public shareholding norm, promoter has decided to offload 6.6% stake. But the question is that will the promoter look to sell further stake? The answer from the management was no. As of now, there is no such plan. Now talking about the agreement, the 3-year agreement that company has signed with an Israeli company, and the name is Palasan. It's a 3-year agreement, and the objective of this agreement, first to back the order in the defense segment from the Ministry of Defense and other PSU companies and also other companies, and that would be specifically related to defense. And as part of this agreement, the company would also help in the global supply chain of Palasan. Now, about the outlook, we are seeing the strong demand that all the auto companies are seeing, and on the back of that, even Belrise Industries maintains mid-teen revenue growth outlook that company has given for FY26 as well as for medium term. Let's listen to what exactly company had to say about both promoter stake sale and the agreement that it has signed with an Israeli company.
Palasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Palasan on supplying some components for their global exports. So that's already in progress, and we should see revenues of that in the next fiscal year. Defense and aerospace in general as a segment would be a higher margin business than our automotive business. We are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'd appreciate is just this year we've announced 4 new manufacturing facilities. Right from our first earnings call, we have guided on merging or acquire 2 of our related party entities. One is Badwe Autocoms and second is Exumates. So if you were to merge both of these entities in, that would have pushed our promoter shareholding above 75%. And in that case, we would have violated the MPS norms set by SEBI. Hence, we have done this transaction in advance of the merger that we filed. And that is the reason why we have gone ahead and done this transaction as of today.
That's all about Bellrise Industries, but which are the other stocks that are moving around in today's trading session? We have Vivek to take us through the buzzing stocks. Vivek, over to you.
Well, thank you so much for that. Another session where, despite what was a muted opening, we've seen a very strong recovery, especially in the broad end of the markets, and the advanced decline ratio quite strong. In terms of the gainers, can't look beyond Bellrise. We just discussed that particular stock, one of the top gainers today. Antony Waste, that particular company got a 330 crore order from Maharashtra. This for a waste processing plant. That particular stock higher by almost 7.5%. Chola Fin, a lot of worries, a lot of whispers yesterday regarding a lot of allegations that were being put by one of the publications, but the company came out today, they gave a clear clarification to the exchange, also held an analyst call. Street clearly liked that, over 6.5% higher. The entire railway pack, all of the railway names doing very well, IRFC, RVN, LT Tiger, Jupiter Wagons, Ircon, Rights, all of these stocks higher significantly in the session today. So we'll wait and watch in case there are any developments as far as the railway names are concerned. And Coal India, that particular stock, yesterday reports indicated that there could be an IPO of one of the units that could come about. That particular stock, the top Nifty gainer today. On the other hand, very few laggards. Coforge, that particular stock, company is mulling fundraise via equity share issuance. Street doesn't like that. They just recently concluded a 2,400 crore IPO. The back of that particular stock lower by over 5%. IT Pack today taking a bit of a breather after yesterday, and last few days up. Most of the names are down anywhere between 0.5% to 1.5%. And Kajaria Ceramics, after the zigzag move you saw yesterday, extremely volatile trading session today, one of the top laggards on the NSE 500.
Okay, thank you so much for that, Vivek. But on that note, we're going to slip into a very short break. After the break, we'll have Sachitana and Dutika to understand what are the market technicals indicating, as well as his individual bets.
You want to talk business? Meet me in the on-board lounge.
One of the largest economy engine of growth. A lot of interest is there in India. So when I talk to people, meet people, I see a lot of positive things about India, which was not the case maybe some years back. So with that kind of a focus, interest, everyone want to have play in India, that really helps. So if you look at the India's growth story, the infrastructure is in place, logistics cost is coming down, manufacturing is improving, export is likely to have a much better impact because of all those things. And if there are the retail growth, which probably gives much better margins in the play. Any lending business, retail play gives a better margin. More people will be interested in coming to that. That's what I believe people are looking at right now. But these are all the positive trend. If at all you have, because if you, India government has talked about Viksit Bharat 2047 and a continuous growth of around 8%, reaching a 30 to 40 trillion. If that is the plan, and we as a responsible corporate, we also need to join this. I think that's where we believe there is a strong growth opportunity. And we should be able to attract much better capital coming into India. That's what's happening.
Well, you talked about all of the opportunities and, of course, the tailwinds for the business, so to speak. Any headwinds that you're concerned about today?
I don't really see headwinds for India's growth story and definitely for us. There may be a few things which may have to improve to reach this to the masses is the rural infrastructure. I feel the rural infrastructure is still need to be addressed, because more job you create in the rural area, that is going to really increase your consumption, because 65
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty is holding on to 26,180 levels on the green side as of now. But will this continue in the second half of the trading session? That's what we want to understand. And let's bring on board Sachitanand Dudekar, Vice President, Research, Derivatives and Technicals at Trade Bulls. Sachi, good afternoon. Thank you so much for joining us as always. Thoughts on 26,180 or 100? Will we sustain that to the day, or given that it's Nifty expiry, weekly expiry, we may see a fall in the second half of the trading session?
Good afternoon, Vinny. I think the 26,200 hurdle is very important. But eventually we see that particular hurdle getting crossed in a day or so, because the rally looks solid for a breakout towards 26,330 eventually. At least for the day, what we're expecting is more of a range-bound move. 26,180, 26,140 is the range wherein the second half may be seen for the Nifty on the spot levels. But if you look at the overall structure, I think we have what we have observed yesterday is a very strong breakout above that 26,000 mark. The opening of this particular week has been very significant, and that's why we believe that there could be a stronger rally unfolding towards 26,500, 560 zone during this particular week. So we are, maintaining a positive bias when it comes to Nifty. Even if we see a decline during the day, I think 26,140 is an ideal zone wherein some fresh additional longs can be deployed. The stop loss for the trade can be placed at 26,040 on closing basis. And eventually on a positional basis, we expect the rally to continue towards 26,330.
Okay. Well, what are your stock-specific calls today, Sachin?
Good afternoon, Ekta. I think what we have already seen is a very strong convincing breakout from HDFC AMC above its 50-day exponential moving average. Now, if you look at the overall structure, it was a significant low top, low bottom sequence. But recently, in the last 3 weeks, we have seen a strong base building action, and there has been a very confident reversal. The 2700 mark was also significant from a call writer's perspective, and what we are observing here is a good, strong short covering data. So we expect this particular move to extend towards 2800, 2840 on the higher side. And hence, we have also recommended building long positions to our clients with a stop loss at 2685. So that could be a disclosure. The other stock on our radar has been ITC, which has been very insignificant in the last couple of months. But if you look at the last 3 weeks, we have seen some, gain in its relative strength position. Even today, the 400, 410 mark has been very significant. This particular range looks now mature for a breakout. And hence, we are expecting a reversal in this particular stock. The base is well set at around 405, and that's why the stop loss can be placed at 402 on closing basis. One can expect a rally towards 416, eventually extending towards 430. And even here, we have recommended building long positions for a positional target of around 430.
Okay, Sachitanand, thank you so much for joining us on the show this afternoon, as well as giving us your individual picks. But on that note, we're going to slip into a very short break. On the other side, we'll have Manisha Gupta, who will take us through a conversation with Kunal Shah of Nirmal Bang Securities on the commodities front. Stay tuned in.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Of the population, depending on agri, which is only 15% of the GDP, that is a huge burden on agri sector. So if you're able to create more job out of the rural area, move to, that's where I believe the lending to SMEs or self-employed people more and more in the rural area is going to help the rural consumption, rural entrepreneurship, and for that, maybe infrastructure, rural infrastructure is very important. I think that's where I feel the infrastructure bottleneck are there, which I believe government will look into it, and both central and state will address that.
So let me end by asking you, would it be fair then to assume on the back of what you've told us that perhaps the first area of synergy would really be on digitization and more digital expansion? Is that what you're going to be leaning on as far as MUFG is concerned?
Yes, digital play, definitely yes. But our basic business model is a customer. We will never onboard customer remotely. We would like to build a relationship with our customer. So even when we strengthen our digital play, our customer interaction or customer meet will never stop. So we'll definitely be building a bigger infrastructure to reach the customer, adding more number of people. So
how many people were you planning to add? And on the back of this, how many people will you now add?
I think we may add around 5,000 people per year on an average for next 4 to 5 years to keep up the growth.
And any geographies in particular where you would like to accelerate your presence?
See, we have excellent presence in South and West. North, Central and East is a little lesser. Maybe we'll be able to create a bigger reach there and grow faster there.
Okay, so let me end by asking you if investors are looking for a snapshot of the key numbers that you're going to be looking out for and the numbers that you're going to be targeting, lay out for us what that snapshot over the next 5 years is going to look like.
See, basically, I can tell you, a snapshot means a 20% on the top line growth, ROA growth from 2.8 to around 3.5, ROE coming down a little because of the higher net worth and going up over the period next 5-6 years back to where we are. And that is what a broad snapshot I can give you.
Well, confident on growth and confident on the future now with this significant deal behind you, which has taken almost a year in the making. What's been the biggest challenge of getting this deal done?
See, I have been discussing with multiple investors or multiple organizations in the last 1.5 years because we were reaching 20% of.
Welcome back, and joining us on the show now is Kunal Shah from Nirmal Bang. Kunal, hi, thank you so much for joining us. There's a saying, sky is the limit, but when it comes to gold and silver, how high is the sky? You're on mute, Kunal.
So gold and silver, we both have seen, outpacing all our targets. The targets which we had kept for the year 2026, all targets are being met during the year 2025. So this kind of rally was not expected. But lately, I think the major reason why this bull run is getting aggravated more than the Christmas rally, it's more to do with what has happened in Japan. Okay, after Japan raised its interest rate by a quarter basis point, we have seen bond yields again shooting up. There was a sell-off in bond market. So market is not willing to accept that the inflation is going to go down. And this fiscal crisis and the monetary crisis fear are for real. And that's why we are seeing at even elevated level, the investment demand keeps coming in. One more thing which is to be noted is the gold-backed cryptocurrencies like Tether is offering one gold-backed crypto products. So holding of this company is now 110 tons. So just imagine this kind of demand was never there in the system. So it is very difficult to quantify which other crypto-based company is going to come up with a product like gold-based crypto and they are going to buy gold. So the investment demand at elevated levels keeps coming in, and that is what is driving gold prices at these levels. So we believe that wherever there is a small correction, I think the trend is looking positive only. We may not see aggressive return like what we saw in 2025, but gold will still continue to remain one of the very valuable and attractive asset class for the investors looking at the current global landscape of the Western economies.
Kunal, when we started 2025, $3,500 an ounce was a target by the end of this year. We are standing at $4,500 right now, $1,000 more than what the markets were anticipating. How would you look at 2026 as the best case or the worst case scenario for gold?
I think $4,000 should hold as a great support. I should not go below $4,000. And in the best case scenario, I see gold can go up and test levels of $4,650 to $4,700. I'm quite conservative in terms of giving targets after the stellar year. So right now, everything is just glorious. So I don't want to enter into 2026 with great expectation, and let the sanity prevail and expect a moderate return, good, healthy 10-15% return. That is very much possible. But aggressive return like what we saw this year is going to be very difficult for gold.
Let's talk about some profit taking in silver then, and if that is a possibility at all, because after 140% of gains, even if there is a 30 and a 40% of a profit taking, that's not so much, right? Because markets have seen very, very strong returns to their investments here.
Yeah, so silver is a very different story. It's a supply side driven story, followed by aggressive demand coming in from the new age sectors like data centers and more of the electronic demand. But I believe that for silver to really witness meaningful correction, there has to be an aggressive supply side shock. So supply should come aggressively during the year 2026. Else, then only you are going to see a sharp crash or something like that. If the supply is not responding to the sharp upside, then I don't think so. There's going to be some meaningful correction, $55, perhaps $60, $55. That's it. Prices may not go below $55. And if the supply side responds, then it's a different story. But right now, no empirical evidence suggests that there is going to be a sharp surge in supply in 2026 after this kind of rise. So even silver will continue to remain attractive asset class, but same like gold, the return expectation should be moderated. If you buy silver around $55 to $60 when it corrects, your return expectation should be $75 to $80. Don't expect it to go $100, $120, that kind of return. That looks a little difficult.
And what's your sense on copper? Because that's another one that has hit a record highs. In this week itself on LME markets there, we do understand that US is buying copper at a premium and a huge premium at that. And here as well, supply concerns are there.
Yeah, so copper, I believe, can outperform and be the best commodity for the year 2026. And we've been seeing that from last 3-4 months, and we continue to remain to that stance. We believe that copper prices on LME can test $13,500 to $14,000. And in India, that should translate into conservatively 1,300 to 1,350 rupees on MCX. So copper is our best pick. 3 reasons. 1, China's involution policy first. Second, the concentrate supply side have remained weak and is likely to remain weak going forward in 2026. And huge demand coming in from EV and the data center stream and from the power sector. So I believe that stronger demand, lower supply, and China involution policy, perfect storm for sharp upside expectation in the year 2026.
All right. So while gold and silver will continue to gain up, it's copper that can be the metal for 2026.
Okay, maybe that we'll have to watch out for the limit there now, right? Gold and silver has reached its limit, at least sky high limits right now. But thanks so much, Manisha, as well as Kunal, for joining us on the show, and Manisha for taking us through that conversation as well. On that note, we're going to slip into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Fly Emirates, fly better.
Because see, we were looking at the next 5 years or 10 years. And when I was looking at, I thought if I get a big international partner, I can look for 100 years. So when I say 100 years, a good partner like MUFG Bank, who if they are interested in India, then I can definitely think of a much larger story. So that's how I looked at. So 20% is a huge support, and that gives me a long
runway.
Well, we wish you the very best of luck as you start this new journey with MUFG Bank as your partner, and look forward to hearing more from you on the opportunities that you see on the road ahead. Mr. Revankar, many thanks for joining us here on CNBC TV18. It's been an absolute pleasure. Well, that is the big newsmaker and the big deal of the week from all of us here on The Record. Thanks very much for watching. Stay tuned to CNBC TV18. We'll be back in a moment with plenty more.
Hello and welcome. As we look ahead into 2026, markets are navigating a complex transition from post-GST adjustments and earnings resets to shifting consumption patterns and a long-awaited cyclical recovery in markets in key sectors as well. 25 has arguably been a tough year. And of course, expectation as we turn the chapter over into the new one is that it's going to be a little easier. Easier, not easy. Well, adding to the complication, of course, more recently has been the slide we've seen in the currency, the rupee, that is, from 90 to 91 in about 10 sessions, being pushed back this morning as we speak, but we'll have to see. To help us cut through the noise, we are joined by the core of Bank of America Global Research's India Equity team, analysts who advise some of the largest money managers and institutions investing in our markets. Amisha heads equity strategy at BofA. Gunjan Prithyani tracks autos across, two-wheelers, passenger vehicles and tractors at BofA. And Neha Manpuria.
Welcome back. Well, as we are set to draw the curtains on 2025, the year saw the biggest C-suite churn in over a decade in Indian as well as global FMCG companies. Shilpa rounds up all the big developments in the sector in 2025 for us.
The corner offices at many FMCG firms saw new occupants through 2025. From Hindustan Unilever and Britannia in India to Nestle, Unilever to PepsiCo globally, 2025 had some of the biggest consumer giants seeing one of the most dramatic waves of C-suite churn in over a decade. Let's start at home. HUL, India's largest FMCG company, saw CEO Rohit Java step down barely 2 years in the top job. His exit came after muted sales, flat volumes and investor pushback on the revival pace. Priya Nair, who served as the president of beauty and well-being at Unilever globally and has over 30 years of experience, has since taken charge and set HUL on a path that focuses on volumes to rekindle growth. Then there's Britannia. CEO Rajneet Kohli resigned in March and moved to HUL. He was replaced at Britannia by Rakshit Hargave, who was the CEO of Birla Opus. But then came the real shocker. Long-time MD Varun Berry abruptly announced his exit in November, with even his notice period being waived off. Markets reacted instantly, the stock slid over 5%, and all eyes are now on incoming chief Rakshit Hargave to steady the ship. There were also planned changes at Nestle India. That was a planned retirement. Manish Tiwari, who was heading Amazon India, has stepped in to replace Suresh Narayanan, who has been at the helm for a decade. Narayanan successfully steered Nestle through its biggest crisis, the Maggi ban. And then he focused on innovation and diversified Nestle's portfolio with expansion into categories like breakfast cereals, pet food, and more. Tiwari is now banking on digital growth, innovation and a consumer-centric strategy to get the FMCG giant accelerating on the next leg of growth. L'Oreal India and Diageo India also saw leadership changes. Overall, 2025 have been a tough year for the FMCG industry in India, which struggled with rising inflation, muted performance, slowing urban demand, while income tax cuts, GST rates changes and cooling inflation towards the end of the year, providing some relief, signs of recovery have begun to show. But the challenge is to keep the ship steady at the time of choppy waters on the global geopolitical and trade front as well. Now, while leadership changes in India were due to a mix of muted performance and planned transitions, the churn in the global FMCG landscape has been a lot more dramatic. Let's start with Nestle Global. Now, the company saw 3 CEOs change in less than 14 months. In August 2024, Mark Schneider was replaced with Laurent Fréchy as Nestle CEO to rev up the company's performance. But Fréchy was ousted less than a year later over an undisclosed personal relationship, and Philippe Navratil was then appointed CEO. Nestle's then chairman, Paul Bulcke, too, first announced that he would retire in 2026, a year earlier than his scheduled retirement. But then he exited even earlier in September this year, and Pablo Ayala has taken over from the 1st of October. All against the backdrop of the company's worst growth in 2 decades, with volumes being flat or even declining and sales shrinking as well, and the boardroom losing patience quickly. Unilever also threw a curveball. CEO Heinz Schumacher was out in less than 2 years, and the company was looking to turn around, but the board wanted faster change, and they handed over the reins to CFO Fernando Fernandez, who has now taken over as the CEO. Diageo also has multiple faces that have occupied the corner office through 2025. In the middle of a multi-year cost-cutting reset, it saw CEO Deborah Cruz step down. Nick Jangiani took over as interim chief, and now the firm is looking forward to welcoming Sir Dave Lewis as its new CEO in 2026, tasked with turning around the maker of Johnnie Walker, which has been plagued with declining sales and high debt. Even Coke and PepsiCo are both pivoting as they struggle to swallow weak beverage demand worldwide. Henrique Brown, who worked at Coke in various leadership roles for 30 years, is now set to take over as the next CEO from March. Rival Pepsi is also in the throes of reorganization. It has elevated its North America CEO to a newly created EVP and vice chairman role, and it has appointed new CEOs, one for North America and one for Latin America Foods, and it soon also unveiled a new plan to accelerate sales and also improve margins. Now, in the global FMCG space, there's a clear pattern to the cause of this churn. Sluggish volumes, discretionary slowdown, rising competition, rising input costs, and geopolitical uncertainty. But most of it all, investor impatience. Boards and investors no longer want 5-year or 10-year plans. They want visible action, and they want it fast. 2025 has seen the FMCG world transform from slow, steady, and predictable to high-stakes, high-pressure battleground where even industry veterans can be shown the door if numbers don't impress. In today's FMCG boardrooms, the message is brutally simple: deliver growth or move aside.
Okay, Shilpa, thank you so much for that. But with that, we're going to slip into a very short break. Nifty still at 26,180 levels. After the break, we'll talk about more markets, stock-specific action. Stay tuned in.
You want to talk business? Meet me in the On-Board Lounge.
And pharmaceuticals at the firm. We'll try and break down what 2026 could look like for markets overall and, of course, for some of the key sectors as well. Thanks very much, all of you. Gunjan, Neha, Amish, appreciate you guys coming down.
Pleasure.
So should we start right at the top? From a strategy point of view, Amish, how are things looking? I mean, the consensus is that it's going to be a little easier, as I said, not like an explosive move or anything of that sort, but maybe a little better into 26 over 25. Is that just turn of the year kind of optimism? We all feel a little more optimistic at that time. Is that time of the year, or you think it's grounded in numbers and you can sort of build that case up from bottom up?
I would agree. 26 is looking better than 25.
Yeah.
So let's say same time last year, markets were looking expensive. Earnings growth expectations from consensus was quite lofty. It seemed like earnings will come off. Small and mid caps was driving the rally. In fact, lower the float on the stock, those stocks were doing well, which seemed like momentum trade that will not sustain. So I think all of that is now behind. If you look at so far in this calendar, for Nifty companies as well, FY26 consensus has already cut their earnings by 11 percentage points. and for FY27 by another 6 percentage points. So I think earnings expectations are now sensible, and earnings growth we think is going to accelerate. So as a result of that, valuations are now also looking reasonable. I would not say Indian markets are cheap still, but they are now reasonable. And with earnings improvement and no more earnings cuts, I would argue 26 is much better. And then finally, when you look at the events calendar, what can drive the volatility in the market, we do think that the events are also skewed on the upside rather than downside right now.
Lesser events which can derail the story in that sense, maybe, right? Hopefully. Has rupee come up in conversations with clients lately? In what way?
Well, it's in the front and the center right now because it's an unknown. And as we know, market always likes to have predictability. So, till the time, and we know the drivers of why the rupee is being weak. So how do you price in? At what price do you say that the rupee is now adequate? Will it appreciate? Will it continue to depreciate? So clearly there are sensitivities for stocks around that. So I think it's in the front and the center of the conversation. If you're a near-term investor, for the long-term investors, they do think that at some point in time, now we are at the fag end of this depreciation, things will settle down, and then they are looking at X of currency, how should they build their portfolios?
So for new investors, foreign investors who are coming in, I mean, you're better off buying now if the currency were to be stable from here, in that sense, right?
Definitely would say so. Even otherwise for a foreign investor, I would say that, historically, whenever Fed has cut rates, it has led to EM.
Welcome back to Halftime Report on CNBC TV18. As of now, the advance decline ratio still continues to be in the favor of advances versus decline. So yes, the broader end of the market, that's the small cap especially, is still managing to hold on to some bit of a gain. 1,750 stocks on the advance side. Apart from that, in the last 1 hour, we've seen some pickup coming in for Aavas Financiers as well as M&M Financials. Both these stocks have seen almost a 1.5 to 2% uptick just in the last 1 hour. So we'll be keeping an eye out on that as well. IFCI, that's another one, more than 2% gain in the last 1 hour. So watch out for that one as well. And obviously today's top gainers continue to be from the railway side, IRCON International, Railtel Corp as well, and IRFC also, which is in focus along with RITES. But let's put the spotlight now on Sun Pharma. That is in focus on account of most favored nation pricing that's coming in the US as well. Ekta, what does this mean for Sun Pharma?
Well, yes. So what has taken place yesterday is that the US CMS, which is basically the Center for Medicare and Medicaid Services, which is basically the insurance arm of the government, has proposed mandatory models to implement MFN, which is the most favored nation pricing model in Medicare Part B and Part D. Now, the model for Part B drugs is called GLOBE and the Part D is called GUARD. So, GLOBE stands for Global Benchmark for Efficient Drug Pricing. GUARD is guarding US Medicare against rising drug costs. So, MFN is basically if you sell a drug for an X amount in UK as well as other developed markets and it's higher in the US, then you have to match those prices in the other developed markets. So, hence the prices would then be lower. Now, under the GLOBE model basically pegs US reimbursement and rebate obligations to these international reference prices. Now, Macquarie has basically written on this development. They've said that Sun Pharma has the highest exposure to branded pharma. Sun Pharma has 20% of revenue from innovative medicines portfolio. Illumia, which is basically their drug for psoriasis in the branded segment, is the largest product and generates a meaningful portion of revenue from Medicare Part B. Illumia may fall within scope of proposed GLOBE model. So they are concerned that there could be pressure on Illumia going forward. Illumia's US list price, for example, is $17,000 plus and versus UK's NHS price, which is $4,731. Now, the implementation of the GLOBE model could then place downward pressure on its net price. However, they have mentioned in their note that the NYSE Pharma Index closed higher despite this news hitting the markets there, suggesting limited market concerns as of now. So, as you can see, even Sun Pharma, their reaction is limited as we speak. So, that's the reason why these stocks, however, continue to be in focus. But on that note, it's a wrap on Halftime Report. Business Lunch will take all the action forward.
whenever dollar has been weaker, it has led to EM flows. If you look at our own house views, we are expecting only 4% returns from S&P next year, but we are expecting 12 for Nifty this year in CY26. Right? So clearly returns also are skewed in favor of Nifty rather than the US. All of that basically points to the fact that logically FII outflows should at least become zero next year. Possibly could also be inflows.
So no more money out from equities, foreign money.
Is our view.
Is that view? And but is there any framework to kind of be able to sort of tell as you begin, or is it just like a function of various things, positioning and how much has been already sold, etc.?
So positioning, yes. But just think about it that if you are a multi-asset fund manager, then the way you are likely to look at is debt versus equities. So the 10-year bond yields are currently around, call it 4/4 on an average. So 4/4, add to that the risk of rupee depreciation. So you might be probably expecting, let's say 6/4 as rupee risk-free. And then add to that the fact that you're not buying bonds, you're buying equities, so you need risk premium. So let's say 5% for equity risk premium. So you're expecting about 11+% returns. As far as the markets give you a visibility that is possible, then the preference is more in favor of equities than debt. And then if you switch to, let's say, within equities, if I'm an emerging market portfolio manager, and then where do I allocate money versus India, China, Brazil, etc., then as I'm saying that on the back of the fact that India's earnings have come off, valuations are now looking okay, India at least is one of the alternatives versus throughout this calendar, India was a avoid. So I think all of that put together, whether you are an equity fund manager allocating between markets or whether you're an allocating across asset classes, FII outflows definitely, in our view, should stop.
You know, we had a senior person from Bank of America on the currency side, on the fixed side, on last week, and I asked him towards the end of the conversation, I asked him, what's the one non-consensus view that you have? And he said, well, dollar will appreciate in 2026. Well, I don't know if that's a published view, but he said it on record. He said it. So, yeah, lots of moving parts. We don't know essentially what's going to happen, but it's a constructive framework, Amish, that you're working with, right? Let's get to some of the sectors now. And Gunjan, autos has been the savior sector in that sense, right? Has done very well, and some of the stocks more than others. What Amish was talking about, that earnings will pick up and perhaps consumption picks up, etc.
Stocks trade ranged in pre-Christmas trade as FPI flows flip, utilities, metals and energy eke out some gains, while IT, consumer durables and auto dragged.
The Adani Group announces the merger of Ambuja Cements, ACC and Orient Cement to create a 107 million ton mega cement company while delivering significant cost savings and simplifying the group holding structure.
Cholamandalam Investment dismisses allegations by Cobra Post on irregular cash levels, suspect related party transactions, ill-gotten gains by key management personnel, and questionable transfers to rating agencies and for CSR. Analysts too see little merit in the allegations. The stock bounces up.
Metal stocks continue to see buying across the board, with the precious gold and silver scaling new highs even as copper, aluminum and nickel surpass their recent peaks as well. Supply side factors are the big drivers for non-precious metals. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. The markets have been trading range today, right? The advance decline ratio is still in favor of the advances, but the markets, they're not doing too much today.
It looks like they've already gone into Christmas mode, already gone into holiday mode. It's a very, very narrow range for the index, although there's a slight bit of an uptick that you can see on the Nifty as of now. The recovery from the lows of the day made an intraday low of around 26,120 odd, and from there on it's been in a very, very narrow range, but now it's moved towards the highest point of the day, looking back to get back towards that 26,200 mark on the index. Of course, 26,205, that's the important level to track on the index, and that's because it has not closed above those levels since the 5th of this month. So that is why that 26,205 level is important. It continues to find some resistance around those levels. Every dip though is getting bought into, and that is something that will comfort the bulls. We're still around 2 hours away. It's the weekly options expiry as well for the NSE contracts. So it's an important last couple of hours for our markets at least.
So it's key to watch what happens over the next couple of hours. But let's take a look at some of those sectors that have been doing well. The metal index, as always, is leading that up move. Hindustan Copper, SAIL, NMDC, all of them gaining between 1 and 3%. We've also got to keep our eyes out on those railway stocks, which are also doing very well in trade. But on the downside, we've got that IT index, which was gaining yesterday, but is now in the red and is the top losing index. If you take a look at Wipro and Infosys, all of them between 0.5% and 1% in the red. Pharma, realty stocks, all of them also losing in trade.
And that is the story of the market so far. Is that Arundhati, since she mentioned IT, and there's that one little recovery that is seen in Coforge. Of course, the stock is still down 4.5%, but at one point it was down 5.5%. So there is some bit of recovery, but as we saw in the morning, the recovery that happened as well, that got sold into very quickly. So it remains to be seen if that sustains or not. Still 5% down on Coforge, the top loser on the IT index. But the big newsmaker of the morning, though, has been Ambuja Cements, and that is after it approved the amalgamation of its subsidiaries ACC and Orient Cement with itself to create a pan-India cement powerhouse. Nigel is joining in with more on this. Nigel.
Well, that's right. The long-awaited and anticipated merger of Ambuja Cement's units have been announced, which will create a unified one cement platform. The board has approved the amalgamation of ACC and Orient Cement with Ambuja Cements. Now, Ambuja will issue 325 shares for every 100 shares held in ACC, while Ambuja will also issue 33 shares for every 100 shares held in Orient. The transaction is expected to be completed in the next 12 months, subject to regulatory approvals. You'll be asking, though, what are the big benefits? Well, it simplifies the group structure and it reduces holding company discount, because some brokerages, they did assign that holding company discount. Next up, well, it improves transparency as well as governance standards via elimination of master supply agreement and the related party transactions. It also aligns with Ambuja Cement's plan to increase the cement production from ballpark around 107 million tons to around 155 million tons odd by 2028. The management targets cost savings of around 100 rupees per ton from the supply chain efficiencies, while Nirmal Bang says that there could be an additional 40 to 50 rupees per ton benefits over the next 2 to around 3 years, which is expected from improved tax efficiency as well as working capital optimization. Since there'll be fresh shares that will be issued, there'll be some kind of dilution, and that's why the promoter holding will come down to around 61%, which compares with around 67% earlier. Brokerages, well, Morgan Stanley, they say that they view this as a positive development. It removes the overhang of managing multiple listed entities under Ambuja Cements, and that's why shareholders will like it. CLSA, they have quantified it. They say that the amalgamation will lead to 10% value accretion for Ambuja shareholders as per their analysis. So net-net, amalgamation will have a neutral to a positive bias for the combined entity.
Nigel, thank you for that update there on the cement companies. The other one, of course, is Cholamandalam, and that is the other stock, the big talking point today, and that is after Cobra Post alleged corporate governance issues. Gaurav is here with more on what Cobra Post had to say, and of course the resultant company clarification as well. Gaurav.
Well, yes, yesterday we saw the stock decline almost by 4%, and post-market we saw a news article from Cobra Post which suggested that there are some discrepancies in the practices, code of conduct and the governance practices that the company is having, and that is the reason why we saw some kind of pessimism. But at the same time, company came up with a clarification. First of all, company said that the entire allegation are malicious and baseless. Apart from that, there were certain allegations that were made in the likes of related party transaction, high cash deposit that the company have, related party disclosures, and at the same time some underwriting practices. So company came up with the clarification and has cleared all the air, it seems, because what they have said is that they have actually reassured insurers that the performance of the company and all the metrics are robust and disclosures are in line with the regulatory requirements. Other than that, the certain key issues. So first, let's talk about cash deposits. Company said that the borrowers that they are catering resultantly actually pay in cash, and that is the reason why these cash deposits will remain as a part of a business. In fact, 15% of the total deposits total repayments come in cash as per the company versus what it was at 50% earlier. And at the same time, they say that it's the nature of the business. Other than that, on related party transaction also, they have made it very clear that none of the related party transactions are against what the regulators have described. And at the same time, the 10,000 crore number, which has been revolving around, company said that this is actually a cumulative number for the last 8 years. And at the same time, several costs were not included as a related party earlier as a part of regulatory requirements. And that is the reason there is some kind of discrepancies that they might have found. Lastly, on the payment to rating agencies, there also company has made it very clear this is actually a standard industry practice. And in fact, they have also given some of the numbers. All in all, they have paid around 20 crores as fees to credit rating agencies for the loans that they have managed to raise almost at 1.7 lakh crores. So definitely that is something they say that is a regulatory and the industry practice, and it is actually lower than the industry if you look at the number. Lastly, they have also confirmed that all the operations of the company are carried out as per the law. So all in all, a very strong word coming out from the company. If you look at analyst community, they also took it in a very positive way. In fact, there is a trust that people have on Chola as well as Murugappa Group, and as a result, if you look at the stock performance, it is up and also holding more than 5% in trade today.
Absolutely, Gaurav. Thank you so much for those details. And that stock is now 6% in the green. But the other stock on our radar is Coforge, which is under pressure as it announced its board will mull a fundraise on the 26th of December. Reema Tendulkar is here with all of those details. Reema?
So Coforge has announced that the board will meet on the 26th of this month, where they will consider a fundraise. And after that, at 5:30 p.m., the company will be holding an investor meet. The last fundraise by Coforge was in May of 2024, when the company raised 2,240 crore via a QIP, and this was to fund the Cigniti acquisition. Now, you can't compare the stock price, the QIP price, to where the stock is currently today on account of stock split, which took place, after that. Now, the question everyone's asking is, why is Coforge looking to raise the money? We don't have the answers. We'll know on the 26th. But is it to raise, money for an acquisition? Because one of the pillars of growth for the company has been acquisition. They've done the Cigniti acquisition. After that, there was the Rhythmos, there was, I think TM Labs. So the company has grown partly on account of building capabilities via acquisitions. At a recent analyst meet, the Coforge had outlined some areas, according to analysts, where they could consider an acquisition. This would be to improve their capabilities in geographies like ANZ, APAC, and even in industries like healthcare and UK public sector verticals. Now, the cash on the books is not very significant, which is why analysts say if they have to do an acquisition, maybe they could be looking for some equity fundraise. Now, why could the stock be under pressure? Because one, every time you raise money, there is some dilution risk. And secondly, in the past, Coforge has had concerns with analysts on account of the cash flow generation, which was the weakest compared to other mid-cap or, large-cap IT peers. After that, the company has course-corrected, and they did guide that, the cash flow payout will be, free cash flow to PAT will be 70%. Is there a risk to that? Or will the company be looking to further increase their investments in data center? Because last time they said they will not be doing that. So I think there are some concerns, and plus Coforge, as we know, has been a rank outperformer. Not this year, but just over the last 3 or 5 years, stock has done very well. So interesting, board meet, Coforge looking to raise some money. 26th is the date.
So Coforge looking to raise some money. Thank you so much for those details, Reema. But it is the top losing stock on the IT index, down about 4.5%. Shifting focus to some news about the economy, the Ministry of Statistics has defended its sources and calculation method for the GDP, adding that the new series will resolve many issues that may have risen due to changes in the economy. The statement comes after the IMF gave India's GDP and national accounts data C grade, citing outdated base year, reliance of WPI as deflator, and gaps in integrating modern data points. Listen in to what MOSPI officials had to say.
They have the three concerns. One is old base of the GDP. Second one is the double deflation. And third one is the statistical discrepancies. These three issues are critical from the statistical point of view. In the new series, our team is addressing all these issues up to the best possible extent. As you all know, the current base is 2011-12. Since then, a lot of changes have been observed in the economy. New industries have come up over the period. New products have also been noticed in the market. digitization has taken place in the entire economy. New highways have come up and new system of toll tax have been introduced. Sales tax regime has been replaced by the GST system.
First is the issue about measuring the informal sector or the unincorporated sector. I think now we have the annual survey of unincorporated sector enterprises, and we have also started giving a quarterly report on that. And that is what is going to inform our base revision in the GDP, having an accurate, much more accurate. We had obviously proxies earlier, and those proxies were the best available at that particular point in time. The issue of double deflation. I think in the new series, we will not have single deflation in any sector. There would be in agriculture, in any case, we use revaluation of the output, which is the best, internationally the best practice.
We'll take a short break here on Business Lunch. More news and updates follow on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Seeing that evidence after these cuts, I mean, what started after a bit of a pent-up because there was that festive thing and, the Shraddh period and there was cuts happen. And right out of that, there was, of course, a big bump in sales. Has that sustained? Are you seeing that being durable, that bump in auto sales being durable, and in what segments mostly?
Sure. So yeah, certainly I think GST has been a very important catalyst. If I look at the sector growth, it's accelerated from nearly nothing in the first half to now in the range of 8 to 10%. So to your point, yes, there was a huge bump, almost 20% up during the festive days. But if you actually even normalize for the time the GST announcement was made till date, the registrations are up between 8 to 10% across various subsegments. So clearly there has been acceleration in growth and it's holding on. Our view is when you think from an auto upcycle perspective, everything that matters, be it credit, crude, cost of ownership through GST rate cut, cost of compliance, regulations are a lot lesser going into the next 2 years. A lot of things are aligned and hence, our view is that growth should sort of sustain going into next year as well. But I think the more pertinent point is, like you started off saying, that auto has been a savior. It's a space that's done well. The pertinent question that we face from investors is what's in the price. I think that's where a lot of positive revisions happened immediately post the GST rate cut. And now it seems like, the expectations have more or less aligned with this 8 to 10% sort of subsegment growth that we are seeing across the various
In some categories, are we going to very quickly revert back to the same kind of situation which persisted before the GST cuts, which is of too much inventory, etc.? I mean, are you starting to see any of that or no? It's kind of flowing through well.
So I think, of course, growth will normalize as the base catches up, but I think, 6 to 8% sort of growth looks par for course. It is
volume growth.
Volume growth, yes.
Oh,
so for PVs and two-wheelers, 6 to 8% sort of volume growth looks par for course as we get into a more normalized base next year. Of course, next couple of months, still the visibility of growth is higher, etc. I mean, you could see two-wheelers numbers being in double digits, but that's more of a base effect. So 6 to 8% for fiscal 27 seems par for course. I think the interesting subsegment could be CVs, which has had no implication from GST as such, but it is a second-order beneficiary of any economic recovery. So that's the segment probably to watch out from a next year's perspective, where expectations are still relatively reasonable, and we are starting to see a little bit inflection on that space.
This entire rare earth magnet issue, right? I mean, it's kind of disappeared off the thing. Although there's been has there been, companies are doing just fine without. So how's it happening? I mean, or it's going to be, it's an issue to watch in 26 as well, or you think it's sorted now?
Welcome back. On to some more market opinion. Earlier in the day, we spoke to Mark Mobius, the chairman of Mobius Emerging Opportunities Fund, on the AI theme, the Indian software and hardware companies, and the market as a whole, along with his outlook for 2026. Listen in.
AI has been pushed and pushed and pushed by so many people that it's quite bubble-like territory. But at the same time, you must remember that AI is here to stay and is expanding. More and more people are adopting AI systems. I myself, I'm using AI almost every day. So there's no question that the AI revolution is here to stay and will continue. But some companies have been emphasizing their AI expertise. And that really may be a little bit too much. Some of these companies are not really into AI directly. And so I think we have to watch it and pick and choose those companies that are really into AI systems and developing AI. Where we would want to focus is on the software companies as well as the hardware. In other words, computer hardware companies, which I think will be growing at a very fast rate going forward. Now, of course, many of these are not listed yet, but as we go forward, this will be a good development area. Well, I think a company like Infosys is a very good company. I'm looking at companies that are doing the hardware for Apple, companies that are not yet listed, but are going to be listed going forward. That would be a very interesting area to develop. I still like gold. I think gold should be part of any portfolio. I hold 10% of my personal assets into gold. And I think going forward, gold will continue to be very, very good. Now, it doesn't mean that it's going to go up in a straight line. There'll be corrections along the way. But there's no question that in US dollar terms, at least, gold will be doing very well, simply because of the proliferation of dollars around the world. And now with AI, you're going to see a lot more development in terms of literal gold. In other words, gold that is not necessarily hard, but soft gold embedded in some of the currencies. So this is going to be a very interesting development going forward. As far as we're concerned, India is number one. It's the most important market in emerging markets, not only because of its size, but because of the youth of the population and because of the developments that are taking place in India that will be revolutionary, very, very important.
So Mark Mobius there betting big on India. On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Fly Emirates, fly better.
Sorted in the short term. But there are two things playing out here. One is the easing of the supply chain. There's clearly a lot more availability now than it was a few months back. Secondly, if you also look at the EV growth in itself, that's sort of moderated. And that's outcome of, GST, because GST has made petrol vehicles cheaper, and hence that, this whole argument of shift towards EVs has been pushed out for a couple of years. I mean, we're seeing a lot modest growth in the on the EV side. So it's both combination of supply and demand being a bit modest, but I think longer term we'll need to find a solution, which is where, lighter rare earth materials, some of these companies are working towards that. Those are solutions we'll have to watch out. But for now, 3 to 6 months, I don't think that's a big worry in minds of corporates.
Niyam, let's talk about, you track hospitals, you track pharma, right? So let me actually pick up with pharma, sure, which is, of course, a big export sector. And the obvious question is this rupee thing, right? Does it make a difference at the margin for earnings?
Not really, not as much as probably it does for the other sectors. While pharma is export oriented, I think the one thing different about pharma is, it's not, US is the largest, but it's not the only market. You also have Europe, you also have, emerging market where currency tends to be volatile. And then you also have your raw material cost, which is usually USD pegged, and some amount of your spending is also pegged to local currency. So the flow through isn't as much, and therefore you don't see pharma stocks react as much to FX moves. I would say less so for pharma.
So what's the big dominant driver going to be for pharma, to your mind? Or is it going to be different things and different kind of subsegments where you'll find places to make money?
Yeah, so I think, while we use the term pharma, there are like 3 different subsegments. For the large cap or the US generic focused names, I think the tariff news has sort of died down. Yeah. Is the possibility completely out? No, you never know, right?
Which is those sectoral
tariffs, the Section 232 tariffs, right? At the moment, what White House has said is there's unlikely that generics would be included in those tariff discussions. Even for branded, we've not really seen anything come out other than the one tweet. So I think the tariff noise has sort of died down. It does not come up in conversation as much. I think for the US-focused names, the big debate is as you get into 2026, you had this very large product rev limit for most companies, which is going away, right? So how do you fill that hole? So are you looking at how is your US pipeline looking? Are you looking at other growth drivers? We have seen companies use the cash flow.
Welcome back. You're still with us on Business Lunch. Let's bring you some updates from US President Donald Trump. President Trump said that the peace talks to end the war between Ukraine and Russia are going well. Take a look.
The talks in Ukraine, Russia are going along. They lost, as you know, 27,000 soldiers last month, mostly soldiers, some people in Kiev, etc., but mostly soldiers. And the talks are going along. And I say that, there's tremendous hatred between these two leaders. Between President Putin, President Zelensky, tremendous hatred, and I hope we can get it done. We are talking. Talks are going okay.
Now, Donald Trump also said that the U.S. would maybe keep or maybe sell the oil it has seized off the coast of Venezuela in recent weeks, adding that the U.S. would also keep the ships that they have seized. Listen.
Oil that has been seized. The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it.
Where's it? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
And he also said that the U.S. needs to have Greenland, not for its critical minerals, but for national security.
We need Greenland for national security, not for minerals. We have so many sites for minerals and oil and everything. We have more oil than any other country in the world. We need Greenland for national security. And if you take a look at Greenland, you look up and down the coast, you have Russian and Chinese ships all over the place. We need it for national security. We have to have it. And he wanted to lead the charge, so we're making him, Marco, today, a special envoy to Greenland. Greenland's a big deal.
Meanwhile, closer home, the situation in Bangladesh continues to be grave following the December 12th shooting of youth leader Sharif Osman Hadi. The Bangladesh High Commission in New Delhi has stopped issuing visas, citing prevailing security situation. Following this, the Indian High Commissioner to Bangladesh, Pranay Verma, was summoned to the Foreign Affairs Ministry in Dhaka and was asked to ensure the safety of Bangladeshi officials at the missions across India. The move comes after groups of protesters held demonstrations recently outside the 2 Bangladeshi missions in New Delhi and West Bengal's Siliguri. Meanwhile, Bangladesh Chief Advisor Mohammad Yunus reaffirmed that they will hold the general elections on February 12th.
And while the market continues to do precious little, Tata Capital is one stock that has perked up in today's session, almost 5% higher on the stock at the highest point of the day now. And the interesting bit is it is for the first time that the stock closed above its IPO price of 326 yesterday, and for the first time in nearly 2 months, and now it has moved higher and broken out of its very, very narrow range. 315 was the low, around 333 was the high, and it kept on trading within that range ever since it listed on the 13th of October, and since then it traded in that range, and now it has moved higher. Just before we call time, a couple of other broader market losers. M&M Financial is one of them. The stock has had a one-way move in the last 1 month, seeing some bit of profit booking at higher levels is M&M Financial, 3% lower on that one. And some profit booking in Chennai Petro. That stock too down 3% in today's session. But railway stocks are continuing to move one way. Jupiter Wagons is up 13, Ircon is up 9.5, Railtel is up 7, RITES is up 6. So 5 out of the top 6 gainers on the Nifty 500 are railway stocks. That is the kind of move that you're seeing ahead of the end of the year. Of course, all of them are beaten down names, down anywhere between 40 to 50% from their peak, but doing well in today's session, more importantly on very strong volumes. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
This large drug to diversify their business and enter into newer segments, OTC, medtech, specialty. So I think there's a lot of focus on which of these will be your sustainable growth drivers and drive earnings momentum, probably not next year, but 2 years out. And therefore valuations are, I would say below, long-term mean, because there's still a little bit, headline earnings won't look as great because of Revlimid going away, but a lot of focus is on what happens to that, capital allocation that you're making into these newer areas for pharma companies. And I think for CDMOs, obviously, there's a lot of discussion around, reshoring, Biosecure Act, with China in licensing, how that impacts biotech funding, winters, has that improved? So I think there is more action, I would say, happening on the news flow side on CDMO versus the US pharma.
The exporters into the
yes,
US. So,
that's right.
And that's an area of interest for you in terms of CDMO, perhaps over the large cap
yes,
companies.
Yes.
Okay, hospitals we've not gotten to yet. I have to take a quick commercial break, so allow me to do that. I'll just take that, come back, and we'll continue this conversation right here. So let's do that. Take a break, and the BofA Top Equity India team is with me. We'll, of course, dive down into individual some of the ideas and what they like more than others. So all of that coming up in just a bit. Welcome back. This is Outlook 2026, and I'm sitting down with Bank of America Global Research's India top equity team. Amish Shah has, of course, been running us through the overall top-down strategy. Neha has been telling us about hospitals and pharma, and Gunjan, of course, has been putting the spotlight on autos as a space. Thanks very much, guys. We didn't do hospitals, Neha, so just want to start with that. So what's the thesis? I mean, it's been a huge wealth creator, and I think, for those who are looking at the headline inflation numbers which get released, and we do that all the time when hospitals come on board and we talk about medical inflation. Yeah. But that is like, from an investment point of view, it's a good thing, right? A bit of medical inflation, not too much, I guess.
Yeah, the debate is out on whether it's a good thing or a bad thing, because the peer pressure is real for healthcare sector across the globe. I think it's not specific to India. I think we're hearing more of it in India now, more in the recent time, because you've seen the kind of growth you've seen in, as we call, revenue intensity or RPOB over the last 5 years. Will that decline? I don't think so. You'll probably see that moderating. There was always also the COVID catch-up, pent-up demand in terms of surgeries, insurance penetration increasing, which allowed people to move up room categories, and that improves realizations for hospitals or revenue intensity for hospitals. There is a fair bit of debate on, at what point does it become a pressure for the hospital companies? I don't think it's anytime soon, because your insurance companies are still fairly fragmented,
Good afternoon and welcome to Midcap Radar, live from the CNBC TV18 Motilal Oswal studio. I'm Vivek Iyer, and with me today is Hormaz Sadakia. Good afternoon, Hormaz. Well, the Santa rally is finally here. We see a gap down opening, but every day we're also seeing a recovery. Today is another session where the Nifty has recovered, and now almost near the 26,200 level.
Nothing has changed on the market in the last 60 minutes or maybe all through the day other than my seating position from the last 30 minutes. But it's been that kind of a day. It's not very unlikely an expiry session as of now at least. But we have a lot lined up. Here's our headlines at 1:30 this afternoon. The stocks continue to trade in a very narrow range on this pre-Christmas day as FPI flows flip. Utilities, metals and energy are some top gainers while IT and consumer durables along with auto stocks are some drags.
Coforge under pressure, stock slumps 5% as the company says its board will mull a fundraise on the 26th of December. Street fears dilution risk and potential risk to profit guidance.
Bellrise Industries has signed a strategic agreement with Israeli firm Plassen to explore opportunities in the defense sector. The promoter also sold 6.5% stake to meet with minimum public shareholding norms ahead of a planned merger of two related entities. The management also tells CNBC TV18 that they are maintaining their mid-teen revenue growth guidance.
A Cobra Post report flags worrying patterns of large value cash transactions at Cholamandalam Investment. The stock, however, surges 6% as the company says the allegations are malicious and baseless with ulterior motives. Reassures investors that performance of the company, its asset quality and its liquidity position continues to remain robust.
And Antony Waste rallies another 9% today after its arm wins another 330 crore rupee order for development of 600 to 800 tons a day mixed solid waste processing plant in the state of Maharashtra from the Thane Municipal Corporation.
Well, that's right. Those are the top headlines. And as you can see, it's actually very news-specific, news-driven stocks that are doing very well in the session. You saw a name like Antony Waste doing quite well. Another stock that comes up on your screen is actually Naukri or InfoEdge. That particular stock has surged to the day's highest point. Well, our colleague Ekta did point out Sun Pharma and a development overnight as far as the US FDA was concerned. On the back of that, Sun Pharma has cooled off from the day's highest point. An important specialty portfolio drug could be part of the MFN program. On fears of that particular stock has cooled off. The other set of stocks that are doing quite well in the session, have a look at Asian Paints. That particular stock has recovered, now mildly in the positive territory. But overall, especially when you're talking about large caps, it's the metal names that stand out. Have a look at a name like Coal India. That particular stock continues to remain the large cap Nifty gainer of the day. And other names like NMDC, Nalco, all doing quite well in the session. But this is our special segment, Mid Cap Movers. Hormaz has skipped across to the wall to take us to the mid caps that are moving around in the session.
Well, nothing much happening in the market as of now, but can't take away from the fact that there is enough and more stock-specific action that is going around in the broader markets. We'll start off with the gainers then. And among the gainers in the broader markets today, Deccan Gold Mines is one such name, 18% higher now on the stock. The rights issue that is currently open for subscription will close on Friday. Nazara Tech has seen some outsized moves in the last couple of weeks, another 10% added in today's session. Copran is another name, 16% higher on the stock, and Steel Exchange India too seeing double-digit gains in today's trading session. But the standout sector today has been the railway names, and the top 5 gainers on the Nifty 500, 4 of them are railway stocks. So look at Ircon, at one point was up 13%. Railtel is up 7, RITES announced an order win this morning, it's up 5%, and Jupiter Wagons has also surged over 13%, following up from yesterday's 20% up move as well. In the newsmakers of the day today, Cholamandalam has been the big talking point. That stock continues to sustain with gains of around 7%. Coforge is seeing some bit of recovery from the lows. At one point was down 5.5%, so some buying interest emerging at lower levels. Antony Waste, a second order in as many weeks, and Sangvi Movers too, up 5% off the highs of the day, but a boost from an order win. Stocks that are doing well on the volumes front, Orient Cement is of course another newsmaker. That too is off the highs of the day. It's down up 5% now. Jai Bharat Maruti has surged to the day's high, and Akums Drugs, after ICICI Prudential bought stake in the block deal yesterday, that stock is off the highs of the day, holding on to gains of around 2.5%, but on very strong volumes. And lastly, some stocks that are bucking the trend, if you would like to call it, or some losers in the broader markets. DCX Systems saw one strong day of gains and has come off since then, 5% lower here. Also lower today, Newland Laboratories, Patel Engineering and Cartrade Tech, that has moved to the lowest point of the day, losses of anywhere between 3.5% to 5%, Vivek.
Well, thank you so much, Hormaz, for taking us through all of the those large movers, especially as far as the broader end of the market is concerned. But it's a good time to welcome Srikanth Chauhan from Kotak Securities for a quick technical check on the market. Good afternoon, Srikanth. Thank you so much for joining us. Well, 26,200 now on the cards, do you feel?
Good afternoon, Vivek. Good afternoon, Harmas. Yes, if we consider the overall trend of the market, then it is not the end. We are going to see the levels of 26,500 or maybe 26,600 in the very near term. And in case if there is any correction, then it will be an opportunity for us to create some long positions. The reason is because we have seen broad-based rally in the market since last almost 10 days. And whenever there is a correction in the market, we saw bottom shifting from 25,700 to next level. And now the bottoms have shifted to 26,000 levels. So maybe the market may spend some time close to this 26,200 levels, but eventually we are heading higher, and any dip will be an opportunity to create some long positions.
Srikanth, good afternoon. What about specific stocks? What's on your list today?
Good afternoon, Harmas. So yes, we like a few metal companies in that Vedanta and Nalco, they did really well in last 7-8 days. But now from here, we are more bullish on stock like GMDC, Hindustan Copper, based on their technical formation. Currently, GMDC is trading around 530, 531. If we consider its technical pattern, then it is forming higher top sort of formation and higher bottom. So higher top, higher bottom is clearly indicating us that the stock is into the specific bullish trend, and we can expect the levels of 575 or 580 in next few weeks. So it's a positional trade to buy at current levels with a stop loss at 510 on the downside. But we are expecting target of 580 or 590. And the other stock on which we are bullish is Indus Tower. There also we are seeing gradual upward activity. It is forming rising diagonal sort of formation, and we are expecting upward breakout from the stock. So from here, the stock can move towards the levels of maybe 450, 455, and we can keep stop loss at 400 for creating any long position.
Srikanth, if I may ask, it's a very limited trading history that you will have on the charts, but Tata Capital, that stock has moved higher today, and for the first time since its listing, it has come out of that very, very narrow range that it traded in, 315 on the lower side, 333 on the higher side. Volumes over the last 2 sessions have been very strong as well. Any view on the charts?
Yeah, I think, see, like whenever there is a lesser history, we try to analyze the stock based on its overall technical pattern on intraday basis. And based on the formation, yes, we are of the view that the stock is on the verge of crossing its important extension level, which is around 370. So from here, the stock can move towards the levels of 370. That's the view. The way the stock has corrected in last 15-20 days, and after consolidating a bit, it is crossing its all important levels, and it has crossed its previous high, as you mentioned. So based on its technical formation, the next level to watch out would be 370. But in the base case scenario, the stock may even move towards the levels of 420.
Okay, thank you so much for joining us, Srikanth, giving us a view on the markets, individual stock-specific calls, also answering our queries as well. We'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Sector is still an important, provider of healthcare in
You don't think anything will be legislated in terms of, not legislated, but basically we've reported on the channel that there have been discussions between insurers, between hospitals, government's been involved, asking them not to take large price increases. Even 2026, and some of the hospitals we've spoken with have confirmed that.
Correct.
So you don't think that's a big overhang from an investor point of view? Does that come up?
See, I think let's not equate revenue intensity to price increase, because revenue intensity is a function of a lot of things: case mix, payer mix, etc. Your price increases is still, low single digit every year, which is what we call as tariff adjustments, right? And given the medical inflation or the input inflation, that's what the hospitals are, mentioning, that's the tariff adjustment that you're taking. So I don't think, that's at, the double-digit number that your medical inflation shows. That's not the right reflection of it. And I don't see, that declining at any point of time, so at least in the near term.
In this space, I mean, stick with the large ones. I mean, or is there a way to do this? I mean, typically you'll have a company which will sort of, spend a lot, add capacity, then it'll go into a bit of a stabilization kind of phase. Then the next phase of expansion starts. And of course, now you've got lots of options. I mean, in the last 3-4 years, so many more companies are in the listed space.
Yeah. So I think you're right. You are seeing the sector go into expansion mode. So the selection would be based on how much capacity are you adding? Is it brownfield versus greenfield? So where could you see margin impact? Is it in your existing market versus, let's say, new market where your risk is higher? Given the entire sector is expanding, so you'll have to be a little more selective in terms of how you choose based on that expansion cycle, rather than buying the entire sector, which worked perfectly for last few years. Probably not not so much this year, but otherwise in the last 5 years the entire sector is.
You're saying valuations are high, so you got to be a little more
correct,
careful.
Especially as you're going into the expansion cycle.
Okay, no real cheap names out there. I mean, they're all adequately well priced from a near-term
That's
perspective.
correct. They are all, I think, even mid caps, large caps are all trading. There could be some discount between companies, but yeah, they're largely trading much higher than the historical average for some of the companies that have a longer trading history.
Amish, I mean, these two sectors, right? I mean, autos and hospitals, pharma, form part of the core overall kind of portfolio, very much so?
Yes.
Welcome back. CCL Products has now made its move towards the lows of the day, 4% down on the stock now. Among the top losers on the small cap index, there's a very sharp down move in the last few minutes. So 4% lower on CCL Products. Also, another stock that has made its move downwards is Aegis Vopak Terminals. That too has now slumped to the lows of the day, 3% lower on that stock as well. So a couple of losers there in the broader market. CCL Products, a very sharp down move in the last few minutes, and the recovery seen in Aegis Vopak too has been very swiftly sold into. But the newsmaker of the morning has been Bellrise Industries, and that is after the block deal that took place. Promoters were selling stake, and the company has also announced a strategic agreement with Israeli firm Plasan to explore opportunities in the defense sector. Promoters sold 6.5% stake this morning to comply with the minimum shareholding norms. Now, this is ahead of a planned merger of its two related entities. The management also told us that they are maintaining their mid-teen revenue growth guidance. Listen into a slice of that conversation.
Plasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Plasan on supplying some components for their global exports. So that's already in progress, and we should see revenues of that in the next fiscal year. Defense and aerospace in general as a segment would be a higher margin business than our automotive business. We are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'd appreciate is just this year, we have announced 4 new manufacturing facilities. Right from our first earnings call, we have guided on merging or acquire 2 of our related party entities. One is Badwe Autocoms and second is Exumates. So if you were to merge both of these entities in, that would have pushed our promoter shareholding above 75%. And in that case, we would have violated the MPS norms set by SEBI. Hence, we have done this transaction in advance of the merger that we filed. And that is the reason why we have gone ahead and done this transaction as of today.
Well, that was the management of Bellrise Industries, one of the top movers in the session today, and seeing significant pickup post the block deal concluded. Well, the next stock on the radar is Cholamandalam Investment. Remember, last evening, Cobra Post alleged significant corporate governance issues. Gaurav joins in with more details on what exactly the management had to say regarding these allegations.
Well, yes, there was a media report from Cobra Post, which actually suggested that there are some discrepancies in the corporate governance that the company is following. And after that, Cholamandalam actually came up with a strong statement and clarification. What they said is that the entire allegations are malicious and baseless. Apart from that, they have cleared the air, it seems. And let me tell you what were the key allegations. First was that was related to the related party transaction. There was an allegation against high cash deposits that they have, and also the payments of fees paid towards credit rating and some underwriting practices. Now, what Chola's management said is that first is that they have reassured investors that all the practices are well in the regulatory framework, and at the same time they have also said that on the cash deposit, borrowers are predominantly catered in a way where borrowers actually repay in cash, and that is the reason, and that is the segment that they have been catering to, and that is the reason why this cash deposit will remain. In fact, in terms of numbers, it has come down to 15% versus what it was at 50% historically, and at the same time they say that as a business these cash deposits will remain and they are all in line with the regulators. Apart from that, on the related party transaction, what they said is that all the related party transactions have been reported again in line with what the regulatory requirements are, and at the same time they have also given some of the numbers. Now, the 10,000 crore number which has been revolving around, they said that this number is cumulative for the last 8 years, and there were some related party transactions which were not falling under related party in the historical time, and that is the reason why they may find some discrepancies, but it is in line with what the regulatory requirements were even then. Lastly, on the payment to rating agencies, they say that this is actually industry practice. It is not something that they are doing on their own. In fact, if you look at the ratio, they have paid around 20 crores for the money, 1.7 lakh crores that they have raised in the past few years. And if you conclude and if you take out the ratio, it is again a bit lower than the industry average, is what the company has said clearly. Apart from that, they also said that all the operations of the company are carried out as per the law of land and at the same time as per regulatory guidelines. So all in all, management was very clear that all the allegations made were baseless, and at the same time they gave confidence to investors that the company is following all the regulatory requirements. In fact, for third quarter, they say that disbursements are likely to remain strong and it could be a turnaround for the company in third quarter. So all in all, a very positive word from management. Positive words were there from analyst community as well, because Murugappa Group and Chola, they actually hold some credibility in the market, and as a result, if you look at the stock performance, it is holding up in trade more than 6% in the day today.
Well, that's right, Gaurav. Markets, at least for now, are shrugging off all of the allegations and the concern that the Cobra Post article has mentioned, and clearly taking the management's words at face value. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
So let's say within the auto space, we like the passenger vehicles space, but we are not that optimistic on the two-wheelers. Because broadly we think that the mass consumption categories are still going to see a very shallow growth revival as compared to, let's say, a well-off consumption basket that will do very well. So in the well-off, you will have passenger vehicles come in, but the mass consumption is two-wheelers, where our view is that the consumer will still take time to delever before he starts to consume in a big way.
And what about
we were not that optimistic on pharma. We were positive on hospitals all throughout. Not so much optimistic on the generic pharma space. But for the next year, we have upgraded that to an overweight.
You know, this India, and Neha mentioned that in the tariffs and 232, Section 232 tariffs, broadly the India-US deal, it's kind of gone to the back burner, right? People were in the game of predicting it this week, next week. It's gone quiet. It'll happen. I guess that's the attitude?
Oh, absolutely. So I think, when I was saying that the risks are skewed to the upside, India-US trade deal getting protracted is one of the downside risks that we worry. Outside of the worries about what if rupee continues to depreciate, what if crude prices go up, and what if there is indeed a AI valuation bubble. So those are the four risks that we are looking out for. And as we know, India-US trade deal, the direct impact of that on current accounts and GDP is not that very high. but the follow-through effect of that, or the cascading indirect impact, that we do worry, and that is definitely.
What is the BofA team, say in Washington, etc.? What's their view? I mean, what's kind of holding this up? I mean, all kinds of theories out there, but is it going to be protracted? Is it going to happen? And how will it happen? When you talk about a deal, is the penal tariff of 25 going to go away? The reciprocal also is going to get addressed. All of it in one shot. What should we expect?
So the feedback that we get from the stakeholders in Delhi is that discussions are all done, and then now it is just about the final signatory. How much time will that take is anybody's guess as of now.
And what about from
similar voices? So similar voices. The idea is that they want to get done with these deals and then focus on the local politics, especially as the midterms come through.
On this AI question which you raised, what's the BofA global team's view?
We are in the positive camp. So our global team believes that AI valuation is not above.
Welcome back. Now, as the year comes to an end and the focus shifts on what is in store for 2026, Nigel is here to tell us how the upcoming year shapes up for the aluminium companies and the industry as a whole.
Well, that's right. Aluminium prices are ending 2025 close to the highs that we've seen this year. So the big question is, does aluminium have more steam left for the next few years? The answer could probably be yes, because there are two factors at play. One is demand is rising and supply is tight. Let's focus on demand first up. Aluminium demand is moving towards a structural story as electronic vehicles use a lot more aluminium than traditional petrol or diesel vehicles. Solar renewable energy projects, well, they are aluminium heavy, and global grid expansion as well as electrification are only accelerating. Put it all together, aluminium demand is estimated to grow at around 2.5% per annum for the next many years. The booster shot is supply growth isn't keeping up. The global aluminium inventories are sitting at multi-year lows. The LME aluminium stocks, well, they are down by roughly around 20% on a year-on-year basis for the past month. China, the world's biggest producer, is already running at around 97% capacity utilization. Production growth in 2025 has been just around 2.5%. And China's capacity is capped. So you'll ask, what about outside China? Well, things ain't easy out there as well. Aluminium smelters, well, they are competing with AI data centers for electricity. The US, Europe, and Africa, all of them are struggling to lock in longer-term power contracts, which means fresh supply of aluminium could probably be hard to come by. Just to highlight a few examples with regard to the power issues. Century Aluminium Smelter in Iceland, well, it faced a partial shutdown in late 2025. That's in late October 2025. While Mozal Aluminium Smelter in Mozambique, that's set to be placed on care and maintenance from March 2026 because the smelter was unable to secure an electricity supply agreement. NALCO joined us here on CNBC TV18 and they said that they expect aluminium to stay in deficit for the next 2 years. On the cost side, aluminium cost curve is hovering around $2,400 per ton for nearly 90% of the producers. Now, in a deficit market like this, prices usually stay well above this cost curve. Let's wind it down then with the valuations of the listed plays. Listed aluminium plays, that is. Hindalco, well, they benefit from higher LME prices through its Indian operations. Though the near term, well, they'll see cash flows which will get impacted because of Novelis's Oswego unit, which was impacted by a fire. NALCO, well, they have soft alumina prices for now, but they'll benefit from stronger aluminium prices. And Vedanta's aluminium business, well, it contributes most of their EBITDA and stands to gain because capacity additions are coming on stream and they are also working on lower coal as well as bauxite costs via sourcing most of their raw material from captive sources. Bottom line, with demand structurally rising, supply constrained, aluminium could remain firmer for longer. That's the hope at least.
Well, thank you so much, Nigel. The key takeaway being that aluminium could remain firmer for longer, as you just mentioned. Well, moving on, Tata Motors has surpassed more than 2.5 lakh EVs since 2018. In fact, Tata Motors PV's MD, Shailesh Chandra, tells CNBC TV18 that they will decide to pass high commodity prices to customers in the coming weeks. Let's listen to excerpts from that conversation.
Tata Motors has reached a very important milestone in our EV journey. We have crossed sales of 2.5 lakh electric vehicles in the country since our inception of the business in 2018 as far as electric vehicle category is concerned. Input cost increase has been a reality, whether we talk about commodity price or the impact of forex and all. And therefore, this is one area where we did not get an opportunity in the stage in the market was where it was initially pre-GST 2.0 implementation. Actually, the industry was declining, and therefore, it would have been very uncomfortable to the customers to go for buying cars if we had increased the price then. So therefore, as we are entering the new calendar year, definitely we are reviewing whether, how we should treat the pricing of the cars. And there are two aspects that we have to keep in mind. One is the input cost, which has increased. But on the other side, the initiative that the government has taken of reducing the duty rates. We'll have to see the residual impact of the commodity or the input cost increase, to what extent we have to pass on. We are reviewing that. And if we have to pass on a bit of that commodity price increase, we'll decide then that, on in the coming weeks.
Well, some bit of move upwards is what the Nifty is witnessing currently, back towards the 26,200 mark, 26,205, that important level to watch, which is the closing level of the 5th of December. Final 90 minutes of the trading session on the other side. Vivek and I take your leave. MF Corner on the other side.
It still has legs for growth. And then as the applications of AI starts coming through, they do think that these companies will be able to show a revenue model and therefore continue to demonstrate earnings growth, and the stocks will continue to do well.
Does that come up as a bit of a point that, in India maybe? But I guess slowly the view is changing now, right? I mean, it was the fact that we don't have a foundational AI play, et cetera, but maybe, no one knows where the value will settle. So maybe adopters will win at the end, and perhaps India is there.
Absolutely. And that's why, if the AI valuation is indeed a bubble, India will definitely outperform the US, which is what we are reflecting as a house view as well when we are talking about S&P going up only 4% next year, whereas Nifty going up 12% next year.
Amish, hopefully no bubble. And even if it's a bubble, as you say, perhaps things are going to look a little better for us because, of course, we've, in a way, paid the price in 2025. Thank you all for joining us. Amish, Neha, Gunjan, thank you for dropping by. And I hope we can do this sometime in the middle of 2025, 2026, and take stock of some of the predictions and views that you guys have presented. Thank you.
Thank you.
We look forward.
Well, that's it from me. A series of conversations, Outlook 2026, focused on, of course, what will make money, what will work as we flip over into the new year. Thanks for watching.
Just a little over 5 years ago, India's aviation sector saw the entry of a large new corporate player. We're talking about Adani Enterprises. Now, 2019, the Adani Group decided to venture into the aviation sector. It set up a wholly owned subsidiary called Adani Airport Holding Limited, and through that, it has decided to foray into India's airport infrastructure sector. Today, Adani is the largest airport infrastructure company in the country. It has 8 airports under its belt, 6 through the privatization process of the government of India, and 2, that's the Mumbai International Airport that it bought out from GVK, and now the Navi Mumbai International Airport, which is all set to open for business on the 25th of December. It's rumored that the Adanis have a big expansion plan, almost amounting to $15 billion lined up for the airport business. It's also rumored that they're looking for an IPO sometime.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, today we're going to be putting the spotlight on children's mutual funds. We've spoken about it in the past, which ones to go about, what are the benefits. We'll still take a look at it. Why? Because the asset under management of this category has risen by 160% in the last 5 years. Now, this is according to the data that we have that came in from ICRA Analytics. Even the number of folios over there have now touched 32 lakhs, which led to the increasing investors' interest in these funds. These are solution-oriented funds that come in, especially for your kids. Now, in that also, they'd highlighted top-performing funds as well, such as the SBI Magnum Children's Funds Benefit Fund. We had the ICICI Pru Children's Fund as well, HDFC's Children's Funds as well. These are some of the names I mentioned. Other than that, you can see it on the screens for you all as well. When you look at these funds, the average CAGR that one has seen over a period of 3 to 5 years for these funds is in the range of 20 to 30%. Now, to put things into perspective, we have Prableen Bajpai, who's the founder at FinFix Research and Analytics, to talk to us about this. Prableen, good afternoon, and firstly, festive greetings to you. Earlier, we are still ahead of Christmas Eve, but nonetheless, festive greetings to you and your team and family as well. You know, this is something very interesting because through this year in 2025, we've spoken about children's mutual funds, the importance there as well. Now, clearly the numbers also show, right, that children's mutual fund is something that is gaining pace. Are these special mutual funds, where we are seeing such a sharp surge, how should one actually start looking at this, the best ones to spot? Given that, you know, obviously, specifically for children's mutual fund, there's obviously going to be the cost of inflation that comes in as well. How should one go about it? To recap on that front, how should one be looking at these funds?
Hi, Vinny, and festive greetings to you and your team as well as your viewers. These are children funds, Vinny, and let's start from the top. So it's basically mutual funds as a industry, you know, all the different schemes are categorized into flexi caps. So we have different categories. Then we have the large caps. And like that, we have a different category, which is called the solution-oriented funds, within which we have two subsets. One is the children's funds and one is the retirement funds. So we're going to touch upon the children's funds. So within these children's funds, like you mentioned, Vinny, there has been a rise in the AUM over the last 5 years, although the number of schemes hasn't risen that much. So the AUM stood at roughly 9,800 odd crores in November 2020. And as of this November 2025, it's now at roughly 26,000 crores. Which is, of course, a high rise in terms of the percentage, which is about 160%. The number of schemes at that time was roughly 10, and now it's up to 12. So in terms of, you know, if we compare as the kind of NFOs we've seen industry-wise, based on that, I would say that the number of entry has been very, very thin in this segment. Only 2 new entrants which have a life of less than 5 years. So in the last 5 years, there are only 2 new schemes actually, Vinny, which have been launched. So I feel as a category, it definitely calls for more attention, which it hasn't got, because I think it is an interesting segment which comes with this name especially attached to it. So there is a connection which the investor can make, and there can be a clear understanding as to for which goal the person is investing. Currently, 78% of the overall AUM, which is about 26,000 crores, is actually into 3 schemes, which are the bigger players. And the oldest scheme is roughly 13 years old, and the newest being about 1 year old. So that's how this category is placed. Now, moving into, Vinny, your question as to how can one start off and look at these schemes. So these schemes come with a lock-in period. So it's an open-ended mutual fund scheme wherein you can invest anytime. But once you invest, then there is a lock-in of 5 years or till the time the child attains 18 years of age or majority, that's called. So let's say your child is 14 years today. So you can you invest, so you can redeem your money when the child is 18. So for you, the lock-in will be roughly 4 years. But let's say the child is 4 years old today, and then you invest. That means for the next 14 years, the money stays there because, after 5 years, you can redeem the money. So from 4 years, the minimum time period that you have to keep it is till the time the child is 9 years old. 5 years is earlier because if you want, you can also keep the money, continue to remain invested there till the time you require the money at the time of college education. The nomenclature and the way the structuring is done within the category, Winnie, that all these different 12 schemes have a different way of investing. So some of them are structured like a flexi cap, some of them are structured like an aggressive hybrid. So some mimic in hybrid category, some of them, track the flexi cap kind of a structure. And within this 12 schemes, in fact, two fund houses like SBI, UTI have two variations for their schemes. So it's a very heterogeneous space. And I think when one starts to look, you actually need to just dive a bit deeper and check what is the structure of the fund. And, then based on your suitability time horizon, one can invest.
Okay, Prableen, thanks so much for, breaking it down for us, It's important for a viewer to understand time and again because we keep getting these queries of how to go about it, even though we've covered it before. But Prableen, there's a point that you mentioned which I found interesting. When you look at the AUM, that's seen a sharp increase, right, in the 5 years, or in terms of the 4 years, that's seen an increase, and interest is increasing for these funds from investors' point of view. But why are there no new funds that have come in, and there are only, I approximately believe, 12 funds which are there for children's mutual fund? Is there any reason why we are not seeing more fund launches or NFOs on this front?
Yeah, actually, that's very interesting, Winnie, because like last 5 years, only 2 new schemes have been launched. So perhaps I think because these funds somewhere are also restrictive in nature. Once you invest, you are there for 5 years, which perhaps mutual fund investors are spoiled for, they're spoiled for choice. They want to try out different things. They want to have different funds in the portfolio. So that can be one reason. The second being that there is no standard structure, Vinny, which is followed here. So once you're investing, the investor will have to, have a very specific knowledge of the fund, that how is that particular fund investing. Like you mentioned, returns have been really good for these schemes, and there is no doubt about it. But at the same time, if you're looking at a 5-year CAGR, the difference in the returns is also very varied, because then you have funds which are debt oriented and then you have funds which are very equity oriented. So, it's a 10% to 30% kind of a variation in returns that we see. So I think some of these reasons sort of restrict their usability. And that's probably the reason that we haven't seen too many funds coming into this space. So I think this is also one space probably underutilized by the industry as such. And I feel insurance in comparison has been launching so many of these children bundled products with investment in insurance. So I think definitely the industry has to rework on the structure, make it better, more interesting and easier for investors to understand. And I think it can be great space for parents to invest for their kids with the kind of clarity that the name itself presents. So I think definitely it should come in more formats, the overall funds in this space.
Absolutely hoping for that, because it's an interesting one. But, this category's return, like you also just mentioned right now, last 5 years, we've seen 21% return. But how does it compare to maybe traditional savings on the long term? Because in 1 year basis, some of the funds have not done that well versus maybe the traditional saving methods that we have. Or how should we compare it with the options like you were mentioning on the insurance side that are there as for a parent to invest as well? So how should we be viewing these funds versus all these other saving methods?
So I think first let's take up insurance, Vinny. So insurance, I think, should be a no-no when it comes to mixing the two things. You should either have a term plan or a health cover or a very clear insurance for the specific reason that you're taking it for, because the role of insurance is providing risk management. And when you're looking at investment, I think then it should be a pure investment product where you have clarity. This is the amount you're investing today, and this is the future value you would get. And also you need I think, clarity in terms of what returns you would be getting, at what time horizon, you can redeem. And there should be no rigidity in terms of pressure on the parents also to invest, because with insurance, once you pay one premium and then you're bound by that for the next 5 years, for example, in a ULIP. But coming, I think, to the more important comparison, because India as a household, if we see, we still have very low allocation towards asset allocation wise, the percentage going into equity from every household is still very limited. While education inflation is very high in India now, it's considered at roughly 10 to 12%. So fixed income, especially FDs, would be a very difficult product in that sense, because when you're looking at taxation and when you're looking at inflation, the real returns actually come out very less. So if you're a person in a high tax slab, and even if your FD is giving you 7%, post-tax, you're only earning 4.9%. And when you're looking at combating 10 to 12% inflation, which also means that almost every 6-7 years, the education cost is doubling, Vinny. So I think fixed income definitely cannot be the only way that you're investing for your long-term goals, especially education. And that is where equity comes in. So equity and fixed income, two different asset classes. Of course, equity is for the long term. So you have to have that horizon of 5 years and plus to invest in equity. But return-wise, Vinny, what we've seen, that equity definitely hands down beats any fixed income product post-tax as well. And that is the only vehicle which can help us get returns which can beat the kind of inflation that we've seen in the education space. And definitely, if you're comparing 1-year returns, then there are so many of the schemes which are giving 2 or 3% returns. So that's not the right way to go about it. So it has to be 5 years and above, definitely.
Absolutely. Long term obviously is the way to compare, but that's a clarification coming in for our viewers, because every time people just see the last 1 year return and then decide on what to invest in, that's not the way to go about it. This is just for our understanding purpose. 5 years, 3 years, 5 years, long term is always the better way to look at any fund, not only children's fund. But on that note, we are going to actually slip into a very short break. We'll come back after the break and keep this conversation going with Prableen as well.
Well, we'll try and find answers to all of those questions when we speak with Jeet Adani here on the CNBC TV18 special. Talk to us about all things airports with the Adani Group. Joining us today is Jeet Adani. Jeet, many thanks for joining us. Congratulations.
Thank you for having me.
You're all set to launch the Navi Mumbai Airport on the 25th of December. Why did you choose Christmas?
No, I always wanted to be Santa.
You did? Is this your gift to the city?
Exactly. No, but on a serious note, we chose it because it's the lowest load and we wanted to have a smooth start. So, better to have a nice, smooth rolling start than to have a jerky one on the first day. And we'll be ramping up over the next month or so. Our operations, the number of flights will steadily be increasing. There's a few snags here or there which you can see when you walk in, which we also need to fix up over the next month, 45 days.
Right.
And then we'll see a full-fledged, high-intensity operation starting February onwards.
Okay, so let's talk about what happens on the 25th of December. How many flights do you start with? And between December 25th and February, which is when you expect full intensity operations, what should we expect?
So we'll start with 30 flights a day, targeting about 8 flights an hour in terms of capacity. And where we go, when we go into February, that will go up to about 24 to 30 flights an hour. So what we're doing in a day, we'll be doing in an hour.
Okay.
Yeah.
And foreign airlines, how many foreign airlines have committed to move operations here or add operations here to Navi Mumbai?
So one thing is that no, we don't, when we're speaking to any airline, we're not telling them to move anything. Because there's no capacity left in Mumbai. So whatever is coming in here is in Navi Mumbai is going to be additional. In terms of foreign airlines, we've spoken to most of them. And what they're saying is that they would want to see, how the connectivity shapes up over the next 3 months. And maybe during the middle of the summer schedule or the winter schedule is when they'll start ramping up. But, we are very confident, and what we are seeing with the first inaugural partners, I would say.
Welcome back to MF Corner on CNBC TV18. We are discussing the increase in the interest for Children's Mutual Fund in 2025 and how it's been. And for that discussion, we still have with us Prableen Bajpai. Prableen, while we've spoken about how one should go about it, where is it that one could look to invest here as well, versus the comparison in terms of insurance as well as traditional savings. But there's a lock-in that comes in, right, during these children mutual fund, 5-year lock-in period or until the age of 18. One, do you think this is very beneficial in terms of parents who are looking as a discipline that is created because of this? And also, given that you've seen such good growth already, what ICRA's report also suggesting that this solution-oriented fund, specifically children's mutual fund, will continue to see this 10 to 18% growth in the next few years. How do you see this potential of this category grow in the next few years as well?
Right. I think here the lock-in is a benefit, Vinny, for investors who have put their money, because I think definitely it inculcates the discipline, which is sometimes not there when we are investing in mutual funds. Mutual funds being a wonderful product, I think the good part that they offer too much flexibility at times also doesn't work in its favor, because people want to just keep redeeming and tend to chase returns or schemes, which are doing better. So I think definitely inculcates discipline, which is really required for goals which are long-term, such as education. So I think that's one point. Second, that it also helps investors stay put through the different market periods. So times of volatility, correction, and then recovery. So I think overall returns can be better if you're actually staying invested for this 5-year period. That's sort of a basic time that we feel is necessary for an equity investor. So in terms of the time period, I think that's a benefit for these funds. In terms of its potential for the future, definitely, Vinny, I think Indian markets, Indian economy, the stage at which we are, definitely holds a lot of potential. I will not comment on the next 2 or 3 years. Maybe, given the way markets have been, it would be wrong to say that, markets will be giving fantastic returns just in 2 years' times. But definitely, all these investments, whenever we do equities for the long term, and I think India as a growth story is fantastic. And there is a high potential for all equity investments through mutual funds which are done. I think we have excellent fund managers in the industry. And we definitely look at double-digit returns overall for the industry.
Absolutely. But also, probably, there are times during this year when we've had conversations. Some of the views do come in that, you could also go in for a flexi cap fund or a multi-cap fund or some hybrid form of fund and keep investing consistently if you do have the discipline. So for a parent who's looking at this, how should one be looking to blend this equity exposure, debt exposure that comes in, or children's mutual fund? How should one go about this whole process? Is it beneficial maybe to just look at individual mutual funds, or would you say for a goal-oriented specifically, then you should just look at children's fund if you're looking for that goal?
Right. So, Vinny, I'll just give a quick example here. Let's say if your child is 3 years old today, and if you're looking at 10 years of yearly expense as on date for college, so it's about 40 lakhs for 4-year course. After 15 years, the same amount becomes 1.67 crores. And for that, if you're looking at 12% returns overall for any mutual fund you're investing in, then you are looking at an investment of 35,000 a month. Now, of course, I think it's a very logical question that, of course, you can invest through other investments as well. And I think that is definitely an option that would give a more variety to investors. Like I said, that probably one of the demerits of solution-oriented funds, these plans, is that we don't have too much variety, very few schemes which are available. So I think one way to tackle the problem of discipline can be that you have the investments in your child's name. You can always have an account opened in the name of the child and have a parallel portfolio created where it can be a combination of some index funds and some active funds for the long term, and invest accordingly. And definitely even government schemes like Sukanya Samriddhi or the PPF, Public Provident Fund, can be added. But with the kind of limited resources I think Indian households have, every time we are adding more of fixed income or more of these products which are slightly lower in terms of returns, the ask for investing goes up. So for the same goal, if you're doing a pure mutual fund portfolio, 35,000 needs to be invested. If you're doing it with Sukanya Samriddhi, then along with Sukanya Samriddhi, you are doing 30,000, which means 42,500 per month. And if you're doing Parag, if you're doing PPF, then you'll have to do about 39,000 overall per month, with 26,500 in SIPs and remaining in PPF. That is because even Sukanya Samriddhi at 18, you can only redeem 50% of the money. And of course, PPF can be redeemed. So just giving an example of how more investments will need to be done, the lower the risk you want to take and go towards fixed income.
Okay, and a quick one, Prableen. There are obviously just 12 funds here, and in that the top 5 performers that are mentioned are SBI's Magnum Children's Fund, ICICI Pru's Fund is there, HDFC's Fund, Tata Children's Fund and UTI. Which is the top pick for you amongst this?
I would go with names, Vinny, I think, which have a track record, so longer time periods, and I think have seen some markets. But I think SBI, the investment plan has proved itself. HDFC has been quite a consistent performer, and I think even ICICI can be looked at. Again, UTI has 2 options, so the equity option can be taken, but will ultimately depend on the suitability of the investor. And, they have to deep dive, just look at the portfolio once before investing.
Absolutely, Prableen. Thank you so much for joining us on the show and, helping us understand Children Mutual Fund, what we should be expecting going forward as well. Thanks so much for that, Prableen, for this conversation.
Thank you, my pleasure.
But with that, let's move to our segment of MF news. That's the mutual fund news that has happened during the last 1 week. The first news flow that we have during this week was the NCDEX has received an in-principle approval from SEBI to launch mutual fund transaction platform. Now, this is aimed to expand the financial inclusion and paving the way for its equity as well as equity derivative segment. So an important update that's come in there. The platform is actually going to be enabling micro SIP channels, rural savings into regulated avenues that come in there and support existing trading members. The move is something that is aligned with regulatory intent to deepen the equity segment. And do not forget, in August, only NCDEX has secured preliminary approval to introduce trading in equity-linked products, including derivatives. In November, NCDEX secured the board approval for launch of an electronic platform for mutual fund distribution as well. So this is one more update that has come in here. Now, let's move on to some news flow that's come in on the NFO fund and the new launches that have come in just in the last couple of weeks. First one is the Kotak Mutual Fund has announced Kotak Nifty Next 50 ETF. It's an ETF fund that's come in. It's open for subscription from 18th of December and will close on 1st of January. Obviously, the benchmark is against the next Nifty 50 index. The other one that has launched an NFO is the DSP Mutual Fund. 2 passive offerings that have been launched. DSP Nifty 500 Index Fund and DSP Nifty Next 50 ETF as well. Both of these have opened for subscription and will close on 30th of December. The third NFO that has been launched is by Tata AIA. They've launched the Multi-Cap Opportunities Fund, pension fund via ULIPs, and this is offering a diverse equity exposure linked to Nifty 500. The new fund offer is open for from 24th of December to 31st of December. So these are all the NFOs that have come in and the important news flows around the mutual fund industry. So that is what we have for you all in today's edition of Mutual Fund Corner. Thank you so much for tuning in. Merry Christmas to all of you all as well. We'll see you all next week for Mutual Fund Corner. But don't go anywhere. You still 1 hour of trade that is still left, and Closing Bell is up next to take you through all of that.
The entire capacity that we have.
Well, one of your inaugural partners, Indigo, is in trouble at this point in time. Winter schedule has to be cleared by the DGCA all over again. Does that is that a concern on what they had committed to you? Could that change also?
So we've already spoken to them. There's been a slight change in terms of the opening schedule, but it's not a material change.
Okay, not a material change. What has been the biggest challenge of getting this particular airport up and running? You've, of course, been leading the airport foray for the Adani Group since your foray into the sector in 2019. But specifically, as far as Navi Mumbai is concerned, what's been the biggest challenge?
Moving a mountain. This is literally moving a mountain out of the site. We had to move about 1.5 crore tons of rock. And we actually took that as an opportunity because we filled the site up, raised it by 8 meters. So from a flood protection point of view, it's now 1 in 100, P100 protection. So if there's like a 1 in 100 year event of flooding, it will still be safe to operate. And that's why we basically just put all this rock into the site again. But the mountain was there until last year. It was still, being blasted, being taken out. and that's been the largest critical part of this project. I would say, to make this airport successful, what's going to be important is the connectivity.
Yes,
So,
because
well,
it took me an hour and a half
exactly.
from the old airport to get here.
Exactly.
Yeah.
And on day one, the road connectivity is quite good. I wouldn't say it's perfect, but it's quite good. Over the next sort of 3 to 6 months, we're going to see the opening of the Navi Mumbai Coastal Road, or the Ulve Coastal Road. That will make the road connectivity quite perfect when it comes to the western side of the site. The metro connectivity, we are seeing the plan has already been made. Now it's going into construction shortly. So there is going to be a direct connectivity from CSMIA to NMIA. And it will also interconnect with all the major metro lines in Mumbai. Water connectivity is something that will be started shortly. eVTOLs, when they come, there's also provisioning for that. So, and suburban is already on, buses are already on. So every form of connectivity that you can think of has to be connected on day one.
Yeah, and connectivity is going to be one of the
key to open this.
Key and one of the big challenges for you. But, Jeet, I want to talk to you about the fact that in 2019, when you decided as a group to foray into the aviation business, it was a challenge for you individually because you were leading that, but also for the group because you had no experience in the airport business. In fact, the rules were changed to say that, look, people who don't have prior airport experience should be allowed to bid for the airports, and you got 6 via the privatization route. How hard a learning curve has it been?
So honestly speaking, it wasn't that difficult on 2 accounts.
To understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Modest gains as of now, not as significant as they were in yesterday's trade.
Markets are actually looking pretty good. I think the key headline is that the Santa rally continues to roll on. And the first tick on the Nifty is in the green. The Nifty opens shy of 26,200.
Certain sectors more than others are certainly looking better, but net earnings are looking better than what people initially thought about.
Well, it's a very exciting opportunity for us, which is fully supported by the top customers.
Remember that AI is here to stay and is expanding. More and more people are adopting.
Now, companies said that the entire allegations are malicious and baseless, and at the same time, they have given some clarification.
Today, a bit of a muted day of trade, at least is what we are seeing coming in for the market.
The Santa rally is finally here. We see a gap down opening, but every day we're also seeing a recovery. Today is another session where the Nifty has recovered and now almost near the 26,200 level.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, and with me is Ekta. Well, Ekta, markets in the green. Expiry will play out, and I can't wait for the next 60 minutes. I'm off to the races.
I'm sure you can't, Nigel. Again, Coorg is where you're going?
Yes, I'm going to Coorg.
And how many days?
I'm going for 5 days to Coorg. I've got tomorrow to get done with the Christmas formalities, get the gifts packed for the kids and family members. And 25th morning, I'm off to Coorg. Going to be nice and cold out there. But I've got 60 minutes more, to
absolutely.
get through the market action.
C for Christmas, C for Coorg. Definitely going to be a great and chilly Christmas, you have to say. Well, we can have all of this, banter, considering that the markets are not doing anything in today's trading session. We're just about consolidating. But we do have the Nifty above 26,200. So let's see whether we inch closer towards that record high. But nonetheless, as of now, we have the Bank Nifty, which is just about higher by around 26 odd points. The mid-cap index, which is just about lower by around 38 points. Nifty just about higher by around 0.15%. And so is the Sensex at this point in time. The advanced decline ratio, it's been holding in the green throughout. So that's positive. So we have around 2,500 stocks advancing to around 1,900 stocks declining on the Bombay Stock Exchange.
Well, that's right, Ekta. And, at the flash at the bottom of your screen told you that gold was really the asset class of the year. Started the year at around $2,600 odd. And as we speak, it's almost at around $4,500 odd. So gold, at all levels, people thought that it's done and dusted. It continues to move ahead. And silver, has also been a big outperformer, particularly in the second half of the year. That's on the verge of hitting $70 per ounce as well. So precious metals have been the way to go. Well, let's tell you what we have lined up for the next 60 minutes. Though on closing bell, the markets trade in a range on weekly expiry day. Nifty hovering around the 26,200 mark, led by metals. However, IT stocks are on the back foot. A Cobra Post report flags worrying patterns of large value cash transactions at Cholamandalam Investment. The stock though surges 6%. The company says the allegations are malicious and baseless with ulterior motives. Sentiment souring on Coforge though, following the fundraise buzz. Coforge board is all set to meet on December 26th. The street fails to build confidence on account of dilution risk, cash conversion rate, and risk to profitability. How do you position yourself, though, for the final hour of trade? Mitesh Thakkar is back with us. Mitesh, yesterday during the course of the day, you're taking some long positions. What do you do right now? We're up close to 40 points. The markets, in fact, have got a bit of an uptick going, actually, in the last 30-40 minutes. What do you do? Carry the position?
Two things, Nigel. One, I think, if you look at the last few expiries, I think the last 1 hour has been typically negative. Now, it doesn't, guarantee that this time it will be the same. Secondly, I think, 26,200, 1020 is an area where we have some intraday highs. The rising channel, which I was talking about, is at about 26,380, but the earlier highs are at about 26,1020. So I think, good time to take some profits if you have had longs. You're roughly about 100 points plus from levels of yesterday. And trail your stop loss to just around today's low, which is 26,120 or just below it. And I believe that, eventually we should have the strength to get past these levels, head towards 26,380, 400. And if we break beyond that, then I think we are looking at much more significant upside. So for the time being, that's the view. On the stock side, I have two calls. KFinTech is a buy. Keep a stop below 1,084 here. Look for targets of 1145. And from extremely oversold levels, Havells is giving first signs of reversals. So it needs to get past 1440. It's at about 1430 right now. So buy above 1440. Keep a stop below 1420. Look for targets in the range of about 1475 to about 1480.
Okay, all right. So that's on a couple of the technical calls that we have at the start of the last 60 minutes of trade. But let's move on now. We have Gaurav, who's going to be joining us. He's looking at Cholamandalam Investment, which is in focus as that Cobra Post article alleged corporate governance issues. But remember that the stock really has brushed it off. In fact, it's up around 6% at this point. Gaurav, over to you.
Well, yes. Cobra Post news article actually suggested that there are some discrepancies in the corporate governance that the company follows, and not only for Cholamandalam Investment, but also for the companies of Burugappa Group. Now, with this, company has come up with a very clear classification and clarification. What they're saying is that the entire allegation are malicious and baseless. At the same time, what they have said that there were certain set of allegations that were made in the likes of related party transaction, high cash deposit, related party disclosures, and at the same time payment of fees for credit rating and underwriting practices. All allegations. Now, if you look at the clarification that has come up from Cholamandalam Investment, it seems that they have cleared the air. They have been very strong in terms of words. What they have said that they are reassuring investors that performance of the company, its asset quality and all the practices are in line with the regulatory requirements and at the same time in line with the law of land. At the same time, on a specific issue, on cash deposit, they say that borrowers who they cater predominantly pay back in cash, and that is something which is going to be a part of the business. In fact, in terms of numbers, they suggested that 15% of the total payback, they get it from the cash versus what it was at 50% earlier. And as a part of a business and the nature of a business, it will continue to remain like that. On related party transaction, what they're saying is that all the related party transactions are disclosed in full and complete details. And at the same time, there were some related party transactions which were not required to be disclosed earlier. And that is the reason why there may be some discrepancy, but it is again in line with the regulatory requirements. In fact, in terms of numbers, there is a number which is revolving around 10,000 crores in terms of regulatory requirement and the related party transactions. They said that this number is specifically the cumulative number for the last 8 years, and that is the reason why we are seeing this number as an inflated number, but everything is in line with the regulators. On payment to the rating agencies, they say that this is actually a standard practice. In fact, if you look at the numbers and the fees that is paid by Cholamandalam Investment, it is a little lower than the industry practice that we have seen earlier. And lastly, in terms of underwriting practices as well, they are very firm and sure that the gross NPAs and net NPAs and all the underwriting practices are in line with the regulatory requirements. In fact, going ahead, companies said that all the operations are carried out as per law and regulatory guidelines, and there won't be any discrepancy. Given that they already have a reputation, not only Cholamandalam Investment but also Murugappa Group, it seems that market has taken everything in a very positive way. For third quarter as well, on the call, management said that disbursement is something that they are positive about, and at the same time, given all the circumstances and the series of events that have happened since morning, we are seeing stock moved up, and it is up more than 5% in a day today.
Okay, all right, got that. Thanks a lot for that. Gaurav, stock up close on 6%. Mitesh, any view on this name? You know, at the start of today's trading session, the stock to watch for the day, I'd given Chola, purely because there was so much of short build-up. The street was sensing something really disastrous that didn't appear to be the case. So the shorts have run for cover. On the charts, how's it looking?
I think in a very tricky pattern in the sense that if you look at the last 1.5 months of movement, we saw multiple times the stock failed to get past 1750. Then there was this bout of slight bad news, and then there was a crash, and today is a rebound. So I'm not sure, but I think the only trading opportunity which will come to me is once we start getting past 750. Otherwise, to me, it's an avoid. There are better opportunities in the markets which have a better risk reward and a slightly more stable structure.
All right, one more question I wanted to ask you, Mitesh, on ITC. You know, the stock has seen a bit of a spike up. It's actually been a big underperformer. It's not done anything much. And if I look at it, you know, the 20, the 50, the, the 100 and 200 DMA, all of them, I think, in that vicinity of around 400 to around 415. There are some unconfirmed reports that are suggesting that there is probably a price hike that could be coming about. A sell-side note as well has come out. And, besides that, they're saying inventory system has been very, very low. The stock is currently at the high point of the day. What's the view on ITC?
I like it a lot. No doubt about it. I think, very clearly this is a stock which possibly is giving a reversal from correction and the sort of sideways activity. A good breakout will happen above 408 or 409. We are not very far from there. And once that happens, I think 420.22 is the first target, on minimum target, which I'm looking at. But a good chance that we are eventually looking at 435 as well. So for ITC, I think it's a pretty good setup.
And a smoker from the office, Ekta, tells me that he just messaged me that I should ask him about ITC. He had gone for a smoke and, they said that the prices are going up. But we'll wait by for a confirmation, though it's an unseasonal time when you see a price hike ahead of the budget, but it appears inventory in the system at least is less. So, someone said that price hikes is actually coming about. A real smoker. We'll wait by for ITC.
We'll wait by and see once ITC probably announces that, and maybe, what the extent of that price hike would be. But nonetheless, we have Gurmeet Chadha, who is the managing partner and CIO at Complete Circle Investments, joining in now. Gurmeet, hi, welcome to the show. Well, it's quiet for the market, so I'm going to discuss gold and silver with you. As we were talking, we saw, the flash come about that silver is at $70. It's given returns of 140% this year, and, it's equal to the investments. If you had invested only in silver this year, you would have made as much as you would have made if you invested in gold 5 years ago. So that's the kind of rally that you've seen. Just give us a sense in terms of whether it's prudent and smart to invest in gold at these levels, and how would you recommend one plays it?
So, Ekta, we've been basically using a multi-asset approach since last year. In fact, there's a category of MF which I like, which is multi-asset, which gives the fund manager fungibility to move across asset classes. I think that's done well. Obviously, nobody saw this coming, right? Silver touching 70 and gold crossing $4,500. So it's been a stellar run. I think a bit of it is also short squeeze with some of the banks like JP Morgan who were short. Commodity cycles can be very sharp. And I think fresh exposure should be done a little carefully. I think I still believe that the multi-asset model is better with 5 to 10% exposure to precious metals. Any risk off, whether it happens through a Russia-Ukraine peace as and when it happens, or let's say there is a bit of a trade truce on India, US, and broadly more trade truce, hopefully in FY26, I think probably then you will get a probably better entry point. So while I think the long-term trajectory looks good because the trust on the dollar is something which is now being debated. Also, the use of silver in high-speed battery charging and overall applications is picking up. But any risk off is where I think you can get a sharp move. And probably that would be a better point to add incremental exposure. For now, I think it's good to enjoy some gains for the new year.
Imagine Mrs. Chadda would have been wondering at the start of the year, no diamonds, no gold, Gurmeet, only give me silver. That would have been the call out there. I think you have a big heart and you gift quite often, I believe, some bangles and, but this time around, I think it should have been silver. She would have been way more happier.
Absolutely, Nigel. Her portfolio now for last 3-4 years is doing better than mine. So no complaints. Yeah.
I'm sure every Indian woman's portfolio has superseded equities right now. So definitely that point is taken.
You can just, Gurmeet, you look at Ekta, she's glowing. Her portfolio is bursting, I think.
Absolutely, yeah. I stayed away from mid-caps. Yes. But nonetheless, we do have Coforge, which is in focus. It's under pressure. And it's announced that its board is going to mull fundraising on the 26th of December. That's on Friday. Reema's here to tell us more. Reema.
So Coforge has announced that the board will meet on the 26th of this month, where they will consider a fundraise. And after that, at 5:30 p.m., the company will be holding an investor meet. The last fundraise by Coforge was in May of 2024, when the company raised 2,240 crore via a QIP, and this was to fund the Cigniti acquisition. Now, you can't compare the stock price, the QIP price, to where the stock is currently today on account of stock split, which took place, after that. Now, the question everyone's asking is, why is Coforge looking to raise the money? We don't have the answers. We'll know on the 26th. But is it to raise money for an acquisition? Because one of the pillars of growth for the company has been acquisition. They've done the Cigniti acquisition. After that, there was the Rhythmos, there was, I think TM Labs. So the company has grown partly on account of building capabilities via acquisitions. At a recent analyst meet, the Coforge had outlined some areas, according to analysts, where they could consider an acquisition. This would be to improve their capabilities in geographies like ANZ, APAC, and even in industries like healthcare and UK public sector verticals. Now, the cash on the books is not very significant, which is why analysts say if they have to do an acquisition, maybe they could be looking for some equity fundraise. Now, why could the stock be under pressure? Because one, every time you raise money, there is some dilution risk. And secondly, in the past, Coforge has had concerns with analysts on account of the cash flow generation, which was the weakest compared to other mid-cap or, large cap IT peers. After that, the company has course corrected, and they did guide that, the cash flow payout will be, free cash flow to PAT will be 70%. Is there a risk to that? Or will the company be looking to further increase their investments in data center? Because last time they said they will not be doing that. So I think there are some concerns, and plus Coforge, as we know, has been a rank outperformer. Not this year, but just over the last 3 or 5 years, stock has done very well. So interesting, board meet, Coforge looking to raise some money. 26th is the date.
Okay, all right. Thanks, Reema, for that. Gurmeet, any thoughts on Coforge? Do you look at that stock? It's under pressure today ahead of that meet.
See, operationally, it's been a good year for them. If you see, they did 6 deals in H1. There was recently Investor Day they did, I think, some time back, where they said they're actually going to do about 20 there. So other than BFSI, even the travel vertical is expected to do well, and so is life sciences. And they've spoken about 14%, I think, exit EBIT margin. So it's been a good year, and that's why the stock, like Coforge or persistent, trades at a premium. So I think it's got to do more with the fundraise and some uncertainty around what they're going to do with the money, and that's why the reaction. But otherwise, I think midcap IT may actually do better. With some currency tailwind also. So we are actually a little contra on IT services. We have HCL Tech in the portfolio. We are looking at, if we can add some more to KPIT. And if we get a good drop between, let's say, persistent or Coforge, don't mind adding some exposure.
Got it. Okay, all right. Gurmeet, I wanted to ask you about, I think we had a technical view came in on ITC. With regard, to a probable price hike and probable low inventory. We have to wait for confirmation on that. But what's the view out there? I think in the past, you had played the special situation, if I remember correctly. What's the view?
So we did add ITC when the ITC hotel demerger news came, and there was a bit of an arbitrage, more in ITC hotels than ITC. The stock also ran up a little bit. The issue is more supply, Nigel. I think the BAT group initially after said that they will not go below 26%, but they have been selling it. And I think that's been one overhang. And I think the big trigger will come once we have more clarity on the overall tax structure and the duty structure on cigarettes. So I think it typically happens pre-budget, and that's why the stock has done nothing for a while, and that's what ITC can do for long periods. The other could be as and when they decide to, demerge, spin off the FMCG business, because that seems to be doing well. So I think the big trigger would come. Obviously, it trades at 14 times, 4-5% dividend yield is more of a safer stock to add. But I don't see much upside since till the time there is more clarity on the stack structure, and their volume growth hasn't been at par with the industry if you compare it with peers, and some news on the FMCG business.
Okay, all right. That's on ITC. But Gurmeet, we were just discussing fundraising a couple of minutes ago. We had Granules, which announced an investment or fundraising of over 1,700 odd crores. It's a combination of warrants and as well as preferential allotment to promoters as well as non-promoters. Your thoughts? Do you like that stock?
You meant Granules India, the pharma company?
Yeah, Granules India.
See, we don't have it in the portfolio. We are actually more bullish on the CDMO names. So we have Divi's, we have Newland, and we have Laurus Labs in the portfolio. We've always been overweight. And fortunately, all three have played out well for us over the last 2-3 years. We are now adding Mankind Pharma. There's been a good correction post the acquisition they did. I think as debt get reduced and more synergy happens with BSV, especially on the consumer health and women fertility portfolio, I think you would see some traction there. And we are seeing if we can add some hospital names on correction, as a portfolio. And with Biosecure Act now likely to be seeing the light at the end of the day, this could open a huge opportunity for the pharma outsourcing industry. So we are more placed there in terms of our holding. We do not have Granules in our portfolio.
We in fact spoke to OneSource Specialty earlier in the day, Gurmeet, and they're expanding their drug device combination capacity. So they seem to be quite bullish on the injectable capacity when it comes to CDMOs. Is that a stock that you've looked at? They have aggressive targets in terms of 2028 revenue as well.
It's part of our investment universe. It's just that, the run-up was too quick. We're also looking at, not related, but say Shelly, which again is a quasi-play on the GLP-1. So we are tracking that space as well. And I think this pharma outsourcing opportunity will be a big one. I've been saying this for a while. This could be as significant as what happened to IT in 90s if the way things are stacked up. And look at the capex some of the companies have done. Look at the capex Divi's has done. Look at the capex Laurus is doing, and some of the other names are doing. In the CDMO names, I think probably the capex done in last 3 years is more than they have done in last 30. And pharma is a very, very specialized technical place. So it's not that you can just do capex and hope things will happen. So I'm very gung-ho on healthcare. I think the overall weightage of pharma healthcare is 5-6% in Nifty 100. I think it's way below than. I think it should be 10-12%.
Okay, all right. Well, quasi-play to the GLP-1 opportunity. That's an interesting one. Thanks, Gurmeet, for joining in and taking us through all of your thoughts on the markets. Well, let's get to Nigel now. He's joining in to tell us what he's tracking within the FNO space. He's hopped across to the FNO desk. Nigel.
Well, Ekta, the markets actually are holding in the green, and the sense you get is actually become a buy on dips, because any kind of dip that's getting bought into, you're making some money, and some kind of consolidation will be par for the course. But given that we have a contract that's going to expire in the next 45 minutes or so, it'll be, expect a bit of a swing at around 3 p.m. What's happened in the last few days is the Nifty Bank that was leading the way. It's gone to a bit of a phase of consolidation. Remember, the all-time high is around 60,100. It's holding around the 20-day MA. It's not decisively conquering that, which will be the next trigger for the markets to move up. The Nifty, though, that's trading comfortably above the 200-day MA, 150 points higher above that, 20-day MA should come up for you on the screen. The 26,200 put, which is the contract that will be expiring in the next 45 minutes. Well, out there, just take a look at the premium. It started the day at around 80 rupees. It's down to around 28 rupees. And if you just punch that in, 80 rupees minus 26,200, you'll get a number of around 26,120, which is approximately today's low as well. So for today's trading session, for the next 45 minutes or so, that level needs to actually hold out. Stocks that are in focus, well, you're seeing a bit of a short covering bounce. Playing in on REC, the stock is holding with some gains. You have, open interest as lower. Chola as well as seeing a big short covering bounce out there. We mentioned at the start of today, if the news is not as bad as expected, the shorts will have to scamper for cover. Precisely what's happened. NMDC has come back on the list. That's seeing a fresh bout of buying. And that stock, in fact, appears to be breaking out. And Indus Stars as well, stock more or less flattish, but it's at a very, very crucial juncture. And given that Vodafone Idea, there is some optimism that maybe there is some kind of relief that's on the cards. I think that's the stock to track actually for the next few trading sessions. Indus Stars, there is periodical buying that we're seeing out there. It's at an important technical level, and it could possibly be a better play than Vodafone Idea. So I think that's why we're seeing a good amount of open interest build up. Back to you, Ekta.
Okay, all right, Nigel, thanks very much for that. We'll take a short break now, but up next, we'll be back with Jigar Mastry of Buoyant Capital to talk about the market. Stay tuned.
Some of the basic sort of frameworks of how do you view a business between airports and ports is quite similar. That you have to sweat the asset, you have to maximize the return before investing again. In ports you have shipping lines, key shipping lines with your customers. Here you have key airlines where your customers. The only difference is there's cargo, here there's people.
Well, there's
that's the
cargo
additional
as well.
part.
That's a
And
significant
cargo as
part of
well,
your revenue.
obviously.
Yeah.
But how do you, the customer experience part is something that we had to learn. And the other part why we didn't find it very difficult was there's no dearth of people who are, professionals, who are very, very accomplished in this field, are very knowledgeable in this field. So really the challenge was that it wasn't the decision of entering the business, but the challenge was how do we get the team up and running and integrated. And obviously the acquisition of Mumbai helped because we got a team that was ready and was already operating a major asset of the country. But then we also got in experts from airlines, from other airports across the world to come back to India, NRIs to come back to India and help us out in this journey. So I think between both of those things, it's not been very difficult to set this up. The challenge now is how do we keep getting better? How do we implement technology? Because this is something no one in the world is doing at this scale. And how do we implement that technology here? How do we develop it? And it goes down into thinking about, how passenger experiences can be improved. How can efficiency of the asset be improved? Simple things like our building management system. For years, ages, building management systems have existed. But when it comes to an airport, how do you link it with airline management, with ground handling, with retail management, with advertising, to as a whole
All
system?
of which you're now doing.
Exactly, yes.
Yeah, which has also sort of put a lot of other people in a little bit of a quandary, saying that there is a conflict of interest there. How do you respond to that?
I don't see it as a conflict of interest. I see it as, there is a single person left to blame.
So you should be held accountable for everything.
Exactly. If anything happens at the airport, there's only two people who should be held accountable, either the airline or the airport. Airline, if anything happens once they've entered the plane, or if there's something with their check-in, and everything else is the airport that's accountable. But, from my...
Welcome back. Markets holding mildly in the green, and ITC, the stock actually that's perking up. It's at a crucial juncture. We had mentioned there's a bit of a buzz with regard to lower inventory as well as higher prices. For the time being, at least, the street is bidding that up. A big underperformer, not moved much. Interesting to see what comes about. On that note, let's welcome Jigar Mastry, co-founder Buoyant Capital, who joins us on the show. Jigar, first of all, congratulations. I think you were quite bullish on Vedanta. That was one of the metal stocks that you had in your portfolio. It was a bit of a counter trade. Is that correct?
Right, Nigel. Commodities, we have been positive. Largely, we think, this is a play on how the US dollar will react. And any commodity, be it, commodities or bullion, when denominated in a fiat currency, would tend to inflate over the next few years. So given that we're positive on all commodities, Vedanta was one stock that we have held for a while now.
Jigar, sorry to press that point a little bit more, but if you had to talk about one commodity that you'll be more bullish on, look at the Asian steel spreads. They're at the lowest that we've seen in multiple years. Copper prices are doing very, very well. Aluminium seems to be bracing for better times. Nalco management told us yesterday. Silver as well has done quite well. So if you have to, someone who's mastered that a few 10 years ago or so, when we should speak quite regularly solely on the metal space, what would you be most bullish on getting into 2026?
The combination of things, Nigel. So, see, one, silver is not just a play on how the precious metal refinery acts, but also on the way how, when denominated in dollars, it would tend to be a lot higher. And the commodity complexes more or less work on the same phenomenon. So, aluminum, copper, all of them actually respond to the same sort of line of things. So, I would say, copper, there isn't really a play. What most companies earn is only TCRC, and to that end, aluminum and silver within the preferences that you gave, Nigel.
Okay, all right. Well, Jigar, hi, welcome to the show. Since we are talking about metals, I'm going to add the word precious before it. Precious metals, gold and silver, they've really taken all of the limelight away from equities this year. What's your sense? Would you be a buyer at these levels, and or is it too expensive?
Right, Ekta. So see, I think, this as a fund, we are mandated to run only equities. So in the equity portfolio that we create, we don't really take positions in metals and in precious metals, so to speak. But the point I was discussing with Nigel does hold here, right? Because what had happened, and maybe if I can take you a little bit back till the time the Bretton Woods Agreement was in place, the balance of power was fairly even, right? You had a USSR bloc, you had a US bloc till at least 1991. And for the first 15 odd years, US did behave. But since 2008, they've printed huge amounts of currency, and there isn't enough alternatives for the rest of the central banks to go around. So the first thing when the printing went through the roof was for central banks to call back all their gold and silver. And eventually those are reacting much more to dollar than their demand supply alone. So yeah, I would sort of have the allocation. Gold is known to move around sort of in steps and then flatten out for a while. So timing, etc., I'm not really an expert, but as an allocation, yes, it's definitely worth large amounts of allocation in one's portfolio.
Got it. Okay, all right. Jigar, what are you making of the entire money flow that we're seeing in these banking and financial names? NBFC's case in point, Shriram Finance. Are you all playing that theme?
So Nigel, if you actually talk about money flows, I'll give you a statistic which at least got us alarmed a little bit. So if you take CY25 and year-to-date CY26, FIIs have sold close to $38 billion in stock. Promoters through IPO, OFS, and block and bulk deals have sold around $44 billion worth of stock. And companies through QIP and IPO have raised around $38 billion worth of stock. And there has been a singular buyer in the entire process, either via mutual funds or direct equity, is retail. Right now, one way to think is that a lot of smart money is moving out. The other way to think is that retail may not be done yet, given that only 5.6% of household savings is coming into equities. We have come a long way from 0.7% that number was in 2014, but most developed markets are at a way higher number. So if you pencil in just about 10% coming into equities, and given real estate and gold, silver has already risen up, equities may be a preferred medium, then we're talking about $100 billion plus flow a year, right? What we have seen in the last 2 years. So what might happen is that things could remain a little more choppy, but it's in the right direction. Your question, yeah, banking financial has been a preferred theme. Some NBFCs have been a preferred theme. So we really like that because a lot of money has been transferred from governments in the hands of people, and some of that is going to get saved via the mediums we spoke about.
Okay. All right. Well, Jigar, how would you be placed on the defense space going into next year?
There is a lot of work, Ekta, that might happen into it, but we think the stock discounts a lot more than that. Right. So as a theme, in fact, if you look at central plus state plus PSU capex, which was growing at a very strong number since COVID, what we are finding for the last year and a half is that that's moving entirely in the hands of people now. So we analyzed the budgets of the past 16 states that went into elections, and found that their social spending bill is higher than their capex bill. And even the government revenues at the central government level are down YOY, which means their capex is going to get hurt as well. A total of almost 6 lakh crores, or about 1.7% of GDP, has moved in the hands of people. And the sectors that drove the market post-COVID until 2024, we don't think those will remain. So our preference for the past 9 to 12 months had moved in favor of consumer discretionary, like two-wheelers, aviation, leisure, cement, to some extent pharmaceuticals, and some of it gets saved, so banking, financials as well.
Okay, all right, Jigar. Thanks a lot for joining in. Wishing you a good end of the year and a rocking 2026 as well. And I think over the last couple of years, you and your team have scaled up very, very well, and wish you all the best.
Thank you, Nigel. Wishing all of you the same at CNBC too. Thanks.
Okay, all right. Well, a good time then to go across to Nimesh, who's joining us on D Street Chatter to tell us what is he picking up in terms of market action for whoever is still at the desk. Nimesh.
I know you are going out for holiday, but we all have to work, Nigel. So, flat markets, Nigel, but the outcome is good. You know, the broader markets have started to outperform. There is a bit of traction back in the broader market names in the last couple of days. So clearly, that's a bit of a feel-good factor. I guess it is to some extent it's also to do with the NAV management towards the year end. So maybe you'll see further upside in the broader market names till the end of this year. Sector-wise, I think the PSU stands out today, and within that, for the second day running, the railway stocks are buzzing, so are the defense names as well. So that's once a couple of sectors stands out. No specific reasons. I guess there is a bit of a pre-budget rally as well in those sectors. But nevertheless, that's space which has done well today. Technically, 26,250 is the level to watch on the upside. There is where the Nifty resistance seems to be. If that gets taken out, you might see further short covering in the days to come. So that's something to track going forward as well. Flows, again, it's a mixed day, not much in terms of flows to speak about. But the good part is that while the Nifty is consolidating, there is a bit of traction back in the broader markets, and they tend to outperform, at least from those extremely oversold levels.
Okay, and Nimish, which are the stocks that you're picking up? Any news on?
Well, so the first stock on my list is Nazara Tech. That's been buzzing in trade today, up 10-12% last when I checked, and good volumes as well. The street is anticipating some corporate development, largely in terms of inorganic move is what my sense is that the company may announce very soon. So watch out for acquisitions from Nazara Tech very soon. The second couple of stocks, whether it's delivery-based buying happening today. So IDFC First Bank and South Indian Bank both stands out in terms of very aggressive buying. So expect high delivery volumes on both those names today. The third name is Hexaware Technologies. Again, while the stock has been consolidating, my sense is that could be a small block in Hexaware very soon. Not the promoter entry, but some large institutional holder may sell a small stake there. So that's something to track. And the last is Jubilant Ingrevia. For the last couple of days, you're seeing some sell-side analysts initiating coverage on the stock. But I understand there is delivery-based buying, and at least one domestic mutual fund is an active buyer in Jubilant Ingrevia at current levels.
Okay, all right, Nimish, thanks very much for that. So that's what's taking place in the dealing room. But Hormuz is now with us. He's going to put the spotlight on all of the top movers in the market. Hormuz, over to you.
The markets may be in snooze mode, but the railway stocks are definitely not. And if you take a look at the volumes, you would get to know that they are all but in snooze mode. You look at the moves, well, they are off the highs of the day. Jupiter Wagons was up in double digits today as well, slightly come off, as was Ircon, RVNL and Railtel. Almost every other railway stock has done well in today's session. But take a look at the volumes. That gives you a bigger picture. Jupiter Wagons has had more than 13.5 crore shares that have been traded. Ircon has had 5.5 crore. Same for IRFC. RVNL has 2 crore shares traded. All of them significantly above their 20-day average as well. It'll be interesting to see what kind of delivery volumes come up, because yesterday for Jupiter Wagons, the delivery volumes were slightly disappointing despite the high traded volumes. So railway stocks on your radar. Tata Capital has seen a big move today on the upside, 4.5% higher, 4.5% big because it has broken out of a very, very narrow range that it was stuck in for the last 2 months since its listing. The biggest single day move that the stock has seen, and for the first time it has broken out of that 315 to 333 range that it was confined to over the last 2 months. Volumes have also been steadily increasing. Today's volumes are already 2x of the average on Monday, and we have had more than 1 crore shares that have been traded on the stock. The last last time we saw 1 crore shares traded were the first 4 days of the company's trading history in October. And the 20-day average here is just 17 lakh shares, or shares with almost 400 crore have already changed hands so far in Tata Capital. Electrotherm is the other one. Another stock seeing double-digit gains, 11% higher on the stock, biggest single-day gain and volume since May of 2023, and close to 8 lakh shares have been traded on the stock today. Take a look at the 20-day average. That's only 12,000 shares. So very, very strong volumes on Electrotherm. The stock is now at its 50-day moving average of 918. The 100-day moving average is at 927. So important levels approaching on the upside. The stock has had a disappointing year so far, down 24%, but that is on the back of a 5x move in 2024. And a 3x move in 2023. And lastly, NMDC is the second straight day of gains for the stock. Volumes already the highest since December of last year. Close to 8 crore shares have been traded on NMDC. The 20-day average is just over 1.2 crore shares. So strong volumes here as well. The stock is above key moving averages, is trading at a 52-week high, is up 25% so far this year, and is turning out to be the 4th year of positive returns in the last 5 years for NMDC.
Thanks, Hormuz, for always joining in and getting that buzz going with regard to all those big movers. And tomorrow, I will not be in, but Hormuz will join us to tell us some of those stocks that are backed with some good delivery as well. Thanks, Hormuz, for that. Well, on that note, we'll slip into a short break. Come back. We'll get you some buy or sell calls with our technical expert. Don't go anywhere.
I see it is, it gives us an opportunity to really stitch the passenger experience together. You know, until now, you had a very fragmented, because you had small operators operating certain parts of the business. So when we started, actually used to be, I used to get frustrated saying that I own the airport, but there's nothing that I can control because everything was, outsourced to some agency or the other. So now that, we've actually executed the strategy of bringing everything under a common umbrella, we are able to, one is from a revenue point of view, cross-sell and upsell much better. And then from an experience point of view, you can control everything and have a end-to-end stitched together experience. So the kind of experience you would get in a parking, the kind of customer experience you get at parking or at a help desk is the same experience you get in a VIP lounge because it's the same people being trained in the same mindset.
So that brings me to the question then, what part of this business are you currently not into that you want to get into? I mean, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not. No. We were legally not allowed
I know,
to.
But I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo.
Absolutely.
If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every.
So from a unit economics point of view, it doesn't make any sense for you.
For us, no.
For you at this point in time, or even in the future.
Yeah.
If the opportunity were to arise.
Yes.
So that's not something that you would consider.
Not at all.
Okay, so let's talk about the airport business then, Jeet, and let's talk about financials because you've crossed 90 million now as far as the Mumbai airport is concerned. Even if
as the platform,
even if I look at the year-on-year growth that you've seen as far as revenue from operations is concerned, there has been an uptick there as well as on EBITDA.
All right, welcome back. Well, the markets as flat as can be. From the broader markets, though, a few stocks actually are catching your attention. Godavari Power and Ispat has spiked to the high point of the day. I think it makes sense to get that one up for you. Greenply, valuation discount in comparison to its peer, larger peer, that's Century Ply. So that stock, in fact, has moved up. And DCX, that stock, in fact, has seen a bit of a move yet again. Last couple of trading sessions, DCX has moved, I think, from around 170 to around 210. And periodically, it's been doing a jig of its own. Very, very large volumes on this name. A rank underperformer suddenly seems to be moving up. Midesh Thakkar is back with us. Midesh, what are your two calls?
So ITC is something which we discussed, slightly off about a rupee down from where we discussed, but I think these structure does suggest a reversal. So we'll take a BTST here with a stop below 404.7. Look for targets of around 410, 412 for tomorrow. It can eventually go higher as we discussed earlier, but I think for a BTSC trade, that looks to be the target. And yesterday, defense stocks had a lot of good breakouts, and today I think one of them is giving a pullback. That's Mazgaon Dock, so it gives you a good entry point. So BTST here with the stop at about 24.90 for targets of 25.50.
Okay, all right. Well, let's talk about one stock which has actually done very well since its listing in May, Belrise Industries, which is in focus because it signed a strategic agreement with an Israeli company to explore opportunities in the defense sector. And additionally, the promoter has sold around 6.6% stake to meet with the minimum public shareholding norms ahead of a planned merger of two related entities. We did speak to the management earlier, so let's listen in to what the management had to tell us.
Plasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Plasan on supplying some components for their global exports. So that's already in progress, and we should see revenues of that in the next fiscal year. Defense and aerospace in general as a segment would be a higher margin business than our automotive business. We are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'd appreciate is just this year we have announced 4 new manufacturing facilities. Right from our first earnings call, we have guided on merging or acquire 2 of our related party entities. One is Badwe Autocoms and second is Exumates. So if you were to merge both of these entities in, that would have pushed our promoter shareholding above 75%. And in that case, we would have violated the MPS norms set by SEBI. Hence, we have done this transaction in advance of the merger that we filed. And that is the reason why we have gone ahead and done this transaction as of today.
Okay, so that's Belrise, stock up around 7% but Samvardhan Motherson plans to acquire Nexon's auto-electric wiring harness business at an enterprise value of 207 million euros. Earlier today, we did speak to the Chief Operating Officer of the company, Pankaj Mittal, about the acquisition and the outlook.
It's a very exciting opportunity for us, which is fully supported by the top customers. This will nearly double the revenues of the wiring harness business in Europe. We expect the closure in the first quarter of 26-27, and the revenues currently are shaped above 700 million euros. As we make deeper inroads with the premium car makers, it will open up more and more cross-selling opportunities, as well as it will help us in our integrated modules business, where we will be able to add more content as the customers have been looking for someone who can give modules. So that's also a kind of direction in which we will all work. Quarter is around the corner for closure, so we can't talk much about this quarter. But definitely year on year, you would see improved revenue performance. The company has had many acquisitions which have been merged in, plus all the entities which have gone in for restructuring in Europe especially have started to give better results. So that's what we told you at the end of the last quarter. And we will be able to give you more color as we close the quarter and move forward. We do envisage double-digit growth as we move forward in the years. So it's not something which happens in a year, but we see a very good growth over the next 3, 4, 5 years after the acquisition is done. And even in the very first or second year, you will see a good growth because the new products which the company has launched for the car makers, they will come in full flow.
Okay, all right. Well, let's get talking on the technicals. We have Jay Bala, CMT of cashthechaos.com joining in now. Jay, hi, welcome to the show. Well, it's quiet in terms of the indices. In fact, the Nifty is absolutely flat as we speak. So everybody is, going on that promised vacation towards the end of the year. But what's your call? Do you think that record highs are probably going to be on the cards towards the year end or by the year end?
Hi, Ekta. The short term, the markets are a bit indecisive. But I've been maintaining since April of this year, that the markets are heading for record highs closer to 29,000. The short term, the indecision comes because the markets are locked between 26,325 and 25,690. So a breakout on either side is likely to provide a big move. Even if the market had a breakdown below 25,690, that will be a temporary blip for the market. The markets could drop to 25,100 or even 24,400. But the medium-term picture would still remain unchanged towards 29,000. So, say from a 2 days to a few sessions perspective, I would think the markets are a bit indecisive, but we'll wait for a breakout. If 26,325 were to come first, then we can anticipate 29,000 faster than what we are anticipating. But like I said before, in either case, I'm anticipating 29,000 either by March to June 2026.
All right, hi Jay. Last interaction of that we are having in this year, but what about the Nifty Bank? That seems to be in a bit of a consolidated phase. What are the levels you're looking out there? Does it have higher highs to go? And the sector really of this entire month and for the year as well has been metals. More to go?
Yeah, definitely, Nigel. Metals definitely has got further upsides to work with. And even today's price action is showing bullishness. As long as the Nifty Metals Index stays about 10,000, which I've been saying for a few weeks now, it's heading for 11,200 to 11,900. That could also be a bit conservative. When it comes to the banking sector, as long as the pullbacks remain above 57,628, I think the banking index has got fresh higher highs, fresh record highs to come through, somewhere closer to 61,000, maybe slightly beyond. It's a bit tired. The banking sector is a bit tired because the lack of pushes there from the private sector banks. Only the public sector banks have lifted the banking sector. We need participation from HDFC, ICICI in particular. So once we get further push from Nifty private sector banks, then I think the index is headed for fresh record high. But watch 57,628. That's a very important level for the banking sector.
Okay, all right. Well, what is buzzing is also a couple of these gold and silver ETFs. So Nippon India Silver ETF is up around 1%. Remember, it's gained around 141%, obviously mirroring silver prices. And we have Gold Bees, which is also buzzing on the upside. It's gained around 3% this week and over 76% this year. But earlier today, we did speak to Mark Mobius, Chairman of Mobius Emerging Opportunities Fund, on the AI theme, Indian software and hardware companies, the Indian market, as well as his outlook for 2026. Listen in.
AI has been pushed and pushed and pushed by so many people that it's quite bubble-like territory. But at the same time, you must remember that AI is here to stay and is expanding. More and more people are adopting AI systems. I myself, I'm using AI almost every day. So there's no question that the AI revolution is here to stay and will continue. But some companies have been emphasizing their AI expertise. And that really may be a little bit too much. Some of these companies are not really into AI directly. And so I think we have to watch it and pick and choose those companies that are really into AI systems and developing AI. Where we would want to focus is on the software companies as well as the hardware, in other words, computer hardware companies, which I think will be growing at a very fast rate going forward. Now, of course, many of these are not listed yet, but as we go forward, this will be a good development area. Well, I think a company like Infosys is a very good company. I'm looking at companies that are doing the hardware for Apple, companies that are not yet listed but are going to be listed going forward. That would be a very interesting area to develop. I still like gold. I think gold should be part of any portfolio. I hold 10% of my personal assets into gold. And I think going forward, gold will continue to be very, very good. Now, it doesn't mean that it's going to go up in a straight line. There'll be corrections along the way. But there's no question that in US dollar terms, at least, gold will be doing very well, simply because of the proliferation of dollars around the world. And now with AI, you're going to see a lot more development in terms of literal gold. In other words, gold that is not necessarily hard, but soft gold embedded in some of the currencies. So this is going to be a very interesting development going forward. As far as we're concerned, India is number one. It's the most important market in emerging markets, not only because of its size, but because of the youth of the population and because of the developments that are taking place in India that will be revolutionary, very, very important.
Okay, well, that is Mark Mobius, well, a shining example, Nigel, of longevity, where we all talk about, you know, how should you be expanding your lifespan and, you know, living healthy and living. This is a perfect example. Absolutely. 89 years old. And one of the key things that he does say is that exercise is a non-negotiable for him. Wherever he is in the world, he has to exercise, either it's cardio or strength training. 89 years old, and that's what he says is his secret to longevity. So that's Mark Mobius talking on the markets there. Well, we'll take a short break, but we'll be back with more. Stay tuned.
The plan now in terms of expansion, it's rumored that you're putting together a $15 billion expansion plan for the airport business.
Yeah. So, I mean, the $1 billion number keeps changing, but, you know, at least
with the currency.
Yeah. So I'll say it in crores is, so our 5-year plan is a 1 lakh crore investment plan, which includes expansion in capacity of Navi Mumbai, you know, refurbishment, major refurbishment in Mumbai, expansion in Ahmedabad, especially timely with the Commonwealth coming there. You know, expansion in Jaipur, in Lucknow. We're inaugurating Guwahati, so that's at the tail end now. And expansion at Trivandrum. So pretty much all of the assets, barring Mangaluru, is in expansion mode.
By 2030?
By 2030, yeah.
Okay.
And, you know, from a financials point of view, we see that there's going to be two major sort of cycles. One is happening as we speak, where we'll see another jump over the next year. Then we'll see gradual growth.
Jump in passengers or jump in
revenue? Numbers, in revenue, in both.
Okay.
Because of Navi Mumbai coming in, you'll see a big jump. And there'll be gradual growth at, you know, taking 10-15% growth every year. And then you'll see a big jump in 29. In 29 will be an even bigger jump because there are a couple of things happening simultaneously. You will see large assets like Ahmedabad, Jaipur, Lucknow come online. And passenger numbers will grow quite a bit. And also that is the time where most of our city side development also comes online.
Okay.
So while the pre-leasing will be done, but the revenue numbers will start ticking in 29-30. And that will represent a massive 30 to 40% jump over the year before that. So that's how broadly over the next 5 years, the investments that we are making today are going to yield returns.
You know, speaking of investment, let's also talk about debt. Debt of a little over 27,000 crores at this point in time. What's the debt reduction plan?
I don't think there will be a debt reduction immediately. I think it's more changing the structure. So if you see Navi Mumbai today, it's been financed using classical project debt from Indian banks. At some point, we want to, once it's operational and stabilized, and before we begin the next phase of Navi Mumbai, we would want to refinance and take the Indian banks out because we would want to tap them again for project financing.
Okay.
And that's been our model if you look at any of the businesses. So we use Indian banks during the project life because that's the sort of appetite that they have. And then for long tenure, you know, 10-year, 15-year, 20-year, 30-year debt, we tap.
All right, markets as flat as can be. It's that sort of a day. You know, you're having the markets actually virtually unmoved. But Jay Bala still with us. Jay, it's a boring market, so to say. But you've got individual trading ideas for us. So help us out with that.
Yeah, I have to be conscious, Nigel. Not only it's a thin market, the markets are a bit stretched, so allocate lower. The gas stocks seems to be pointing to some activity, and probably something's churning up in that sector. So I like Gujarat Gas from the space, along with a stop loss of 379, possibly heading to 500. The next best within the space is possibly Gale here, but it's not yet broken out. And you might also want to pay attention to selective defense stocks. And I don't have a fully convincing picks, but I would, because we are already long on Bharat Forge, which I had given to CNBC TV18 somewhere about end of October or early September, I don't recall exactly. Bharat Forge, you can add to it with a stop loss of 1379, and it's probably heading to 1347. It's probably heading to fresh all-time highs.
Got it. All right. You want to give us your take on precious metals?
Yeah, gold and silver are coming to very important resistances. The short-term picture is such that it can be a bull trap for gold. Watch out 45.05 on spot gold. Spot gold 45.05 is a very important level. If it can take out this level on an accelerated basis, gold might have further highs to come through. But I suspect this might be a very important resistance for this for the precious metal. Silver, the next resistance is about 71. So watch out for resistance to kick in. I'm anticipating a short-term correction or short to medium-term correction to come through, but the long-term remains bullish. So you might want to lighten up positions if you're long around these levels. But if you're a long-term investor, still remain holding on to it. If you can stomach some headwinds from a 3 to 6 months perspective, post that it'll come back to the bullish path.
What about Bitcoin, Jay? It's been a tale of two halves. First half of the year, rocking. The cryptocurrency boys were partying. Second half of the year, we've seen a sharp decline. But you're not ruling out that this could just be an interim break and then they get back to its bullish ways?
That's right, Nigel. The December low of 79,500 or something, we would like to see the market clock one more low below that. And post that, I think Bitcoin can go back to either 150,000 or even 200,000. But that's a medium to long-term perspective. But it's very important what it does between 74,000 to 69,000. That's a very, very, very crucial support from a medium to long-term perspective for Bitcoin. So the short term, I would like to see one more break of the December number, the spike low at about 79,500. And then I anticipate a resurgence for Bitcoin.
Okay. All right. Jay, what about the mother market? What are you making of the mother market? Because the US markets have been on this big rush. Those dips are getting bought into. Then one thought that maybe in December it'll lose its way, but actually they come back strong. What's the outlook out there? If you want to give us a few levels.
Yeah. See, it said as goes the Dow, so goes the market. The Dow clocked fresh all-time highs in December. The S&P and the Nasdaq haven't followed it, but yesterday's price action is indicative that the rest of the markets are likely to follow the Dow. And even the semiconductor index, SOX, that has clocked fresh record highs in December. So all signals are such that we are looking at fresh record highs for S&P and the Nasdaq. We are looking at somewhere close to 51,000. So probably Santa can bring the important 50K in the festive season, and probably looking at something like 27,000 for Nasdaq. But post this fresh record highs, possibly a short-term correction is due. But 6920 cash S&P, that's an important level, which is the all-time high. I'm anticipating somewhere about 7,100 by January. So yeah, fresh record highs anticipated for all the mainline indices.
Okay, all right. And for the dollar index, your long-term support levels, where do they stand?
Yeah, I was anticipating the dollar index to pull back to somewhere close to 103. There's a small possibility that the 100.9 that we saw a few sessions ago, that might have been a corrective peak. So it's probably short-circuiting the corrective rise. If dollar index were to break below 97, it's probably heading to test its long-term support at 95.5 to 94.5. So watch 97 as an important downside support. That were to break, it's heading back to 95, 94.5, the long-term support.
Okay, all right, Jay. Thanks a lot for joining in and giving us all those views. Wishing you a good end to the year, and I'll see you in 2026. Thanks for joining in. Well, the stock of the last 1 hour actually has been ITC. We'll have to wait for any kind of confirmation. But as I mentioned at the start of the show, there's a buzz that there is a price hike that's come about and there's inventory at lower levels. Jan 1st is when they talk about the price hike. Let's see whether or not that's true. But the markets otherwise ended more or less flattish today, but stocks did a thing of their own. Coal India was up close to 3.5%, ITC as well did support, and Shriram Finance continues its winning ways. On the flip side, we had stocks like Infosys that took a bit of a breather. You had Bharti Airtel that was down in trade today, and Tech Mahindra as well did come in for some profit taking. But Ekta, plenty of action in the broader markets, isn't it?
Yes, absolutely. Well, the mid-cap index ended as flat as can be, but we had the advanced decline ratio, which was in the positive side. So around 2,500 stocks advancing to around 2,000 stocks declining. In terms of stocks that gained, it was Chola Investment as well as Chola Finance. So they brushed off all of that negative news, up around 6% and 3% respectively. We had a couple of other counters such as GMR Airports, which did well. So that was up around 2.6%. A couple of these metal counters continued to gain. So SAIL was up around 2.5%. On the downside, a couple of stocks which did see a decline was Meesho. So that stock was down around 7%. It's lost 16% this week. Idea Forge was down around 3.6% in today's trading session. And something like a DCX Systems also lost out around 3% Grow2 lost out around 3% today. And a couple of the banks also ended in the red. So South Indian Bank as well as Federal Bank did see some profit booking. Well, overall, it was absolutely flat for the markets. And I guess the volumes will be lesser as we go through the trading week, considering that the holiday season has begun. The US markets will be closing half day tomorrow and will be closed for trade on Thursday as well. It's a wrap on Closing Bell. Markets Forward coming up next.
Either global, domestic, either one.
Well, you spoke about refinancing, and you just did a refinancing of about, 750 million, I think, in June this year. What about the currency risk at this point in time? We've seen the rupee depreciate now to 91. Does that worry you?
So structurally, it doesn't affect us because we keep hedging and we don't keep any exposure to currency. So our policy has always been that no exposure to currency, no exposure to interest rates. So whatever we refinance at, we lock that interest rate for 20 years. Whatever we refinance at in terms of currency, we lock that also for 20 years.
So the Adani Enterprises rights issue, there was buzz that perhaps you could use some of those proceeds to cut debt for the airports. Is that likely?
No, so there's some debt that Adani Enterprises has.
8,000 crores.
Yeah, no. So
the loan that they've given.
That AEL has given to Adani Airports, that is the part of it which will get cleaned up.
Okay, so you will use the rights issue to clear that, the 8,000 crore rupee.
Yeah, but that's not an eventual end use. The eventual end use is going to be the expansion.
Okay. You talked about capital markets. So an IPO for the airport infrastructure story from India for you, when is that likely? Are you working towards it?
So absolutely. I think right now it's fluid in terms of which option to go for. There's always an option of a demerger from Adani Enterprises, which is what we had done in the past. There's also an option of IPOing. I wouldn't say we're leaning one way or the other. Also whether to get in an anchor at the right time to establish a value benchmark.
A strategic or?
Strategic anchor, someone who can, has a name in the market and is able to.
In the airport business?
At the airport business. So giving the airport business itself the right value benchmark before we demerge or IPO. That's also something we're considering. But right now I wouldn't be able to give you a firm date, but definitely over the next 2-3 years, you would see something coming up.
What would you said that there's no decision yet or no preference yet on which route you decide to take. But as you evaluate both these options, what are some of the pros and cons of both, either the demerger or the IPO?
Look, demergers are something that we are used to. We've done IPOs before in the past, but what demerger allows us to do is unlock value to enterprise shareholders directly. And that's something that they also do expect. And an IPO really doesn't allow us to do that. and but it does create a lot of buzz. So so I think it's evaluating between those two, that whether we are able to push the value of the business as much as we can on day one, or we give the right return to shareholders on day one and then push the value sustainably. So I think we're leaning more towards demerger, but I would say the decision hasn't been made today.
Okay, the decision hasn't been made today, but you anticipate that call in the next
sometime soon.
You know, 6 airports through the privatization route. If the government were to put more airports up for privatization, do you still have the appetite to take on more?
Absolutely.
You do?
Yes. I mean, if you see the airports that have been sort of identified for the next round, there's a lot of them which are...
Indian markets end flat after a volatile trading session, with Nifty slipping below 26,200 despite the benchmarks closing in the red. But market breadth remained positive, with advances outpacing declines.
Cholamandalam Investment rejects allegations of corporate misgovernance leveled by Cobra Post, calls it malicious and baseless. Cobra Post had highlighted a worrying pattern of large value cash transactions and related party transactions between the listed NBFC, its subsidiaries, and the parent Murugappa Group. Cholamandalam says it has compiled with all regulations.
And Adani-run Ambuja Cement's board announced its merger with ACC and Orient Cement to create a 107 million ton production powerhouse. The transaction is expected to be completed in the next 12 months, subject to regulatory approvals. Promoter shareholding in the consolidated entity will reduce to around 61% from the current 68% post the merger. Hello, welcome to Markets Forward on CNBC TV18, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vinny Motiwala. With me is my colleague Vivek Iyer as well. Vivek, it's been a day which was a bit muted, but nonetheless, yesterday we had seen a very good run-up. We're still holding on to 26,000. So no complaining on that front. Even though we've closed below 26,200, I think 26,150, 100 is what I think experts were also talking about as a level to watch out for. An advanced decline ratio, nonetheless, at least the broader end of the market, small cap specifically, managed to close in the green today, Vivek.
That's right, Vinny. Good afternoon. And again, another session where, even though the advanced decline ratio on NSE is slightly in favor of the declines, what we actually saw was a day where we saw buying coming in from lower levels. But we have a lot lined up on the show. So let's see what we have in store for you today. We start with the top movers and shakers of the day with Hormaz Fatakia. We get you the full statement of Chola Investment dismissing Cobra Post allegations, the ACC Ambuja Orient merger, remember Adani consolidates its cement business, and Coforge, remember, came under pressure on fundraising plans. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But well, now on to our first segment of the day. Hormaz joins in now from the big wall with the top movers and shakers of the day.
It was a kind of a day when the markets went into a bit of a snooze mode until the last 30 minutes, where there was some action, at least on the upside as well as on the downside. And there were some energy stocks that did very well in today's session. NLC India beat Coal India. There is buzz around an IPO of one of its units. SJVN also did well, as did Reliance Power. But the one sector that stood out today were the railway names, and they continue to move higher. It was the third straight day of gains for all of these companies, be it Jupiter Wagons, Ircon, Railtel. You pick up a railway stock and it was higher today, gains of anywhere between 4% to 9%. Of course, all of them ended off the highs of the day, but with gains and, more importantly, on very strong volumes. The newsmakers of today included the likes of Coforge, another board meet for another fundraising proposal, the stock ending almost 5% lower. Another order for Antony Waste, Sangvi Movers also an order win boost, and Cholamandalam, of course, we'll talk more about that as the show goes by, with the stock managing to hold on to gains of around 6%. New listings have been the talk of town, and Meesho, another day, another fall today, almost 8% lower on the stock. The stock is now down almost 30% from its post-listing high. Grow, after getting a sell recommendation from one brokerage note, was also down today, as was Physicswala. And lastly, Stocks that ended at a 52-week high today. JK Tyres did well. And NMDC, of course, metal stocks continuing to move higher. Shriram Finance, another day, another high for the stock as well. And Cupid ending 2.5% higher, a 52-week high here as well.
Okay, thank you so much for that, Hormaz, for the list of all the stocks that were moving around in today's trading session. But let's move on and go across to Nigel. He's going to talk to us about Ambuja Cement that surged in today's trade. And obviously, this came in why? After ACC's board has approved that scheme of amalgamation with its parent, Ambuja Cements. Under this plan, obviously, we have Ambuja Cements that will issue 328 equity shares for every 100 shares of ACC. What are the implications? What more are the details? Let's go across to Nigel for that.
Well, that's right. The long-awaited and anticipated merger of Ambuja Cements units have been announced, which will create a unified one cement platform. The board has approved the amalgamation of ACC and Orient Cement with Ambuja Cements. Now, Ambuja will issue 325 shares for every 100 shares held in ACC, while Ambuja will also issue 33 shares for every 100 shares held in Orient. The transaction is expected to be completed in the next 12 months, subject to regulatory approvals. You'll be asking, though, what are the big benefits? Well, it simplifies the group structure and it reduces holding company discount because some brokerages, they did assign that holding company discount. Next up, well, it improves transparency as well as governance standards via elimination of master supply agreement and the related party transactions. It also aligns with Ambuja Cement's plan to increase the cement production from ballpark around 107 million tons to around 155 million tons odd by 2028. The management targets cost savings of around 100 rupees per ton from the supply chain efficiencies, while Nirmal Bang says that there could be an additional 40 to 50 rupees per ton benefits over the next 2 to around 3 years, which is expected from improved tax efficiency as well as working capital optimization. Since there'll be fresh shares that will be issued, there'll be some kind of dilution, and that's why the promoter holding will come down to around 61%, which compares with around 67% earlier. Brokerages, well, Morgan Stanley, they say that they view this as a positive development. It removes the overhang of managing multiple listed entities under Ambuja Cements, and that's why shareholders will like it. CLSA, they have quantified it. They say that the amalgamation will lead to 10% value accretion for Ambuja shareholders as per their analysis. So net-net, amalgamation will have a neutral to a positive bias for the combined entity.
Well, some significant consolidation between the Adani Group cement entities, and thanks, Nigel, for explaining that particular transaction for us in detail. Well, the other stock that came under pressure today was the share of Coforge. It slid nearly 5% on plans of fresh fundraising. The IT majors board meeting on December 26th will consider funding options, including equity issuance and private placements. Concerns around potential dilution and uncertainty over the capital raise have soured sentiment. Rima joins in with more details.
So Coforge has announced that the board will meet on the 26th of this month, where they will consider a fundraise. And after that, at 5:30 p.m., the company will be holding an investor meet. The last fundraise by Coforge was in May of 2024, when the company raised 2,240 crore via a QIP, and this was to fund the Cigniti acquisition. Now, you can't compare the stock price, the QIP price, to where the stock is currently today on account of stock split, which took place, after that. Now, the question everyone's asking is, why is Coforge looking to raise the money? We don't have the answers. We'll know on the 26th. But is it to raise, money for an acquisition? Because one of the pillars of growth for the company has been acquisition. They've done the Cigniti acquisition. After that, there was the Rhythmos, there was, I think TM Labs. So the company has grown partly on account of building capabilities via acquisitions. At a recent analyst meet, the Coforge had outlined some areas, according to analysts, where they could consider an acquisition. This would be to improve their capabilities in geographies like ANZ, APAC, and even in industries like healthcare and UK public sector verticals. Now, the cash on the books is not very significant, which is why analysts say if they have to do an acquisition, maybe they could be looking for some equity fundraise. Now, why could the stock be under pressure? Because one, every time you raise money, there is some dilution risk. And secondly, in the past, Coforge has had concerns with analysts on account of the cash flow generation, which was the weakest compared to other mid-cap or large cap IT peers. After that, the company has course corrected, and they did guide that the cash flow payout will be, free cash flow to PAT will be 70%. Is there a risk to that? Or will the company be looking to further increase their investments in data center? Because last time they said they will not be doing that. So I think there are some concerns, and plus Coforge, as we know, has been a rank outperformer. Not this year, but just over the last 3 or 5 years, stock has done very well. So interesting board meet, Coforge looking to raise some money. 26th is the date.
Okay, 26th is the date, Rima. We'll keep an eye out on that. Thanks so much for that. Let's bring on board now our experts for today as well. We do have Jay Bala of Cash the Chaos as well as Mayuresh Joshi of William O'Neill to discuss more in terms of markets as well as individual stock names as well. Jay, I want to start with you in terms of the levels now that one should keep an eye out on. Today, it was a very dull day that came in for the markets, but we still managed to close around 26,200. Not at 26,200, but around that level. So now what are we keeping an eye out on, and how should we view the next levels for the Nifty as well as the Bank Nifty?
The markets are stuck between 26,325 and 25,690. A breakout on either side of these levels, the markets are likely to see a big one-sided move. So the indecisive in the short term can be attributed to the light trading activity around the festive season and probably around New Year. So let's see. I would prefer the market to break out to the higher side. Even if the market were to break down below 25,690, it will be a temporary pause in the bullish move for the markets. I'm anyway anticipating the markets to get to 29,000. Like I've been saying since April, by March to June 2026. So what the market does in the very short term depends on which side the breakout occurs. So the levels on the Nifty is 26,325 and 25,690. When it comes to the banking index, as long as the sector remains above 57,629, it is bullish. So watch 57,629 as a key level.
Okay, thank you so much, Jay, for your views as far as index levels are concerned. But bringing in Mayuresh as well. Mayuresh, good afternoon and thank you so much for joining us. Mayuresh, if you have a specific view on Coforge, just last year the company did a large acquisition of Sigvity, raised close to 2,400 crore via the QIP route. Again, a likely QIP on December 26th. What could be the likely reason for this particular QIP? And can the management actually go ahead and consider another acquisition so soon? And within the mid-cap IT basket, where does your favorite lie?
Absolutely. No, I think that seems to be something that we need to probably ponder on the 26th on what the QIP will be used for. However, I think mid-cap IT companies have reported a reasonable set of numbers. The commentaries have been relatively strong, and they have given a reasonable amount of guidance in terms of constant currency revenue growth, the EBIT performance itself in both absolute and margin terms, as well as expectations in terms of the pricing environment probably remaining stable as well. Having said that, I think what really transpires, as I said, over the next few days for Coforge is something to be seen. But something like a persistent and emphasis is what we continue holding in our global portfolios. Our take is that based on all the facts and the commentaries put together, mid-cap IT, though valuations a tad bit on the higher side compared to large cap, still seem to have better rating rankings and all the institutional holding parameters that we see in canceling. So outside Coforge, I think persistent and emphasis is something we continue holding in our global portfolios.
Okay, persistent is something that you would look at outside Coforge as well, and emphasis as well. Thanks for that view there, Mayuresh. But let's move on and talk about Bellrise Industries. That rose more than 6% in today's trading session. Now, this came in after the promoter, Sumed Tools, sold around 7% stake, and this is through block deals. The stake sale was undertaken to comply with the minimum public shareholding, the requirements that were there, and the promoter has indicated that it does not plan to reduce any further stake. Now, let's go across to Sud to get more details on this front. Sud?
So it's been 6 months since Bellrise Industries got listed on stock exchange, and what a move this stock has seen, almost double from the listing price of 100 rupees. Now the stock is hovering around rupees 180, and today also it has moved as high as almost 12% in today's trade. And the reason, two reasons. First, promoter has sold nearly 6.6% stake to raise almost 900 crore. Another company has also signed a 3-year defense agreement with an Israeli company. So now first talking about the block deals and why the the company has sold, or promoter has sold nearly 6% stake. So basically, it's to meet the minimum public shareholding norms. As of September 2025, total promoter stake was 73%. But in the DRHP, company had mentioned that there would be a merger of two related parties. Once that merger would have taken place, the promoter stake would have crossed 75%. So to meet the minimum public shareholding norm, promoter has decided to offload 6.6% stake. But the question is that will the promoter look to sell further stake? The answer from the management was no. As of now, there is no such plan. Now talking about the agreement, the 3-year agreement that company has signed with an Israeli company, and the name is Palasan. It's a 3-year agreement, and the objective of this agreement, first, to back the order in the defense segment from the Ministry of Defense and other PSU companies and also other companies, and that would be specifically related to defense. And as part of this agreement, the company would also help in the global supply chain of Palasan. Now about the outlook, we are seeing the strong demand that all the auto companies are seeing, and on the back of that, even Belrise Industries maintains mid-teen revenue growth outlook that company has given for FY26 as well as for medium term. Let's listen to what exactly company had to say about both promoter stake sale and the agreement that it has signed with an Israeli company.
Well, thank you so much, Sudarshan, for joining in and giving us, exactly what transpired as far as Belrise was concerned in the trading session today, one of the top movers. And as Sudarshan pointed out, let's also listen in to what the management of Belrise had to say on the growth outlook going forward.
So Palasan itself is a $2 billion company globally. So it's massive and is able to garner share with all of the top suppliers in North America as well as Europe. So in that sense, the market opportunity is quite massive, not only in India, but globally. In fact, we've already started working with Palasan on supplying some components for their global exports. So that's already in progress, and we should see revenues of that in the next fiscal year. Defense and aerospace in general as a segment would be a higher margin business than our automotive business. We are maintaining the mid-teens revenue guidance as of now with stable EBITDA margins. What you'd appreciate is just this year, we've announced 4 new manufacturing facilities.
Well, that was the management of Belrise, one of the top movers in the session today. Well, Mayuresh, coming to you, I don't know if you've had a chance to look at this particular name, but within the auto ancillary space, there's been so much of consolidation happening, especially to companies, that are export-facing, especially to Europe automakers. Within that particular space, do you feel majority of the pain is over and 2026 calendar year can be a better growth year? Top picks there.
It should relatively, Vivek. And both, I think, the OEM market, which is shaping up and gearing up pretty well in terms of volumes, new launches, as well as the replacement market, should actually start working for the auto anch industry as a whole. The second element, obviously, is that pricing should remain relatively stable. Replacement, the pricing was always relatively better and stronger and robust. But even the OEM prices with demand coming back strongly should hold up. Input costs have probably moderated and stabilized to a large extent. And therefore, I think the kind of products that a lot of auto anchs are probably introducing, which is largely ICE, EV generated as well. The powertrains are probably more attuned to the newer platforms. I think as a space, it should continue doing well. So I think we continue holding a stock like Uno Minda, where our belief is that the content per car will go up significantly higher over the next few years. They've got capacities which are built up in terms of integration, both forward and backward. And therefore, the product mix that they've probably got should work in its favor as we head into FY26.
Jay, what's your view for Belrise? I know there's not enough terms into charts in terms for Belrise Industries listed just this year itself. But is that something you would look at, or maybe you would stick to the market leaders on the auto ancillary side?
See, with the limited history that's there, Vinny, it's giving a reasonable signal. And today's spike high and then closing around the midpoint of trading range is not that of an encouraging sign. But from a slightly zooming out a little bit on the higher time frame, the stock, if it were to drop back to 140 to 135 and then reverse, that will be a very bullish signal for the stock. Within the auto ancillary space, I like Motherson Sumi, and I've been bullish on it, and I'm expecting fresh all-time highs to come through. So the topic within the auto ancillary space remain Samadhana Motherson.
Well, thank you so much, Jay, as well as Moiresh, for joining us, giving us your view on both technical as well as fundamental aspects. Thanks once again. Well, with that, it's time for a quick break. We'll get you the top corporate voices along with the key market events to watch out for on the other side. But let's listen to what Mark Mobius had to say on the opportunities in the Indian market as we head into that break.
Where we would want to focus is on the software companies as well as the hardware, in other words, computer hardware companies, which I think will be growing at a very fast rate going forward. Now, of course, many of these are not listed yet, but as we go forward, this will be a good development area. Well, I think a company like Infosys is a very good company. I'm looking at companies that are doing the hardware for Apple, companies that are not yet listed, but are going to be listed going forward. That would be a very interesting area to develop.
Potential. And that's why we think we would be quite aggressive in the next round as well.
Which ones are most suitable for you?
I'm not going to say that on live TV.
Come on, which ones have you identified as key assets that you would like to go after?
So as of now, I would say all 11.
All 11?
Yeah, absolutely.
So that's the kind of appetite that
yes,
you have.
Absolutely.
Do you have a war chest that you're going to put to work as and when that process
So
starts
I
again?
don't think we'll need a large amount of capital upfront. What is going to be quite helpful is the amount of work we have done on the existing platform. So in terms of people, process, technology is something that we don't need to reinvest now. So we can simply extend it now to whatever new airports that we add. We've been...
Welcome back to Markets Forward on CNBC TV18. Now let's talk about some of the key corporate voices that we had for you all during the day. First up, we had Shwetank Singh, who's the MD and CEO at Chalet Hotels, and he told CNBC TV18 that the company witnessed historic November numbers in terms of demand trends, driven mainly by increase in terms of holidays and a pickup in MICE demand as well. The company expects robust performance in Q3 and Q4, with average room rates growth likely to be in mid-teens during these quarters. A strong H2 is what he's expecting.
Well, Maersk Docks Management, on the other hand, said that the Indian Navy is in the process of finalizing a deal for 3 additional P-75 submarines, which is expected to close by the end of FY26 or early FY27. The company has maintained its FY26 guidance, with revenue growth projected at around 9% and EBITDA margins projected near 15%.
The CDMO giant, one source, also spoke to CNBC TV18. The management said that India is emerging as key market for the GLP-1 weight loss drug. The company has tied up with many pharma companies, Natco Pharma being one of them, and sees it as a big opportunity for semaglutide in Canada. Remember, semaglutide goes off patent in 2026 in Canada. And before we wrap up this edition of Markets Forward, let's go across to Gaurav, who's here to tell us which are the key events to watch out for in tomorrow's trading session. Gaurav, apart from Christmas Eve being tomorrow, what are we keeping an eye out on?
Let's talk about Indian market and stock-specific action that we should be watching out for. First is JK Tyres, because tomorrow is the record date for Cavendish Industries' merger with JK Tyres. So let's watch out for this one. GRM Overseas. Now, this company will trade its bonus issue in the ratio of 2:1. So let's see how the stock market reacts to that. Apart from that, Aeroflex Industries, let's watch out for this as well, because tomorrow is the meeting for a board where they will consider disinvestment from the material subsidiary MR organization. So let's see how market takes up this news and how they react on this as well. From the IPO markets, let's not forget about Gujarat Kidney and Super Specialty. Remember, the 250 crores IPO got subscribed almost more than 2.4 times, and tomorrow is the last day for subscription for retailers. And from the new listing side, we have got SME IPOs which will come. First is the Global Solutions Logistics, 30 crore IPO which got subscribed almost more than 13 times, and Mark Technocrats, which 43 crore IPO which got subscribed more than 10 times. So let's see how the new fresh listing happens for these companies. From the global point of view, let's not forget about the Bank of Japan. they will release the minutes of its October policy meeting. So let's see if there is anything material that we can pick up from that. And lastly, from the Western markets, if you look at these markets, they're actually gearing up for the Christmas Eve, because we've got US market and US bond market. Both of them will be functioning for almost half day. And lastly, most of the major European markets, they will also be functioning only for the half day. In fact, the German market, it will be closed tomorrow because of the Christmas. So let's, from the global point of view and the cues from Western market at least, it looks like a muted day. But let's see how market reads this going ahead.
Well, most European as well as most global markets seem to have at least a half day or a half session as far as Christmas Eve is concerned. We, however, will be working completely tomorrow, given the fact that we have a full working day. But with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Of people quite well to be able to extend into new airports that come in. So we don't need to go out and buy talent. We have actually grown that talent in-house. The technology that we are using to run an airport like Navi Mumbai is something that we can extend immediately on day one. And the processes was also something that we've, again, part of it adopted from outside, part of it grown in-house, and then sort of engineered it over time to be as good as it is today. Of course, it's never perfect. But that's something that we also extend to new airports. So I don't think capital is the problem. I think it's more the opportunity.
As and when the opportunity does arise, you're in the market for all 11 is what you're pointing at. But what's special? You've talked about technology, and you talk about the fact that this in a way is going to be the airport that showcases your ambition of putting together a new modern airport, not just for India, but benchmark to global standards. What's going to be special and new here at the Navi Mumbai airport?
So, actually it's in the name itself. It's New Mumbai. So if you look at the existing Mumbai airport and you compare this, well, you'll see some traces of the same heritage, but everything here has a new feeling to it. So, the entire backbone infrastructure that we're using to run this airport on technology is completely new. And what it's allowing us to do, very small use case, I'll tell you, is for passengers, one of the biggest anxiety is that where is their bag? How long is it going to be before it comes up on this baggage belt? And we are able to track it to the 30-second interval. So we can tell passengers that don't worry, your bag is going to be here in the next 6.5 minutes. So that gives them the sort of relief of stress that they can go around and do something else. And they get an alert when their bag comes in, which no airport in the world does today. They do it that it's arrived at an airport, but not to the level of a belt.
And you're saying individually?
Individual bags.
Okay.
Individual bags, not a flight. Individual bags.
Okay.
Yeah. So that's, one of the things that's because of the new backbone that we've developed, it's allowing us to do. There's a couple of other things that also we're exploring is how do we use AI to actually automate a lot of processes that are repetitive and manual and SOP driven. So using agentic frameworks to actually, make phone calls and coordinate with 5 people, using a very smart voice agent, you can do that. You don't need people to actually sit and
How many
make
people,
those
by the way, here are working on the Navi Mumbai project?
During construction was about 25,000 people. Once we start operations, in phase 1 itself, it will be about 5,000 people directly, plus add a couple of thousand more indirectly.
Okay.
Yeah.
So technology is going to be the big USP as far as this airport is
Technology
concerned?
and hospitality.
Okay. What's going to be different on the hospitality front?
So hospitality, what we've done is actually trained our entire staff, be it housekeeping, shop staff, lounge staff, our ground.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end flat after a volatile session. Gold prices, meanwhile, hit another record high. The yellow metal has hit a new lifetime high for the 50th time this year. The government is addressing the concerns raised by the IMF on India's GDP data, says the Statistics Ministry. This comes days after the IMF gave a C grade to India's GDP data and flagged discrepancies. The government does not expect much change in the GDP number after shifting to the new base next year.
Adani Group is set to merge its cement companies into a single entity. Ambuja Cements announces a merger with ACC and Orient Cement to create a single company with 107 million tons in capacity. The merger is likely to be complete in 12 months, subject to regulatory approvals. Cobra Post accuses Cholamandalam Investment of fund diversion worth 10,000 crore rupees and levels allegations of corporate misgovernance. Cholamandalam calls the charges malicious and baseless, says it has complied with all regulations. Get ready to pay more for cars and bikes in the new year. Tata Motors announces price hikes in January. Mercedes, BMW and MG Motor also hike prices by up to 3%. Higher commodity prices and a weak rupee take a toll even as demand remains strong. Air quality in Delhi and large parts of North India remains hazardous. 2 people killed after a pile-up of heavy vehicles on the Lucknow-Varanasi highway. The Bombay High Court pulls up civic authorities and the Maharashtra government for not enforcing pollution control measures at construction sites. Hindu right-wing outfits protest outside the Bangladesh High Commission in New Delhi after a Hindu man was lynched over blasphemy allegations. Dhaka summons the Indian High Commissioner, citing concerns over the security of its mission. The US drug regulator approves the first ever pill to fight obesity from the maker of Wegovy, that's Novo Nordisk. The landmark decision will open up the access to treatment to more patients. The pill will be launched in the US early next year. Industry leaders welcome India's new nuclear energy bill, which limits the supplier's liability and paves the way for private sector participation. But US-based Holtec International questions the 49% limit on foreign direct investment. L&T seeks viability gap funding for small modular reactors and a cut in GST from 18% to 5%. Also on the show, once a thriving diamond hub, Surat's Qatargam gasps for survival after Trump's tariffs. Over 1.5 lakh workers have lost their jobs in Surat alone. Nearly 20% small factories have shut down. A ground report coming up. Let's start with the day's market action. A volatile session on Dalal Street saw all the key indices end the day absolutely flat. The Nifty closing below the 26,200 mark, just about holding on to positive territory. The Sensex slipping at close, down about 40 points. The mid-cap index absolutely flat, and nothing much for the Nifty Bank as well. So volatile session, but a flat close for our markets. That's the story for the equity markets today. In the money markets, the rupee slipping to 89.76 against the dollar, but it did recover in late trade, ending the day flat also. The currency saw some pressure as importers and corporates stepped up dollar buying. 89.65 is the dollar rupee for you. From currencies to the precious metal market, gold continued its blistering rally as safe haven buying in hopes of further rate cuts by the US Fed in the new year helped the yellow metal scale even newer peaks. Silver followed suit, hitting fresh highs as well. The year has seen gold hit record highs for 50 days. Veteran investor Mark Bobius is continuing to bet big on gold and said that 10% of his personal assets are in gold.
I still like gold. I think gold should be part of any portfolio. I hold 10% of my personal assets into gold. And I think going forward, gold will continue to be very, very good. Now, it doesn't mean that it's going to go up in a straight line. There'll be corrections along the way. But there's no question that in US dollar terms, at least, gold will be doing very well, simply because of the proliferation of dollars around the world.
From metals to the commodity markets, crude oil prices edging lower as traders weighed geopolitical risk. The U.S. signaled it may sell crude oil seized from Venezuela. This even as Ukrainian attacks on Russian vehicles raised fresh concerns over potential supply disruptions. President Trump telling reporters that the U.S. could either keep or sell the Venezuelan oil seized off its coast in recent weeks, adding that the seized vessels would also remain in U.S. custody.
Oil that has been seized. The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it. We're keeping.
Where's it going? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
Well, that's President Trump there on Venezuelan oil. Now, back home, the government is addressing the concerns raised by the IMF on India's GDP data. This as per the Statistics Ministry. Now, this comes days after the IMF gave a C grade to India's GDP data and flagged discrepancies. The government does not expect much change in the GDP number after shifting to the new base next year. Sapna standing by with more details, but for that, let's listen in to what government officials have to say.
IMF grading for the GDP. As you know that they have assigned the grading C. And mainly they have the three concerns. One is old base of the GDP. Second one is the double deflation. And third one is the statistical discrepancies. These three issues are critical from the statistical point of view. In the new series, our team is addressing all these issues up to the best possible extent.
It is not as if the Indian GDP numbers are overstating the GDP case, but unfortunately, all these underinformed or half-baked questions are left deliberately hanging so as to sow the seeds of doubt in people, and it doesn't necessarily serve any purpose because they are not rigorous also.
Well, the government is not expecting too much of a change as far as the GDP numbers are concerned. In terms of the shift to the new base years from February 2026 onwards. Secretary Mosby, Mr. Saurabh Garg, explained that though it's a bit early to comment on that just yet, but the government is not expecting much of a change from the previous expectations, quote unquote, as far as the GDP data would be concerned. That's one. Second, of course, he has also clarified that the back series on GDP will be available at a later point in time for the data sets previous to FY23. As far as FY23, FY24 and FY25 are concerned, the back series on GDP should be available almost, as soon as the second advance estimate on Feb 27 is out on the new base year. Third, he also explained on the double deflator. He said that under the new series, the effort of the government would be to completely not use a single deflator. The attempt will be to use a double deflator as far as possible, wherever possible. On this front, it may just be possible that Mosby will also be coming out with the concept paper on double deflator and how it is to be used, what are going to be the combinations. That could just be a possibility. So we'll have to wait and watch and see on that. But interesting comment coming in from the Mosby secretary that the government is not expecting much of a change in the GDP data or the GDP growth numbers, despite the shift to the new base year from next year.
All right, Sapna, many thanks for joining us. Now, the Adani Group is all set to merge its cement companies into a single entity. Ambuja Cements has announced a merger with ACC and Orient Cement to create a single company with 107 million tonnes in capacity. The merger is likely to be complete in 12 months and is subject to regulatory approvals. Nigel here with the details of what this big cement merger could mean. Nigel.
Well, that's right. The long-awaited and anticipated merger of Ambuja Cement's units have been announced, which will create a unified one cement platform. The board has approved the amalgamation of ACC and Orient Cement with Ambuja Cements. Now, Ambuja will issue 325 shares for every 100 shares held in ACC, while Ambuja will also issue 33 shares for every 100 shares held in Orient. The transaction is expected to be completed in the next 12 months, subject to regulatory approvals. You'll be asking, though, what are the big benefits? Well, it simplifies the group structure and it reduces holding company discount because some brokerages, they did assign that holding company discount. Next up, well, it improves transparency as well as governance standards via elimination of master supply agreement and the related party transactions. It also aligns with Ambuja Cement's plan to increase the cement production from ballpark around 107 million tonnes to around 155 million tonnes odd by 2028. The management targets cost savings of around 100 rupees per tonne from the supply chain efficiencies, while Nirmal Bang says that there could be an additional 40 to 50 rupees per tonne benefits over the next 2 to around 3 years, which is expected from improved tax efficiency as well as working capital optimization. Since there'll be fresh shares that will be issued, there'll be some kind of dilution, and that's why the promoter holding will come down to around 61%, which compares with around 67% earlier. Brokerages, well, Morgan Stanley, they say that they view this as a positive development. It removes the overhang of managing multiple listed entities under Ambuja Cements, and that's why shareholders will like it. CLSA, they have quantified it. They say that the amalgamation will lead to 10% value accretion for Ambuja shareholders as per their analysis. So net-net, amalgamation will have a neutral to a positive bias for the combined entity.
Well, and Nigel, many thanks for joining us. Now, shares of Cholamandalam Investment rebounded in trade after the company rejected allegations made in a Cobra Post report. Cobra Post alleges corporate misgovernance and claimed to have found a worrying pattern, in its words, of large value cash transactions and related party transactions between the listed NBFC, its subsidiaries and the parent Murugappa Group. Cholamandalam has called the report malicious and baseless and said it has complied with all regulations. Cobra Post standing by its reporting and held a press conference today alleging fund diversion to the tune of 10,000 crore rupees.
Chola is now going and sort of thumping down, we have declared. I'm categorically saying that only 2,000 odd crores of it was declared as related party transactions, and in this particular instance only about 116 crores out of this whole big amount. So there has been partial disclosure. We have combed through annual reports, we have combed through finance, and if they are misrepresenting that they have declared these related party transactions.
Well, that is Anirudh Behel of Cobra Post. Now, get ready to pay more for cars and bikes in the new year. Most automakers plan to hike prices as high commodity costs and a weak rupee take a toll even as demand continues to be strong. Sudarshan joins us now to take us through the list of companies that will be hiking prices. Sud.
If you're looking to buy a car or a bike, you may have to hurry as auto companies are looking to increase the prices very soon. Tata Motors has already announced that in the Q4 of FY26, it will be taking price hike. Other two major car makers, Hyundai and Maruti, are yet to take a call on price increase, but sources suggest that Mahindra & Mahindra is looking to increase the prices in the month of February. While all the luxury car makers have already announced price increase, and that would be effective January 1 of 2026, and the price increase is in the range of 2 to 3%. Coming to two-wheeler segment, all the ICE makers, TVS Motor, Hero MotoCorp, Bajaj Auto, are yet to take a call on price hike, and here also sources suggest these companies are looking to may decide on price hike in the month of January or February, while the EV maker Ather Energy has already announced an increase by prices by up to Rs 3,000 for its scooter segment. Now the question is why these companies are undertaking price hike. There are two major reasons. All the commodity prices have increased sharply in 2025, and if you talk about steel, aluminium, copper, prices of all these commodities are trading somewhere near record high. And the second reason is weakening rupee. Rupee has weakened against dollar sharply in 2025, almost 6%. And because of that, imported component prices has moved higher. So these are the two major reasons why these companies are undertaking price hike. But if you look beyond the price hike and the demand, in 2025, the demand uptick that we have started seeing in the festive season because of GST rate cut has sustained, and currently all these companies are seeing a strong demand. When the analysts put out that if the current demand holds in FY26, there is a possibility of an increase in the growth estimate, especially for the passenger vehicle segment. So the bottom line, while these companies are looking to undertake the price hike, demand trend remains very strong for the entire segment.
That change in the price, which is the baseline change, that we have to protect, because that was the intention of the government. We'll have to see the residual impact of the commodity or the input cost increase, to what extent we have to pass on. We are reviewing that, and if we have to pass on a bit of that commodity price increase, we'll decide then that in the coming weeks.
Well, prices likely to go up for car makers in January. Now, US drug regulator has approved the first ever pill to fight obesity from the maker of Wegovy, which is Novo Nordisk. The landmark decision will open up the access to treatment to more patients. The pill will be launched in the US early next year. Ekta is here with the details. So, Ekta, now Wegovy available in a pill form, but of course will start in the US.
The US FDA has approved a pill version of Novo Nordisk's blockbuster obesity drug Wegovy, marking a major expansion of the fast-growing GLP-1 weight loss market. The once-daily pill contains semaglutide, which is the same ingredient used in the injectable Wegovy and Ozempic, and is expected to launch in January 2026. Clinical trials showed 17% average weight loss according to reports, better than the injectable Wegovy's 14 to 15%, but still behind Eli Lilly's Lilly's Mounjaro, which remains the most potent drug in the class with 20 to 22% weight loss in late-stage studies. Novo Nordisk is now the first to market with an oral GLP-1 amongst the 3 drugs which are available or popular at this point in time, such as Wegovy, Ozempic as well as Mounjaro. But competition, it seems, is heating up. Eli Lilly, Roche and AstraZeneca are all developing oral alternatives, betting that convenience is possibly going to drive adoption, especially amongst patients which are hesitant about injections. While Mounjaro dominated prescriptions in 2025 due to its efficacy, analysts say pills could reshape the patient choice, with the global obesity drug market projected to reach $50 billion by 2030. The race, it seems, is no longer just about efficacy but also ease of use and access to the drugs. In India, Novo Nordisk has launched Wegovy and Ozempic, but Mounjaro, it seems, is already the top-selling obesity drug, clocking over 100 crores in sales in November alone. Whether an oral Wegovy can catch up remains to be seen.
Well, Ekta, many thanks for joining us. We'll take a break, but once we return, a thriving hub, Surat's diamond market is now gasping for survival after Trump's tariffs. A ground report when we return.
In a hospitality school. So we want people to get the same experience they would get at a Taj or an Oberoi at an airport. So when you go and speak to a person, you shouldn't feel like that it's going to be like a overbearing kind of conversation. The way people greet you, the way people,
Industry leaders have welcomed India's new nuclear energy bill, which limits the supplier's liability and paves the way for private sector participation. But US-based Holtec International has expressed disappointment about the 49% FDI cap. The company's CEO believes such a cap is unnecessary and there should be no limit for foreign investments. Meanwhile, L&T has called on the government to consider a viability gap funding for small modular reactors and a cut in GST from 18% to 5%.
The amount of investment permitted should not be limited to 49%. I don't think there should be a limit on foreign investment. It's an unnecessary restriction. The $200 billion that Bloomberg projects can become $400 and $600 billion if we simply allow people who believe in India.
At least for first few small modular reactor, there is a need for a scheme for viability gap funding so that when you set up few small modular reactors, the learning curve will bring down the cost and the time for construction also will reduce. Today, if you see renewables have GST of 5%, which is composite equivalent of 8.9%, whereas the nuclear is operating at 18%. So there is a differential. Now, when you want it to be compared with the other sources of energy, I think the government should definitely look at this.
Now, India's diamond industry, which was already struggling since 2022, is facing fresh stress due to the tariffs imposed by President Trump. Santi Agora travelled to Surat, India's diamond hub. She reports that a fall in exports on account of tariffs are hurting diamond workers across the value chain. Take a look.
This is 21-year-old Chotu Kumar. We met him in Surat's Katagram area, well known as a diamond hub where the precious stones are sorted, cut and polished. Originally from Kanpur, Chotu came to Surat at the age of 13 and worked as a diamond sorter. He earned up to 28,000 rupees a month. Since August, however, work has dried up. He tried switching to working with lab-grown diamonds, but the pay, he says, is a fraction of what he used to earn.
मिलेगा बोल रहे होगा काम होगा बैठो और क्या है इधर कारखाने में बदलता हूँ तो फिर काम भी नहीं होता है उधर से जाता हूँ तो उधर भी नहीं होता है जीना हीरा आता था तो काम हो जाता था अब तो बहुत ज़्यादा CVD का हीरा आता है वो चलता भी नहीं है और पूरा मेहनत पूरा थक जाता है शरीर शाम को
हीरे में आपको पैसा भी कम मिलता होगा
पैसा देता है पर अरे उसे 13-14 रुपये देता है पर उसमें शाम तक शरीर को ऐसा तैसा हो जाता है फिर रूम भाड़ा भी उसमें भरना पड़ता है 4,000 रूम भाड़ा है.
As we spoke to Chotu, several other diamond workers gathered and they all had similar stories.
दिवाली के बाद हमारा जो जॉब वर्क था उसमें जो मजदूरी दी जाती थी कल ही हमारा भाव कम कर दिया और टाइम तो हमको फुल भरवा रहे हैं.
पहले कितना कमा रहे थे अभी कितना कमा रहे हैं
मान लो जो कमाई था उसमें से हम 40% का हम डिफरेंट पड़ गया.
रूम भाड़ा नहीं निकलता काम पूरा नहीं था आखत जाता આવતા रूम भाड़ा नहीं खर्च ज़्यादा बढ़ जाए पगार नहीं પૂરતા મળતા આખો દી હીરા ઘસવી તો 300-400 ના કામ થાય એમાં શું આપણે મોંઘવારીમાં થાય
नहीं होता काम नहीं होता गिराक नहीं आता ना.
A big reason for this dramatic slowdown is the steep tariffs imposed by the US on Indian diamonds. The US was India's largest export market for diamonds. According to the Indian government, cut and polished diamond exports to the US stood at $5,926 million in 2023 and $4,883 million in 2024. This dropped sharply to $2,422 million as of September 2025. Experts estimate that in Surat alone, over 1.5 lakh diamond workers have lost their jobs so far since the tariffs were imposed. Many others are working at sharply reduced incomes.
अगर वर्कर का देखें तो अभी छोटी छोटी जो कंपनियां हैं वो मेरे हिसाब से 15 to 20% अभी बंद हो गई है. तो उसके जो वर्कर है उसको अभी जॉब नहीं मिल रहा है क्योंकि कोई अपना काम बढ़ाना नहीं चाहता. जो है उतना भी वो सर्वाइव नहीं कर पा रहा है. तो मेरे ख्याल से 10 to 15% वर्कर अभी जॉबलेस हो गए हैं और अभी दिख नहीं रहा है कि आगे जाके कब अपना हमारा बिजनेस जो है वो सर्वाइव कर पाएगा.
Exporters are looking for solutions desperately. Many hope the government will lend a hand. Exporters of lab-grown diamonds say entering new export destinations has helped them stay afloat. However, these diamonds come with much lower margins. This puts pressure on operations, which trickles down the supply chain. Like many other sectors, India's diamond industry, a large chunk of which is housed in Surat, hopes that an India-US deal will fructify sooner rather than later, giving the entire industry some much-needed relief. In Surat, with camera person Ajay Dabulkar, this is Santya for CNBC TV18.
Well, a sector that is reeling under the impact of Trump's tariffs. With that, it is time for us to wrap up this edition of Business 360. The news will continue right after this short break. Stay tuned. We're back in a moment on CNBC TV18.
Hello and welcome. You're watching Commodity Champions. I'm Manisha Gupta. Well, the precious metals are on fire once again. Gold hit a fresh record highs near $45 an ounce, $4,500 an ounce, marking its 50th record high for 2025. The prices are up a stunning 70% from just $2,600 in the month of January. This is also the strongest annual gain since 1979. Silver, in the meanwhile, is keeping pace. The metal has hit an all-time highs near $70 an ounce mark, recording a massive surge of 140% from the month of Jan. Back home, the Indian silver prices have also scaled to a fresh peak above 2,15,000 rupees per kg. So what's driving this bull run? Escalating US-Venezuela tensions, expectation of further interest rate cut from US, robust central bank demand, and of course, sustained exchange-traded fund inflows. Also adding to the demand is portfolio diversification, which are powering gold and silver both on the higher side. Silver also is being lifted by strong industrial demand, tight inventories, and supply constraints. Joining us now to discuss the outlook for precious metals is Michael Terenzio. He's president and CEO at the Silver Institute. Michael, hi, thank you for joining in. I know when this year started, we were all very, very bullish on silver, and the most bullish of upsides that people talked about was $40, $45 an ounce. Nobody talked about $70 an ounce as a possibility in 2025. With the kind of run-up that we already have seen, what is your sense? I mean, how would you put the top 5 reasons for being silver for where it is?
Well, thank you again, Manisha, for the opportunity. Well, look, it's been a remarkable year for silver. We don't think this is going to end anytime soon. Quite frankly, when you look at the 5 factors, you can look at the debasement of the dollar. A lot of this is a debasement trade. You can also look at the fact of the tariff uncertainty at the beginning of the year, which continues for silver today, since we were placed on the critical mineral list. You can look at geopolitical tensions, and you can also look at, the fact of the matter is that people are getting away from some of the traditional investment cycles and turning to hard assets like silver and gold. And this is something that we've seen throughout the year. Like you mentioned earlier, I don't think anybody could have predicted this market, but it's worth it. It's fair. And the fundamentals behind silver are very strong.
Michael, let's talk some numbers now. So what is Silver Institute really looking like in sense of supplies, demand, industrial demand, investment demand? If you were to break silver in all of those 4 brackets, what does it look like?
Well, look, we're going to have a slight decline in overall demand, but that's mostly due to global GDP. Nonetheless, it's still going to be very slight, almost 0%, 1% at best. On the industrial side, again, a tiny decline. But that goes to tell you the underlying strength of the market, Manisha. I mean, silver, beyond its energy transition metals, is increasingly being used in AI, in the data centers, the chips that are used to power these data centers. This is a new technology, much like we saw with solar panels in 2009 and 2010. We're going to be seeing a lot more demand, and we put out a report a few weeks ago on silver, the metal of the future, where we think that this is going to be another strong demand center for silver.
Michael, in all the previous instances, whether it was 2008 and 2011, when we did see silver nearing those all-time highs, how are you looking at this year as different? And the kind of profit-taking or a very sharp correction that we saw in silver, are you anticipating that this time around too?
I don't think so. I think this market has much more room to grow. If you just take a look at what's taking place in exchange-traded products, we're projecting over 200 million ounces of silver alone going into those financial instruments. Retail, coin and bar sales are very strong in certain regions of the world. On the investment side, we think it's going to continue. And for the reasons I outlined earlier. I mean, look at people are diversifying their portfolio, and they're increasingly looking at silver.
What is the kind of deficit that we are working with this year? And Michael, if there is any approximate number that you see for 2026?
Yeah, we think it's going to be a little shy of 100 million ounces a year. So anything between 100 to 95, which is quite strong. If you look at the last 5 years of deficits, When you add those up, it equals almost 1 year of mine supply coming to the market. And speaking of mine supply, we think it's going to be essentially flat this year. There are just no new significant new projects online or in the future. So we think this deficit is going to continue into 2026 and into 2027.
Michael, how are you looking at the Indian markets? Because that October squeeze was historical, what we saw in UK markets. And at the same time, India was buying physical silver in a very, very large quantity, leading to a very strong premium here, a silver squeeze in the international markets. But what we saw in that very historic October that we can call it now, how is the current times looking like?
Well, India is very key. It's a central country to the global silver market. And everything that I've seen, I was in India earlier this year. I'm going back again in February of next year. Fact of the matter is India's market is doing very, very well. We saw a huge run-up of silver investment and silver purchases leading up to Diwali, which really almost fractured the market with respect to silver supply coming into India. We've seen supply tensions in the United States, but India really took the matter to a new degree, a new level in the couple of weeks going back to leading up to Diwali. And quite frankly, that has eased somewhat, but the demand for silver in all of its forms, especially investment and jewelry and silverware in India, is quite strong.
It is. Michael, I have been talking to a lot of industry participants, and they believe that 7,000 or 7,000 plus tons is what silver could be imported in India in 2025. Are you working with any numbers at all?
I don't have those numbers right in front of me, but just yesterday I read a report from our consultants at Metals Focus, and that seems to be the case.
Michael, how are you also looking at 2026 in sense of demand? I mean, I do understand that people sitting on huge profits right now. We started silver with $29.50 an ounce. We are trading at 70 right now. Are people going to take profit at any point in time, or the next year targets of 80 and 90 and I've heard 100 as well? What are you putting out as number? What is your expectation?
Well, I think there may be some small profit taking, but look, this happened back in October when we saw the price hit $50, $54. It went down to 47, and look where we are today. I think the underlying strength in the market lie with its fundamentals. The fact that the world is still very chaotic. We have geopolitical tensions all over the world. People are looking at silver as an alternative investment, one of the oldest investments since money was formed. And we think it's going to be a banner year next year, Manisha.
All right. Michael, just coming back to India then, and as you said, India has been one of the major factors to on where we've seen silver right now, because the Indian markets were buying exactly at a time when we were talking about a silver squeeze as well. I just want to talk about India from here on. How much of a purchasing power or purchasing possibility at these current levels do you see coming in from India?
Well, look, I think India is a very price-sensitive country when it comes to silver, and we have seen throughout the year in India that sensitivity has been affected in some of the industrial demand out of India. We've seen it affect, to a small degree, jewelry and silverware purchases in your country. But quite frankly, India has always cherished silver for centuries, for hundreds of years. They have looked at India and they've looked at silver as a sound investment, an essential tool in modern industrial applications. And we think it's going to continue to play a very important role in our market.
A very quick final question then, Michael. If US as of now has put silver in the critical mineral list, and markets do fear that we could be looking at a tariff of 15% perhaps, is the reason that silver is lying in US right now. In a scenario, if that does not happen, if that silver does come back to the other geographies, are you anticipating a good amount of profit taking then?
I'm not anticipating profit taking just because silver was placed on the critical mineral list. The critical mineral list identifies those minerals which are essential to the national security of the United States, have vulnerable supply chains, which are subject to some form of disruption, and serve as essential functions in the manufacturing of products. And as this clean energy transition continues, the President of the United States placed silver on the critical minerals list because he saw its vital importance to U.S. industry. So we're waiting to see what happens with the U.S. Trade Representative's recommendations with respect to Section 232 to the president. And we should see those by mid-January.
Okay.
And quite frankly, no matter how it goes, if they put tariffs on or they don't put tariffs on, it may not affect the market that much. If they put tariffs on, we could see another squeeze of metal coming to New York from overseas. So we'll just have to see. But it's important to note that the reason why they registered this for the United States this year is that they've recognized silver's transformation from primarily a precious metal to a strategic industrial commodity, which is essential for clean energy and technological advancement.
That point is well taken. So, well, mid-Jan is the time to watch out for. If US does do that, then we're looking at another squeeze coming in for silver prices. But in any case, a small correction and then a gradual constant increase is what we are anticipating for silver. Michael, as always, thank you so much for joining in and making sense of what's happening into the markets and what to anticipate for 2026. But with that, it's time for a short break. Coming up, we put spotlight on crude oil prices and where it's headed in 2026. We will be joined by Bob Yoger of Mizo Americas on the other side. Welcome back. You're watching Commodity Champions. Crude oil continues to trade on the negative trajectory so far in 2025. Prices are down 20%. It's headed for a third yearly decline. However, it is the base metals such as copper, aluminum, nickel, which are trading near record levels. Copper is trading at a record highs. We've seen US copper to a 5-month highs driven by tight supply conditions, while we also are looking at aluminum trading at a 3.5-year highs. It is about 2026 that we are going to discuss with Bob Yoger of Mizo Americas. Bob, hi, thank you so much for joining in. Crude oil prices, a third yearly decline. Even as there have been various geopolitical tensions, it has been concerns about supplies which are in surplus. I first of all want to touch about the geopolitics. US, Venezuela is the latest one, and that seems to be aiding sentiment in some sense. What's your view?
It's a headline bullish factor. It's really not a, we lose Venezuelan production. It's a spit in the bucket compared to what we have floating around this the planet at the moment. Venezuelan production is about 900,000 barrels a day. They don't export a whole lot of crude oil. That is, those exports are obviously under siege by the Trump administration, intercepting some of the what they consider to be random or kind of sanctioned tankers. So we have that going on. The bottom line is, at the end of the day, Venezuela, we could easily take that production off the market and still have excess supply that would put pressure on the market. Right now, we have about 3.8 million barrels a day more crude oil supply than there is demand. Every day, 3.8 million barrels of crude oil somewhere on this planet are getting stuffed into storage. That's why the price is under siege. That's why the headline, Venezuelan headline, will not really get this market too far to the upside.
Oh, absolutely. Bob, with that kind of a number, do you think OPEC at some point in time in the new year, as early as the first quarter, could perhaps change its stance of not producing or not increasing production?
That's a very good question. They have taken about 2.7 million barrels of production, added it to the market this year. They paused that new barrels in November. It was the last time they've added barrels, 137,000 barrels. And now they've put a pause on. My personal opinion on the issue is that if Brent crude oil starts to trade south of $50, they will start to take those barrels back. They will start to take those barrels back off the market. They are probably not quite, they probably did not add quite 2.7 million barrels. They're probably 500,000 barrels below that, but still it's a very oversupplied situation. And I will add, if the negotiations between Russia and Ukraine pan out, part of the peace plan is to bring Russia back to the community of nations rather quickly. And that would free up Russian supplies too, which would only add to the oversupply that we already have. They are still moving barrels, but it has been difficult. It's been a bit more difficult. But if there is a peace deal, it could put additional pressure on crude oil here.
So, Bob, what you're saying is that $50 a barrel is a threshold, and from there is when we could look at OPEC reacting. I mean, we're still $10 away from that. So there's plenty room into the market. There
is. But like I said, 3.8 million barrels a day, that's a lot of crude oil. Once global supplies start to increase basically exponentially almost in a short period of time, we will probably see this thing come under pressure. I think that we will see the low 50s for Brent. That means pushing U.S. crude oil into the 40s. So the numbers that the producer starts to, some producers are not making money on their barrels coming out of the ground against those levels.
Right.
So that would be problematic for everybody. And I think at that point, the OPEC folks have to start thinking about cutting production.
That's about OPEC, Bob. I also want to talk about the non-OPEC countries because the U.S. is producing at record highs. And I was reading a report which suggested that currently it's a sub 14 million barrels per day of production coming in from U.S. But give it another couple of years and 3 years perhaps and can hit 16 million barrels per day as well. If not in 26, perhaps in 2027. Are we looking at that kind of a crude coming in from U.S.?
Yes, we're going to get to 14 million barrels. I think that's a layup basically. But we have other countries that are producing and increasing at a pretty fast clip too. Guyana came from out of nowhere and have added a significant amount of barrels. They're going to approach 1 million barrels here pretty soon. That's a big number for a country that was at zero not that long ago. And we'll point out, if you look at the map, that's right next to Venezuela, coincidentally. Brazil, Canada, Mexico are all adding barrels to the global supply. And we don't need those barrels. U.S. production, despite the fact that we put in an all-time record high, pretty close to 14 million barrels on November, in the report dated November 7th, still hammering away, still producing at a near record clip. And it's starting to get close to 14 million barrels. That's a lot of barrels. And there's no sign that the U.S. producer is basically pulling back on the throttle right now. It's still, to a large degree, full speed ahead versus crude oil at 55, bid at $58 over the last 2 weeks. So it's they're still holding their market share. They're competing with the OPEC folks for market share and doing so quite successfully.
Yeah, but Bob, isn't it about the cost of production? Because the OPEC folks really have it much lower than from where U.S. stands.
They do, but after social spending and stuff like that, along those lines, you know, the social safety net that supports a lot of those countries, at the end of the day, raises that number significantly. So they have to deal with that. But yes, it is a competition at the end of the day. The OPEC folks stepped into that space when the crude oil was already soft. You have to wonder, they're that determined to really claw back market share. You remember correctly, the first time they added the barrels was on basically the day that Donald Trump announced tariffs. So a really kind of a head scratcher. And they've, like I said, they've come off and added 2.7 million barrels since then. It has really kept a lid on, if there's any positive development as far as inflation, which is a major worry here in the United States, really a major worry globally, it is the cheap cost of energy. It has kept a lid. The OPEC producer has helped keep a lid, and the U.S. producer, almost at record levels, has helped keep a lid on energy prices here.
Bob, that's all about the supply that we've spoken about, but what about demand? Do you see that getting improving at all? We understand China seems to be going the EV way. They don't need so much crude oil. The demand growth is not going to be as strong as we've seen in the last 1 decade. But India, how are you looking at that? And the U.S. demand, what's your sense on that too?
India is front and center. You have 1.4 billion people that will be increasing their profile, their demand profile into the near future. But it's India's up to meeting the demand. You have the largest refinery in the world. The Reliance refinery in India is by far the largest refinery in the world. It's an engineering marvel. It is over 1.2 million barrels a day at least. There's no other refinery in the world larger than 1 million barrels. And the other one that's close is the refineries in Venezuela. Those are basically multiple refineries in one little cluster, and they're operating at probably way less than 50%. So, yes, I mean, infrastructure investment and infrastructure in India to deal with the expansion in India is clipping along at an amazing pace. There's oil coming out of the refineries in India right now where they can export some barrels of gasoline and diesel. And actually, when President Trump forwarded his peace plan for Russia, Ukraine, the price of diesel has fallen by 25% since then. That's not necessarily a good thing for India. India exports diesel and does a good job at it, about 500,000 barrels a day, and before about the time of the peace plan came out. And if we can clear a peace plan and India is able to move those barrels more aggressively, the price would tend to tick higher. They could move those barrels to the Eurozone, where it's a bit difficult now because of sanctions to a certain degree. But clear out a peace deal, get it done, and India will be able to move barrels and also concentrate on infrastructure improvement, enlargement, and also servicing the ever-growing demand profile for the Indian populace.
Point taken, Bob. So one thing is quite clear, that the prices are not going up in a hurry when it comes to crude prices, not in 2026. But a peace deal clearly can put India in a positive mode yet again, and that's something we will watch out for. But thank you so much for your time, as always, and making sense of what's happening in the crude prices and for your outlook for 2026. And with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I'm Parikshit Luthra. Days after the killing of Sharif Usman bin Hadi, a popular youth leader and a vehement India critic, triggered a spate of violence and arson in Bangladesh, the situation in the country remains grim. Hadi, a prominent figure in last year's July uprising that led to the downfall of the Sheikh Hasina regime after a 15-year rule, was shot in broad daylight in Dhaka on December 12th. He was eventually airlifted to Singapore, where he succumbed to his injuries a week later. A sea of mourners bid him a hero's farewell. His coffin was draped in the national flag, while the perpetrators of the attack still remain at large. Hadi's death had a cascading effect. Protesters went on a rampage across cities, targeting politicians, newspaper offices and government institutions. Bangladesh's Islamist groups alleged that the assailants had escaped to India. There were protests outside the India Visa Centre in Chittagong. The Indian government has since suspended visa operations in Bangladesh. In a counter-move, the Yunus government curtailed visa services in India. The lynching of a Hindu man in Bangladesh over alleged blasphemy have muddied India and Bangladesh ties even further. Hundreds of people assembled outside the Bangladesh missions in Dhaka, in Delhi and Kolkata to protest against the brutal killing. Amid this unrest, Bangladesh is bracing for the homecoming of Bangladesh Nationalist Party's de facto chief Tariq Rahman, the elder son of former Prime Minister Khalida Zia. Rahman, who is in all probability going to be the party's PM face in the upcoming election. He had left Bangladesh in 2008 and is settled in London. And accused in a slew of cases, including corruption and graft, Tariq Rahman was arrested by a military-backed caretaker government in 2007 and has spent 18 months in jail before leaving the country. Most of the cases against him have since been quashed. Let me now go across to our guest this evening. K.C. Singh, former Indian ambassador, is joining us. Ambassador Singh, thank you very much for joining us. How would you describe the current state of ties between India and Bangladesh? Is it set to worsen in the next few weeks? We've not seen the kind of protests we're seeing outside the Bangladesh High Commission in Delhi and the kind of anti-India protests we've seen in Bangladesh.
Well, I think India has shown restraint so far, and I think what BHP did outside the Bangladesh High Commission could be avoided. Because what is the message we are sending? Tomorrow, if a Muslim is lynched in India, would you have Bangladeshis, Pakistanis, entire Islamic world protest outside Indian embassies? That has not happened. He was not an Indian national, to the best of my knowledge. You can call in the High Commissioner, you can convey this thing, but BHP turning it into a public issue and creating chaos, you are playing into the hands of the Bangladeshis. That's exactly what they are wanting. They are doing it, and we start doing it, then they justify it, and they have by stopping the visa services. The situation is not likely to get any better because Sheikh Hasina is in India. We are not about to hand her over. She's been sentenced to death. Elections are supposed to be in February, but Awami League may not be allowed to contest. So it'll be something that Sheikh Hasina did because the election that she had, BNP, that is Khalida Zia's party, had boycotted it. She still held the election. Now, here is a lesson for us. You see, when we sit contented in Delhi, thinking we have an ally who can keep doing what he or she wants in a neighboring country, as long as a counterterrorism, going after the extreme right suits us, then you play in, then when that person is overthrown, and it's happened time and again to Americans, it happened in Iran. If you keep backing a regime and then that regime is overthrown by popular protests, then you will pay the political consequences. And that is what is happening today. So India is waiting it out. That's the only card that we can play at the moment. But at the same time, there is pressure that you can exert because jobs haven't come back. Bangladesh economy is hurt by the US duties, and garment export was one of their major exports. Jobs have not been available. So there's economic chaos.
Ambassador K.C. Singh, when it comes to the general election in February, Mohammad Yunus has said that he is committed to ensuring free and fair elections on the 12th of February 2026 in Bangladesh. What's the state of play? Who do you think is the dominant power ahead of this February election?
See, the lesson that we learn after Arab Spring in Islamic countries is like in Egypt. When you overthrow an autocrat, then it is the right wing that always better organized, which survives better the autocrat's persecution. And that is why Jamaat-e-Islami, with the support of Pakistan, has been asserting itself. That is the one which is feeding. Probably when the students' protests were there, it was there from pushing it from behind the scenes. But the students did form a separate party, National Citizens Party, NCP. Now, we don't know if it's going to be a three-way fight. Awami League won't be in it. But you have the party, the BNP, and you have Jamaat-e-Islami, and you have the NCP, the Students' Party. Now, students, how much popular support they have will get tested unless they do an alliance with Jamaat-e-Islami or with one of the other parties or maybe with BNP. So we are seeing a new reorientation of political parties in Bangladesh. But out of them, well, BNP will probably be better for us than Jamaat-e-Islami, but they have had an alliance with Jamaat-e-Islami in the past. So it's possible after the election, they again enter into an alliance. And Pakistan is just happily watching it, trying to roll the script back and make history we've forgotten in Bangladesh that India got them liberated in 1971.
Right. Do you feel India is now losing ground in Bangladesh? Are these signs that we're picking up from the ground good for India's neighborhood ties? Can India do anything? Do we have certain options to salvage the situation, keeping in mind the close linkages we have with Bangladesh, both politically and economically?
Look, at the moment, I think we're just sitting back and watching. We'll have to wait and see what kind of an election is held, because Muhammad Yunus has not shown that he is fully in charge or he's calling the shots. And being an interim government, he couldn't really make any policy changes or reach out. In the meanwhile, you had President Trump come in. You've got those other challenges for the Bangladeshi economy. Chinese would be watching very closely. So we have to wait until an election is held. And hopefully some kind of a stable government emerges. If it doesn't, there's always the military, which has played a role in Bangladesh before. You don't want the military to come in again. But whoever is in charge, then we talk to that government, because that government can claim a mandate. The current interim government doesn't have a mandate. It's only a transitional arrangement.
All right. And if I were to speak about certain external factors at play in Bangladesh, while India would want to continue having a very strong stake in peaceful relations with Bangladesh, you've got US, which has interest there. You've got China, you've got Pakistan. Do you think any of these three external forces are somehow having an influence on the current developments?
See, considering Pakistan drawing closer to US, we don't know what is the US game. They played that game before 1971. And with President Trump, you don't know. He may be quite happy to go along with Pakistan if they say, look, they'll open the economy, they'll let your companies come in, we'll keep the Chinese, in one corner. What is the game that emerges? We don't know. The American game is now so uncertain and so unpredictable. I think we have to play our own game. I don't think we can count on anyone in the neighborhood, and see how we can safeguard, bring stability, and make sure the next government does not adopt an anti-India posture or start giving shelter to terrorists or militants or militant Islam, because it's got such a long boundary with India and with sensitive states. We've got elections coming up in Assam. And there, the way BJP has its politics, Bangladesh is used as a word for garnering votes and bringing people together. Unfortunately, the more you do that, the worse it gets for Bangladesh-India relations.
All right. Thank you very much, Ambassador K.C. Singh, for joining us to speak about the difficulties in ties between India and Bangladesh right now. And as you said, India will just be waiting and watching till a new government comes into place in Bangladesh in February, and we would like to take it from there. Time for a short break here on News Center, but don't go anywhere. We put the spotlight on the India-US trade deal talks. On the other side, we will be speaking to Ajay Sahai of FIO and Arpita Mukherjee of ICRIER on the other side. Welcome back to News Center. It's been nearly 4 months since the United States imposed 50% tariffs on India. Uncertainty over a bilateral trade deal remains, with negotiations underway in full swing. India's exports to US remained largely resilient in November, rising 22% year-on-year. Near-term demand has held up, but exporters and trade bodies warn that rising costs are increasingly being absorbed by both Indian suppliers and global buyers, and this may not be sustainable over the medium term. Concerns about the road ahead are already visible. Diamond workers in Surat are feeling the brunt of tariffs, with estimates suggesting more than 1.5 lakh jobs lost since the levies were imposed. Many are also working at sharply reduced incomes. To cushion the impact, the Indian government is pushing for diversification of exports, stepping up trade negotiations with other countries. The challenge now will be to sustain the export momentum. Joining us right now is Ajay Sahai, Director General of Federation of Indian Export Organizations, and Arpita Mukherjee, Professor at the Indian Council for Research on International Economic Relations. Thank you very much for joining us on the program today. Professor Mukherjee, if I had to ask you about the impact on Indian exports January onwards, January 2026 onwards, so far we may be resilient because before the 50% tariffs came into effect, there was some amount of front loading as well. Many of the exporters had planned well in advance and they got their shipments in. Having said that, what kind of a brunt do you foresee in case we don't have a trade deal in a January to March period?
See, we are in a difficult situation now because we are facing one of the highest tariffs with the largest market that we have. Having said that, part of this tariff is cushioned on both sides, as you rightly pointed out, because there are certain products where other competing countries also have a high tariff. What we really need to do is to reduce the logistic and other cost of transportation. So that's one point. Second point is that, some of our competitors are really facing low tariff, and that's cause for concern. We are also trying to diversify exports by signing trade deals. We did it with Oman, we did it with UAE, and if we are able to get the European Union deal through by January, things may be much better than what we stand today. So two things we need to note in January. One is the US court cases, which itself may rule in favor or not in favor of the tariff imposed. Secondly, there is a likelihood that India and EU may announce a trade deal. And a European Union trade deal, this particular product category, can be really beneficial for India to kind of diversify export. Having said that, exporters may need some incentives.
All right. Let me get in a word from the DG of FIO, Mr. Ajay Sahai. Mr. Sahai, you've had so many consultations with the Ministry of Commerce, with the Commerce Secretary as well. Has there been any kind of assurance on a timeline, on some sort of timeline that they're looking at within which a trade deal would be signed with the United States? Are you expecting some good news, maybe in the last week of December, first week of January?
I think it's nothing which is left to the negotiator. Probably a political call has to be taken by the US president, and therefore it can happen any day. It may be slightly delayed also. But from the exporter perspective, I think we have to see that deal is in place before the next season starts. So at best, exporter will be able to continue with this kind of export number probably up to March, because in the new season, if the tariff remains in place, buyers will move to the next supplier. As of now, a lot of companies are not moving through it because you have a social audit also by the major companies. And companies are also hoping that since this is a temporary phenomenon, let us somehow maintain our good relation with the buyer. And once the DTA is in place, whatever little loss the industry is having, they will be able to recover it.
Right. Mrs. Sai, as our colleague Santya Gora was reporting from the Surat diamond industry, where more than 1.5 lakh jobs have been lost since the tariffs were imposed. I'm sure there are other labor-intensive sectors which are also facing the brunt. Could you give us a sense that on ground, what's been the impact so far on jobs? And when you speak about the next season, by which quarter or which month of 2026 do you expect things to start getting impacted negatively in the absence of a trade deal?
In fact, in some of the segment, for example, we thought that marine will be the worst hit sector, but luckily for us, marine has diversified into the new market of China, Russia, and Europe, and their export numbers are pretty impressive. In the diamond segment also, of late, some concession has flown, and if we look into the number for the gems and jewelry export, they are pretty good. Please bear in mind that a lot of exports to many of the countries in South America and North America was happening to the US. US was importing, and from there the distributor was sending the consignment to the rest of the world. Now we are directly exporting that, and therefore the number to these countries have moved up. But of course, I do agree in some of the labor-intensive sectors, there will be challenge. Some of the industry has moved to the domestic market also. I don't have the exact number, what is the impact on the ground on some of the micro and small sector, but government is doing its best. The Reserve Bank of India has also extended some kind of support to the export. We are hoping the deal to be through very quickly. And as I told, I expect the deal to be there by January, February, because when we talk to the exporter, they say that they are somehow managing with the existing order. The order for the new season, which will be commencing from April onwards, have been put on hold. And if the duty issue is not settled, probably these orders may go to some other countries.
Right. Let me also get in Professor Mukherjee once again. Professor Mukherjee, when we speak about the initial deal that we're looking at for the United States, it's going to be a goods deal primarily. We have, according to various reports, there is no official confirmation from the government, but it seems that both sides are veering towards an average tariff rate of 15 to 20%. At that rate, how competitive will we be to other geographies in South Asia? And that is not the only aspect. After that, you'll have deliberations on more non-tariff barriers. You'll have deliberations on services trade as well. You would like to have a broader trade pact in place and some sort of legal footing as well. So there will continue to be hiccups, even if we get this early trade win with the US in the range of 15 to 20%. What do you think we will need to do in the year 2026 to protect ourselves against this US-led volatility in trade talks?
See, one of the things you need to understand is that the 15 to 20% gives us quite good competitive edge in the US market. So basically, whoever they are giving that 15% tariff lines, whether it is Japan or any other country. Now, the problem is not that. To get that 15%, we have to give 0% in many areas of imports, which are very sensitive for us. Let's say if we have to open up the dairy market, that's really sensitive. We haven't done that for even New Zealand. So therefore, you need to think that how open are the Indian domestic industry to agree to open up sensitive sectors. So that is the first hurdle that the trade negotiation is facing. The second hurdle that the trade negotiation is facing is that suddenly the US has changed its position. US with Indonesia has a position where they said, okay, sign on digital trade, sign on, defense with Japan. Now, here we don't know how surrogate is the deal with Japan, defense and other things, but digital trade is something which India would like to sign with US. Visa is something that India would like to do with US, and that can be a part of the initial package. That was the initial feeling in India. Only tariff deal has a big problem that we also have a large domestic market where there is a lot of sensitivity to zero tariff. I think that getting at 15%, if you get 15%, it's a good deal. Like you are getting the deal as anybody else has received it. So the deal is not bad, but the bigger issue is that what are you going to give for that deal? And I think that's the problem at this negotiating stage. US at this stage
All right.
is negotiating non-tariff barriers with any of its trade partner. That's the second point.
All right. Yes, and those negotiations will possibly begin the second or third phase of the trade talks next year. Let me also get in Mr. Ajay Sahai once again. Mr. Sahai, when it comes to improving the competitiveness of exports beyond this trade negotiation with the US, we are at an advanced stage of negotiations with the European Union, and possibly by 26th of January, when Ursula von der Leyen, the EU Commission President, arrives in India, we'll possibly see a signing of the EU-India deal as well. Having said that, what more do we need to do in order to ensure that our export growth story continues on a sustained path as well? Because it seems that irrespective of the outcome of the trade talks with the US, you cannot count on the Trump administration. They may throw up some other tariff tomorrow.
No, you're absolutely right. And if you look into India, we have gone for a very aggressive FTA strategy. This year alone, we have formed up the 3 FTA, one with, of course, with UK, and then with Oman, and then with New Zealand. And I'm pretty sure the EU FTA should also be finalized by January. And once that happens, probably we are getting a market as big as the US, and for some of the labor-intensive sector, this may be an equally important market. But of course, I will not say that it should come at the cost of the US. US is an extremely important market for us. Probably the profit margins are also better. I feel that when it comes to the technology and intellectual property right related sectors of exports, we will continue to do very well. The challenge is more on the labor-intensive sectors of export. And besides tariff, I think we need to work on the skilling part of our worker. That is extremely important, both for improving the quality and consistency of the product. That needs to be looked into. The logistics cost, in any case, is getting addressed, and to some extent, we have improved on the logistics, and probably in the times to come, we will see much action happening also. Luckily for us, the Red Sea route has now become operational, which has reduced the transit time also and the cost. So these factors are positive, but of course, the world is moving towards protectionism and weaponization of trade. We have to probably live with these kinds of challenges.
All right. And Professor Mukherjee, final question to you. Are you expecting certain measures to be announced in the union budget? Do you feel that there could be some measures which on a long-term basis could support our export story?
Yes, definitely. I hope that there are some long-term measures announced, and more in terms of the trade facilitation, which Mr. Shah has already pointed out. Certain things are happening already in India, but probably we need cross-border trade facilitation agreements to happen, cross-border trade to become paperless. Lesser documentation, lesser time frame will actually help our trade partners both on the from the import perspective and export perspective. So one is that trade facilitation measures and going paperless should be something that should be announced in the budget. Secondly is probably some kind of incentives, and a backup plan has already been there. The BharatNet and other information sharing platforms are happening. How do you diversify a market? There has to be a market diversification strategy and a risk mitigation strategy. So there may be some measures to that effect. And there may be some changes in the foreign trade policy, because the foreign trade policy is quite ongoing, and how does it support the MSMEs? Some measures to support the MSMEs would be, well taken. It will give them a lot of mental comfort to try out new markets. That's the bigger issue.
All right.
They can't try it out.
All right. Thank you very much, Professor Mukherjee and Mr. Ajay Sahai for joining us for a very important discussion. So there is a hope that there will be a trade deal between India and US in the month of January, but there is no confirmation from either the Indian side or the US side. But yes, exporters are hoping we will see some clarity on the trade deal soon, at least before the next season hits, because as Mr. Ajay Sahai said, that if we don't have a trade deal by the next season, there will be an impact on India's labor-intensive exports. That's all we have time for. Goodbye and thanks for watching.
Hello and welcome to Rewind 2025. I'm Shireen Bhan. The year has turned out to be a landmark for India's financial regulatory landscape. Under Governor Sanjay Malhotra, the Reserve Bank of India has rolled out one of the most far-reaching reform agendas in over a decade. Ritu explains what changed, why it matters, and how the RBI's regulatory philosophy itself has evolved.
2025 is going to be remembered as the year the Reserve Bank of India fundamentally rewired how Indian banks operate. Under Governor Sanjay Malhotra, the RBI did not just tweak rules, it dismantled and rewrote them, merging many and simplifying more. In all, we saw more than 80 regulatory changes in a single year, all aimed at the single objective to free up bank balance sheets, to revive credit growth and prepare the system for India's next investment cycle. At the heart of these reforms lies a clear shift in regulatory thinking. Governor Sanjay Malhotra has argued that Indian banks today are far stronger than they were a decade ago, better capitalized, better governed, and more resilient to shocks.
We have taken measures very balanced, calibrated, thought out, considered, and we'll continue to take more measures, as and when required. Always the aim will be to promote the stability while at the same time improving competitiveness, encouraging and enhancing growth of the economy.
One of the most consequential changes came in M&A financing. For years, banks had faced tight restrictions on funding acquisitions and promoter buyouts, which was a hangover from the excesses of the last credit cycle. In 2025, the RBI recalibrated those limits and opened the doors for acquisition financing by banks. The signal was clear. Consolidation and capital reallocation are now seen as part of economic efficiency, not excess.
So there was a period of time when we thought acquisition by one company of another company typically is a hostile route, and that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context, where everything is the market and everything goes through the marketplace. And now in a completely different context, I believe the Reserve Bank has done the right thing to open it up, because it's an excellent avenue of business for banks.
Linked to this was a broader easing of rules governing bank loans against shares, IPO financing and structured credit.
These announcements are, I call them as banking reforms 3.0.
Yeah.
And these reforms are, for a long-standing demand from the banking industry.
Yeah.
And very proactively addressed by the RBI.
Yeah.
I believe that they're absolutely credit accretive.
Prudentially, the RBI chose sequencing over shock therapy. The expected credit loss framework was deferred, allowing banks 4 years' time to adapt systems and capital planning. Older project finance norms were withdrawn and merged into a simple, unified credit framework.
Circumstances change, times change, requirements change, and so nothing should be frozen in time. And so that's why we had earlier also said that we continuously reviewing our regulations. It's very important that we continuously revise, review, improve our whole regulatory ecosystem.
Another major cleanup came through the removal of overlapping and legacy frameworks. The RBI consolidated a total of 3,809 circulars into updated master directions and scrapped another 5,673 obsolete circulars to ease compliance. Liquidity coverage ratio norms were relaxed and external commercial borrowing norms were liberalized, giving firms greater access to offshore capital while retaining safeguards on maturity, currency risk, and end use.
The global discourse has been to move towards a principle-based regulation for reasons of simplicity over exhaustive specification, which may not even be possible. Not only is it not possible, but it can also lead to a very creative way of complying with the regulations
adopting a tick box kind of an approach that, yes, we have complied with these, and these provisions of the various regulations, and not serve really, the outcome.
These reforms extended beyond large banks. Risk weights on lending to NBFCs and MFIs were restored, co-lending norms expanded, and priority sector rules eased for small finance banks. Parallelly, the RBI addressed the cost of credit. Through 2025, it delivered 4 rate cuts, taking the repo rate from 6.5% to 5.25%. Loan reset norms were reviewed to ensure faster transmission to borrowers. The governor exuded confidence.
Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period.
But the clearest signal of confidence showed through in bank licensing. After a long hiatus, the RBI granted a full-fledged banking license to AU Small Finance Bank and also approved Fino Payments Bank's transition into a small finance bank. The other significant shift came when RBI signaled greater openness to foreign capital, paving the way for Japan's SMBC to invest in Yes Bank and Emirates NBD buying a stake in RBL Bank. Taken together, the RBI's actions in 2025 mark a decisive shift from crisis-era regulation to growth-era regulation. Now, this is not deregulation without discipline, but the tone has changed. The RBI is no longer regulating for the last crisis, it is regulating for the next investment cycle. In Bengaluru, Ritu Singh.
Well, a significant year, 2025 for the RBI, many regulatory changes being ushered in. Now, 2025 has also been a landmark year for the goods and services tax in India, characterized by sweeping reforms, simplified slabs, strong collections and a major shake-up in how tobacco and sin goods are taxed. Timsy Jaipuria has the details on what changed. Timsy, the government finally gave the consumers and the industry something that they'd spent years asking for.
Well, let me take you back to Independence Day 2025. Since Prime Minister Modi took charge, he has reserved his 15th August speech for some big bang announcement. And this year was no different.
मेरे प्यारे देशवासियों, हम नेक्स्ट जनरेशन जीएसटी रिफॉर्म्स लेकर के आ रहे हैं. ये दिवाली के अंदर आपके लिए तोहफा बन जाएंगे.
The Finance Ministry went into hyperdrive after this, and Finance Minister Nirmala Sitharaman was able to deliver on what industry had been demanding for years: a simpler, cleaner rate structure, much ahead of schedule. She announced the changes on the 3rd September and set the 22nd of September for the biggest GST rate rationalization since the tax was launched in 2017. The old 4-slab structure of 5%, 12%, 18% and 28% was the first to go. In its place, we have a simplified 2-rate structure, a merit rate of 5% and a standard rate of 18%. We also have a special rate of 40% applicable only on sin goods. Of course, this meant a ton of goods had to be moved to new rates. So many key commodities like butter, ghee, biscuits, pasta, namkeen, etc., especially those categorized as basic and essential goods, were brought under the 5% slab. Remember, many of these were earlier taxed at either 12% or 18%. Goods like cement and paints, which were classified as standard goods, were moved to the 18% bracket. Most services remained to this rate slab. A major category here is basic 4-wheelers and 2-wheelers. These have been brought down from the 28% plus cess bracket to 18%, making them more affordable. Similarly, a bunch of consumer durables like TVs, refrigerators and washing machines have been moved down to the 18% slab from the earlier 28% slab. The council also cleaned up the list of items in the luxury, sin and demerit goods category. Now this list is limited to a few items like aerated drinks and luxury cars. So in the case of aerated beverages, the tax incidence has been kept the same but made simpler. Instead of 28% plus cess of 12%, these attract a flat 40%. Similarly, luxury cars also attract a flat 40% GST instead of the earlier 28% plus cess. Medicines were the other big impact area of this exercise. A host of drugs were brought down from 12% to either nil or were zero rated. This made these drugs cheaper. GST on essential services like health and life insurance premia has also been brought down from 18% to nil. So that's the much needed relief for these insurance customers and a long-standing demand from both the populace and industry. The government's confidence in pushing through and implementing this major reform came from two sources. One is the fact that there was a need to re-energize the consumption cycle. The other was a trend of strong GST collections, which were averaging at nearly 2 lakh rupees a month for most of the financial year. As you can see on this chart, there is a slight dip in the number announced at the beginning of December to 1.7 lakh crore rupees. This is the first collection where the full impact of GST 2.0 was felt, and the government is of the opinion that it is still indicating overall GST revenues as remaining robust. And so that's a strong sign that the simplified slabs, a rise in consumption due to cheaper goods, and improved compliance under GST 2.0 are helping sustain tax buoyancy. But there is one area that's yet to see a change in slabs, and that's the levy on cigarettes, tobacco products and pan masala. The GST Council had held off making any changes to these products as the compensation cess these brought in was still being used to pay off the loans taken to compensate states for the losses due to COVID-19 pandemic. Currently, these goods attract 28% GST plus cess. But we do have some clarity on how these will change once the loans are repaid. According to two bills introduced by the government, the Health Securities and National Security Cess Bill 2025 and Central Excise Amendment Bill 2025, the government plans to replace the quantum of compensation cess levy on cigarettes, cigars, gutka and other tobacco products and pan masala. Under GST 2.0, these products are expected to fall under the new demerit slab of 40%, and the gap in the tax incidence will be made up by the new taxes. On pan masala, for instance, tax will be 40% GST plus Health Securities and National Security cess. On cigarettes and other tobacco products, we are looking at 40% GST plus a higher rate of central excise duty. Effectively, this will retain the overall tax incidence on these products, preventing any sharp drop in government revenues while keeping prices steady. So, for the Goods and Services Tax 2025 has not been just a year of routine tweaks. It's been a year of evolution into a leaner tax with simpler slabs, stronger collections and sharper enforcement, while keeping consumer prices in check and setting the consumption cycle rolling again. In New Delhi, Tim C. Jaipuria.
Well, 2025, the year that we saw that big GST rate rationalization. Up next on Rewind 2025, a year of top-level churn across the FMCG industry in India and around the world. That and more when we return. You're watching Rewind. Well, this is Rewind 2025. It's been a sluggish year for steel makers across the world. Weak demand, high energy costs, tariff tensions, and persistent overcapacity proved to be a heady cocktail for companies world over. However, the new year is bringing fresh hope for the industry. Nigel explains why steel makers are pinning their hopes on a turnaround in 2026.
Well, that's right. The big question is what's in store for steel in 2026? Well, in the near term, steel prices, they have weakened, and that's likely to weigh on margins for steel companies just in the near term. In India, the hot rolled coil prices, they're down by roughly around 8% from the September quarter. That's driven by lower Asian prices as well as the expiry of the interim 12% safeguard duty, which happened in early November. But that's where things start to get a little bit more interesting. Now, there are growing hopes that steel prices may be close to the bottom. And they say this because Asian steel spreads, well, they are at near 15-year lows, almost 40% below their long-term averages. At these prices, these levels, spreads, well, they look unsustainable. And part of the street is optimistic of a recovery, especially if China's anti-involution policy leads to production or supply cuts. Now, let's turn our attention to the largest steel producer, which is China. China's steel production is down by close to 3 to around 4% year to date. But exports, they're up by around 6.5 to around 7%, and they remain elevated because Chinese demand has been weak. In fact, Chinese exports have crossed 100 million tons in the first 11 months of 2025 itself, and that continues to put pressure on steel prices. Turning to India, well, India's steel consumption has grown by around 11 to around 12% CAGR over the last 4 years, and growth of around 7 to 8% is expected in the times to come. At the same time, Indian steel companies, well, they are adding capacity, which means demand needs to keep pace to avoid oversupply. And that brings us to a key policy trigger. With Chinese exports high and export options limited, well, steel companies are hoping for the reintroduction of safeguard duty that expired in November 2025. Earlier in 2025, remember, the interim 12% safeguard duty helped domestic HRC prices trade at roughly around 9% premium to landed imports. But once that duty expired in November, prices, well, they have quickly converged with import levels. If safeguard duty returns, well, they could provide the much needed support to domestic steel prices. So heading into 2026, steel, well, it faces near-term pressure, but the setup could hopefully slowly improve with spreads near the bottom. Policy support will be in focus, and demand growth, as always, will be the key swing factor.
Well, thanks very much, Nigel. Will it be a turnaround year for steel? One will have to wait to see. But it was a year of change for consumer companies world over. Unilever, PepsiCo, Diageo, L'Oreal all saw changes in the corner office. In India, HUL, Nestle, Britannia saw leadership changes as the FMCG industry transformed into a high-stakes battleground. Shilpa reports the message to FMCG CEOs from the boardroom is simple: perform or perish.
The corner offices at many FMCG firms saw new occupants through 2025. From Hindustan Unilever and Britannia in India to Nestle, Unilever to PepsiCo globally, 2025 had some of the biggest consumer giants seeing one of the most dramatic waves of C-suite churn in over a decade. Let's start at home. HUL, India's largest FMCG company, saw CEO Rohit Java step down barely 2 years in the top job. His exit came after muted sales, flat volumes, and investor pushback on the revival pace. Priya Nair, who served as the president of beauty and well-being at Unilever globally and has over 30 years of experience, has since taken charge and set HUL on a path that focuses on volumes to rekindle growth. Then there's Britannia. CEO Rajneet Kohli resigned in March and moved to HUL. He was replaced at Britannia by Rakshit Hargave, who was the CEO of Birla Opus. But then came the real shocker. Long-time MD Varun Berry abruptly announced his exit in November, with even his notice period being waived off. Markets reacted instantly, the stock slid over 5%, and all eyes are now on incoming chief Rakshit Hargave to steady the ship. There were also planned changes at Nestle India. That was a planned retirement. Manish Tiwari, who was heading Amazon India, has stepped in to replace Suresh Narayanan, who has been at the helm for a decade. Narayanan successfully steered Nestle through its biggest crisis, the Maggi ban, and then he focused on innovation and diversified Nestle's portfolio with expansion into categories like breakfast cereals, pet food, and more. Tiwari is now banking on digital growth, innovation, and a consumer-centric strategy to get the FMCG giant accelerating on the next leg of growth. L'Oreal India and Diageo India also saw leadership changes. Overall, 2025 have been a tough year for the FMCG industry in India, which struggled with rising inflation, muted performance, slowing urban demand. While income tax cuts, GST rates changes, and cooling inflation towards the end of the year, providing some relief, signs of recovery have begun to show. But the challenge is to keep the ship steady at the time of choppy waters on the global geopolitical and trade front as well. Now, while leadership changes in India were due to a mix of muted performance and planned transitions, the churn in the global FMCG landscape has been a lot more dramatic. Let's start with Nestle Global. Now, the company saw 3 CEOs change in less than 14 months. In August 2024, Mark Schneider was replaced with Laurent Freshy as Nestle CEO to rev up the company's performance. But Freshy was ousted less than a year later over an undisclosed personal relationship, and Philippe Navratil was then appointed CEO. Nestle's then chairman, Paul Bulke, too, first announced that he would retire in 2026, a year earlier than his scheduled retirement. But then he exited even earlier in September this year, and Pablo Ayala has taken over from the 1st of October. All against the backdrop of the company's worst growth in 2 decades, with volumes being flat or even declining and sales shrinking as well, and the boardroom losing patience quickly. Unilever also threw a curveball. CEO Heinz Schumacher was out in less than 2 years, and the company was looking to turn around, but the board wanted faster change, and they handed over the reins to CFO Fernando Fernandez, who has now taken over as the CEO. Diageo also has multiple faces that have occupied the corner office through 2025. In the middle of a multi-year cost-cutting reset, it saw CEO Deborah Cruz step down. Nick Jangiani took over as interim chief, and now the firm is looking forward to welcoming Sir Dave Lewis as its new CEO in 2026, tasked with turning around the maker of Johnnie Walker, which has been plagued with declining sales and high debt. Even Coke and PepsiCo are both pivoting as they struggle to swallow weak beverage demand worldwide. Henrique Brown, who worked at Coke in various leadership roles for 30 years, is now set to take over as the next CEO from March. Rival Pepsi is also in the throes of reorganization. It has elevated its North America CEO to a newly created EVP and vice chairman role, and it has appointed new CEOs, one for North America and one for Latin America Foods, and it soon also unveiled a new plan to accelerate sales and also improve margins. Now, in the global FMCG space, there's a clear pattern to the cause of this churn. Sluggish volumes, discretionary slowdown, rising competition, rising input costs, and geopolitical uncertainty. But most of it all, investor impatience. Boards and investors no longer want 5-year or 10-year plans. They want visible action, and they want it fast. 2025 has seen the FMCG world transform from slow, steady, and predictable to high-stakes, high-pressure battleground where even industry veterans can be shown the door if numbers don't impress. In today's FMCG boardrooms, the message is brutally simple: deliver growth or move aside.
Well, 2025 turning out to be a year of churn for the FMCG sector. Will 2026 beckon better days? With that, it is time for us to wrap up this edition of Rewind 2025. Here's wishing all of our viewers a very Merry Christmas and a very Happy New Year. Keep watching CNBC TV18. We promise to keep you updated on everything that matters to you. Stay with us. We're back after this break. Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end flat after a volatile session. Gold prices, meanwhile, hit another record high. The yellow metal has hit a new lifetime high for the 50th time this year. The government is addressing the concerns raised by the IMF on India's GDP data, says the Statistics Ministry. This comes days after the IMF gave a C grade to India's GDP data and flagged discrepancies. The government does not expect much change in the GDP number after shifting to the new base next year. Adani Group is set to merge its cement companies into a single entity. Ambuja Cements announces a merger with ACC and Orient Cement to create a single company with 107 million tons in capacity. The merger is likely to be complete in 12 months, subject to regulatory approvals. Cobra Post accuses Cholamandalam Investment of fund diversion worth 10,000 crore rupees and levels allegations of corporate misgovernance. Cholamandalam calls the charges malicious and baseless, says it has complied with all regulations. Get ready to pay more for cars and bikes in the new year. Tata Motors announces price hikes in January. Mercedes, BMW and MG Motor also hike prices by up to 3%. Higher commodity prices and a weak rupee take a toll even as demand remains strong. Air quality in Delhi and large parts of North India remains hazardous. 2 people killed after a pile-up of heavy vehicles on the Lucknow-Varanasi highway. The Bombay High Court pulls up civic authorities and the Maharashtra government for not enforcing pollution control measures at construction sites. Hindu right-wing outfits protest outside the Bangladesh High Commission in New Delhi after a Hindu man was lynched over blasphemy allegations. Dhaka summons the Indian High Commissioner, citing concerns over the security of its mission. The US drug regulator approves the first ever pill to fight obesity from the maker of Wegovy, that's Novo Nordisk. The landmark decision will open up the access to treatment to more patients. The pill will be launched in the US early next year. Industry leaders welcome India's new nuclear energy bill, which limits a supplier's liability and paves the way for private sector participation. But US-based Holtec International questions the 49% limit on foreign direct investment. L&T seeks viability gap funding for small modular reactors and a cut in GST from 18% to 5%. Also on the show, once a thriving diamond hub, Surat's Qatargam gasps for survival after Trump's tariffs. Over 1.5 lakh workers have lost their jobs in Surat alone. Nearly 20% small factories have shut down. A ground report coming up. Let's start with the day's market action. A volatile session on the Lal Street saw all the key indices end the day absolutely flat. The Nifty closing below the 26,200 mark, just about holding on to positive territory. The Sensex slipping at close, down about 40 points. The mid-cap index absolutely flat, and nothing much for the Nifty Bank as well. So volatile session, but a flat close for our markets. That's the story for the equity markets today. In the money markets, the rupee slipping to 89.76 against the dollar, but it did recover in late trade, ending the day flat also. The currency saw some pressure as importers and corporates stepped up dollar buying. 89.65 is the dollar rupee for you. From currencies to the precious metal market, gold continued its blistering rally as safe haven buying in hopes of further rate cuts by the US Fed in the new year helped the yellow metal scale even newer peaks. Silver followed suit, hitting fresh highs as well. The year has seen gold hit record highs for 50 days. Veteran investor Mark Bobius is continuing to bet big on gold and said that 10% of his personal assets are in gold.
I still like gold. I think gold should be part of any portfolio. I hold 10% of my personal assets into gold. And I think going forward, gold will continue to be very, very good. Now, it doesn't mean that it's going to go up in a straight line. There'll be corrections along the way. But there's no question that in US dollar terms, at least, gold will be doing very well, simply because of the proliferation of dollars around the world.
From metals to the commodity markets, crude oil prices edging lower as traders weighed geopolitical risk. The U.S. signaled it may sell crude oil seized from Venezuela. This even as Ukrainian attacks on Russian vehicles raised fresh concerns over potential supply disruptions. President Trump telling reporters that the U.S. could either keep or sell the Venezuelan oil seized off its coast in recent weeks, adding that the seized vessels would also remain in U.S. custody.
Oil that has been seized. The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it. We're keeping.
Where's it? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. maybe we'll use it in the strategic reserves. We're keeping the ships also.
Well, that's President Trump there on Venezuelan oil. Now, back home, the government is addressing the concerns raised by the IMF on India's GDP data. This as per the Statistics Ministry. Now, this comes days after the IMF gave a C grade to India's GDP data and flagged discrepancies. The government does not expect much change in the GDP number after shifting to the new base next year. Sapna standing by with more details, but for that, let's listen in to what government officials have to say.
IMF grading for the GDP, as you know that they have assigned the grading C, and mainly they have the three concerns. One is old base of the GDP, second one is the double deflation, and third one is the statistical discrepancies. These three issues are critical from the statistical point of view. In the new series, our team is addressing all these issues up to the best possible extent.
It is not as if the Indian GDP numbers are overstating the GDP case, but unfortunately, all these underinformed or half-baked questions are left deliberately hanging so as to sow the seeds of doubt in people, and it doesn't necessarily serve any purpose because they are not rigorous also.
Well, the government is not expecting too much of a change as far as the GDP numbers are concerned in terms of the shift to the new base years from February 2026 onwards. Secretary Mosby, Mr. Saurabh Garg, explained that though it's a bit early to comment on that just yet, but the government is not expecting much of a change from the previous expectations, quote unquote, as far as the GDP data would be concerned. That's one. Second, of course, he has also clarified that the back series on GDP will be available at a later point in time for the data sets previous to FY23. As far as FY23, FY24 and FY25 are concerned, the back series on GDP should be available almost, as soon as the second advance estimate on Feb 27 is out on the new base year. Third, he also explained on the double deflator. He said that under the new series, the effort of the government would be to completely not use a single deflator. The attempt will be to use a double deflator as far as possible, wherever possible. On this front, it may just be possible that Mosby will also be coming out with the concept paper on double deflator and how it is to be used, what are going to be the combinations. That could just be a possibility. So we'll have to wait and watch and see on that. But interesting comment coming in from the Mosby secretary that the government is not expecting much of a change in the GDP data or the GDP growth numbers, despite the shift to the new base year from next year.
All right, Sapna, many thanks for joining us. Now, the Adani Group is all set to merge its cement companies into a single entity. Ambuja Cements has announced a merger with ACC and Orient Cement to create a single company with 107 million tons in capacity. The merger is likely to be complete in 12 months and is subject to regulatory approvals. Nigel here with the details of what this big cement merger could mean. Nigel.
Well, that's right. The long-awaited and anticipated merger of Ambuja Cement's units have been announced, which will create a unified one cement platform. The board has approved the amalgamation of ACC and Orient Cement with Ambuja Cements. Now, Ambuja will issue 325 shares for every 100 shares held in ACC, while Ambuja will also issue 33 shares for every 100 shares held in Orient. The transaction is expected to be completed in the next 12 months, subject to regulatory approvals. You'll be asking, though, what are the big benefits? Well, it simplifies the group structure and it reduces holding company discount because some brokerages, they did assign that holding company discount. Next up, well, it improves transparency as well as governance standards via elimination of master supply agreement and the related party transactions. It also aligns with Ambuja Cement's plan to increase the cement production from ballpark around 107 million tons to around 155 million tons odd by 2028. The management targets cost savings of around 100 rupees per ton from the supply chain efficiencies, while Nirmal Bang says that there could be an additional 40 to 50 rupees per ton benefits over the next 2 to around 3 years, which is expected from improved tax efficiency as well as working capital optimization. Since there'll be fresh shares that will be issued, there'll be some kind of dilution, and that's why the promoter holding will come down to around 61%, which compares with around 67% earlier. Brokerages, well, Morgan Stanley, they say that they view this as a positive development. It removes the overhang of managing multiple listed entities under Ambuja Cements, and that's why shareholders will like it. CLSA, they have quantified it. They say that the amalgamation will lead to 10% value accretion for Ambuja shareholders as per their analysis. So net-net, amalgamation will have a neutral to a positive bias for the combined entity.
Well, and Nigel, many thanks for joining us. Now, shares of Cholamandalam Investment rebounded in trade after the company rejected allegations made in a Cobra Post report. Cobra Post alleges corporate misgovernance and claimed to have found a worrying pattern, in its words, of large value cash transactions and related party transactions between the listed NBFC, its subsidiaries and the parent Murugappa Group. Cholamandalam has called the report malicious and baseless and said it has complied with all regulations. Cobra Post standing by its reporting and held a press conference today alleging fund diversion to the tune of 10,000 crore rupees.
Chola is now going and sort of thumping down, we have declared. I'm categorically saying that only 2,000 odd crores of it was declared as related party transactions, and in this particular instance only about 116 crores out of this whole big amount. So there has been partial disclosure. We have combed through annual reports, we have combed through finance, and if they are misrepresenting that they have declared these related party transactions.
Well, that is Anirudh Behel of Cobra Post. Now, get ready to pay more for cars and bikes in the new year. Most automakers plan to hike prices as high commodity costs and a weak rupee take a toll even as demand continues to be strong. Sudarshan joins us now to take us through the list of companies that will be hiking prices. Sud.
If you're looking to buy a car or a bike, you may have to hurry as auto companies are looking to increase the prices very soon. Tata Motors has already announced that in the Q4 of FY26, it will be taking price hike. Other two major car makers, Hyundai and Maruti, are yet to take a call on price increase, but sources suggest that Mahindra & Mahindra is looking to increase the prices in the month of February. While all the luxury car makers have already announced price increase, and that would be effective January 1 of 2026, and the price increase is in the range of 2 to 3%. Coming to two-wheeler segment, all the ICE makers, TVS Motor, Hero MotoCorp, Bajaj Auto, are yet to take a call on price hike, and here also sources suggest these companies are looking to may decide on price hike in the month of January or February, while the EV maker Ather Energy has already announced an increase by prices by up to Rs 3,000 for its scooter segment. Now the question is why these companies are undertaking price hike. There are two major reasons. All the commodity prices have increased sharply in 2025, and if you talk about steel, aluminium, copper, prices of all these commodities are trading somewhere near record high. And the second reason is weakening rupee. Rupee has weakened against dollar sharply in 2025, almost 6%. And because of that, imported component prices has moved higher. So these are the two major reasons why these companies are undertaking price hike. But if you look beyond the price hike and the demand, in 2025, the demand uptick that we have started seeing in the festive season because of GST rate cut has sustained, and currently all these companies are seeing a strong demand. When the analysts put out that if the current demand holds in FY26, there is a possibility of an increase in the growth estimate, especially for the passenger vehicle segment. So the bottom line, while these companies are looking to undertake the price hike, demand trend remains very strong for the entire segment.
That change in the price, which is the baseline change, that we have to protect, because that was the intention of the government. We'll have to see the residual impact of the commodity or the input cost increase, to what extent we have to pass on. We are reviewing that, and if we have to pass on a bit of that commodity price increase, we'll decide then that in the coming weeks.
Well, prices likely to go up for car makers in January. Now, US drug regulator has approved the first ever pill to fight obesity from the maker of Wegovy, which is Novo Nordisk. The landmark decision will open up the access to treatment to more patients. The pill will be launched in the US early next year. Ekta is here with the details. So, Ekta, now Wegovy available in a pill form, but of course will start in the US.
The US FDA has approved a pill version of Novo Nordisk's blockbuster obesity drug Wegovy, marking a major expansion of the fast-growing GLP-1 weight loss market. The once-daily pill contains semaglutide, which is the same ingredient used in the injectable Wegovy and Ozempic, and is expected to launch in January 2026. Clinical trials showed 17% average weight loss according to reports, better than the injectable Wegovy's 14 to 15%, but still behind Eli Lilly's Mounjaro, which remains the most potent drug in the class, with 20 to 22% weight loss in late-stage studies. Novo Nordisk is now the first to market with an oral GLP-1 amongst the three drugs which are available or popular at this point in time, such as Wegovy, Ozempic as well as Mounjaro. But competition, it seems, is heating up. Eli Lilly, Roche and AstraZeneca are all developing oral alternatives, betting that convenience is possibly going to drive adoption, especially amongst patients which are hesitant about injections. While Mounjaro dominated prescriptions in 2025 due to its efficacy, analysts say pills could reshape the patient choice, with the global obesity drug market projected to reach $50 billion by 2030. The race, it seems, is no longer just about efficacy, but also ease of use and access to the drugs. In India, Novo Nordisk has launched Wegovy and Ozempic, but Mounjaro, it seems, is already the top-selling obesity drug, clocking over 100 crores in sales in November alone. Whether an oral Wegovy can catch up remains to be seen.
Well, Ekta, many thanks for joining us. We'll take a break, but once we return, a thriving hub, Surat's diamond market is now gasping for survival after Trump's tariffs. A ground report when we return. Industry leaders have welcomed India's new nuclear energy bill, which limits the supplier's liability and paves the way for private sector participation. But US-based Holtec International has expressed disappointment about the 49% FDI cap. The company's CEO believes such a cap is unnecessary and there should be low limit for foreign investments. Meanwhile, L&T has called on the government to consider a viability gap funding for small modular reactors and a cut in GST from 18% to 5%.
The amount of investment permitted should not be limited to 49%. I don't think there should be a limit on foreign investment. It's an unnecessary restriction. The $200 billion that Bloomberg projects can become $400 and $600 billion if we simply allow people who believe in India.
At least for first few small modular reactor, there is a need for a scheme for viability gap funding, so that when you set up few small modular reactors, the learning curve will bring down the cost, and the time for construction also will reduce. Today, if you see, renewables have GST of 5%, which is composite equivalent of 8.9%, whereas the nuclear is operating at 18%. So there is a differential. Now, when you want it to be compared with the other sources of energy, I think the government should definitely look at this.
Now, India's diamond industry, which was already struggling since 2022, is facing fresh stress due to the tariffs imposed by President Trump. Sandhya Gora travelled to Surat, India's diamond hub. She reports that a fall in exports on account of tariffs are hurting diamond workers across the value chain. Take a look.
This is 21-year-old Chotu Kumar. We met him in Surat's Katagram area, well known as a diamond hub where the precious stones are sorted, cut and polished. Originally from Kanpur, Chotu came to Surat at the age of 13 and worked as a diamond sorter. He earned up to 28,000 rupees a month. Since August, however, work has dried up. He tried switching to working with lab-grown diamonds, but the pay, he says, is a fraction of what he used to earn.
मिलेगा बोल रहे हैं, होगा काम होगा, बैठो और क्या है। इधर कारखाने में बदलता हूँ तो फिर काम भी नहीं होता है, उधर से जाता हूँ तो उधर भी नहीं होता है। हीरा हीरा आता था तो काम हो जाता था, अब तो बहुत ज़्यादा सीवीडी का हीरा आता है, वो चलता भी नहीं है और पूरा मेहनत पूरा थक जाता है शरीर शाम को।
हीरे में आपको पैसा भी कम मिलता होगा?
पैसा देता है पर अरे उसे 13-14 रुपये देता है, पर उसमें शाम तक शरीर को ऐसा तैसा हो जाता है। फिर रूम भाड़ा भी उसमें भरना पड़ता है, 4,000 रूम भाड़ा है।
As we spoke to Chotu, several other diamond workers gathered and they all had similar stories.
दिवाली के बाद हमारा जो जॉब वर्क था उसमें जो मजदूरी दी जाती थी, कल ही हमारा भाव कम कर दिया और टाइम तो हमको फुल भरवा रहे हैं।
पहले कितना कमा रहे थे, अभी कितना कमा रहे हैं?
मान लो जो कमाई था उसमें से हम 40% का हम डिफरेंट पड़ गया।
रूम भाड़ा नहीं निकलता, काम पूरा नहीं था, आखत जाता આવતા रूम भाड़ा नहीं, खर्च ज़्यादा बढ़ जाए, પગાર નહીં પૂરતા મળતા, આખો દી હીરા ઘસવી તો 300-400 ના કામ થાય, એમાં શું આપણે મોંઘવારીમાં થાય?
नहीं होता काम नहीं होता, गिराक नहीं आता ना।
A big reason for this dramatic slowdown is the steep tariffs imposed by the US on Indian diamonds. The US was India's largest export market for diamonds. According to the Indian government, cut and polished diamond exports to the US stood at $5,926 million in 2023 and $4,883 million in 2024. This dropped sharply to $2,422 million as of September 2025. Experts estimate that in Surat alone, over 1.5 lakh diamond workers have lost their jobs so far since the tariffs were imposed. Many others are working at sharply reduced incomes.
अगर वर्कर का देखें तो अभी छोटी छोटी जो कंपनियां हैं वो मेरे हिसाब से 15 to 20% अभी बंद हो गई है, तो उसके जो वर्कर है उसको अभी जॉब नहीं मिल रहा है क्योंकि कोई अपना काम बढ़ाना नहीं चाहता, जो है उतना भी वो सर्वाइव नहीं कर पा रहा है। तो मेरे ख्याल से 10 to 15% वर्कर अभी जॉबलेस हो गए हैं और अभी दिख नहीं रहा है कि आगे जाके कब अपना हमारा बिजनेस जो है वो सर्वाइव कर पाएगा।
Exporters are looking for solutions desperately. Many hope the government will lend a hand. Exporters of lab-grown diamonds say entering new export destinations has helped them stay afloat. However, these diamonds come with much lower margins. This puts pressure on operations, which trickles down the supply chain. Like many other sectors, India's diamond industry, a large chunk of which is housed in Surat, hopes that an India-US deal will fructify sooner rather than later, giving the entire industry some much-needed relief. In Surat, with camera person Ajay Dabulkar, this is Sandhya for CNBC TV18.
Well, a sector that is reeling under the impact of Trump's tariffs. With that, it is time for us to wrap up this edition of Business 360. The news will continue right after this short break. Stay tuned. We're back in a moment on CNBC TV18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and these are the top headlines from the startup world. Defense tech startup Koreal Technologies has bagged $30 million in Series B funding round led by ValueQuest. This capital will not only elevate their manufacturing and R&D efforts but also enable them to participate in significant defense initiatives. Prosper.io has bagged $4 million in a Jungle Ventures-led seed round recently. It offers subscription-based tax planning and compliance services for salaried users and enterprises across India markets. New funds will boost product development, B2B sales, and expansion into wealth management and adjacent services. Nakshatra Labs, a deep tech company, has raised $3 million in a pre-Series A funding round led by Rain Matter. With the new capital infusion, Nakshatra Labs plans to deepen its R&D efforts, expand into new high-growth motor applications. Entrepreneurs Nikhil Kamath and Kishore Biani have introduced the Foundry, a residential business launchpad designed to support early-stage startups in India. Selected participants can retain up to 25% equity in ventures they help create, and successful startups may receive seed funding of up to 4 crore rupees. NVIDIA has told Chinese clients it aims to start shipping its second most powerful AI chips to China before the Lunar New Year holiday in mid-February. The US chip maker plans to fulfill initial orders from existing stock, with shipments expected to total 5,000 to 10,000 chip modules, Reuters reported. OYO's parent Prism makes a fourth attempt to go public, secure shareholder approval to raise 6,650 crore rupees through an initial public offering. Those were the headlines that we're tracking for you this evening. But on what's brewing today, India's deep tech ecosystem is gaining momentum and a new pool of patient capital is entering the market. Byte Capital has announced a 180 crore rupee early stage fund aimed at backing lab-to-market deep tech startups building globally relevant IP-led technologies. With over half the fund already subscribed, Byte Capital plans to invest across 18 to 20 startups in sectors ranging from space and life sciences to clean energy and frontier engineering. As India's deep tech startups attract record funding and global attention, we speak to the founder of Byte Capital on their investment thesis, portfolio bets and outlook for the year ahead. Amit Chand, thank you so much for taking time out and being here with us on Startup Street. Let me start by asking you, Byte Capital has announced its maiden 180 crore rupee deep tech fund, right? Over 50% of the fund is already subscribed. Who are your key LPs and what does this early backing tell you about investor appetite for deep tech as an asset class, especially in India?
Thank you so much for having me here. So first of all, the LPs are primarily ultra HNIs, few family offices. And yeah, what we are seeing that there's a immense interest in the LP base to come and have this patient capital deployed over a deep tech ecosystem. Because what we are also seeing, and they are also seeing over a period of last 6 or 7 years, the deep tech has moved from niche and niche into a priority area, right? It is becoming a foundational layer.
Sure. And with planned investments across 18 to 20 startups and check sizes of 3 to 6 crore rupees, right? What kind of founders and technologies are you sort of prioritizing at the lab to market stage?
So we are looking at mostly into hardware part of it, but because that's what we believe in. If India as a nation has to grow, the manufacturing has to scale up, right? And so more primarily 80 to 85% of the investment will go into hardware part of it. And we will fund them from pre-seed to Series A stage, from early check from 3 crore rupees to 6 crore rupees and do a follow-on somewhere around till 15 crore rupees.
All right. And you've already sort of begun deploying this capital, right? Can you tell us about the kinds of companies you're betting on so far and what these early portfolio investments sort of reveal about your deep tech thesis?
So we, on the public domain, there's one investment which has been done from our end. It is into Vyom IC. It is into startup, space tech. And they are building the India's first position, navigation and timing constellation, which is again a very basic foundational layer for India to build their infrastructure, right? And the other, which we are looking at, they are into robotic, life sciences, and clean energy space.
So some exciting spaces there. Are you already in talks with other companies to sort of make more investments?
Yes, we are building our thesis and building our pipeline accordingly. So we want to invest somewhere around 4 to 5 investments per year. Over a period of 4 years, we want to do somewhere around 18 to 20 investments.
All
the
right.
pipeline is already there.
Sure, tell me. Continue.
I'm just saying that pipeline is already building. So we just wanted to go dig deeper and deploy it with much more diligence.
All right. And you've earmarked 55% of this, as you pointed out, for follow-on rounds, right? So how critical is patient capital in deep tech and how does this sort of differentiate your fund strategy from other deep tech, funds that already exist in the ecosystem?
So 55% follow-on is basically to back your winning horses. Right, out of 20 portfolio, 8 to 10 we see that they are doing phenomenally good. We want to have the same equity when we came in at a very early stage to keep the same equity and take a better exit.
Sure, and so you get a better exit. Also, by how much do you want to close this fund at?
So we will be deploying we will be closing the fund somewhere around 180 crore rupees. And we want to close it somewhere around Q3 2026.
All right. And India's deep tech startups raised over $600 million in 2025, right? So where do you sort of see the strongest momentum today across sectors like AI, space, clean energy and life sciences? Where are the next big ideas coming out of in terms of the sectors you're looking at within the deep tech space?
So I think every sector has 1 or 2 brilliant ideas which is coming up. If you talk about space, there are a lot of brilliant ideas. We are seeing a lot about applied sciences. We are seeing a lot on robotics, right? Life sciences, drug discovery is one bigger part. The government just opened up privatization of nuclear, right? So we will see many startups coming up now on the clean energy part as well. So it's a ever evolving sector. So you can't say that I'm looking at on X sectors today. Right? You need to keep updating your thesis on the moment the technology grows.
Sure, absolutely. And sort of from an AUM perspective, this is your first institutional fund. How do you sort of see Byte Capital scaling its assets under management over the next few years?
So as of now, we are purely focusing on Fund 1, right? For next 3 to 4 years, at least the pure focus on deploying that 18 to 20 startups. And then we see where we go from Fund 1 to Fund 2.
All right. And sort of looking ahead to the new year, what is your outlook for deep tech funding in 2026? And what milestones should we watch out for from Byte Capital over the next 12 months?
So in terms of the funding, what I'm seeing across the ecosystem, the funding is growing. Yeah, the people are okay and started investing in deep tech momentum. Like I just said, we have moved from niche and need into a private priority area, right? So the current challenge right now is you have a lot of people who are doing your early investment, but the growth funding is still very nascent. Very few people are doing the growth funding, which is essential for any deep tech to grow. So to me, I see next year there will be more funds which are raising the growth capital for these guys so that the entire ecosystem grows in. And apart from the Byte perspective, you will see a lot of announcement happening on startup which are building one of its kind technology, one of its kind in the world.
Absolutely. And also the Indian government has provided substantial backing for the deep tech sector through significant funding initiatives, dedicated policy, and strategic national missions, right? So do you think the government has done enough for deep tech, and do you feel that it's given enough impetus for the sector at large?
To me, if I have to see my journey of deep tech investment as an angel investor for the last 7 years, right? Government has done a lot of push in terms of scaling this ecosystem. And the current fund of RDI, which is 1 lakh crore rupees, again, it's a validation that government is pushing a lot to scale up the manufacturing and build our own IPs and technology from the India for the world. So yes, government is doing a lot in terms of scaling up the deep tech ecosystem.
Sure. And 2025 is coming to an end. Looking out at 2026, where do you think the big money will go? What are the sectors that are on top of everyone's radar, especially for investors?
So space and defense are again big because they are seeing a lot of momentum. Space has been built their ecosystem over a period of last 6 years, right? So again, on Q1 2026, we will see 3 very nice things which are going to happen on the space sector. 2 private launch vehicle are taking their first payload on orbit, right? Which will mark a very defining moment for the space tech sector for India. Then the biggest ever private satellite made in India, first of its kind, multi-sensor, all-fusion, all-weather satellites is getting launched. So another Q1 2026, we will see it is going to be a defining moment for space tech.
All right, defining moment for space tech in the first quarter of next year. All right, Amit, thank you so much for taking time out and being here with us on the show. And we wish you all the best on this journey. And moving on, the parent company of Oyo Hotels, Prism, has received shareholder approval to raise up to 6,650 crore rupees through an initial public offering. This will be the company's 4th attempt at going public. The hotel aggregator first filed for an IPO in 2021, targeting a valuation of up to $12 billion, which was shelved. It briefly revived plans to list in March 2023 through a confidential filing, but that did not take off either. In May this year, Oyo delayed the issue for the 3rd time, opting to raise debt instead.
Well, Bengaluru-based veterinary clinic chain Dr. Paws has raised 29.3 crore rupees in a pre-Series A funding round, which was led by Chirude Ventures, to scale its physical clinic network beyond Bengaluru and also expand into at-home vet services. This round included about 21.5 crores in equity and the rest in venture debt. Now, Dr. Paws currently operates 3 clinics in Bengaluru, and it is setting up 2 more centers, which will take the total to 5 clinics in the city by the end of this year. For more on the plans ahead, joining me now is Udit Gadkare, the co-founder of Dr. Paws. Udit, thanks very much for your time here on Startup Street. The pet care sector itself is quite fragmented in India. To begin with, what is the size of the opportunity for you and the specific gaps in the market you identified, and how are you addressing them any better than some of your competitors?
Sure. So I think in general, the pet market is really, really increasing. There's different numbers as to how big it is. I think most market estimates would say it's somewhere around 3 billion to 5 billion right now, and it can really, really expand further. And we're seeing the expansion all around. I think within that, the vet healthcare space is a large part of this. So the market is split broadly into pet products and pet services. Within pet services, this is the biggest space. But I think really what me and Rakesh, that's my co-founder, we felt was the industry was going through a big amount of change. And what it was really coming to was there was a new type of pet parent who was getting a pet for the first time. And they needed something different because pet healthcare, there were some great doctors, but the infrastructure was really poor. the focus on customer experience and what a pet parent needed was very, very lacking. And this young wave of new pet parents or first-time pet parents, basically in all other aspects of their life, they'd had better experiences or were receiving better experiences. And the vets still seem to be stuck way back, just like it was 20 years ago. So that's kind of really what we wanted to work on.
Well, tell us about this 29.3 crore pre-Series A funding that you've raised. How exactly are you going to deploy this capital? I mean, between clinics, at-home services, product, or even tech, what gets the biggest share?
Yeah. So we are first and foremost a modern veterinary clinic business. So the largest share of this is going to go towards expanding our footprint. Our 4th and 5th centers will be opening this month in Bangalore, but with this funding, we should at least get to somewhere around 15 clinics outside of Bangalore as well. So maybe Hyderabad, Pune as well. Some amount of this capital will be deployed in 2 new business lines, like you mentioned. One is at-home care, which is really just focused on convenience. And the other is our own label of products. We'll deploy initial capital here based on the response. How we do, more and more capital could get deployed there. And the other kind of area outside of business verticals will be really on how do we equip Dr. Paws with the best tech? How do we equip Dr. Paws with the best team? I think we know we're not an AI-first company as our DNA, but we definitely want to be AI powered and AI enabled. There's so many things that we can do to just make our doctors their medical diagnosis stronger or more reliable. There's so much we can do on making our teams more efficient in terms of admin. There's so much we can do in terms of even our creative team, for example, using AI to just become faster and more efficient at what they do. So we definitely want to invest in technology as well with this funding.
Right. We understand your plan is to get to 9 clinics in Bengaluru by 2026 and then expand to Hyderabad and Pune. I mean, how do you decide which specific cities, why these 2, and your target timeline for becoming a national brand?
Yeah, so look, from day one, the vision was always to be a national brand. And I think the market is there for us to do that. Bangalore is a natural starting place, as Rakesh and I were both based here. Hyderabad, we just feel is a really, really attractive market right now. The pet population is really booming. And the vet kind of ecosystem is probably slightly less developed than in cities like Delhi NCR or even Bangalore for that matter. And Pune, we see very similar sort of situation to Bangalore. And these cities are kind of culturally very similar, Western Hyderabad with the IT, Bangalore, as well as Pune. So the offering that we have, obviously we'll need tweaks for local markets, but the level of tweaking might be slightly smaller, and that's what attracts us there. But certainly you will see us in Delhi NCR, Kolkata, Bombay, markets like this very soon as well.
Well, a quick word on your financials as well. I mean, in this year and a half of operations, what do they look like? How many of your clinics have broken even, and the kind of revenues you're currently clocking at the moment?
Yeah, so essentially right now we're running with 3 clinics live. We have our Indiranagar and Sanjinagar branches, which are about, you could say, 17 and 16 months old respectively. And then you have HSR, which you could say is about 8 months old. All of them are operationally profitable at a clinic level, and so Indiranagar and Sanjinagar both got there within 4 to 5 months. HSR also within the 5 to 6 month category. On average, our clinics right now are doing somewhere around, on average, it's working out about 28 lakhs per month as revenue from all our clinics. Of course, across the portfolio, RMV, with being the largest clinic, probably has a slightly higher share. We definitely think in this market, on average, per clinic, we would aim to do at a portfolio level 35 to 40 lakhs per month, with some clinics being much, much higher in really strong markets. But at portfolio level, we would expect at least 35 to 40 lakhs per month per clinic.
All right, Udit, we'll leave it at that. Thanks very much for your time here today on Startup Street.
Perfect. Thank you so much for having me, Ritu.
Okay, and on that note, we're going to wrap up this edition of Startup Street. Thanks for tuning in, but stay with us. More news and updates will continue after this break.
Welcome back to Startup Street. 2025 has been a breakout year for India's intercity bus travel. Online bus ticketing platform Redbus, in its latest bus track report tracking the entire Indian intercity bus sector between April and September 2025, reveals that over 140 million passengers travelled by intercity buses, a 25% year-on-year jump. What's powering this growth is Bharat beyond the metros. With 6.7 lakh routes connecting over 11,000 towns, buses are increasingly becoming the backbone of long-distance mobility. With nearly two-thirds of journeys now exceeding 250 kilometers, comfort is the driving choice. AC, sleeper and hybrid buses dominate bookings, while digital ticketing continues to bring more private operators online. So what do these trends tell us about how India is traveling today and where intercity mobility is headed next? Joining me now is Prakash Sangam, the CEO of Redbus. Prakash, welcome to Startup Street. Your latest bus track report shows a 25% jump in India's intercity bus travel, with over 140 million passengers between April and September. What's driving this surge, and why is this growth structurally different from earlier cycles?
Yeah, first of all, thank you for having me here. And my pleasure entirely to be here. Look, I think the primary reason why the growth is coming through is because of the fact that we need to understand, first of all, before we go into the reasons, as to what are we talking about when we have put out the numbers on India Bus Track. So we are talking about those buses which are digitally connected to our platform, and therefore we have full access to the inventory, and we're able to count it in some sense and put out what the size of the market is. And the second thing is that we are talking about purely the private bus market. So in the bus market, there are the government operators, the regional road transport corporations, which run their own buses. And we have got the private bus operators, right? And the market report that we have put out is for private operators who are digitally connected to Redbus. And now coming on to the factors for the market growth, it's driven by both demand side as well as supply side.
Absolutely, and we'll delve into all of these points that you made. But like you pointed out, this data goes beyond Redbus and captures the entire private bus ecosystem with 6.7 lakh routes and over 11,000 towns connected. What does this tell us about how Bharat is traveling today? And with Tier 3 routes growing 19% faster than the national average, is the next phase of growth clearly anchored in smaller towns?
Yes, you're absolutely right. And what is really causing this to happen is a sheer increase in connectivity. That is happening by the fact that the highway and roadway network in the country is fast expanding, right? So that is bringing in a lot more towns into the focus area. It's better connected now, and connectivity is going up. The other reason why we are finding more of the Tier 3 towns reflecting and lighting up on our charts is because of the digitization story.
Yeah, the report says Maharashtra and Goa lead in bookings, while Andhra Pradesh and Telangana top occupancy rates. So does this explain, the sharp regional contrast? And with 61% of bookings coming from non-metro India, is this the clearest sign yet of digital travel adoption beyond big cities?
Yeah, it points the direction. And the reason why the trends are different by regions is that if you look at bus travel and contrast it with, say, rail or air travel, right? The number of operators in rail is just one, Indian Railways. And in air travel, you can count the number of airlines in the fingers of one hand. Whereas when it comes to buses, it's a very, very diverse, very segmented market. We have like more than 6,000 operators on our platform. The rules are very, very state specific, a lot of state level nuances. So we don't have any pan-India national operator.
Let me now point out to Red Rail. It has also seen massive traction during Kumbh, with Karnataka recording a 19x jump. So how important is rail in your broader mobility strategy? And do you see bus and rail increasingly complement each other rather than competing?
Yeah, historically also bus and rail have had, there are very different segments who go for rail, demographic segments, right? So you typically find that senior citizens, women, families, they tend to prefer a rail because they make their plans in advance. Whereas a lot of the younger crowd whose plans change more frequently, who make last minute plans, who are interested to quickly board the bus from closer to where they are and get off in the destination, which is closest to where they want to get to finally, a lot of them prefer buses. So the demographic segments have been largely different for train and bus. But we are finding that with trains, especially the capacity, there's a lot of capacity constraint. The supply is constrained. So there are a lot of people who get waitlisted tickets. And we see that as an opportunity to end up cross-selling buses to them because bus becomes a viable option for them.
Sure. One final question before I let you go. You've said AI will remain a key focus in 2026. Again, looking ahead to the next year, what is the single biggest shift you expect in how India travels by bus?
Look, I think there are two parts to it. So on the AI front, I think what we have seen is that we have applied Gen AI. I'm talking about Gen AI. I'm not talking about machine learning, which already had a lot of application on things like dynamic pricing, personalization, etc. On Gen AI, we have done a lot of implementation of Gen AI on the customer support side of things, and that has come up really well. We have also seen a lot of Gen AI implementation with respect to productivity of our workforce, with coding assistants and even non-tech people using a lot of AI to get more productive at work. We are going to focus AI now more on the pre-booking side of things to help with both trip planning as well as help people get what they want in terms of discovery of buses much more easily than what they're able to do now, because we can understand natural language better. They can speak to the device, right? So that's one part. Sure. As regard to the greater change in the bus industry that we are likely to see, I think it's going to be consolidation of the existing trends.
Well, with that, it's time for me to wrap up our conversation. Many thanks, Prakash, for your time and for joining us on Startup Street.
Thank you for having me.
With that, it's a wrap on this edition of Startup Street. More news and updates continue on CNBC TV18.
Well, 2025 will go down as the year that India's financial sector saw a significant amount of FDI coming in, both strategic as well as financial capital. We've seen deals in RBL, IDFC Bank, Federal Bank, and the largest to close out the year perhaps is the one with Shriram Finance and MUFG. Joining us now on the record to talk to us about this deal, what they intend to do with the capital that they get, and whether or not a bank license is on the anvil at all, is Umesh Revankar. Mr. Revankar, many thanks for joining us here on CNBC TV18. Appreciate your time. Let me start by asking you, you're well capitalized. You didn't really require the capital, 20% tier 1 capital already. The rationale and the timing of this deal?
See, capital is always welcome. And when the capital is coming from a reputed international organization, that makes a huge difference for the cost of funds. And as we were discussing, we were looking for some kind of a large international partner for our growth. And when the right opportunity was there to take this, we thought we should take it. So one thing we are very clear that 20 is what it looks little higher above the regulatory requirement. But since we have an international rating, the 20 is something which is borderline.
Okay.
So you need to be above 20 all the times. So we were already in the borderline. So we were looking. Indian regulatory requirement or statutory requirement is 15.
Correct.
But since we have an international rating, so it was 20, and the international rating agencies prefer to be about 20. So we were always looking at that. And when we had a great opportunity of highly reputed organization like MUFG, then we thought we should take it forward.
Okay, so how long were the talks on? I know that this is something that we've spoken about and asked you previously as well, but how long were the talks on? And were there other suitors that you were also talking to? And what made you want to zero in on MUFG specifically?
We were talking to multiple people. It is not that it's just one team or one organization we were talking to. But we were looking at the appropriateness because being a lender here in India for nearly 50 years, we wanted an organization which has an international reputation and who have experience of being a partner in various other countries. MUFG is a one bank. If you look at their background, they have been a partner in Morgan Stanley US with 23% stake there. They also have the investment in Thailand, Indonesia, Philippines, and Vietnam. 4 countries. So Asian countries also, they have a very large exposure in the retail lending. So most of their lending in the Asia is in the retail.
Okay.
So I thought with their experience, knowledge, and the expertise what they built on digital platform, it will be a great suit for India so that we can play on their experience, plus the digital platform which they have built, which looks very robust, and we can easily have an advantage of what they have gained out of their experience in the other Asian countries.
Okay, I'll get to the synergies in just a second, but let's talk about the 20% stake. And there is a lot of speculation that they could perhaps look at eventually going beyond 20%. Has that been a discussion, a conversation that you've had with them? Are they interested?
See, the conversation can go on from 5% to more. So there has been a repeated discussion on how much to invest and what should be the long-term plan. Right now, we are sticking to 20. And probably with experience what they gain of the investment, then we may take a call. But right now, there's no talk of anything about going above 20%.
You're saying right now there is no call on going above 20%, but with experience, perhaps there could be an eventuality where you could see that. Would that result in an open offer? Will that result in a management change?
See, as far as they are concerned, they are very clear that management will continue with Shriram because we have a 50 years experience in India, plus the management depth they have seen. They have come and visited the branches, talked to the senior management team. They have seen the depth. So they're very happy with the depth. So there's absolutely no talk or discussion on management change. Management will continue to remain Shriram. And the way we run the business will be the Shriram way of doing business. I don't see there is any change on that.
But an open offer, do they have the appetite for that?
I don't really see that. We have not discussed on that right now. So probably as they experience India, if they are very happy with India, because right now India is growing at 8% plus GDP, and that really is the excitement they have, and they would like to see how India is growing. And with this kind of a capital coming in, and I think there will be a much stronger demand for credit in India.
So the door and the window in the future is open?
I can't say that now, because right now discussion is limited to 20% only.
Okay, limited to 20%. Let me ask you about the other piece that's being speculated on, and something that Uday Kotak tweeted about also, is this a precursor to an eventual bank license? Is that the plan? Is that the aspiration? Is that the ambition?
I can't comment on that, because see, the way Mr. Kotak's journey, if you see, he started as an NBFC.
Correct.
But immediately he moved to bank, because his constituency, where he wanted to address, where he wanted to focus, was maybe a bank. My constituency is different. I want to be in retail lending. I want to service the customers who are underbanked and unbanked. So, and there is a huge opportunity and scope for me being an NBFC. Whether I need to change that, I don't really see that now.
But what about MUFG? Does that, does the ambition change with MUFG coming in?
So that is something which we need to discuss over the period. I don't think this is the time to discuss about it. And a banking vehicle is totally different. And your constituency is totally different. When you become a bank, you need to be prepared for multiple services. You can't be just lending services. Right now, being a focused lending company to the self-employed and small enterprises, SMEs, we are focused on that. And there is a huge opportunity potential for us to service this particular segment, which is underserved. And we would like to be prefer to be in this segment, because as per the own RBI's data, RBI and World Bank data, around 40 lakh crore is the credit gap in SME sector alone. Forget the other segment which we are in vehicle financing. So there is a huge scope and opportunity. Why should I change my constituency? And that's giving me a good margin and good customer connect, and I am able to do a lot more things with my customer. Otherwise, I need not do that.
Okay, so you need not do that. At least that idea is parked for the moment. But let's talk about something that you brought up, and that is the cost of funds. How much do you see an improvement as far as your cost of funds are concerned? What kind of a decline are you envisaging now with this deal going through?
See, right now, if you look at my balance sheet, my debt to equity ratio, which is around 4.3, 4.4. With the infusion of this, as and when the money receives, maybe it will come down to around 2.6 level. And again, there is a scope for me to increase my debt to equity ratios so that profitability goes up. So the pressure on me to raise resources comes down to that extent, and therefore I'll be more choosy, and I can bring down the cost. My expectation is that I can bring down the cost by around 40-50 basis points incrementally over the period now.
That's a significant improvement over what you've guided, which is about 15 basis points at this point in time, right?
That's normal course, yes. With this capital coming in, it is going to be that much. And long run, it is going to be much higher, because with a strong balance sheet, our ability to raise resources at cheaper cost will further increase.
So can you lay out the trajectory on what you mean by in the long term you can see an even more significant than a 40-50 basis point reduction as far as your cost of funds is concerned?
We are AA plus and credit rating. We have been discussing with the credit rating agency for upgrade, and if that happens, then there will be additional advantage. We will have a broader selection of broader sources to go, and that will bring down the cost further down. So apart from the strong balance sheet and rating upgrade, that should give us nearly, I believe, around 100 basis point decrease over the next 1.5 to 2 years, not immediately.
Okay.
It may take a longer time, but that will bring down, today is around 8.8.
Correct.
And that, if it comes down to around 100 basis point in the next 2-3 years, that much I can pass it on to my customers. Ultimately, how much we are able to pass it on to the customer and make them more comfortable, that matters a lot to retain my customer and grow the customer.
Well, let's talk about growth then, because that's the big question. What do you do now with this capital, which is quite significant, that's coming in? Does that whet your appetite to grow more aggressively? And does it change your portfolio mix as well?
I don't really see a change of portfolio mix because there is enough opportunity in our segments like commercial vehicles, passenger vehicles, machineries, and two-wheelers that are our major vehicle segment, plus you have SME segment, which is around 15% of the portfolio. So if you look at each of this portfolio, the demand is very high. Now, last 5 years, if you look at from 2019 onwards, commercial vehicle sales came down.
Yes.
And through the COVID, it came down further. And post-COVID, it has grown. If you look at the last 10, 15 years commercial vehicle sales, you see that whenever the sales come down, when economy slows down, come down, it jumps beyond what it was in the previous peak by 20%. This time it has never even crossed the previous peak. That is 2018 was the previous peak. That means there is enough potential. People have postponed buying a newer vehicle for nearly 4 or 5 years, mainly because India upgraded the emission norms to Bharat Stage 6. And at that same time, there was inflation pressure. So most of the vehicle prices went up by around 40%. Therefore, many people have postponed buying or upgrading the vehicle. And I believe next 4 to 5 years, if India is growing at the current GDP growth rate, we should be upgrading most of our fleets. And also the new technologies are coming into the vehicles, whether it's a passenger vehicle or commercial vehicle, two-wheeler. As the new technology comes, the prices are going to be a little higher. So that will absorb most of the money what we have raised is what I strongly believe. So we should be able to grow more than 20% in these segments which you are in. Plus the SME segment is very vast. The opportunity there is multifold. So we should be able to really cater to the SME segment much efficiently rather than what we are doing now. We have been doing most out of the relationship now. So we should be able to build more on SME portfolio.
The kind of growth that you talked about, and a lot of it is because, as you pointed out, was pent-up demand on account of things like BS6, GST, and so on and so forth. But now with MUFG coming on board, with this deal getting done, do you accelerate the kind of growth momentum that you're already factoring in? And in terms of new opportunities, what kind of new opportunities, if any, do you look at? I understand that you will continue to double down on commercial vehicle financing, SME financing, and so on and so forth. But your AUM aspiration, does that now change on account of this deal?
Definitely, yes. There will be a higher AUM growth. We expect from 15% guidelines what we had given, we should be able to grow around 20% is what I feel, because we have enough branch network, depth in the management, we have a reach, we have everything to grow. We don't have to really build that to grow. Since I have that kind of a network and people, and also the constituency, my constituency is very comfortable with me, that the customers, I'll be able to really grow. So 20% growth is a comfortable growth for next 5 years. As long as India's economy is growing, the GDP growth rate is at what today, 8%, we should be definitely growing at 20%.
At 20%, at least for the next 5 years or the foreseeable future is what you're pointing out. But, you also talk about restructuring. What is that restructuring going to entail? Is it a restructuring at the holdco level? Can you explain to us what the restructuring as part of this MU entails?
Basically, what we're talking about is the credit business and the protection business. We have a partner. Yes, insurance.
Sanlam.
Yeah, life general we have. We also have AMC business. We also started wealth business. So we would like to make this as a two broad segments. And the lending segment will be a totally focused one, where MUFG is going to be a partner. And the rest of the businesses are going to be with the Sanlam and other partners, if there are any. So like that, we are differentiating and making it. That's a plan. That's a structure which we are proposing. That is at a holding company level, is nothing to do with SFL level.
In terms of metrics now, and you gave us a very clear indication of what the cost of funds will look like, but in terms of other metrics, whether it's return on equity, etc., what could the next few years look like? What are you working towards? What are the targets?
There are multiple moving ratios here. Definitely the ROE will definitely come down because of the large capital infuse. But ROA will go up. So as the ROA goes up, then ROE will definitely go up. As we are able to leverage more, the ROE multiple will go up. That's how it looks like. But you have to see other moving parts, like net interest margins are going to go up because of cost of fund is coming down. Our credit cost is going to come down because we are going to onboard a customer with higher credit profile, better credit profile. That is going to bring down my credit cost to some extent. So this, and with these two in between, margin and the ROA, definitely the ROA will move towards from 2.8 now to around 3.6 level, and multiple of that as I leverage nearly 4 times, and that's the kind of the ROE I'm going to get. So ultimately we'll move towards 15.5 or 16 in next 5 to 6 years, what is there today. So the growth trend is very clear, and all the ratios will be more positive year on year, and that should be the way we should be working for next.
As far as the margins are concerned, you did point out clearly that you expect a margin expansion on account of this deal going through as well. What will the margin expansion trajectory look like over the next few years, you think?
The net interest margin could reach to around 10% because of the capital being there. Capital getting deployed will bring down your cost of fund to some extent in the next 2 to 3 years. So then over the period it will moderate. So that's how it will look like.
The regulator, of course, the regulatory process will now start with the agreement being inked. What are the timelines that you envisage? And I'm sure that there would have been an informal check with the regulator on whether this deal has their blessings or not.
See, we are going to put the application now. Definitely, we are in touch with the regulator for various other requirement purposes and also for a dialogue. So these are all things we have to be taking, the other interested organizations or parties or regulator in touch. So I believe there is they are welcoming this because it shows a lot of confidence in India's growing economy. That's one thing. And large capital coming in retail lending definitely help the credit growth and also the consumption, indirect consumption or direct consumption. It also add a lot of asset getting created. See, we are one organization which has always focused on lending against asset or for acquiring an asset. So asset creation gives a lot of opportunity for individual to progress in his life and building a sustainable income. So whether you are buying a taxi or buying a truck or bus or machinery, all this will add to your ability to improve your income. So that being the case, I feel the regulator will be definitely be very positive about it and hope everything will go on time.
What's the indicative timeline by when you expect all the clearances to come through?
We have given a 3 to 4 months window for everything, but hopefully would like to get
close
things
it earlier.
faster. Yeah.
So how does life change? Assuming that within the next 3 months you will get all of your regulatory clearances in place, how does life then change when the clock starts ticking from then on?
See, we are already preparing ourselves for faster growth. So as and when it falls in and the money comes in, the next is the growth. How do we speed up or how do we plan our growth? Already it has been planned, but then the acceleration starts and the
So that's what I'm trying to understand. What if you're assuming you're in 3rd gear today and you're going to the 5th gear, what changes between now and then?
See, change is once you go into 4th gear, what happens when you drive the vehicle?
Yeah.
Then you are able to see the visibility much better. And you are able to maintain your speed and control in much better way. So you are in total control of what you are doing. So that's how I think moving from third gear to fourth gear will give us that kind of a comfort, smooth ride, and that will definitely be helpful to everyone.
They've got 2 board seats. What else changes on account of this deal from a governance perspective?
The best practices, what the MUFG Bank has says definitely will come in. Apart from their expertise, their knowledge, that definitely get added. And probably our people also would be able to visit some of their some of the companies where they invested and try to see what they have done differently or unique. We would like to be a unique player. We don't definitely want to copy things, but that learning will help us to improve our management and efficiency. Ultimately, efficiency improvement is a productivity gain, and that will result in your better credit cost. That will result in better ROA and ROE.
So, you talked about how this is in a way a vote of confidence for the India growth story. It's a vote of confidence for the Indian financial sector. What do you make of the list of deals that have been inked this year? As I said, both strategic as well as financial, a whole bunch of deals getting inked in the banking sector, but also in the NBFC space. Yours, of course, the largest FDI into the sector, at least up until now. What do you make of this?
So
and does this change the competitive intensity of the business as well?
So what I understand is, India being now the engine of growth, among one of the largest economy engine of growth, a lot of interest is there in India. So when I talk to people, meet people, I see a lot of positive things about India, which was not the case maybe some years back. So with that kind of a focus, interest, everyone want to have play in India, that really helps. So if you look at the India's growth story, the infrastructure is in place, logistics cost is coming down, manufacturing is improving, export is likely to have a much better impact because of all those things. And if there are the retail growth, which probably gives much better margins in the play. Any lending business, retail play gives a better margin. More people will be interested in coming to that. That's what I believe people are looking at right now. But these are all the positive trend. If at all you have, because if you, India government has talked about Viksit Bharat 2047 and a continuous growth of around 8%, reaching a 30 to 40 trillion. If that is the plan, and we as a responsible corporate, we also need to join this. I think that's where we believe there is a strong growth opportunity. And we should be able to attract much better capital coming into India. That's what's happening.
Well, you talked about all of the opportunities and, of course, the tailwinds for the business, so to speak. Any headwinds that you're concerned about today?
I don't really see a headwinds for India's growth story and definitely for us. There may be a few things which may have to improve for to reach this to the masses is the rural infrastructure. I feel the rural infrastructure is still need to be addressed, because more job you create in the rural area, that is going to really increase your consumption. Because nearly 65% of the population depending on agri, which is only 15% of the GDP, that is a huge burden on agri sector. So if you're able to create more job out of the rural area, move to, that's where I believe the lending to SMEs or self-employed people more and more in the rural area is going to help the rural consumption, rural entrepreneurship, and for that, maybe infrastructure, rural infrastructure is very important. I think that's where I feel the infrastructure bottleneck are there, which I believe government will look into it, and both central and state will address that.
So let me end by asking you, would it be fair then to assume on the back of what you've told us that perhaps the first area of synergy would really be on digitization and more digital expansion? Is that what you're going to be leaning on as far as MUFG is concerned?
Yes, digital play definitely yes, but our basic business model is a customer. We will never onboard customer remotely. We would like to build a relationship with our customer. So even when we strengthen our digital play, our customer interaction or customer meet will never stop. So we'll definitely be building a bigger infrastructure to reach the customer, adding more number of people. So
how many people were you planning to add? And on the back of this, how many people will you now add?
I think we may add around 5,000 people per year on an average for next 4 to 5 years to keep up the growth.
And any geographies in particular where you would like to accelerate your presence?
See, we have an excellent presence in South and West. North, Central and East is a little lesser. Maybe we'll be able to create a bigger reach there and grow faster there.
Okay, so let me end by asking you if investors are looking for a snapshot of the key numbers that you're going to be looking out for and the numbers that you're going to be targeting, lay out for us what that snapshot over the next 5 years is going to look like.
See, basically, I can tell you, a snapshot means a 20% on the top line growth, ROA growth from 2.8 to around 3.5, ROE coming down a little because of the higher net worth and going up over the period next 5-6 years back to where we are. And that is what a broad snapshot I can give you.
Well, confident on growth and confident on the future now with this significant deal behind you, which has taken almost a year in the making. What's been the biggest challenge of getting this deal done?
See, I have been discussing with multiple investors or multiple organizations in the last 1.5 years because we were reaching 20% of capital adequacy, we were looking at the next 5 years or 10 years. And when I was looking at, I thought if I get a big international partner, I can look for 100 years. So when I say 100 years, a good partner like MUFG Bank, who if they are interested in India, then I can definitely think of a much larger story. So that's how I looked at. So 20% is a huge support, and that gives me a long runway.
Well, we wish you the very best of luck as you start this new journey with MUFG Bank as your partner, and look forward to hearing more from you on the opportunities that you see on the road ahead. Mr. Revankar, many thanks for joining us here on CNBC TV18. It's been an absolute pleasure. Well, that is the big newsmaker and the big deal of the week. From all of us here on The Record, thanks very much for watching. Stay tuned to CNBC TV18. We'll be back in a moment with plenty more.
Hello and welcome to News Center. I'm Parikshit Luthra. Days after the killing of Sharif Usman bin Hadi, a popular youth leader and a vehement India critic, triggered a spate of violence and arson in Bangladesh, the situation in the country remains grim. Hadi, a prominent figure in last year's July uprising that led to the downfall of the Sheikh Hasina regime after a 15-year rule, was shot in broad daylight in Dhaka on December 12th. He was eventually airlifted to Singapore, where he succumbed to his injuries a week later. A sea of mourners bid him a hero's farewell. His coffin was draped in the national flag, while the perpetrators of the attack still remain at large. Hadi's death had a cascading effect. Protesters went on a rampage across cities, targeting politicians, newspaper offices and government institutions. Bangladesh's Islamist groups alleged that the assailants had escaped to India. There were protests outside the India Visa Centre in Chittagong. The Indian government has since suspended visa operations in Bangladesh. In a counter-move, the Yunus government curtailed visa services in India. The lynching of a Hindu man in Bangladesh over alleged blasphemy have muddied India and Bangladesh ties even further. Hundreds of people assembled outside the Bangladesh missions in Dhaka, in Delhi and Kolkata to protest against the brutal killing. Amid this unrest, Bangladesh is bracing for the homecoming of Bangladesh Nationalist Party's de facto chief Tariq Rahman, the elder son of former Prime Minister Khalida Zia. Rahman, who is in all probability going to be the party's PM face in the upcoming election. He had left Bangladesh in 2008 and is settled in London. And accused in a slew of cases, including corruption and graft, Tariq Rahman was arrested by a military-backed caretaker government in 2007 and has spent 18 months in jail before leaving the country. Most of the cases against him have since been quashed. Let me now go across to our guest this evening. K.C. Singh, former Indian ambassador, is joining us. Ambassador Singh, thank you very much for joining us. How would you describe the current state of ties between India and Bangladesh? Is it set to worsen in the next few weeks? We've not seen the kind of protests we're seeing outside the Bangladesh High Commission in Delhi and the kind of anti-India protests we've seen in Bangladesh.
Well, I think India has shown restraint so far, and I think what BHP did outside the Bangladesh High Commission could be avoided. Because what is the message we are sending? Tomorrow, if a Muslim is lynched in India, would you have Bangladeshis, Pakistanis, entire Islamic world protest outside Indian embassies? That has not happened. He was not an Indian national, to the best of my knowledge. You can call in the High Commissioner, you can convey this thing, but BHP turning it into a public issue and creating chaos, you are playing into the hands of the Bangladeshis. That's exactly what they are wanting. They are doing it, and we start doing it, and they justify it, and they have by stopping the visa services. The situation is not likely to get any better because Sheikh Hasina is in India. We are not about to hand her over. She's been sentenced to death. Elections are supposed to be in February, but Awami League may not be allowed to contest. So it'll be something that Sheikh Hasina did because the election that she had, BNP, that is Khalida Zia's party, had boycotted it. She still held the election. Now, here is a lesson for us. You see, when we sit contented in Delhi, thinking we have an ally who can keep doing what he or she wants in a neighboring country, as long as a counterterrorism, going after the extreme right suits us, then you play in, then when that person is overthrown, and it's happened time and again to Americans, it happened in Iran. If you keep backing a regime and then that regime is overthrown by popular protests, then you will pay the political consequences. And that is what is happening today. So India is waiting it out. That's the only card that we can play at the moment. But at the same time, there is pressure that you can exert because jobs haven't come back. Bangladesh economy is hurt by the US duties, and garment export was one of their major exports. Jobs have not been available. So there's economic chaos.
Ambassador K.C. Singh, when it comes to the general election in February, Mohammad Yunus has said that he is committed to ensuring free and fair elections on the 12th of February 2026 in Bangladesh. What's the state of play? Who do you think is the dominant power ahead of this February election?
See, the lesson that we learn after Arab Spring in Islamic countries is, like in Egypt, when you overthrow an autocrat, then it is the right wing that always always better organized, which survives better the autocrats' persecution. And that is why Jamaat-e-Islami, with the support of Pakistan, has been asserting itself. That is the one which is feeding. Probably when the students' protests were there, it was there from pushing it from behind the scenes. But the students did form a separate party, National Citizens Party, NCP. Now, we don't know if it's going to be a three-way fight. Awami League won't be in it. But you have the party, the BNP, and you have Jamaat-e-Islami, and you have the NCP, the Students' Party. Now, students, how much popular support they have will get tested unless they do an alliance with Jamaat-e-Islami or with one of the other parties or maybe with BNP. So we are seeing a new reorientation of political parties in Bangladesh. But out of them, well, BNP will probably be better for us than Jamaat-e-Islami. But they have had an alliance with Jamaat-e-Islami in the past. So it's possible after the election, they again enter into an alliance. And Pakistan is just happily watching it, trying to roll the script back and make history we've forgotten in Bangladesh that India got them liberated in 1971.
Right. Do you feel India is now losing ground in Bangladesh? Are these signs that we're picking up from the ground good for India's neighborhood ties? Can India do anything? Do we have certain options to salvage the situation, keeping in mind the close linkages we have with Bangladesh, both politically and economically?
Look, at the moment, I think we're just sitting back and watching. We'll have to wait and see what kind of an election is held, because Muhammad Yunus has not shown that he is fully in charge or he's calling the shots. And being an interim government, he couldn't really make any policy changes or reach out. In the meanwhile, you had President Trump come in. You've got those other challenges for the Bangladeshi economy. Chinese would be watching very closely. So we have to wait until an election is held. And hopefully some kind of a stable government emerges. If it doesn't, there's always the military, which has played a role in Bangladesh before. You don't want the military to come in again. But whoever is in charge, then we talk to that government, because that government can claim a mandate. The current interim government doesn't have a mandate. It's only a transitional arrangement.
All right. And if I were to speak about certain external factors at play in Bangladesh, while India would want to continue having a very strong stake in peaceful relations with Bangladesh, you've got US, which has interest there. You've got China. You've got Pakistan. Do you think any of these three external forces are somehow having an influence on the current developments?
See, considering Pakistan drawing closer to US, we don't know what is the US game. They played that game before 1971. And with President Trump, you don't know. He may be quite happy to go along with Pakistan if they say, look, they'll open the economy, they'll let your companies come in, we'll keep the Chinese, in one corner. What is the game that emerges? We don't know. The American game is now so uncertain and so unpredictable. I think we have to play our own game. I don't think we can count on anyone in the neighborhood and see how we can safeguard, bring stability, and make sure the next government does not adopt an anti-India posture or start giving shelter to terrorists or militants or militant Islam, because it's got such a long boundary with India and with sensitive states. We've got elections coming up in Assam. And there, the way BJP has its politics, Bangladesh is used as a word for garnering votes and bringing people together. Unfortunately, the more you do that, the worse it gets for Bangladesh-India relations.
All right. Thank you very much, Ambassador K.C. Singh, for joining us to speak about the difficulties in ties between India and Bangladesh right now. And as you said, India will just be waiting and watching till a new government comes into place in Bangladesh in February, and we would like to take it from there. Time for a short break here on News Center, but don't go anywhere. We put the spotlight on the India-US trade deal talks. On the other side, we will be speaking to Ajay Sahai of FIO and Arpita Mukherjee of ICRIER on the other side. Welcome back to News Center. It's been nearly 4 months since the United States imposed 50% tariffs on India. Uncertainty over a bilateral trade deal remains, with negotiations underway in full swing. India's exports to US remained largely resilient in November, rising 22% year-on-year. Near-term demand has held up, but exporters and trade bodies warn that rising costs are increasingly being absorbed by both Indian suppliers and global buyers, and this may not be sustainable over the medium term. Concerns about the road ahead are already visible. Diamond workers in Surat are feeling the brunt of tariffs, with estimates suggesting more than 1.5 lakh jobs lost since the levies were imposed. Many are also working at sharply reduced incomes. To cushion the impact, the Indian government is pushing for diversification of exports, stepping up trade negotiations with other countries. The challenge now will be to sustain the export momentum. Joining us right now is Ajay Sahai, Director General of Federation of Indian Export Organizations, and Arpita Mukherjee, Professor at the Indian Council for Research on International Economic Relations. Thank you very much for joining us on the program today. Professor Mukherjee, if I had to ask you about the impact on Indian exports January onwards, January 2026 onwards, so far we may be resilient because before the 50% tariffs came into effect, there was some amount of front loading as well. Many of the exporters had planned well in advance and they got their shipments in. Having said that, what kind of a brunt do you foresee in case we don't have a trade deal in a January to March period?
See, we are in a difficult situation now because we are facing one of the highest tariffs with the largest market that we have. Having said that, part of this tariff is cushioned on both sides, as you rightly pointed out, because there are certain products where other competing countries also have a high tariff. What we really need to do is to reduce the logistic and other cost of transportation. So that's one point. Second point is that, some of our competitors are really facing low tariff, and that's cause for concern. We are also trying to diversify exports by signing trade deals. We did it with Oman, we did it with UAE, and if we are able to get the European Union deal through by January, things may be much better than what we stand today. So two things we need to note in January. One is the US court cases, which itself may rule in favor or not in favor of the tariff imposed. Secondly, there is a likelihood that India may and EU may announce a trade deal. And a European Union trade deal, this particular product category, can be really beneficial for India to kind of diversify export. Having said that, exporters may need some incentives.
All right. Let me get in a word from the DG of FIO, Mr. Ajay Sahai. Mr. Sahai, you've had so many consultations with the Ministry of Commerce, with the Commerce Secretary as well. Has there been any kind of assurance on a timeline, on some sort of timeline that they're looking at within which a trade deal would be signed with the United States? Are you expecting some good news, maybe in the last week of December, first week of January?
I think it's nothing which is left to the negotiator. Probably a political call has to be taken by the US president, and therefore it can happen any day. It may be slightly delayed also. But from the exporter perspective, I think we have to see that deal is in place before the next season starts. So at best, exporter will be able to continue with this kind of export number probably up to March, because in the new season, if the tariff remains in place, buyers will move to the next supplier. As of now, a lot of companies are not moving through it because you have a social audit also by the major companies. And companies are also hoping that since this is a temporary phenomenon, let us somehow maintain our good relation with the buyer. And once the DTA is in place, whatever little loss the industry is having, they will be able to recover it.
Right. Mrs. Sai, as our colleague Santya Gora was reporting from the Surat diamond industry, where more than 1.5 lakh jobs have been lost since the tariffs were imposed. I'm sure there are other labor-intensive sectors which are also facing the brunt. Could you give us a sense that on ground, what's been the impact so far on jobs? And when you speak about the next season, by which quarter or which month of 2026 do you expect things to start getting impacted negatively in the absence of a trade deal?
In fact, in some of the segment, for example, we thought that marine will be the worst hit sector, but luckily for us, marine has diversified into the new market of China, Russia, and Europe, and their export numbers are pretty impressive. In the diamond segment also, of late, some concession has flown, and if we look into the number for the gems and jewelry export, they are pretty good. Please bear in mind that a lot of exports to many of the countries in South America and North America was happening through the US. US was importing, and from there the distributor was sending the consignment to the rest of the world. Now we are directly exporting that, and therefore the number to these countries have moved up. But of course, I do agree in some of the labor-intensive sectors, there will be challenge. Some of the industry has moved to the domestic market also. I don't have the exact number, what is the impact on the ground on some of the micro and small sector, but government is doing its best. The Reserve Bank of India has also extended some kind of support to the export. We are hoping the deal to be through very quickly. And as I told, I expect the deal to be there by January, February, because when we talk to the exporter, they say that they are somehow managing with the existing order. The order for the new season, which will be commencing from April onwards, have been put on hold. And if the duty issue is not settled, probably these orders may go to some other countries.
Right. Let me also get in Professor Mukherjee once again. Professor Mukherjee, when we speak about the initial deal that we're looking at for the United States, it's going to be a goods deal primarily. We have, according to various reports, there is no official confirmation from the government, but it seems that both sides are veering towards an average tariff rate of 15 to 20%. At that rate, how competitive will we be to other geographies in South Asia? And that is not the only aspect. After that, you'll have deliberations on more non-tariff barriers. You'll have deliberations on services trade as well. You would like to have a broader trade pact in place and some sort of legal footing as well. So there will continue to be hiccups even if we get this early trade win with the US in the range of 15 to 20%. What do you think we will need to do in the year 2026 to protect ourselves against this US-led volatility in trade talks?
See, one of the things you need to understand is that the 15 to 20% gives us quite good competitive edge in the US market. So basically, whoever they are giving that 15% tariff lines, whether it is Japan or any other country. Now, the problem is not that. To get that 15%, we have to give 0% in many areas of imports, which are very sensitive for us. Let's say if we have to open up the dairy market, that's really sensitive. We haven't done that for even New Zealand. So therefore, you need to think that how open are the Indian domestic industry to agree to open up sensitive sectors. So that is the first hurdle that the trade negotiation is facing. The second hurdle that the trade negotiation is facing is that suddenly the US has changed its position. US with Indonesia has a position where they said, okay, sign on digital trade, sign on, defense with Japan. Now, here we don't know how surrogate is the deal with Japan, defense and other things, but digital trade is something which India would like to sign with US. Visa is something that India would like to do with US, and that can be a part of the initial package. That was the initial feeling in India. Only tariff deal has a big problem that we also have a large domestic market where there is a lot of sensitivity to zero tariff. I think that getting at 15%, if you get 15%, it's a good deal. Like you are getting the deal as anybody else has received it. So the deal is not bad, but the bigger issue is that what are you going to give for that deal? And I think that's the problem at this negotiating stage. US at this stage
All right.
is negotiating non-tariff barriers with any of its trade partner. That's the second point.
All right. Yes, and those negotiations will possibly begin the second or third phase of the trade talks next year. Let me also get in Mr. Ajay Sahai once again. Mr. Sahai, when it comes to improving the competitiveness of exports, beyond this trade negotiation with the US, we are at an advanced stage of negotiations with the European Union, and possibly by 26th of January, when Ursula von der Leyen, the EU Commission President, arrives in India, we'll possibly see a signing of the EU-India deal as well. Having said that, what more do we need to do in order to ensure that our export growth story continues on a sustained path as well? Because it seems that irrespective of the outcome of the trade talks with the US, you cannot count on the Trump administration. They may throw up some other tariff tomorrow.
No, you're absolutely right. And if you look into India, we have gone for a very aggressive FTA strategy. This year alone, we have formed up the 3 FTA, one with, of course, with UK, and then with Oman, and then with New Zealand. And I'm pretty sure the EU FTA should also be finalized by January. And once that happens, probably we are getting a market as big as the US, and for some of the labor-intensive sector, this may be an equally important market. But of course, I will not say that it should come at the cost of the US. US is an extremely important market for us. Probably the profit margins are also better. I feel that when it comes to the technology and intellectual property right related sectors of exports, we will continue to do very well. The challenge is more on the labor-intensive sectors of export. And besides tariff, I think we need to work on the skilling part of our worker. That is extremely important, both for improving the quality and consistency of the product. That needs to be looked into. Right. The logistics cost, in any case, is getting addressed, and to some extent, we have improved on the logistics, and probably in the times to come, we will see much action happening also. Luckily for us, the Red Sea route has now become operational, which has reduced the transit time also and the cost. So these factors are positive, but of course, the world is moving towards protectionism and weaponization of trade. We have to probably live with these kinds of challenges.
All right. And Professor Mukherjee, final question to you. Are you expecting certain measures to be announced in the union budget? Do you feel that there could be some measures which on a long-term basis could support our export story?
Yes, definitely. I hope that there are some long-term measures announced, and more in terms of the trade facilitation, which Mr. Shah has already pointed out. Certain things are happening already in India, but probably we need cross-border trade facilitation agreements to happen, cross-border trade to become paperless. Lesser documentation, lesser time frame will actually help our trade partners both on the from the import perspective and export perspective. So one is that trade facilitation measures and going paperless should be something that should be announced in the budget. Secondly is probably some kind of incentives, and a backup plan has already been there. The BharatNet and other information sharing platforms are happening. How do you diversify a market? There has to be a market diversification strategy and a risk mitigation strategy. So there may be some measures to that effect, and there may be some changes in the foreign trade policy, because the foreign trade policy is quite ongoing, and how does it support the MSMEs? Some measures to support the MSMEs would be, well taken. It will give them a lot of mental comfort to try out new markets. That's the bigger issue.
All right.
They can't try it out.
All right. Thank you very much, Professor Mukherjee, and Mr. Ajay Sahai, for joining us for a very important discussion.